nearly 2% across their combined workforce. Now, if this had happened a few years ago, you'd probably just assume that business had slowed down, but that is not at all what's happened. These banks are still growing, they're opening branches, expanding loan books, adding customers, and even continuing to hire, and yet the headcount has fallen. Let's start with HDFC Bank, which has reported its first ever decline in headcount in nearly a decade, and it saw its workforce fall by 3,343 employees in FY26. Now, if you look at the comments in the annual report, the bank says technology is helping it automate the routine work and allowing it to move employees from the back-end jobs into more customer-facing roles. Second, Kotak Mahindra Bank, they saw the workforce also decline by 1,269 employees to about 74,000 in FY26. And here's the most interesting part. In the same year, Kotak Bank hired more than 28,840 odd people, which is up 42% from the previous year, and yet the overall net number is lower. Now, Kotak says hiring is increasingly now getting focused on AI, cloud, and engineering talent, while process simplification and technology adoption is changing its workforce requirements. Finally, Axis Bank reporting a second consecutive year of lower headcount. The workforce has fallen by 3,116 employees, or 3% of its workforce in FY26, which is a much sharper fall than we saw in FY25. Yet, the bank added nearly 400 branches in the year. It hired more than 31,000 employees. So you get the gist. The reason is not identical across these banks, but the clear link is technology adoption, routine processes becoming more automated, and hiring becoming more specialized. So gone are the days where banks would expand their workforce as business expanded. Technology is now changing how work gets done, and that's beginning to show up in the hiring numbers.
All right, Ritu, many thanks for joining us. Now, the Delhi High Court has ordered SpiceJet to pay 50 crore rupees to former promoter Kalanthi Maran's Carl Airways within the next 45 days. The court had previously directed SpiceJet to pay 144 crore rupees to Maran. SpiceJet proposed payment of 50 crore rupees in 45 days and the remaining 94 crore rupees in another 45 days. But the High Court held that SpiceJet needs to show bona fides. It will hear the matter again after the initial payment of 50 crore rupees is made in the next 45 days. SpiceJet had ordered a property in Gurugram for the dues, which was rejected. Now, the Supreme Court has appointed former Apex Court Judge Justice L. Nageshwaran Rao as the mediator in the long-running inheritance dispute between industrialist Baba Kalyani and his sister Sugandha Hiramat.
Hello, good morning. You've tuned into Power Breakfast on CNBC TV 18. I'm Vinny Motiwala. With me is my colleague Rachna as well. Rachna, a very good morning, and let's get started with the top headlines.
Good morning, Vinny. Let's start with the headlines. Tensions around the Strait of Hormuz flare up. US launches fresh attacks on Iran following US president's threats. Iran retaliates by attacking US military bases in neighboring regions. Meanwhile, both US and Iran claim guardian of the Hormuz Strait status.
Stocks on Wall Street close lower as Iran tensions dampen investor risk appetite. Nasdaq loses more than 1.5%. Markets in Asia-Pacific region opened largely in the red. The GIFT Nifty is indicating a gap-down start for the Indian market.
Brent crude surges past the $85 a barrel mark after President Donald Trump reinstated a blockade on Iranian vessels transiting the Strait of Hormuz. Meanwhile, gold prices hold just below $4,000 an ounce.
Inflation accelerates to its highest level in 18 months. CPI in June reaches 4% after a sharp rise in food prices. Economists remain divided on a potential rate hike by the RBI. Also, watch out for the WPI data releasing later today. June WPI inflation is seen at 9.38 versus 9.68% in May.
HCL Tech beats muted estimates in Q1. Constant currency revenue shrinks 0.5% compared to expectations of a 1% contraction. Headcount declines by close to 3,300, the highest in the last 2 years. Let's take a look at the Asian markets. Let's start with Korea. The Kospi is attempting to find its feet after Monday's near 9% crash. In Taiwan as well, you can see the markets have opened about 2% down, 1.8%, and Hang Seng also 1.11%. But in Korea, it was SK Hynix's worst session on record, and Thursday is the big one for the market because the Bank of Korea is all but certain to hike rates for the first time in over 3 years, with inflation at a 2.5-year high. Japan is also a relative outperformer, down now about just a few points, but Nikkei holding marginally lower after we saw what happened yesterday, which was a 2% slide. Now, overnight also on Wall Street, it was red across the board. The Nasdaq tumbled 400 points, down 1.5%. The S&P lost nearly 1%, and the Dow slipped about 0.25%, cushioned by the energy. The trigger today is President Donald Trump reinstating the blockade on Iranian ports with 20% toll on Hormuz cargo. Brent surged close to 10%, and the WIX jumped 14%. But what does it mean back home? It sets up a cautious oil-driven session on weekly expiry day. So expect volatility going into the close. As you can see, Nifty implied open down almost about 200 points for today.
Okay, surely we'll keep an eye out on that. Do not forget, today is the Nifty weekly expiry as well. Yesterday also we did see a gap down start and we recovered. So today, is that going to be the case, or something we'll watch out for? But volatility is something maybe that is going to continue in the trading session. But on to those updates from West Asia, right? And what's coming, that the US is carrying out more attacks on Iran, as President Donald Trump formally notified Congress that hostilities had resumed, with American forces carrying out defensive strikes against targets within Iran beginning last week. Now, speaking to Fox News, he said that negotiators believed that they did struck a long-term peace deal with Iran after an 11-hour meeting on 12th of July. But Tehran broke it by introducing new demands. Trump also said that the US will be known from this point onwards forward as the guardian for the Hormuz Strait, adding that the US would be reimbursed at a rate of 20% on all cargo shipped through the Strait of Hormuz to cover the security costs. Let's also listen into what he had to say on this front.
But we had a deal. What nobody knows, we had a deal. It was a done deal. And then they broke it. They always break it. We've had 10 deals with these people. And so we're just going to hit them very hard. And we're going to keep the strait, and we'll probably run it. We'll become the guardian of the strait. Maybe we'll call it the guardian angel of the strait. Yeah. And we should be reimbursed for that. When we do that, we're going to be reimbursed because the other nations are very wealthy. They're on our side. And we can't be expected to do that for nothing, unlike we had for many years. You know, we guarded the strait for 50 years more, and we never got paid for it. They made all the money, and the United States was just, they wouldn't. It's amazing. We never made. We guarded it for nothing, and now we're going to guard it. We're going to get paid for guarding it. A lot of money.
We're controlling the straits. We're putting the blockade back, and it's a blockade not for anybody but Iran. In other words, anybody doing business with Iran can't go through. Everyone else will be able to go through. So it's a blockade. It's a very strong blockade. The blockade was probably more effective even than hitting them, but I think the combination is the thing that really does it.
But do you think a deal is still possible? Do you think they'll return to that?
Yeah, I think a deal is possible, sure, I do. Yeah, I want to be reimbursed because we're protecting a very rich portion of the world. We're spending money, and so what we've done is we are going to be reimbursed for protection.
Moving on the other side, Iran's foreign minister did not hold back, responding on X, sarcastically agreeing with President Donald Trump that whoever secures the strait deserves to be paid, before declaring Iran itself the strait's eternal guardian. Arakchi also called President's 20% figure excessive, but notably didn't rule out on Iran charging its own fee. On the Iranian side, furthermore, you had the state media reports retaliatory strikes on U.S. Military facilities across Jordan, Kuwait, Bahrain, as well as Oman, and claims that the Revolutionary Guard has shut the Strait of Hormuz entirely. Now, this even as U.S. Central Command insists that the strait remains open for the lawful transit.
All right. Thank you so much, Winnie, for that comprehensive update. But now let's get in Manisha Gupta for all the updates from the commodity space. Good morning, Manisha. All right, we'll get you an update from. All right, we'll just check if Manisha Gupta's line is connected. Manisha, can you hear us? And if you could take us through the update in the commodity space.
Well, thank you so much for that. Absolutely. The overnight gains have all been in case of the crude oil prices. 10% up in the matter of time. It's trading at a one-month high, and we are back above $84 a barrel with that. The ceasefire between the U.S. and Iran has all but collapsed. The U.S. and Iran have both of the countries released statements asserting control over Strait of Hormuz, with the U.S. also announcing that all other cargo will be subject to payment requirements at 20%. The calculation of that comes much, much higher. But that is not all. The U.S. president also has said that he is backing a Russian sanctions bill to penalize buyers of Russian oil and natural gas. So whether it is via Strait of Hormuz or the Russian oil, both of getting out of the market is what the markets are feeling the pinch from, and is the reason you've seen a 10% gain in crude oil prices in the overnight market. But with all of these concerns, the crude oil price is rising higher, the U.S. dollar index strengthening yet again. There is some pressure that you're seeing also in case of precious metal prices. So gold fell 3%, silver fell 4% in the overnight markets, and most of the base metal prices have declined as well, barring aluminum, because with Middle East cut off, the aluminum concerns are yet again coming back into the space. Having said that, it is going to be about the U.S. inflation data and the U.S. Fed Chair Kevin Warsh Congress testimony today is what the markets also will be taking cue from.
Okay, absolutely. Important cues that we'll watch out for in the world of commodities. Manisha, thank you so much for joining us as always and taking us through that update this morning. On that note, we're going to slip into a very short break. After the break, we'll come back, tell you how these cues are going to be impacting our Indian market, set you up for trade. Stay tuned in.
Welcome back. You're watching Power Breakfast on CNBC TV 18. In the U.S. market, stocks closed lower after the U.S. reimposed blockade on the Strait of Hormuz. Nasdaq was down more than 1% at close. CNBC's Kate Rooney gets us a wrap of all the action on Wall Street.
U.S. markets were down across the major indexes in Monday trading as President Trump says he is reimposing the blockade of the Iranian coast after the ceasefire fell apart. The Dow lost 138 points, the S&P 500 fell 60, and the tech-heavy Nasdaq dropped by 408 points. With the ceasefire now over, President Trump said on Monday he would reimpose a naval blockade of the Iranian coast and said the U.S. will impose fees of 20% on all cargo shipped through the Strait of Hormuz, declaring America the, quote, guardian of the major international shipping route. The Trump administration had previously rejected Iran's plan to charge a toll on ships passing through the strait, saying that would be illegal under international law. U.S. and international oil prices jumped about 9% after the president's statement. And a federal appeals court just revived more than 500 lawsuits against Kenvue, the maker of Tylenol. The suits allege that prenatal use of acetaminophen, the active ingredient in Tylenol, is linked to autism or ADHD. The appeals court said a lower court judge improperly excluded expert testimony from 3 doctors. Kenvue, meanwhile, argues no independent research has found a proven link between Tylenol and autism. That's what's happening here in the U.S. Back to you in Mumbai.
Thank you so much for that, Kate. But let's move on and also listen in to Mohammad Al-Arian, Chief Economic Advisor at Allianz, on the recent West Asia flare-up and the impacts on the market.
It is having some spillover effect, but they're very contained. I think there's 2 reasons for this. One is the markets deeply believe that these skirmishes are going to just remain skirmishes. It's not going to evolve into outright conflict yet again. It's not going to evolve into a long-term closure of the strait. And then the second issue is there's so much else to focus on. And most of what else you have to focus on is positive. So you put these 2 things together and the market says, okay, I am going to reflect this in Brent going to high 70s, but I'm not going to take it to high 80s or 90s, which is where it would be if you believe that this is going to be much bigger than what it is.
Do you think that's the right call?
I do. I think it will be contained. I think neither side want to go back to a full conflict. But both sides want to make their point for domestic reasons.
All right, that was Mohammed Al Arian. But now, how will the overnight cues impact our Indian market? We have our research team joining in with how the trade setup looks like and the stocks that are likely to be in news today. First up is Upasna, who will list out the stocks to watch for in today's trade. Good morning, Upasna.
Good morning, Rachna. First up, let me start with Grasim, certainly the stock of the day, as Aditya Birla Renewables to buy Spring Energy at an enterprise value of nearly about $1.8 billion. Mind you that this deal is amongst the India's largest renewable energy acquisition by value and scale. Next up is HCL Tech on the back of its Q1 numbers. CC revenue is down about 0.5% versus estimates of a decline of 1%. EBITDA margins saw an uptick of 40 basis points sequentially and stood at 16.9%, while the street was working with 16.8, so largely in line on that front as well. And the company has maintained its FY27 revenue guidance range, that is from 1 to 4%. Next up is ICICI Pro AMC. Overall, it's been a good quarter for the company. Net revenue is up about 1%. Revenue yields stood largely stable around 52 basis points, but the EBITDA has seen a dip of about 3%, and margins stood healthy at 72%. PAT has also seen an uptick of 26% sequentially. Nuvoco Vistas is the other one on our radar on the back of its Q1 results. Overall, it's been a good result for the company. Volume growth stood at 5%, revenue saw an uptick of 9%, and operating margins largely stable at 18.2%. Emcure Pharma will also be in focus as company plans to acquire the remaining 12% stake worth 232 crore in Geneva Biopharmaceuticals. And lastly, coming to BEL, it bags orders worth 572 crores since June 22. And lastly, coming to NHPC, 2 units, that is 170 megawatt each of the company's power station in Sikkim have resumed operations. So certainly even that will be on our radar today.
Okay, Upasna, thank you so much for that. Important stocks to watch out for, but important cues in the world of F&O. Let's go across to Sudarshan to take us through that. Good morning, Sudarshan, and today is a weekly expiry as well, global volatility. What are we keeping an eye out on?
Good morning, Vinny. So it's fight for the role of a guardian for Strait of Hormuz. Let's see who takes the role of guardian for market and support today's market, because as of now, GIFT Nifty is indicating a sharp downtick of almost 200 points. As far as the cues are concerned, 2 things that you have to keep an eye on. First, market cues and macro cues. Market cues, if you talk about FI's action, have largely been positive. But if your macro cues turn for worse, then even market cues will follow that. And that's the reason I'm saying this, because take a look at crude. Brent is now back at the level of $84 per barrel. It's at a 1-month high. Just 2 weeks ago, it was at $70. So from that level, it's up almost 10%. So that's indicating you how worse the macro cues have become. And after that, market cues will be following that. Talking about FIs, yesterday, both in the index futures and in the stock futures, they were sellers, but they have added long positions, reduced short positions. One positive part is that aggressive put writing has continued for second or third straight day. Yesterday also, if you take a look on the put side, the volume on the put strike rates of 24,050 and 24,000 were almost 4 to 5x of what we have seen on the call side in the range of 24,200 to 24,300. So market cues have been indicating you that on the bottom side, for now, 24,000 seems to be protected, but it's fully linked with how your macro cues go ahead. Now, on the upside, as Nifty tries to cross the level of 24,200, it gets into major supply zone. And for now, it's been unable to hit the level of around 24,300. Now, as far as the stocks are concerned, one stock remains in the band, that is Kings Technology. Keep an eye on Grasim because the company has gone ahead and acquired a company. So that stock will be in focus. Also, keep an eye on all the OMC names, aviation companies, and even HCL Tech. It was a mixed set of earnings, so we might see a downtick.
All right. Thank you, Sudarshan, for that update. You're right. Yesterday, the question was if the Strait is open. Today, the question is who is controlling it. So to get you all the market cues we need to watch for today, let's get Sonal in. Good morning, Sonal.
Good morning, Rachna. Well, the big story continues to be geopolitical risk, which is back on the table. US continued to strike on Iran, and they launched the 3rd consecutive night of strike against Iran. Crude prices have surged. Sudarshan was mentioning as well at a 1-month high, $85 per barrel, and that definitely is a pain point for India as an economy and as a market as well. US markets in the trade last night, they were lower. Nasdaq saw cuts of around 0.2% across the board. It was a red-looking screen. Fall was also led by some of these chip makers. So that is something that should be on your radar. Inflation data for the month of June is expected today. But ahead of all this, Treasury yields rose sharply at that 4.62% mark. Investors feared higher inflation in the US markets as well. Asian markets are largely lower because of these fresh escalations. GIFT Nifty is indicating a start for our own markets in the red as we speak. For India, inflation has become a worry because June headline inflation rose to 4.4%, which was driven by food prices, where the food inflation came at 5.3%.
Price hikes as well. This is above the RBI band of around 4%. So this is the highest that we've seen in around 17 to 18 months. For our own markets, yesterday we shrugged all the war worries because there was a smart recovery towards the end of the trading session. However, we closed absolutely flat, but recovery is something we cannot really ignore. IT stocks saw buying and Nifty held above the 24,200 mark. HCL Tech's results will be the other key factor because they were slightly better than estimates. Nifty yesterday found a support near 20 DEMA, which is placed at 24,029. Now the Nifty has support at 24,000 and resistance at 24,300. So these are two important levels on the Nifty as well. DIs continued their buying in yesterday's trading session, 2171 crore rupees. There was a sell figure from FIIs as well. Now, market could be in a consolidation mode, but broader moves could be driven by Q1 earnings. Of course, we've been analyzing that. Domestic inflation data that we saw today did not look so good, and global geopolitical headlines. So these are the three factors which could decide the market move.
Sure. Okay, Sonal, thank you so much for that important cues to watch out for the Indian market, especially coming in with earnings, inflation, as well as what happens on the geopolitical front. But on that note, we're going to sip into a very short break. After the break, we'll get to you how HCL Tech's Q1 numbers were. Stay tuned in. Welcome back to Power Breakfast on CNBC TV 18. Now, let's talk about earnings. And HCL Tech beat the muted estimates in Q1 FY27. Constant currency revenue that shrunk by 0.5% compared to expectations of 1% contraction, and headcount declines close to 3,300. It's the highest in the last 2 years. Let's go across to Rima to get an understanding on how the numbers were. Rima, with you.
Thanks so much for that. I think for me, two numbers stand out. One is advanced AI revenues. They've come in at $171 million. That is a 10.6% growth on a quarter-on-quarter basis, and year-on-year up 62%. Now, this is an acceleration compared to the prior quarter. In the last quarter, Q4, advanced AI revenues grew by 6.1% QOQ. This has picked up to a 10.6% quarter-on-quarter growth. It now is about 4.7% of the overall revenues. The second positive is the total deal wins at a record high at $4.5 billion. And this is an increase of about 24% quarter-on-quarter, 33% on a year-on-year basis. And even if you want to say, well, deal wins can be lumpy, look at the average over the last 4 quarters or the last 12 months. The TTM, last 12 months, deal wins are up 9%. So all in all, what you have is that the company has delivered on low expectations, in fact, even done better on the revenue front. The company's consolidated revenues have fallen by 0.5%, not as bad as the 1% the street was anticipating. EBIT margins up 40 basis points to 16.9%, despite taking in a restructuring cost. FY27 guidance has been maintained on revenues and margins. No cut in the top end of the guidance as was feared. So revenues for this year will stand between 1 to 4%, with margins at 17.5 to 18.5%.
All right, thanks Reema for that update. Now, consumer price index rose to an 18-month high last month, driven primarily by a spike in food prices. This is the first time that retail inflation breached the 4% mark in close to 1.5 years. Lata Venkatesh is here for more. Lata, highest in 18 months, but pretty much on expected lines, we're guessing.
Yes, the inflation number is higher than what the CNBC TV18 poll was. In fact, other polls on the street as well. 4.2 was the expectation. At 4.38, it is a little uglier than expected. And the pressure is coming from both fuel and food. Food inflation at 5.09 is clearly higher than what the street was prepared for. In fact, it is 5.32 if you take a composite number, the food inflation. That compares with 4.78 in May and our own poll of 5%. The other reason why the inflation number is higher is obviously fuel. Transport inflation has risen from about 1.7% to well over 4%. So clearly it's food and fuel. The overall number, however, for April, May and June together works out to 3.93%. Whereas the Reserve Bank's forecast was 4.2. Therefore, the expectation on the street is that in spite of the June number being higher than what the street was expecting, there will not be any change to the expectation from the Reserve Bank because it is undershooting their forecast. For August itself, economists we spoke to believe that there will be no move from the Reserve Bank, and that was also seen in the bond market. Bond yields did not move an inch after the inflation number was announced. So, in short, slightly higher than expected, but markets unmoved.
Okay. Anthropic now has rolled out rupee pricing for cloud AI services in India. Rachna is going to tell us more on this one. Rachna, over to you.
That's right. Anthropic has started rolling out rupee pricing for Claude in India. But now, why the special pricing? Because India is now Claude's second largest market after the United States, accounting for nearly 6% of global usage. Claude Pro will cost about 2,000 rupees a month on annual billing, while the max plan starts at 11,999 rupees. But here's the twist. Indian list prices are actually higher than comparable US prices, although the Indian prices include local taxes. So the difference isn't a like-for-like markup. And it's unlike OpenAI, which launched India pricing with UPI support last August. Anthropic hasn't enabled UPI yet, so users still need to use cards or App Store billing. This comes on the back of Anthropic's Bengaluru office and India head hired from Microsoft and enterprise tie-ups with Infosys and TCS. So India is clearly high up on Anthropic's priority list, and this is the latest move proving just that. We'll keep an eye out for more updates that come in from Anthropic, but a good time to be an Indian right now. But in comparison, it may differ in future.
Absolutely, Rachna. Thanks so much for that. But with that, we are absolutely out of time on this edition of Power Breakfast. Thank you so much for tuning in. Nifty implied opening still indicating a gap down start and a red start for the Indian markets. Don't go anywhere. Bazaar Morning Call is up next.
Every morning, the countdown begins for the markets with meticulous research and analysis designed to help you capitalize on the trading day. Beaming live from the CNBC TV 18 Motilal Oswal studio.
Good morning. Welcome to Bazaar Morning Call. We're coming to you live from the CNBC TV 18 Motilal Oswal studio. I'm Reema Tendulkar. With me are Mangalam and Nigel. It's a Tuesday morning, but it's going to be a thunderous day. There's so much news flow to track with crude and earnings and the way markets are behaving. Likely to behave today.
Yep. Good morning. So now it seems like maybe things are getting a little more annoying than one would have liked, because crude is now at 84. Up until late 70s, most of the experts were like, this is contained. And yesterday too, from a 180-point downtick, we saw a recovery on the frontline index. The question is whether that happens for the second time running or not, because now with higher crude, all the other problems that we faced earlier come back, that of FII selling. The only support perhaps is the fact that, Kospi is underperforming and the AI trade may seem to be, peaking out a little bit.
Well, I think best case scenario will be what we did yesterday, right? Exactly. We outperformed in yesterday's trading session, ended more or less flattish, while all the other Asian markets took a slam dunk. But today, you have woken up to news that crude oil prices are comfortably above that $80 per barrel mark, which is obviously a negative for our market. So we'll have to see how it goes. But Reema, let's get straight to the action.
Well, indeed, we've got two guardians and one straight. And the question is who controls it? And that's resulting in that 10% increase in crude prices overnight. It topped that $85 per barrel mark as we speak. It's at 84 as the US-Iran standoff continues to escalate. Lots happened in the last 24 hours. So let's begin with the post on Truth Social, where US President Donald Trump announced, and I'm quoting, "We are reinstating the Iranian blockade." It's named like that because they're only stopping Iran's ships or customers from entering or leaving. Only Iran. Let's just quickly listen in to the Trump bite.
But we had a deal. What nobody knows, we had a deal. It was a done deal. And then they broke it. They always break it. We've had 10 deals with these people. And so we're just going to hit them very hard. And we're going to keep the Strait, and we'll probably run it. We'll become the guardian of the Strait. Maybe we'll call it the guardian angel of the Strait. And we should be reimbursed for that. When we do that, we're going to be reimbursed because the other nations are very wealthy. They're on our side. And we can't be expected to do that for nothing, unlike we had for many years. We guarded the Strait for 50 years more, and we never got paid for it. They made all the money, and the United States was just, they wouldn't. It's amazing. We never made. We guarded it for nothing, and now we're going to guard it. We're going to get paid for guarding it. A lot of money.
Well, indeed, according to reports on one full supertanker, we're talking about $32 million for guarding one ship, because the amount that Trump is looking to charge is close to about 20%. The Iranian blockade on Iranian ports kicks in at 4 p.m. Eastern time today. And remember, the U.S. Central Command has launched a third straight night of strikes on Iran, so that also continues. But on that point about who will guard the Strait and will fees be collected, can you guard for free? It doesn't end there. Foreign Minister Abbas Araghchi took to X, calling Trump's 20% too much and adding, "We will be fair." Iran continues to insist it will remain the only guardian of Hormuz. Citi has warned that this shipping fee proposal materially raises the risk of further military escalation. That is the big worry point. The other big story is a surge in U.S. bond yields, hitting 4.62 levels on the back of the Middle East strain. And there are two important data points to track. One, the U.S. June CPI inflation data later expected today. And Fed Chair Kevin Warsh makes his first appearance before the Congress today and on Wednesday. And back home, India's own inflation CPI breached the 4% mark. This is the RBI's target for the first time in 18 months. It came in at a level of 4.38% for June. This is on the back of the recent fuel price hike. Expert economist that I spoke to yesterday also said that headline inflation could increase further because food prices may remain elevated on account of higher cereal prices and El Nino concerns. So that's the added concern this morning. Asia this morning is literally swinging between the red and the green line. It's swinging like a yo-yo ball. Right now, as we speak, Kospi is down nearly 2%. At one point of time, though, the Kospi had recovered and was up nearly 1%. The gift Nifty, all things considered, currently down close to about 200 points. And that point is taken, right? The crude price hike couldn't have, not hike, the surge in crude prices couldn't have come at a worse time because we got used to, markets were comfortable with that Brent crude coming down to 70, 75, and now it hit 80 and now closer to $85 per barrel. There's lots to track. The IPO, on the IPO front, the SBI Funds Management IPO opens today, closes on Thursday. It's a large issue. They're looking to mobilize 9,810 crore. The Biocon block, HCL Tech, and then we've got the weekly expiry as well. But Nigel, do you think that lower end 28,300 do we get closer to that with this weakness in the morning?
I think you meant 23,800, 24,000.
Yeah, sorry, 23,800. Yeah.
So we'll keep an eye out on that. The problem is that Trump has gone ahead and reinstituted a naval blockade on the strait, which has led to the sharp spike we've seen in crude oil prices. Remember, I was looking at the ship traffic through the Strait of Hormuz. That fell steeply on Sunday itself. And the Department of Energy said that close to 8.5 million barrels of oil were transited via the strait on Sunday. That is nearly 50% of what we saw a week or so ago. So there's already been an impact, and yesterday there would be a further impact. The data that I'm talking about is as of Sunday. Now, in yesterday's trading session, institutions turned sellers because you put the data points together. The FI is selling well, it outweighed what the DIs put in. And in the futures market, the FI is the unwound longs, both on the index as well as on stock futures, as you can see, and they have mildly added some shorts as well on stock futures. The put writing, though, that continued. And that's what's pushed the PCR all the way to around 1.43. That's closer to the upper end of the range, which comes in at around 1.6. But the good news is FIs continue to write puts as well. Even in yesterday's trading session, there was a good amount of puts. Close to around 41,000 contracts were written on the put side. Now, given that expiry, will play out, and that will make things very, very volatile in the second half of trade. But we'll keep an eye out on a couple of strikes. So let's get them up for you on the screen. The 24,350 call, that's the important mark. Good amount of open interest built up out there. And there was a mix of activity, some taking a bit of a punt in case we woke up to better cues this morning. So that premium around 20. But the aggressive writing was seen at around the 24,000 put. And I'll tell you what, the premium ended sub that 30-odd mark. But at the high of the day, it was close to around $100. So for today's session, yesterday's low becomes an important level to defend. Remember, yesterday's low, as well as the 20 DMA, well, they were very, very close to each other. That's the 20 DMA on an intraday basis. We broke the 20 DMA both on the Nifty as well as in the Nifty Bank, but we managed to claw back. So for today's trade, you're hoping that yesterday's low at least gets defended. In terms of the stock to watch, I'm going to be keeping an eye out on Biocon. This Mylan block has been in the works. We here at CNBC TV 18 had put out the alert first as well. So once this gets out of the way, we'll have to keep an eye out on this stock because it could be ripe for a big bounce, given that this was a bit of an overhang on the stock. I think the stock of the day could actually be Biocon in today's trading session.
Right, Nigel, thanks a lot for that. So that's a stock that we will be tracking, but let's get in some important global opinion. We do have our guest joining us, Ravi Batra. He is, joining in, who is obviously the Chair, National Advisory Council, South Asian Affairs. Thanks a lot, Mr. Batra, for joining in. Crude at 84, we're none the wiser after multiple months of this back and forth. And, it's impacting the Indian macros right now. For all that's taking place, do you think it is possible for one nation to claim stake over the Strait of Hormuz and at the same time impose a toll, so to say? And what happens from here on? What is it that we are expecting?
Well, you've asked a lot of questions, but first, let me just say to you that thank God we finally have leadership that's willing to act. You don't have to agree with President Trump for everything he does, but the fact is he must be credited with the fact that he takes action. There is nothing worse than someone having the ability to make a change or to make correction and then not use that ability. So the fact that the United States has that capacity, it's important to be able to use it. Otherwise, you end up with the red line in Syria like we had when President Obama drew the line and the line blew away. So the fact that President Trump has not given up, no matter the ups and downs that are going on a daily basis with Iran, is something to be applauded. One. Second, we cannot have another North Korea again. The entire world slept. The great powers slept. And North Korea is today a major entrenched power in the nuclear club. And that's not a good thing. It's a bad thing. And we have to deal with that accordingly. We certainly don't want that to happen with Iran when they're supporting the Houthis in Yemen. Even today, the Security Council had a session on it because even the funeral arrangements, as Tammy Bruce announced and shared with the Security Council today, that even the plane carrying the quote mourners to the funeral in Iran, they were actually bringing back supplies for further terror attacks. So we do need law and order, whether it's in a street outside my home or outside your home, or among nations. Even nations need to police their borders, international waters, et cetera, to make sure that freedom actually means something. If you don't police it, there is no freedom. Freedom doesn't come for free. You literally have to police it to make sure that your neighbor stays in their place, and so you can enjoy the freedoms on your own place. So what President Trump is doing with Iran is a very difficult thing because he's trying to get a country to give up its nuclear ambitions. And its nuclear ambitions of Iran are not so they can cut down on power usage or make the electricity cheaper. Their ambitions for nuclear power is to essentially overshadow their neighbors.
All right.
So that's what's going on. And with respect to your question, about for example, President Trump today mentioned that, there may be a 20% fee for all the expense the United States is, incurring just to maintain peace and security in that region. Now, that doesn't mean the customer has to pay. Iran basically has to simply agree to sell its oil in dollars so that it's through the SWIFT banking, which allows our sanctions to work, which allows there to be one set of books, not two sets of books, like a crooked business. So it'll be one set of books. It'll be sold in petrodollars. And as it's sold in petrodollars, then the levy is on Iran, not on the customer. So it's not really a charge. It's not a toll that the customer ought to pay or should pay. It's a toll that the supplier has to pay because they're the ones messing with the Straits of Hormuz. So the person who's creating the harm, the person that's creating the danger, that's the IRCG, and so that's Iranian, and so it's only fair that the seller of oil out of Iran should be the one carrying that cost primarily.
All right. Hi, good morning, Mr. Batra, and good to see you. When taking your points on board, from an equity market standpoint, what the market participants will want to know is, are we bracing for a longer drawn battle? Do you think that this is the re-escalation that was feared by equity markets, but you're finding a couple of positives that, you have a president in there, Mr. Trump, that's taking action. So do you think this is the restart of the war and we should be in for a prolonged war? Your take.
Well, again, Iran is a sui generis case because most countries pride themselves on their structure of governance, and their structure is a pyramid. On top, like for example, United States, even with separated powers, you've got the president of the United States as the head of the executive, and then you have a legislative head and you have a judicial head. But the executive is singular. In India, you have Prime Minister Modi, President Xi Jinping in China, or President Putin in Russia. So there is a hierarchical system. However, what Iran did since the 1979, American hostage crisis, and then the Iran-Contra affair, what Iran did is they intentionally compartmentalized governance. So there is, people say that there's 30 different pillars of governance within Iran, and each one is independent. They're vertical, and then they join at the top, so it's sort of a plateau. And especially when on February 28th of this year, when the war started, or the police action started, and most of the leadership was killed of that plateau, the problem, of course, is now who do you make a deal with? I am today of the view, personally, and this is my personal view, that since IRGC is the one that's creating the problems in the Strait of Hormuz, it is IRGC we should be talking to, and maybe talking less to the foreign minister of Iran, because the foreign minister of Iran does not control the IRGC. And since the Iranian governance model is unique to Iran and no other country has it, other than perhaps the United Nations General Assembly. Think of the Iran being run as if it was the General Assembly of the United Nations. It's very difficult to do anything that way. Very difficult to cut a deal that way. So I think it's IRGC that we got to deal with, because they're the ones throwing the mines in the water. They're the ones, sending out the missiles and the attack. So perhaps we need to do a switch and try making a deal with IRGC and let IRGC deal with everybody else in Iran. Because whatever we've tried so far, and everybody has, to try to come to some resolution, that is not working. So, I think President Trump may well take a look at IRGC and say, since you're the guys who are creating the internal bottleneck to the world and creating all this problem, maybe you're the one we need to cut a deal with. And we're going to, or else we're going to straighten you out, which is the only, peace and war is always a combination between, let's be nice or we're not nice. And it's always been nice if you can. And I think President Trump is the person who can bring people to the table, even those who are not willing or really want to make peace.
Interesting opinion. Thank you, Mr. Batra, for joining us this morning on CNBC TV 18.
Pleasure.
All right, let's tell our viewers the interactions lined up on the show today. 8:35, we've got Sandeep Agarwal of Suvilo Investment Managers to talk about HCL Tech's numbers, their data center foray, what it means for the industry. 9 a.m., we'll be joined by Keshav Lahoti of HDFC Securities to put the focus on consumer durables. 9:20, Sanjay Parekh of Soham Asset Managers will be the market master for the day. 9:35, we'll bring you a discussion around the power sector as Aditya Birla Group acquires Shell India's renewable arm. Following that, Amit Murarka of Axis Capital will be chatting with us at 9:50 to tell us what to expect from the metal earnings in Q1. And towards the end of the show, Lata will speak to the management of Bank of Maharashtra. Stay tuned.
Time to take a quick break. Got a lot of stock-specific action track for you. We'll get to that in just a bit in our special Top 10 segment. But here's the list. HCL Tech, ICICI Pru, Novoco, BEL, MQ Pharma, and Sigma Advanced Systems. They'll be reacting to positive news flow. On the flip side, Grasim, Biocon, non-coal miners, as well as, they'll be reacting to negative news flow, while crude sensitives should see a mixed start. We get in further detail on the other side of this short break.
Welcome back. You're watching us here on Bazaar Morning Call on CNBC TV 18. 180 points is what the GIFT Nifty is indicating as a lower start. Let's see whether we go ahead and see a recovery just the way we did yesterday. Now that cut has been lowered by about 15 points, 165 points. But a bunch of stocks on our radar this morning. And our team is always with us here on CNBC TV 18. Let's start with Nigel Grassim, the big acquisition that took place yesterday.
Well, that's right. Yesterday, out of nowhere, you had this big announcement that came in from the Aditya Birla Group. Now, Aditya Birla Renewables have acquired Solin Energia Power. Remember, Aditya Birla Renewables is the subsidiary of Grassim. So, Grassim will be the stock that you'll be looking at. The seller is Shell. In terms of the details. Further, in terms of the numerical details, the deal is done at an enterprise value of around 17,200 crores or thereabouts. And what about this asset that they've acquired? When Solin Energia Power has a cumulative contracted portfolio of around 5 gigawatt. Part of it is operational, part of that will get operationalized as well. The turnover that they've declared for the last few years is ballpark around 1,100 to around 1,250 crores or thereabouts. It's been in that range. What's the rationale they've given for it? Well, it gives them an opportunity to expand the renewable energy footprint. Also, Aditya Birla Renewable Energy's portfolio moves from around 4.4 gigawatt all the way to around 9.4 gigawatt because they're adding 5 gigawatt by this transaction. And they're saying in the years to come from around 9.4 gigawatt, they want to even double that and move to around 20 gigawatt. The debt in the books, you'll be worried about that. Standalone basis, it's around 6,800 crores. That's in Grassim. And on a consolidated basis, which will include the other entities, it's around 37,000 crores. However, they go on to state that the acquisition will be funded by a mix of debt, equity from Grassim, so we'll have to wait for clarity on that front. And there'll be investment coming in from Global Infra Partners. That is a wholly owned subsidiary of BlackRock. And they're already invested close to around 2,000 crores in Aditya Birla Renewable Energy with a green shoe option of close to around 1,000 crores or thereabouts. So the contribution coming in from Grassim, the contribution coming in from this entity as well, GIP, will be watched for here. And they're saying by the end of this year, this transaction will close out. Most brokerages believe that maybe, in fact, it's a little bit larger and they'll seek further clarity. We could see a knee-jerk reaction because of the size of the transaction. So expect Grassim to open up in the red for starters. But the other big stock of the day could be Biocon. Sudarshan has been reporting that the large trade was expected. And bang on, Sudarshan, it's been announced. Tell us more about this large trade that we are expecting.
Good morning, Nigel. So Nimesh has been highlighting about Biocon block deal for the last 2 weeks on his D-State chatter. And on Friday, we had announced that on Monday or Tuesday, Biocon may announce the block deals and in which Mylan is likely to sell its part or entire 5.64% stake for the value of around 3,500 crore. Now, yesterday book was launched, we understand from sources, floor price at a discount of almost 8% to yesterday's closing price. But if the block happens in the block window, we might see a recovery in the stock. Now, the question is how Mylan has got 5.64% stake in Biocon. So they used to hold stake in Biocon Biologics and early in 2026. So in January 2026, part of the deal, being part of the deal, Biocon had acquired Mylan's stake in Biocon Biologics through share swap and cash. So through share swap, they were given the allotment via preferential basis of more than 6% stake. And now, as of March, 5.6% stake that Mylan held, now they are going to sell its entire stake via block deals. And that is, in all probability, might happen in the block window.
All right, take that point. Might happen in the block window. So that's about Biocon. Rima, HCL Tech. The tech stocks have been bouncing back. HCL Tech results better than what the street was expecting.
Yeah, it was not a bad set of numbers. It was actually a decent set of numbers, and a couple of internals were positive. One, the company recorded highest deal wins at $2.4 billion, and this doesn't take into account that $1.1 billion deal that they announced in July. So the company is saying the pipeline is on the stronger side. Secondly is the AI revenue. The AI revenue is accelerating. It's gone up 62% on a year-on-year basis. It still constitutes only 4.7% of the overall revenue, but it's growing well. And thirdly, the company also announced a foray into data centers, and the street is viewing this positively because the company is making a play for the AI ecosystem. So they said that the initial investment will be for 3,500 crore rupees, and they will be building their own AI data stack. But eventually, they want to scale up that investment and have a capacity of 50 megawatts. On the numbers, as I said, not as bad as feared. Revenues did decline by 0.5%, but the street was working with a 1% decline. Margins went up by 40 basis points to 16.9%. The company has held on its guidance. So all in all, the print is fine. The internals are okay. The only thing to bear in mind is this is a stock which has rallied 14% in the month of July itself. Remember, after it won that large $1 billion net new deal, the stock was excited. And with this outperformance, it's also now trading at a premium to its peers. So HCL Tech would be at 16 times, while an Infosys or a TCS would be at 14, 15 times after yesterday's up move. So maybe the stock has run up quite a bit. So we'll have to see how this plays out. But purely on numbers, okay.
All right, let's go across to Divyani. She's here to tell us about ICICI Pru AMC. Divyani?
Well, ICICI Pru AMC came in with an inline set of numbers. Now, mark-to-market gains have added to the PAT this time around, and quarter-on-quarter performance was largely steady, with a slight drop that was seen in the market share in equity as well as the overall average AUM. Now, on a quarter-on-quarter perspective, let's look at the metrics. Now, mutual fund quarterly average AUM was up 1.1% to 11.17 lakh crores, while equity quarterly average AUM, that was up 1.7% to 6.3 lakh crores. Now, market share across both dipped slightly with about 10 basis points of moderation in overall, while 20 basis points in equity, and systematic flows have dipped to 4.5% on a quarter-on-quarter perspective. So that's a slight negative. But coming to the financials, net revenue came in at 1,440 crores, up 1% on a quarter-on-quarter perspective, with net revenue yields which were largely stable at 52 basis points. Now, ESOP costs have added to the employee costs this time around, which rose 44.5% on a quarter-on-quarter perspective. But keep in mind, Q4 was a low pace to begin with, and EBITDA as a result dropped 3% with margins healthy at 72%. This time around. Now, PAT was up 26% despite all of this as a result of the mark-to-market gains, which came in at 181 crores of other income versus a loss of 90 crores in Q4. So all in all, an inline set of numbers, and keep in mind the biggest overhang, which were the yield impact as a result of the expense ratio changes. Those don't seem to have been impacted. So all in all, an inline set of numbers, going with a green on ICICI Pru AMC in trade today.
Thanks a lot for that, Divyani. I'm going with green as well in Nuvoco Vistas. The reason I say that because the numbers look quite good. Let's run you through a few data points. The revenue growth was close to 9%, and consolidated volumes came in higher by around 5%, coming at around 5.3 million tons or thereabouts. Realizations, that was the positive aspect. On a sequential basis, they popped up by close to around 7% or thereabouts. The exposure to East India, that's helped, and a good contribution coming in from premium products as well. That's what could have led to realizations popping up by close to around 7%. So they've got the benefit of higher realizations. And, it looks like the negative with regard to higher input costs, that's not really played out. But the operating profit looks good. That as well has come up by close to around 10%. And on an EBITDA per ton basis, it looks like they're focusing even on the cost side as well as getting the benefit of higher realizations. And that's why on a sequential basis, this is the calculated number, EBITDA per ton popping up by around 80 to 90 rupees, which is encouraging. With regard to the structural growth trajectory, they say that the Vadraj cement plant as well as the east region expansion that they had planned, that's what's going to take capacity to around 35 million tons or thereabouts. So put everything together, decent volume growth, a good amount of realization spike up, and focus on cost side. The stock should react favorably, expected to open up in the green. We'll see how that goes. One of those underperformers from the cements pack, but starts off earnings on a positive note. Well, let's focus on another clutch of stocks. Sudarshan's tracking this very closely, actually. The non-coal miners and what's going on in Karnataka. Sudarshan, please go ahead.
So first, before I start and talk about this, let me say that this case is different from another cases between Karnataka government and central, and that case is still pending before President of India. Now, as far as this case is concerned, yesterday Supreme Court has rejected the plea, and that had challenged the mining rules requiring payment of royalty on royalty. Supreme Court holds that computation of royalty is constitutional and valid. So what was the plea? Kirloskar Ferrous had filed a plea challenging royalty computation, and that plea has got dismissed. They had said DMF, that is District Mineral Foundation, and NMET, that is National Mineral Exploration Trust, contributions are added to the sale value for royalty computation, and that plea Supreme Court has dismissed. So what's the impact? Who is going to benefit? State governments are going to benefit because they'll be the biggest beneficiaries of the royalty payouts by miners. As far as miners are concerned, Supreme Court decision dashes hopes for lower royalty payment, and also this decision reaffirms existing formula for computation of royalty. So can be mild negative for companies like Kirloskar Ferrous, NMDC and Vedanta.
That's right. Sentiment negative coming in there. If it went in their favor, it would be good. As Sudarshan Singh, for the time being, no relief coming in. So sentiment negative for these companies. Let's go across to Vinny. She's here to tell us about some other stocks in news. Vinny?
Hi, good morning. First up, let's talk about BEL. They've received additional 572 crore orders since the last time they made the disclosure in June. So additional orders coming in for the company. These are some orders that include EVM batteries, tank subsystems, components, upgrades, spares, services. All these are different orders that they've received, but 572 crores additional orders, so some bit of a green on the screen. We have MCure Pharma that could see some green as well after the company is buying out that remaining 12% stake that they have in a biotechnology subsidiary of the company already. So now this company, Genova Biopharmaceuticals, will become a wholly owned subsidiary. The transaction value for this additional 12% stake is around 231 crores. Let's move on to the next stock, and the last one for today is Sigma Advance. This is also a defense company. We're expecting green here. Why? The company has acquired a UK-based company which is called Bromford Precision Solutions. This is for 153 crore rupees. What will this do for Sigma Advances? It will strengthen its position in Rolls-Royce supply chain while complementing the UK division. So furthermore, growth and expansion on the UK-Europe side. Furthermore, the company plans to scale up the acquired company's capabilities in automation, selective transfer of components, manufacturing in India as well. So that will support the synergies in terms of growth for the company, and they're targeting an EBITDA margin improvement through capital investment as well as automation over the medium to long term.
Right, Vinny, thanks a lot for that. But no day goes without us looking at the crude prices, and Manisha joins in on crude sensitives once again. This time, Manisha, a 10% spike is what we've seen overnight.
Oh, well, absolutely. 10 to 11% of gains in the overnight market, with now the Brent trading above $84 a barrel. It's a one-month high that we're looking at in terms of the crude oil prices. The ceasefire between U.S. and Iran has all but collapsed totally, and there are various statements coming in from both the countries, with U.S.-Iran releasing statements asserting control over Strait of Hormuz. U.S. has reinstated blockade on Iran vessels transiting the Strait of Hormuz. It also has said that all other cargo will be subject to a payment requirement at 20% of the cargo, much higher than what Iran perhaps had initially initiated. Trump also has said that he's backing a Russian sanction bill to penalize buyers of Russian oil and natural gas. So not just the Strait of Hormuz and the Middle East oil supplies that I see are getting cut off yet again, but the Russian oil being sanctioned and buyers being penalized is something that also has added a lot of premium to the crude oil prices right now. The strength in US dollar index is yet another thing, and the markets do believe that we are perhaps going to be staying above $80 a barrel for the near foreseeable future. And most experts also believe that this U.S.-Iran peace resolution perhaps could drag on for another 6 to 8 to 12 months as well. So we are looking in for a choppy ride for the crude prices.
Thank you very much for that. Let's do a quick recap then of the top stocks. Stocks with positive news flow are HCL Tech, but we'll have to wait by to see the stock market reaction. ICICI Pru AMC, Nuvoco Vistas, BEL, MCure Pharma, Sigma Advanced Systems. Stocks with negative news flow are Grasim, Biocon, non-coal miners. Crude sensitives are likely to open mixed. Get into a break. On the other side, we'll connect with Sandeep Agarwal of Suvilo Investment Managers to discuss the IT sector earnings and the key trends so far. Welcome back. Let's talk about IDBI Bank, because what we understand from our sources is that government has green-lighted the strategic divestment in IDBI Bank. Sapna joins in with more from what she's picked up from her sources. Sapna.
Yeah, exactly. So this is a personal move after quite some time. Previously, the fact was that the bids that had come in were probably below the reserve price, and the government was in a bit of a rethink mode. But having said that, right at the top, government has been indicating that the IDBI stake sale is very much on, and keeping that as a perspective and as a background. So yesterday, 2 high-level meetings were held. The CDD, the core group of secretaries on disinvestment, and that's headed by the cabinet secretary. They met twice, alongside the IMG, which comprises of the actual administrative departments, that is DPERM, as well as financial services, TFS. They also met, and the fact that these are alongside back-to-back meetings, it definitely indicates that some decision has been taken on the IDBI stake sale. Most likely, the proposals will go for cabinet as well at the final stage. Probably a lot of internal stitching up and fresh approvals will be required. We don't really know the substance, the actual substance of the meetings, but the trend is totally positive. The direction is totally positive. And, this basically gives a big push to the IDBI stake sale, which has just been stuck for quite some time. So that's what it is as of now.
All right, so that's an important, development out there. The government and LIC will sell about 60.7% stake in IDBI Bank. The green light has been given. Let's welcome our fundamental guest then, Mayuresh Joshi, who's the Director of Research at MarketSmith India, joining in now. Mayuresh, IDBI Bank and the banking space in general, if the government was to look at a strategic divestment soon, this is something that has been in the works for as long as one can remember. If this were to happen, who do you think would be best suited, and what would it do to the system?
Morning, Mangalam. I think, yes, we waited long enough for this divestment to probably take place. And if this does go through very, very positively, I think it will give that intent, because the government has been trying to divest over the last couple of financial years in terms of its key strategic assets. But it does give the right signal to the market that the government is intentful in terms of divesting some of its assets. And therefore, I think that will be a very, that should be a very positive signal to the markets. That the other divestments that are probably in the pipeline might also probably see the light of the day. Therefore, I think if this does go through, I think this is going to be very, very positive as far as the divestment is concerned. And specifically, I think the FI approach towards India, because the divestments have largely not been happening. And if this does happen with regulatory concerns going on, I think the next steps that might happen is the next PSUs that might come in focus post-20.
Mayuresh, hi. Morning. We're seeing one of the largest renewable M&A deals in India yesterday, with the Aditya Birla Group buying Spring Energy from Shell for 17,200 crore rupees. It's nearly $2 billion. What's your assessment for Grasim? Nigel was telling us it could be mildly negative because it's a very large deal that they need to execute on. But will there be a rub-off impact on any other stocks? How will this impact the sector per se?
Morning, Rima. So yeah, I think that there should be some element of a negative connotation as far as Grasim is concerned, because that's a massive outlay that you're probably talking about. And therefore, from an immediate perspective, I think if the capital expenditure starts coming through, or the capex starts coming through, I think the cash flows will definitely get impacted. And therefore, on that note, I think it might just have that sentimental plus the impact in terms of operating cash flows if there is a significant outflow that probably goes through. For the sector as a whole, obviously, I think a large part of the move in terms of even the environmental guidelines that a lot of companies are probably adhering to, and a lot of the renewable thrust that the government is embarked upon, both from a green energy perspective as far as solar is concerned, wind, hydro, where the tariffs have also gone up quite significantly over the last few years. Obviously, is a step in the right direction and meeting global goals as well. Obviously, what this has done in terms of expectations of how the renewable space will probably play out, specifically solar. I think if more capacity additions keep on going through, I think the tariffs might start probably tapering off. More supply coming through from an immediate short to medium term perspective. So again, I think renewable hot space, but we need to be very, very selective. I mean, hydro within renewable might continue doing well, and therefore small hydro specifically within that. But yes, Grasim will feel that pinch because of the heavy capital outlay affecting its space.
Right. So that's about Grasim. Mayuresh, have you made some thoughts on HCL Tech's performance and its stock price movement, its first quarter numbers, all of that in context with the industry outlook? What does it look like?
Mangalam, I think even in the last quarter, I think HCL Tech had given a reasonable set of numbers in the large cap IT names. Again, the transformational deal that they probably won on the AI front with the Mercedes, that will probably aid them going forward. And the guidance that they probably kept, both in terms of revenue guidance and the EBIT margin, being a tad bit higher, in fact, substantially higher than what they probably reported in the quarter gone by. So I think that does give hope in terms of the sector as a whole about the kind of transformation that our IT companies are trying to probably make through. And some element of trust that is probably coming through in terms of AI deals that are probably being given to them. Even in TCS's case, I think the revenues have obviously gone higher. The order book, the TCVs are obviously moved higher. But yes, I think HCL Tech, good set of numbers, the commentary was good, and therefore they probably execute well, along with the more that we probably see in terms of some element of inorganic acquisition as far as the AI space is concerned. I think it is one of the better performers in the large cap space as far as we see it probably.
Sorry, just getting back to the point about renewable energy. We've got large players. Adani Green Energy, I think, will still remain the sector leader, though now Aditya Birla Group will come in perhaps second with this move. But you've got NTPC Green, then you've got a lot of EPC players. You go down, you've got a Suzlon, etc., Vari. Which stock would you bet on here?
So, Rima, as I said, I think if you probably look at the space itself, right, solar, wind, and hydro, I think hydro probably is a tad bit better place for two key reasons. One, I think in terms of the tariffs that the government has probably reviewed for hydro projects, I think they are steps in the right direction. The second element, I think, is in terms of small hydro itself. So I think if you probably see the construct, anything below 25 megawatts that probably comes through has a better tariff that probably comes through, and there is no fixed commitments on the company side itself. And therefore, what you probably see in terms of hydro companies is that they're probably bidding in, not for those mega projects that are probably coming through, but the small to medium projects is somewhere which probably becomes very, very viable for them. And therefore, I think hydro within the renewable space, when you talk about SJVN as an example, in my opinion, I think might continue delivering better set of
Hydro would be NHPC, SJVN. Are these the two plays in India?
Yes, I think when you talk about larger, well-capitalized stocks.
Okay. Yeah. And are there any small or mid-cap plays in hydro renewable energy space?
They are, but I think there is issues in terms of market cap and liquidity. So I think it becomes very, very difficult to probably go out there and buy very, very aggressive policies.
Okay. So the way to play it would be still the larger players, well-capitalized players. Regulated though, but NHPC and SJVN on your radar. Mayuresh, will come back to you. Just want to quickly put the spotlight on IT earnings. HCL Tech. We have with us Sandeep Agarwal, fund manager at Sovilo Investment Managers, now joining in. Sandeep, first, HCL Tech's data center foray. It's small, initially a 3,500 crore commitment, but their plan is to scale up to 50 megawatts. And what they clearly said is that this is not a power space, a rental kind of an agreement. What they want is that we will provide you the infrastructure, but we will also additionally provide you the AI intelligence, AI as a service on top of the infrastructure. So that is going to be the differentiated play to tap into the sovereign AI theme in India. What have you made of this interest in data centers by IT companies? Because it's not just HCL, even TCS had announced Hypervault. And what does this mean for the return ratios? Because services is very different from infrastructure.
Hi, Rima, good morning. So, all these companies, I think, are in the right direction. I think all of them, the large ones definitely, who has the balance sheet, they will move into this direction because they have the capability to add the intelligence value. And if the infrastructure is managed and built by them, the comfort for the client and comfort for them to manage also goes up substantially. In terms of return ratios, as you already hinted that, the return ratios of services are very, very high because the desk cost is recovered probably in the first 8 or 9 months. So the ROEs, X of cash, are huge. You can't have those ROE and ROCs in this business. But let me tell you, the highest ROC and ROE also in this data center business will be with the IT companies, primarily because they will be able to add high-end services and intelligence layer to it, which other players who are doing pure data center, probably they will get the rental yields or some bit of, some benefit over and above that. But I think pure vanilla data center players who are mostly from the real estate side, they won't make big money in the long term because it will become very commoditized. But the IT services company, which are now foraying into that space, they will do phenomenally well. And I think, people have, again, I would reiterate at the cost of being repetitive, that people have confused disruption and cycle as one word. Disruption is separate, cycle is separate, and this is a disruption which is a combination of hardware and software, which never ever has happened in the last 30, 40 years. And that is the reason people are confused. They are not able to form view. In my view, all these companies will do phenomenally well. Just wait 6 to 12 months. You will see good numbers coming in from these companies.
Making that point, Sandeep, and you have been bullish on the IT sector per se, but just getting back to the point about return ratios, what are the current return ratios of services companies? And as their business model changes, whether it's a pivot towards little bit of products, outcome-based, or maybe even these data center investments that the companies are making, and there is a fairly large outgo as they scale that up, what would the return ratios look like, say 5 years down the line, today versus 5 years, if you had to give a broad range or guess?
So, Rima, the right way to look at it is that, right now, when I was an analyst 4 or 5 years back, I used to see return ratios X of cash because you can't take into cash into net worth to calculate the return ratios. It is little unfair. So you have to replace that with a slightly better investment, and I think this is a much better investment. So if you are making 5-6% on the fixed deposit, which these companies were keeping with the large banks, this business will definitely be upwards of 20-25%. So your overall ROE, ROC going forward, if you include cash, then it will definitely improve by 7-8%. Standalone, this business ROE, ROC will be 10-15% lower than the services. But on a whole, because now you will be distributing less cash, your ROE, ROC should go up.
So some numbers here. Sorry, you're saying this business going forward will give you 10-15% ROE, ROC?
I think more closer to 20.
No, services today is giving you, what are the return ratios?
Services today is very confusing because, you have to, I think you have to reduce, take out the cash to calculate the return ratio. If you do that, then all are almost 35-40% unless there is some acquisition which has come in and dented the ROE, ROC. So pure vanilla, any company, IT company should be at 35-40% ROE, ROC if you exclude the cash and they have not done acquisition. On the overall basis, including the cash, most are at 20%. So this business which is coming in will be, closer to 20. So overall, I think still it will improve because your cash will go out. The less amount of cash will be distributed, more will be diverted to these businesses.
Okay. Any other trends, Sandeep, in the numbers from HCL or TCS that stood out for you?
So, Rima, I would only say that, this is the time to, we have been very bullish for last 2 months and, from there also stocks have fallen, to be honest. But I see that, next 18 months will be phenomenal. As I have said earlier also, if you do the EPS number, most of these companies should give you 45-70% cumulative EPS growth in next 3 years, which turns out to be 12-13-16-17% CAGR of EPS for 3 years, which is phenomenal. How many companies in Nifty at that size, that corporate governance and that balance sheet can give you that? So I think even if the sector doesn't re-rate, you will make 45-70% in this sector in next 3 years, which is a phenomenal return in my view.
Okay. And mid caps versus large caps, because mid caps are also making some large bets, M&A bets, Coforge and Encora, and it's still playing out. Persistent with Nagarro, while it's a high return, high risk kind of a play now.
So, Rima, you should not see right now, mid and small, large and small. That was the time till 2021 and prior. Now, post that, because deal sizes have got shrunk, everyone is able to participate in any deal. So the mid, large and small, and in fact, small and mid cap are at a more advantageous position in last 5 years versus the large cap. And it will further, the advantage will move towards small cap also. So the right way to look at is the technology stack. I think ER&D companies will be at receiving end for at least next 6 to 12 months, primarily because there is a slowdown in some of the verticals in the manufacturing side where they are. Secondly, remember that, AI disruption is highest in the manufacturing side and ER&D of the product. So wherever there is ER&D involved, the AI disruption is highest. So I think that is not being discounted. Having said so, I believe ER&D as an industry has to grow at a faster pace than IT services, because IT services penetration is very, very high while ER&D penetration is very low. But then the stocks are also at very high PEG ratio. So I am not comfortable with any ER&D company, but non-ER&D IT services, I am very comfortable. I think, across the board, good money has to be made in this sector.
Sandeep, you think 2 years down the line, people will be sitting on hefty 40-50% returns on tech companies, select tech companies who have already got badly beaten down?
So Nigel, I will say you this, that, in next 2 to 3 months, you will see a lot of upgrades from the analysts who will catch the first leg of the uptrend. And then there will be upgrades in next 12 months by the analysts who have recently downgraded the stocks at the bottom of the cycle. That is what my view is. Because, as I said, this is a cycle which no one has, including me, has not seen in last 30, 40 years. It is a combination of hardware and software which has never happened. So we are all confused, and that is the reason we are not putting appreciation to the work which Indian IT companies are doing. You just see next 6 months how numbers turn out, and let me tell you, market is extremely smart. The EPS growth of 45 to 70%, if they find that in next 1 month, 2 months, the stocks will not wait for 3 years to give you that return.
Right.
So market will always discount in much ahead.
The reason I'm asking you this is because you were very bearish on the companies, and, that played out very, very well. The stock saw a sharp correction. And now you have turned the corner, and the last month or couple of months, I think you've turned quite positive on prospects. And now you're in the bullish camp, though, as you have mentioned numerous times in the interview, that you're not an analyst any longer, but you're maintaining a positive stance now on tech names. Yeah, Maglam.
In the past, he said that you spoke about 45-50%. His math is that it would be about 65 to 70% returns as well. Very recently, he had, made that call. So obviously, the street, he is betting on the IT pack.
Okay, all right.
ER&D.
Okay. Next of ER&D.
All right, that's thanks a lot, Sandeep, for joining in, giving us that view. Always a good chat with you, and we look forward, in the time to come, to keep getting your updated view on the sector. For the time being, you're in the bullish camp.
Thank you.
By the way, keep an eye out on the bottom of your screen, that large trade on Biocon, that's taken place. Important, it's happened in the block window. And now it's going to be very, very interesting. I'll tell you what, because there were some shots that were, built up in anticipation of this block. The pricing was at a discount, but that was on expected lines. Now those shots, they may have to scramble for cover because the deal has taken place in pre-open. So Biocon, after a bit of an underperformance in comparison to the farmer index in the last few months, it could possibly be the stock of the day. And Vikas Kemani as well, yesterday when he joined us on the show, he was talking about their bullish stance, which is official, with due disclosures, that they have been fairly optimistic on the prospects of Biocon, not giving a time-wise, recommendation, but saying that the prospects of the company are good from here on. That's out of the way. Keep an eye out on the stock. And post-market hours, when you look at the institutional numbers, they'll be impacted by around this 1,850 crore rupees or thereabouts.
Just a word on this thing, where the floor price was at an 8% discount to yesterday's close. But the fact that it's happened in the block window implies that the price difference is not more than 3%. So block window allows you to do a trade only if it is within 3% below or above the previous close price. So obviously, the deal has been done at a much higher price than the initial discount. So which provides proves that maybe one, there was strong demand for this, and secondly, at the same time, the shots which would have will run for cover.
And I think Sudarshan was giving some feedback that probably there was a good demand as well for the company. So we'll keep an eye out on that. We'll get you further analysis. For the time being, we'll slip into a short break. On the other side, we'll continue our chat with Mayuresh Joshi. We'll also get in our technical experts. Stay tuned.
Welcome back. You're watching us here on on Bazaar Morning Call. Mayuresh is still with us. Mayuresh, your thoughts on the jewelry space? Kalyan Jewellers in particular has rallied about 50% in the last 4 trading sessions. It's interesting because, when it started rallying, the discount that it was trading to Titan was about 70%. Now it's at around 55%. At peak, it's narrowed to about 40%, 35 to 40%. Where do you see Kalyan Jewellers and all the other jewelry companies right now?
Well, a phenomenal move by Kalyan, no two ways about it. And the numbers were pretty decent, but I think it's probably do a comparison with how Titan delivered. He disappointed on that day itself, but it recovered very, very fast. However, our take is still very clear. I think the leadership stocks within the space, Titan is something that we still continue to like. Numbers have been phenomenal, and they are probably changing and tweaking the product mix. As we see more amount of wedding jewelry brought in with better margins as well. And therefore, I think the expectations in terms of a steady state of growth might actually continue. The other stocks that we like within the space of Mandamai, that stock has given phenomenal moves over the last few weeks as well. So I think as an actionable idea at this point of time, I think Titan probably is still among the large cap leadership stocks.
All right, take that point. Thanks a lot, Mayuresh, for joining in. We'll leave it at that today and take a short break. On the other side, we have the pre-open rate, and also with us will be Keshav Lahoti of HDFC Securities to focus on the consumer durable space.
Well, just a minute or so. In a few minutes, we'll get the more concrete rates. For the time being, the pre-open rates are suggesting we're going to be pulling back to kickstart trade. That's on expected lines going by the global backdrop and the spike that we're seeing in crude oil prices. Let's welcome Sudarshan Sukhani as well as Mitesh Thakkar on the show. Good morning, gentlemen. A bit of a challenging trading session is up ahead. Yesterday, we got lucky. There was a good recovery from the day's low. But how do you approach trade today? Sudarshan, you go first. Would you be looking to buy into this dip?
Good morning. No, that was yesterday. Every day is different. We were winning buyers at the dip in the morning itself. Today it's unlikely to be the same for 2 reasons. First, the market has already digested some of the gains. It found a dip, it bought into it. That's the end of it. Second, today is also FNO expiry, weekly expiry. And we have noticed that weekly expiries can do strange things to the Nifty. So today, the trade is you wait patiently for a very significant and sharp dip if it comes about. That would be somewhere around 23,800. It may not even come about. In that case, there is no trade. If you find the Nifty between 800 to 900, that's 23,800 to 23,900, somewhere in that range, go and take that chance and buy, not otherwise.
All right, 23,800 and 23,900. Mitesh, your call on the index. I mean, between yesterday and today, the big difference is oil prices. They've spiked by about 10%.
See, good morning. Yesterday's recovery was slightly surprising because I still believe that the market is, kind of non-directional in the sense that the indicators, the volatility oscillators are turning flat. So I broadly believe that we'll do a range of 23,800 to about 24,300, 350, thereabouts. And therefore, it will be more of a consolidation kind of a period for the next week or a couple of weeks ahead. The idea is that the Bank Nifty also, needs to close above 58,500 for a fresh breakout. That's not happening as well. We've had about 2 attempts in the last 3 weeks over there. And therefore, I think, these trends required for a breakout is missing. And on the downside, we are seeing repeatedly support coming at the 10, 20-day averages, which is close to 23,800, 850 zone. So I think it will be mostly a sideways consolidation. Don't trade in the middle of the range, but as you get to the edges, you will find a trade on the long side if it's the lower edge, and on the short side or profit booking if it's the upper end.
Understand that. And this morning we'll also monitor the rupee, because over the last 2 trading sessions we've seen the rupee weaken from 95.3, yesterday closed at around 95.6, and this morning straight off the bat it's opened closer to 96. The rupee has been very, very well behaved for the last month or so, but will a fresh spike in crude prices cause another worry on the rupee or not is something that we'll be tracking very closely. So Darshan, your individual stock trades?
Well, Angel 1 is a buy with a stop under 335. And for all of them, you have to adjust the stops depending on the gap down. Bank of India is a buy with a stop under 140. HAL is a buy with a stop under 44.25. And this tells you that if there is a dip, I'm a buyer. Wait for that dip. Patanjali is a sell with a stop above 415.
Right. So you have 3 buys and a sell. Mitesh, your calls?
I have 2 buys and 2 sell-side calls. On the buying side is Blue Star. If you get it around 10-15 rupees lower than yesterday's close. So around 1705, buy with a stop at 1688. Look for a target of 1755. And Coforge, if it starts to get past yesterday's high of 1547. So buy above 1548, keep a stop below 1525. Look for targets of 1600. On the sell side is BDL, Bharat Dynamics, with a stop at 1321 for targets of 1260. And Dr. Reddy's, it's at a pivot level of 1230. The closing was 1234. Most likely with the gap down, we'll see the stock open below 1230. So sell below 1230 with a stop at 1251 for a target of 1190.
All right, take that point. Thanks a lot, gentlemen. We'll come back to you in a very short while. Meanwhile, let's also welcome Keshav Lahoti, who is the research analyst at institutional equities at HDFC Securities, specializing obviously in consumer durables. Keshav, a whole host of things to speak to you about. But let's start with Voltas, because we understand that the company has taken price hikes by about 2.5 to 3%, and this citing higher raw material costs and increased demand. If you could give us a sense on whether your channel checks confirm this. From the start of this year, what has been the quantum price hike, and especially the timing, because you usually don't see all these companies take price hikes post the peak summer season. So do you think there's demand which is strong enough to justify this kind of price hike? And what's your outlook? What's the demand channel check suggesting?
So firstly, good morning. Thanks for having me on the show. So as you already, correctly highlighted, now we are, off season. Normally, we don't expect price hike to play out in July. But yeah, our channel check confirms Voltas have taken a 2 to 3% price hike. Now, talking from the start of the year, the price hike in RSA industry has been around 10%, but that has been taken to offset the table change, and the high commodity inflation. But still, whatever the price hike industry have taken is not sufficient to pass on the entire cost inflation. Still, industry need to take more 3-4% price hike to completely offset the cost inflation. So I think this price hike was required, because on demand side, demand is doing fine. Last year base is good, low. This year demand has been pretty healthy. The summer has been pretty hot. We are also talking about El Nino. Even the IMDb has forecast this time the rainfall will be 90% on long-term average. Currently also the rainfall is 18 to 14% deficit. So demand trends are healthy. Demand is not a concern, but we are surely cautious on the margin side because of the cost inflation.
Okay, all right. Got that. Hi, Keshav. Good morning. Good to see you in. Keshav, what do you make of, Amber's announcement that they made over the weekend? they had that subsidiary that they're looking at now unlocking some value probably, and probably looking at an IPO. What kind of valuation matrix are you giving to it? That's the entity that's growing at a faster clip as well.
Hi, good morning. So yeah, right now Amber have also announced it. In fact, they have firstly done the Oppo transaction. Now on Elgin side also they have announced the bonus shares and all this thing. We think the company is well preparing themselves for the IPO. Surely once you come for the IPO, your stock price needs to be to where, share price can't be very high. I think that is what they are preparing for. I think Elgin Electronics is what IPO industry will be looking for it. But it's, a lot of acquisition has happened through Elgin. Amber have done 3-4 acquisition last year. I think let's wait for the time, then we'll see how the things will shape up the time when the company will be ready for the IPO. I think it will take a few quarters. I think that time it would be, more appropriate to talk. And secondly, there is still, unclarity for us whether Oppo will be through Elgin or Amber. So that will be also the deciding factor for the valuation.
Right. Speaking about deciding factors for valuations and deals with global companies, Dixon, the long-awaited JV with Vivo was given a nod, and the company has said that they will start production in a month or so. While volume estimates are ranging from, multiple brokerage houses, I just wanted to understand, what are you penciling in for this year and the year after in terms of both volume and revenue? And do you think people will now look at, Amber once again because of the Oppo deal and the Vivo deal from Vivo JV from Dixon may not get that kind of eyeballs? I mean, we're just trying to understand how investor behavior would be.
Firstly, talking about Dixon, so long term, the JV was pending for a long. Finally, they have got the approval. So Vivo does 35 million volume in a year. Management have highlighted 2/3 of the volume, that is 22 million, will come to the JV. So as we understand, the JV will take still 40 days to start the, commercialization and all this thing. We understand now Dixon will buy the plant of Vivo also. So for this year, we are penciling a volume of 9 million. And next year, we are modeling a volume of 20 million for the Dixon. Now talking about Amber. So whether Oppo deal will have an impact on Dixon in the near term, the answer is no. Because whatever the volume Amber got it's not offsetting the Dixon. It's from their, internal production, whatever they do. But in the mid to long run, we believe surely Amber entering in the mobile space is possibly, they won't be just restricted to Oppo. They will possibly try more clients maybe 2-3 years down the line. So surely the impact will come, maybe not in the near term, in the mid to long run. And Amber entering on the mobile space is a positive for Amber, because earlier they were gaining market share on RAC side, the outsourcing was increasing, but Amber's 2/3 of the revenue comes from RAC side. Now the industry is expected to grow by 15%. There is not much scope to, outperform the market. We believe Amber will grow in line with the market. So possibly to shoot up the growth rate, Amber might have decided to get into the mobile space, because earlier in the RAC side, the company was growing by 25-30%, which no longer we expect it to continue. Just for example, last year, Amber was guiding in RAC industry side, they'll outperform the industry by 10-15% for FY26. And this year, they have clearly articulated they will grow in line with the industry.
Okay, all right. Final question, Keshav. Getting into market opening, top 2 picks?
So our top 2 picks on durable side is Orient Electric, and we like Eureka Hopes also. And on EMS side, our topic is Sigma. Although stock have done pretty well, we have released a report on December, a deep dive. There, the stock have given more than 50% return. But I think someone can wait to make an entry in Sigma, but we like the long-term story of Sigma.
Got it. Appreciate you joining in, Keshav. Thanks a lot for giving us all the cues to chatting up with you rather soon. By the way, keep an eye out on the bottom of your screen. That entire recovery that we saw in the rupee, that's got sold into, because the rupee, after recovering all the way closer to around 94 odd, that's moved back above the 96 odd marker. I think on the verge of moving to those peaks that we saw earlier. I think that was closer to around 97 or thereabouts. But the rupee has weakened to start trade today. That's a bit of a sentiment negative. So let's see how that goes. Well, 9:10 a.m. Sudarshan joins us to give us his call. Sudarshan, you go first.
Well, it's HAL. Buy HAL with a stop at under 44.25. Adjust the stops according to the gap down.
Okay. All right. Mitesh, what about you?
Yeah. I go with the sell on Dr. Reddy's if it breaks 1230.
Nigel, wait, before we go across Nigel, Sudarshan, Speaking about Biocon, it's it's moving fairly well in pre-open, settled much higher.
So entire 9.2 crore shares that we are talking about have changed hands in the block deal window. Mylan has sold its entire 5.64% stake, so major overhang is gone. Now, as expected, that has happened in the block deal window, and that tells you how the demand was. The floor price was around 378 rupees per share, and the deal for the entire 9.2 crore shares, or say 5.64% stake, has happened at the 5% higher to the price of 378, and exactly the price at which it happened was rupees 400 per share. Now, just if I can give you the background, Mylan was given or allotted the shares in Biocon for the stake that it held in Biocon Biologics, and as per the deal done in January 2026, Biocon had announced deal for Biocon Biologics via share swap and the cash. So because of share swap, they were given, Mylan was given almost more than 6% stake in Biocon. Now the entire stake Mylan has sold. Mylan has exited the company and overhang is gone. And because of the deal happening in block deal window, Biocon stock is sharply higher in pre-opening session, up almost 4%.
Got it, sir. Thanks a lot for that. That could probably be the stock of the day, opening up close to around 4%. The shorts as well could have to run for cover. Let's focus on Grasim. Now, late last evening, Grasim subsidiary Aditya Birla Renewables, they have acquired Solenergy Power from Shell PLC. And here are the details. The deal is done as an enterprise value of around 17,200 crores or thereabouts. The acquired entity, which is Solenergy Power, has accumulated contracted portfolio of around 5 gigawatt. Part of that is, most of it is functional, and some part of that will get operational as well. The turnover for the last few years has been in the vicinity of around 1,100 to around 1,250 crores or thereabouts. And normally for these sort of businesses, the margin that you're assuming is around 75 to around 80%. What's the rationale? Well, it gives them an opportunity to expand in the renewable energy footprint. It increases Aditya Birla Renewable Energy's portfolio from around 4.4 gigawatt. They go all the way to around 9.4 gigawatt, and they've set their sights on doubling from there, targeting close to 20 gigawatts over the next 3 years or so. The debt in the books, well, standalone entity is around 6,900 crores, consolidated entity is around 37,000 crores or thereabouts. How will it be funded? That'll be top of mind, right? They're saying there's going to be a mix of debt. There'll be some equity that will come in from Grasim, and there'll be some investment that will be coming in from Global Infra Partners as well, which is a subsidiary of BlackRock. And just in December 2025, JIP, they had put in close to 2,000 crores in Aditya Birla Renewables with a green shoe option of around 1,000 crores. That valued Aditya Birla Renewable Energy at around 14,600 crores. Transaction should close out by the end of this calendar year. Citi, they maintain their buy rating. They understand that Grasim will have to raise some debt. They believe that the stock could react negatively in the near term. While Morgan Stanley, they have an overweight rating. The target price they have around 3,900 crores. They see this development as a positive one for both Aditya Birla Renewables as well as Grasim, because the deal provides immediate scale in comparison to any kind of greenfield development that they would have done. And they scale their capacity to around 10 gigawatt. Put everything together, stock opens up mildly in the red. We'll have to keep an eye out on how it progresses from here on. Big deal nonetheless, 17,000 crores.
All right. Thank you very much for that. And the bell has gone. And the Nifty has opened with a cut of 150 points at the 24,060 level. 0.6% lower on the Nifty and the Sensex. The Nifty Bank too down nearly 380 points. A similar 0.6% decline on the Nifty Bank. The level to track will be yesterday's intraday low of 24,000, from which the markets rebounded to ultimately close up at 24,200. But this morning, given the standoff at the Strait of Hormuz, crude prices now back at $85 per barrel, and so much uncertainty in the Middle East, we have a gap down opening, still hovering around 24,200. So what's taken a knock? Well, it's HCL Tech. Numbers, as we said, are fine. But the stock had already run up 13% in the run-up to the numbers in the month of July. And on account of that, valuations at 16 times were at a premium to an Infosys TCS. CLSA Citi have downgraded the stock on the back of that. They believe after the run-up, the stock was fairly valued. Interglobe Aviation is a drag today. That's down 2%. L&T, with an exposure to Middle East, is taking a knock, 1.5% down. Asian Paints, all the stocks negatively impacted by the rise in crude prices, are on the back foot. Auto names are weak today. M&M, Tata Motors Passenger Vehicles, down 1.5% approximately. In the banking names in the NBFC complex, it's Shriram Finance, 2.3% down. Kotak Mahindra, 1.2%. HDFC, ICICI Bank, also lower by 1%. On the way up, it's Hindalco, that's a top gainer, that's nearly up 1%. ONGC is holding up in the green. Nestle is resilient, that's up nearly 0.5%. but way more red than green. The advanced decline ratio to begin trade with has about 2 stocks advancing for 5 stocks declining. But it's not falling. After that opening lower of about 130, 140 points, we're still there. Let's see how the day progresses. But HCL Tech is the big loser now, 2.5% down.
Well, that's right, Rima. I think the stock of the day and the stock of yesterday as well as today is Just Dial. In 2 sessions, it's put on close to around 30%. So big move is what we're seeing out there. Fino Payments Bank yesterday was up. Today, in fact, it's seeing some follow-through banks. So that's up close to around 6% as well. Kalyan Jewellers, as Mangalam was telling us, there was that bit of a valuation gap. And the valuation gap is still there, though not as much as what it was, say, a few trading sessions ago. So that stock as well continues its good run. Massive move out there. Novoco, well, it starts off on a positive note. You have the East India prices that were good. Good pricing improvement of around 7%. You'll await clarity on this front. Remember, the stock has been a rank underperformer, but now they've got scale as well. So that stock up close to around 6%. I'll be interested to see whether or not it can hold on to these gains. That's going to be important because in the past, sometimes the pops get sold into, but that stock, numbers look good. Starting off the cement pack numbers on good note. So that stock is up. Concord. Sudarshan tells me that, in fact, out there, the volumes are better than expected. And that's why that stock is up and about in today's trading session. It's opened up with a gain of around 5%. It's half from the top, but that stock as well continues its good run. Biocon could probably be the stock of the day. That's up and about in today's trading session. And, no one wants a war. But if there is a war, then there could be lack of gas supply. If that is the case, if there's going to be some restricted movement as well, then aluminium could be in a bigger deficit. That's the way the street looks at it. And that's why you have a stock like, say, Nalco, that corrected from around 450 all the way to around 330 rupees. For starters, that's one of the top volume movers today. It's up close to around 2%. In the near term, maybe the street believes that aluminium prices at least could get some kind of support on that front. So that could be one of the stocks that we're looking at. PDS as well, some positive news flow that did come in. Stock up 10%. Big move on that name. Mangalam.
Indeed, a multi-year sourcing partnership with a French retailer is what PDS has signed, and that explains why the stock is up 10%. On Container Corp, the disclosure of physical volumes happened in the dying minutes of trade yesterday, and that's why the stock is higher by about 5.5%. So the actual volume growth for the company has been around 8.9%. Exim volumes 9.8%, domestic volume 6.17%. This, on an absolute basis, is much lower than what the street was, earlier working with. However, the management guidance at the end of the first quarter was obviously, scaled down. So on lowered guidance expectations, this company has met them, and that explains why we're seeing a bit of a pop. But as you pointed out, the stock had once half from the top as well. Biocon is now adding on to those gains. And, Kalyan Jewellers is not the only jewelry company that is surging right now. We're seeing some traction on Thanga Mill Jewelry as well, up around 3%. We continue to see some purchase on Blue Jet Healthcare as well. Been a big mover this month, up around 18%. Seeing another, 2.5% sort of gain come by. Happiest Mind, the stock surged yesterday. Vivek had broke the story that maybe, one of the buyers of Ashok Suta's stake could be ITC, the infotech company. But Happiest Minds finds another set of buyers today, up around 3%. On the way down, we are seeing some decline in, players like Lodha Developers and a lot of the real estate players, which had seen a big move earlier. But now, with geopolitical uncertainty coming back, we have seen, some of the profit booking on these real estate names. CEAT is lower by about 2.5% as well. Typically, a user of crude as a raw material, so tire companies are lower. And finally, we have Bajaj Consumer reported a stellar set yesterday, but the stock continues to sell off because this stock had already rallied about 190%.
Couple of, initiating coverage reports as well. Investec, they've initiated coverage on Seshasai Technologies, target price of around 430 rupees. The stock has opened with a gain of around 2.5%, but just to alert our viewers, in the last 1 month, the stock is already up close to around 20%. So a bit of a pop is what you're seeing out there. Volumes as well picking up. But if you pull up a last 1 month chart, there's an initiating coverage report that's come in overnight from Investec. But the stock as well has seen some kind of rally in the last month or so. Yeah, it's up close to around 20% in the last 14 days. And the other one is Privy, I think so. DAM Capital, I think they had come out, or Incred actually had come out with an initiating coverage report on Privy Specialty. That one as well is up close to around 2% as we speak. Volume's not very, very high though on that particular name.
Well, TCS continues to see buying from yesterday, adding on another 2%. Yesterday up 6%. Infosys in the green, Wipro basically money which had gone into HCL Tech because HCL Tech was growing faster than peers, perhaps is getting reallocated back to some of the other large cap companies like TCS, Infosys, which were trading at a discount to HCL Tech. But let's invite Sanjay Parekh, founder, CIO of Soham Asset Management, on the show. Thank you very much for joining in. Sanjay, just when we were getting comfortable with the idea that maybe the Middle East issue is behind us and crude has settled between $70 to $75 per barrel, there come the latest skirmishes. And I'm reminded of that conversation that we were having with Vikas Jain of CLSA. And he said that it's difficult to see how peace actually comes back in a sustainable way in Middle East. And therefore, he says that adopt a barbell strategy. Have some hedges in the event that the situation continues to worsen. Is that the way you all would think of constructing your portfolio? Play for both sides. Things stabilize, improve. You've got a few plays, and if things get worse, his idea was play the upstream names, even aluminium names, and they're all doing well today, Hindalco, Nalco. Would you have some hedges in your portfolio?
Yeah. Good morning to all the viewers, Rima. So, yes, it's painful, right? So we were towards the resolution, and again, it's escalated. So, certainly we'll have to go through the pain, and till the time this is totally not resolved, because it has linkages to crude and supply chain. I think crude at 80, 85, we can still manage, but the supply chain on a longer term and the risk that it can further flare up is where market is worried. So I think market, till the time we get a proper resolution, market may consolidate for a while. But on the question on, at least on our side, what we've done is we moved up to large cap. We said that which are the leaders which are better off. And then you're right that we also had hedges through, Vedanta Aluminum or, even metals, Vedanta standalone. And you do get, even Reliance, we believe, is better off in the sense it's not going to get negatively affected. So some of the large players is what we invested in, and then leaders which will get less affected, like some of the telecom names, barring the crude part, which the diesel price in the tower generally is insulated. So that's where we positioned our portfolio, and it's worked well till now for us.
Okay, so you're protecting your downside with investments in a Reliance, a Bharti, a Vedanta Aluminum. Am I correct?
Yes.
Okay, what are the other changes that you've made to play the upside, capture the alpha in the last 2 months?
Right. So I'll tell you our portfolio positioning, and these are disclosures that we own it and in our portfolio. So we have Mahindra and Maruti as leaders. We have Samvardhan Motherson. We have Adani Port in the port segment. In telecom, Bharti is a big weight. Reliance is a large weight in E&P. And then, Grasim, we wanted to participate through Ultratech. So we have small weight Grasim. Sun Pharma, we have in pharma. Again, as a hedge, it helps us. IT, which, you've always been covering so well, we've increased our weight to IT recently in the fall. We've added Coforge. We increased our exposure. And so we've reduced our underweight, but we've increased the weight to IT, to Infosys, which was our existing holding. So that's where, our overall, and then real estate we like because the opportunity is pretty large. So we do own DLF, and a recent entry we've done into Lodha, that is around 15 days back. So that's the way most of, and then Lenskart, which is broadly insulated, or Eternal, we have small weights. So this is how our portfolio is positioned, which has helped us as a large cap buyers and avoiding the fall. That's the purpose we've achieved.
Right. Sanjay, good morning. Thank you for joining us. Since you spoke a little about Grasim and the play via, Grasim for Ultratech, what is your sense on the deal that came by yesterday?
Right. So it's just initial, we need to get the details, but broadly, I understand it's around 8.5, 9 times EV/EBITDA. The EBITDA is not yet known, but based on the capacity, when they go full stream at 5 gigawatt, ideally the renewable play, 17,000 crores, the EBITDA should be more like 1,800 to 2,000 crores on a full scale basis. And in renewable, it don't take time to complete, right? So this should be 12 to 18 months far off, and then the entire 5 gigawatt hopefully should get completed. So it's very reasonable at 9 times, 8.5, 9 times. We don't have the numbers. These are our workings. And the existing portfolio is there in place. So they want to build this. Even the existing capacity, as we understand, is taking time to ramp up and contribute meaningfully to the EBITDA. So the whole piece meaningfully will contribute 12 to 18 months ahead. But certainly overall, from a strategy point of view, we're not worried about it.
Do you think it could be another value unlocking opportunity, Sanjay? Do you think at some point of time, Grasim, that was traditionally only into VSF as well as chemicals, now suddenly you could probably expect some value unlocking in the coming years? Say in the next 5 years, you could possibly see value unlocking in paints. You could possibly see a renewable energy vertical as well getting listed, because now it's got that scale as well. It could be a 10 gigawatt in the next 18 months or 24 months or thereabouts. We'll wait for clarity on that. And then scaling to around 20 gigawatts. Your take?
Yeah, Nigel, you're right. So paints certainly has done well. Market has started to attribute a reasonable value, on EV2 sales because profits are yet to come. But they've certainly done a very good job there. And it's still work in progress. Of course, the structure is that today they own 100%. How the structure in future will remain, we yet to see. The renewable piece is recent. They already had a 4 gigawatt plus capacity, but yet that also has to show meaningful EBITDA because some of it, as I understand, is through group captive. Some of it is so the overall platform was valued at around 14,000 crores recently, and so it's still meaningfully yet to contribute. So we want to see the contribution and EBITDA in 2-3 years, which should come through, and then maybe derive a proper value. But for now, we're not ascribing a very big value towards this renewable piece.
Okay, all right. Let's talk about the telecom stocks then. We're going to be having a big Jio IPO later this year. And that sector could actually come back to life because you'll have the big IPO. The street is looking forward to maybe a possible tariff increase. How would you approach the sector? You have an IPO that's due. You have a core company, which is Bharti Airtel. I think you'll have some exposure out there. And Vodafone Idea, not the stock for the faint-hearted, but some believe that it has a good case to survive from here on. Capital could flow to them. And if that tariff increase comes about, that'll be music to the ears of shareholders. How would you approach the space? Or maybe you go for, Infotel, Industars.
Right. So, Nigel, first, we have Bharti as yet. It's a large weight for us. And of course, Reliance, we have, again, a large weight, which you indirectly participate through Jio. So start with Bharti. I think it's quite reasonably valued. A price increase is one difficult answer, which even the managements now try to almost not guess or second guess. And I think Bharti is working towards, if you see the recent annual report, the downstream businesses they are planning to build, I think they're underappreciated. The cloud, the NBFC also, they clearly have a right to win. For the postpaid segment, they can do the digital lending piece because they know exactly the behavior of them. So I really believe they have a right to win there. The data center, these are the three big opportunities. And then of course the value addition on postpaid in the mobile segment. So I think the business will look far different in 2-3 years, where the downstream businesses will have significant value creation. And we really believe this could be a good compounder over 3 years, best in class on all the aspects, take revenue, market shares, margin, frugality, capital cost, return ratios, payout. So all of them, we believe it's a good core holding, which we'll continue to own. On the rest, of course, Jio IPO will help our Jio based on the value, reliance on the valuations. It's a good thing, for sure. Most of the analysts are now attributing the Jio valuations in the RIL SOTP. There could be a marginal leg up and then there could be a holding company discount. So I think from a Reliance perspective, I don't think it'll matter much. It'll be more the fundamentals, which we again are very positive on the long-term fundamentals of Reliance. So that's very on the Indus. For now, we are avoiding because we think growth is missing there, and the new businesses in Africa and even the renewable integration. I think we're going to take some time. It's good dividend yield, but we rather want to participate through Bharti.
Yeah. I didn't hear any asset management companies in the list that you highlighted, at least in the large cap space. SBI Mutual Fund's IPO opens today, valued at about 1.18 lakh crores. So still at a discount to say an ICICI Pru AMC. Do you think they've left value on the table in the AMC space? Which stock would you back? Or is SBI Mutual Fund a stock to own in one's portfolio, given the franchise?
I think SBI Mutual Fund is reasonably valued. Certainly, they have kept money on the table at 24 times, broadly on 28. It is at a discount to the large peers. And I really believe that there could be good listing gains, maybe 10-15% surely. So we really believe, certainly the listing should be broadly around 650, 670 is what our assessment is. It's a very good IPO. They've done a phenomenal work. It's an amazing franchise, not only built on SBI, but even, SBI is just 23% of the business. They've built this business, and this is a business of scale. We clearly believe that's a 10-year, runway for growth. And it's really reasonable valued at the IPO price.
Right. Sanjay, in the past, you have liked a lot of the EMS plays and you've made serious monies there as well. Thereafter, you, I guess, took some money off given the valuations, you weren't very comfortable. But now after some time correction, perhaps in a lot of cases price correction as well, it's back in focus. We've heard from, Dixon, the final approval for the joint venture with Vivo has come by from the government. You have, on the one hand, value unlocking expected in Amber. You've in the past liked SGS Sirma as well. So where are you on that? What are your thoughts?
Yeah. So Mangalam, in hindsight, we bought Sirma twice. And both the time, I think we should have held on. So certainly in hindsight, we've sold it early because we found a valuation expensive. But, one learning is that when the growth is really intact, the overvaluation can continue for a while. And we need to learn from it. In terms of Dixon, again, it's very actively on our radar. They have not delivered recent times. Even this year could be a lower growth. Last year itself was disappointing, but they have a phenomenal management and amazing runway for growth. The opportunity is pretty large. They will also move from only predominantly mobile segment to non-mobile. Vivo will contribute. So when we look at this company on 28, 29, 30, it's certainly at a very good growth rate. It's just that, again, valuation is discomforting. At a price, we'll certainly be investors in Dixon.
Sanjay, maybe not a stock that you own in your portfolio, but any thoughts on Just Dial, up 35% in 2 days?
No, Rima, we're not on our active radar. It's just a lot of value. I think the cash I just read was just before the rise cash was more than the market cap.
Yes.
And there's a leadership change, but not an expert on the stock.
Right. So what are you actively, investigating right now from an investment opportunity perspective? You've given us what you own. You've given us what you don't like, but is on your radar. There's the EMS space, a couple of those players out there. But apart from that, where else are you actively pursuing opportunities?
Well, there are several opportunities. I think, we're agnostic. We have a large cap bias. The strategy has helped us. In fact, our NAV is, from Jan to June, we've really the entire fall of 7% we could mitigate. And our NAV was marginally higher than our NAV at Jan starting, So that has helped us. But on bottom-up basis, there are several opportunities. In renewable space, we met few companies. In the Digitech space, we have been evaluating few companies. Car trade earlier, we already own it, at work for us. So in mid and small cap, we are very, very clearly bottom up, trying to look for ideas, but only at the price value gap that we see. Otherwise, we are more happy with large cap. You know, that's the strategy. It's worked for us, you know.
Got it. Okay, all right. Sanjay, always a pleasure having you on the show. Thanks a lot for joining in and giving us your take. Have a good remainder of the day, and we catch up soon as well.
Thank you. Have a nice day.
All right, let's focus then on one of India's largest renewable energy deals. Grasim's arm, Aditya Birla Renewables, will acquire Shell-backed Spring Energy for around 17,200 crore rupees. Following the transaction, Aditya Birla Renewables' portfolio moves up from around 4.4 gigawatt to around 9.4 gigawatt. To discuss this, what it means for the company, what it means for the industry as well, we're joined by Mr. Piyush Pandey, the Senior Vice President, Centrum India. We also have Shrishti Ahuja, Partner Investment Banking at EY. Good morning, lady, as well as gentlemen. Thanks a lot for joining in. Well, Piyush, since it's market focus first, I want to come across to you. What do you make of this transaction? They're picking up close to 5 gigawatt for around 17,000 crores or thereabouts. The asset is yet to ramp up at full capacity, but a couple of details first. For this sort of an asset, what kind of margin should we assume? 75 to 80%?
Roughly for in the renewable space, EBITDA margin is roughly close to around 85 to 87%. But most of the cost items comes below EBITDA, like say depreciation and finance cost. So I would say getting this 5 gigawatt at a price of around 7,000 crores, roughly it comes to around 3.5 crore per megawatt, which is reasonable. So I would say, given the fast pace growth in this industry, players do want to use acquisitions to scale up faster.
Correct. But there'll be some more money that they'll have to put on the table, right, to ramp it up, this 5 gigawatt or thereabouts. How much are you assuming? As you said, back of the envelope calculation suggests it's around 3.2 crores per megawatt, which is pretty good. But there will be some capex. How much are you factoring in?
See, out of this 5 gigawatt, roughly 3.3 is operational and 1.7 is close to under construction. My sense is that they would require additional capex in the range of, say, roughly in the case of around 4 to 5,000 crores to ramp up the under construction capacity.
Okay, so then it would work to close to around 4.1, 4.2 crores per megawatt, which is still pretty okay, right?
Yes.
Which is the reference point, past transaction that we've had, or if you have to put up a greenfield, then how much does it come to?
See, for pure solar project, it is around roughly 3.5 crore per megawatt or 3.4 crores. And if you do a solar with battery, then it comes to around 4.5 crore per megawatt. So I would say those are the benchmarks and current times, yeah.
Okay, all right, got that then. Let's get in Shrishti Ahuja as well on the show. Hi Shrishti, good morning. Thanks a lot for joining in on the show. It's a landmark transaction coming in from the Aditya Birla Group. Aggression coming back in there as well. In various portfolios, they've gone ahead and showed their might. What do you make of this particular transaction, the big foray into the renewable energy space and effectively doubling the capacity, in one single transaction?
Yes. So, see, actually what we're seeing is that a lot of Indian conglomerates are going long on Indian renewable energy as a sector. And until today, the sector was mostly dominated by large global financial investors and international utilities. But given the volume that the sector offers, like the sector needs about $25 billion of greenfield capex per annum, the Indian players are now seeing that the sector is mature, yet it offers significant investment opportunities. So this is a trend that we are seeing across the board, where large Indian players are becoming very active.
Got it. Yeah, indeed. Piyush, coming back to you, out of this 5 gigawatt, you just gave us some broad numbers in terms of solar, plus if they're putting a battery storage system as well. You have any further clarity about this 5 gigawatt? How much of it is solar? How much of it is other renewable energy? I don't have that clarity, so I'm asking you.
I would say in terms of breakup, we don't have the details, but my sense is that bulk of the capacity is in solar. Mostly it should be around, say, roughly 90% of capacity should be in solar. And remaining 10% can be like, say, wind or other. And if it is complemented with battery, then of course the value of the asset can be significantly increased.
Okay, all right. And what about valuation-wise, Piyush? All we have is the revenue number, which scales between 1,100 crores to around 1,250 crores or thereabouts. If I look at it and if I give it that 80-85% EBITDA margins, then on a trailing basis, it doesn't look very, very cheap on an EV upon EBITDA basis. But on a forward basis, how do you see this number? If you have to compare, what EV upon EBITDA is it done at? And who are the peers that trade in the market? What EV upon EBITDA multiple do they trade at?
Generally, in my coverage, so I cover like NTPC Green and Acme Solar. So NTPC Green roughly trades at around, say, 14-15 times EV EBITDA on FY28. Acme Solar slightly cheaper at roughly around EV EBITDA of 12 times on FY28. So broadly, I would say, see, currently, we also have to look at, like, say, under capacity scales up. That can lead to significant growth in EBITDA going here. So anywhere between 12 to 14 times EBITDA on FY28 can be sort of fair valuation estimate. Yeah.
Both on replacement costs and EV upon EBITDA, this transaction looks pretty favorable actually for the Aditya Birla Group. Would you say that?
Yes, both on the replacement cost as well as on the EV EBITDA valuation. Right. It looks reasonable, I would say.
Right. Shrishti, I just wanted to understand from a pure business perspective on renewable energy, where everyone's putting up so much capacities, etc. What's the kind of ROI that investors get on putting up renewable capacity? That's point number one. And secondly, from a user standpoint, how much is the price different from what we see in traditional sources?
Right. So see, I think in terms of the returns, there is a stark difference in the market for what a greenfield bid will offer versus, some of these M&A transactions. So any sponsor, when they're going out and bidding for greenfield projects, they would typically solve for, let's say, mid to late teens rupee levered IRRs. And then the underlying assumption is that once the projects mature, the cost of debt comes down, there is a possibility to monetize these assets and get a yield contraction. And this is what we've seen a lot of global developers and funds, for example, doing. When I come to the returns for operational projects, these are typically early double-digit rupee returns, but these vary about 100 to 200 bips, depending on, for example, what is the configuration of the project, solar being the lowest and complex FDRE projects being the highest. And it also varies a little bit depending on the off-taker. So central off-takers would generally merit the lowest cost of capital. And on your second part of the question of, consumers, how do the consumers see this? See, the good thing is that renewables still, although in terms of installed capacity, it has almost become 50% of India's capacity. But in terms of actual energy contribution, it's much lower because plants operate at lower CUF. So the consumers, in a way, are indifferent because it's a blended cost of power. And today, anyway, renewable is at grid parity. So it does not affect the consumers, but definitely the entire power mix becomes greener.
Okay, all right. Thanks a lot, Shrishti, as well as Piyush for joining in and giving us clarity with regard to how do you all view this particular transaction. Net, it appears that the Aditya Birla Group has got this asset at a fairly good valuation. And it's showing, that Indian companies as well, they continued focus on the renewable energy piece. Wishing you all both a good day ahead. Thanks for joining in. Well, time to slip into a short break. On the other side, we have Amit Murarka of Axis Capital who will be joining to discuss what do we expect from the metal sector in Q1. Stay tuned.
Welcome back. Well, after the initial bout of recovery from the lows, the market sold off once again. The Nifty is below the 24,100 mark, sitting with a cut of almost 130 points. And this time around is the Nifty Bank, which has taken it, lower. It's down about 1% and no support coming in from the IT index as well. So across the board, there is some selling. And the advanced decline comes up for you once again. It's widened, 1,800 stocks in the red for about 900, which are in the green. So there is a bout of selling after the recovery that we saw. So let's see how that goes. The rupee has weakened past 96.1. But this is also the time where we get you our special quarter se quarter tak segment, where we bring you earnings expectations from each sector. And today, Nigel has walked across to the wall to tell us how the first quarter will be for the metals sector. Nigel.
All right. Thanks a lot for that, Mangalam. Well, quarter one FY27 earnings season is set to begin for the metal sector, and expectations point to more or less a mixed quarter. While for ferrous companies, well, they're likely to benefit from stronger steel prices, non-ferrous players could see support coming in from elevated base metal prices. Let's start off with the steel companies first. The average steel realizations are expected to increase by around 4,000 rupees per ton on a quarter-to-quarter basis. That's driven by price hikes that were implemented over the last 2 quarters. However, higher realizations are likely to partly offset by rising input costs, like coking coal prices, which remain elevated, and iron ore cost as well did move up higher in the past quarter. On the volume front, well, steel companies are expected to report around an 8% year-on-year growth, although volumes may decline by close to around 14% on a sequential basis, but that's because of the seasonality factor that did play out. The capacity ramp-ups at Jindal Steel as well as at JSW Steel, that's what's expected to support the overall shipment growth. Overall, the sector margins are expected to improve by roughly around 1,500 rupees per ton in quarter one FY27. That's supported by elevated flat steel prices. That said, the benefit is likely to be moderated because of the higher coking coal cost as well as seasonal weakness in rebar prices in particular. Though HRC prices have remained pretty stable, the rebar prices have come in for some profit taking, or in fact, there's come in for some pressure as well. And now we're getting into a seasonally weak period as well. So rebar prices could remain under the weather. For non-ferrous companies now, expectations remain broadly positive because commodity prices have been strong, and that's what's going to support earnings for the past quarter. On a sequential basis, you have aluminium prices are up by 12%, zinc prices are up by close to around 7%. However, silver prices have pulled back in the past quarter. So let's have a check now on the company-wise EBITDA expectations. Hindalco, that's expected to report the strongest EBITDA growth at around 14%. This is as per Jefferies estimates on a sequential basis. Followed by JSW Steel, that's expected to deliver a growth of close to around 11% on the EBITDA. On the other hand, Hindustan Zinc is expected to see a marginal decline of around 1%. Coal India could report a fall of close to around 4%. And Tata Steel is expected to report a decline of close to around 7% in EBITDA, followed by Sham Metallics at around 11%, and Jindal Stainless, which may see the sharpest decline on a sequential basis of around 13%. Overall, the quarter is expected to reflect the improving steel realizations and resilient base metal prices, although higher input costs and company-specific factors are likely to keep the performance a little bit mixed across the metals pack. Well, to help us out with how the last quarter is panned out and what are the top picks from here on, we're joined by Amit Murarka, the Executive Director at Axis Capital. Hi, Amit. Good to see you. When interesting times, right, for the metals pack. Last quarter, things look good, where base metals prices could go no wrong. And now, towards the end of the quarter, well, it seems a bit of a wake-up call. First, give us a couple of expectations. Which stock could be the potential outperformer in terms of earnings reaction for quarter one, FY27?
Yeah, good morning, Nigel. We are expecting a strong performance from the non-ferrous space, which benefited from higher aluminium pricing in the quarter. Additionally, the physical markets are also tight. So there was a premium on the delivery of the metal to the local markets of about $300, $350 a ton versus usual premium of $800. So it's been a very strong quarter for generally the aluminium names. The steel names are also doing well, but there's a bit of a moderation due to cost inflation coming in from coking coal and the broader inflation from West Asia crisis. So to name the companies, essentially, Hindalco and Nalco both are expected to see a 13 to 14% sequential EBITDA growth in our coverage. The steel companies will have more or less a flattish quarter in that sense because of the volume declines that we have seen due to the seasonality.
Okay, all right. Amit, how would you approach the ferrous pack? Some of these stocks, they've either consolidated the pullback. Stocks like Tata Steel, SAIL, they have seen a good pullback from the recent top. Is it providing a good entry opportunity? Now, this monsoon season will not have much good news. But do you think that steel is providing a better entry opportunity, or would you stick to the non-ferrous names?
No, we clearly prefer the ferrous names in the current situation. This is obviously premised on the assumption that the West Asia conflict doesn't get dragged on for too long, because that's essentially an important driver of aluminium pricing and the stocks which we have seen in the last 6 months. So our core thesis is that the conflict doesn't get too prolonged, and aluminium market, we believe, will be in a surplus in CY27. We see a 0.5 million ton surplus, assuming a ramp up of Middle Eastern supplies. So we therefore see downsides to actually the metal prices, aluminium prices, and some of the aluminium stocks as well. Whereas in ferrous, I think the pricing, particularly for rebar, will have a tailwind from the seasonality factor, as in once we start getting out of the monsoon, we expect better construction demand and recovery in prices, and expect some upside from names like JSPL and JSW Steel from current levels.
All right, quite interesting then. So you're in the camp that says that ferrous over non-ferrous. Since you're expecting the aluminium global sector itself to go into a surplus in 2027, what pricing are you working with? Because people were dancing away at around $3,800 per ton. It's come down to around $3,000 per ton, and now overnight there is some bit of a pop. I think the Chinese aluminium company has gone ahead and increased their guidance as well. That's what's having some positive sentiment rub off. But pricing, what are you factoring in for this year and next?
So this year we are at $3,150 a ton, and next year we are at $2,800.
Okay, all right, $28, got that. Also, let's focus on some of those miners then. Coal India is a stock that has been in focus. The government came in there. They did the smart thing, right? They went ahead and they did the OFS. There was plenty of demand though. Currently, the stock price is below the allocated price, in that OFS. I think it's the allocated price was around 447 or thereabouts. What's your view on Coal India? Do you believe risk reward is still favorable? And if you want to come in with a word on NMDC?
So we see risk reward as favorable in Coal India. I think people basically are playing the stock also as a proxy to energy pricing, as we see. So whereas we believe that the Indonesian coal pricing, the export pricing will stay elevated in the longer term, because the production quotas over there are getting cut, exports are going down consistently. And the pricing has already jumped by almost 40% or so in the last 1 year. That's going to support the e-auction pricing and volume for Coal India, which we've already seen in Q1, wherein e-auction volumes have jumped almost 45% YOI for Coal India, and premiums have also been better. So we see actually there being good traction in the name from here on. And additionally, there's some value unlocking expectations as well from some of the subsidiary IPOs, which could happen in the second half of the fiscal.
Got it. Okay, all right. So Coal India, but you'll have a buy rating on that stock, I think.
Yeah, we have an ad rating.
Okay. The point you made on rebar prices, the gap between rebar prices and HRC, that's between longs as well as flats, that's widened quite a bit, because rebar prices have corrected while HRC prices have been more or less stable and they've fallen less. Do you think that has got a little bit excessive right now, and now you expect actually that catch up to take place?
Exactly. So I would expect rebar pricing, actually, to kind of put a background to it. Rebar pricing has a seasonality, strong seasonality rather, to monsoon. For the last 3 years particularly, we have seen prices drop by almost like a 10 to 15% range and start recovery once the monsoon gets over. So we have already seen a big correction of almost 15% actually happen in the last 2 months. And I think probably the pricing will stay a bit weak for another month and a half, and then will start to recover. And the gap in that sense should shrink, though we don't expect rebar prices to reach parity to HRC.
Yeah.
I think they will stay at a discount simply because HRC has a support of safeguard duty of 11.5%, which is not available in rebar.
Got it. Since I think JSPL is a stock that you're quite optimistic on, and a couple of factors are playing out. One is the volume growth. Then you'll have pricing, as you're saying, could bottom out. Obviously, it doesn't catch up to HRC, but that gap between the two at least narrows out. And they have a higher amount of long exposure, though they're adding flats as well. How concerned are you about this rejig at the top? The CEO comes in October 2025, moves out already. I mean, how do you approach a stock? You want some stability at the top, right?
Honestly, it has been one of the long-standing issues in the company. this management has been in a bit of a flux for quite some time, not just the last 1 year. And that obviously is the reason why there is so much volatility in the name as well. But ultimately, I think we have seen that investors tend to reward growth and earnings. So to that extent, I would say that the recent correction kind of is giving a good entry point in the name.
NJSPL. Okay, all right. So in Jindal Steel, as it's been renamed. Final question: the Vedanta Group has been in focus because of the various verticals that have now got listed. I wanted to ask you about the Vedanta Iron and Steel unit because that's a smaller part of the business. But in terms of I know you don't officially cover it, but in terms of a replacement cost or any kind of math you have done with regard to that entity, because suddenly the street is quite excited about that unit as well. Probably because it's a smaller vertical, price-wise as well, it's less than 50 rupees. So there's a lot of interest. Any view on that name?
Honestly, won't be able to offer a comment on it as we don't cover the name. So we'll stick to covered names in this discussion.
Okay, all right, Amit, we appreciate you joining in. Thanks a lot for giving us your view on a lot of those stocks. So that's the call coming in from Amit. Ferrous over non-ferrous, that's the name that he's looking at. And in terms of ideas, one of the top picks that they have is Jindal Steel. The recent rejig at the top is making investors a little bit nervous, but he believes it's a good entry opportunity. And from the mining pack, Coal India is another stock that they like. Rima, back to you.
Thank you very much for that. And I think for the aluminium players today, Chalco, which is the Chinese-owned aluminium company, has released, I think, the numbers and
that's
some
what
profit.
we discussed.
Yeah, that's also pushing up stock prices like Nalco and Hindalco today. But let's just get in Sudarshan now for more on Biocon and the block deal and the way the stock has reacted. Sudarshan.
Stock has reacted positively, currently up more than 5%. Just if you talk about the news, more than 9 crore shares have changed hands. And the entire block deals happened in the block deal window. And that's the reason you are seeing a sharp surge in the stock price. And the block deal value total value is more than rupees 3,600 crore. The biggest positive part is that it has happened at rupees 400 per share. And that's at a 5% premium to the floor price that company had set. And the floor price was rupees 378.50. Now, the another positive part is overhang of Mylan holding the stake in Biocon is gone. Mylan has sold its entire 5.64% stake. So how did Mylan hold the stake in Biocon? So remember, Biocon and Mylan have had the long-standing partnership that it's been going on since 2005 or 2006, and Mylan held the stake in Biocon Biologics. Now, early in 2026, as part of the agreement, Biocon had acquired over 6% stake from Mylan that they held in Biocon Biologics, and instead of that, they have got more than 6% stake in Biocon. Now, some stake they had sold earlier, but remaining 5.64% stake they have sold today. Just at the end, remember, do you know at what price Mylan had got the share in Biocon via preferential allotment? It was at rupees 405.70 per share. So if the question is, did Mylan make any money? The answer is no.
Okay, thank you for that interesting fact there. Before now, the stock is reacting to the fact that the stake sale overhang is now out of the way. A quick word on HCL Tech. Stock is still under pressure, seeing some profit booking. Remember, it had rallied 14% till yesterday in July itself. And on account of it, the stock was trading at a premium to peers like an Infosys TCS. So HCL Tech's valuation PE FY28 was about 16 times, while a TCS was closer to 14.5 times, and Infosys a similar number. So there is that, that reverse trade taking place. Maybe some money is being pulled out of HCL Tech and it's going into other names like a TCS. But purely on, numbers, it's a decent set of numbers. The advanced AI revenues have gone up 62% on a year-on-year basis, though it's still 4.7% of the overall revenues. Net new deal wins are strong at a record level in Q1 at $2.4 billion. The company is saying the pipeline is also strong. Remember, in July itself, they had won a $1.1 billion deal. The company holds on to its FY27 guidance. It's making a bet on data centers with an initial investment of 3,500 crore rupees. So all that is great. All that is fine. But I think the only niggle in the, there's nothing in the numbers per se why the stock is correcting. It's just that perhaps it had run up too much in the near term. So there is that mean reversion taking place versus peers. But Mangalam, Concor?
Well, Container Corp, it's buzzing in today's trading session. The company actually reported its first quarter business update yesterday towards, the dying minutes of trade at around 320 thereabouts. The numbers, 8.89% is the volume growth, the total volume growth that the company has reported. Exim volume growth at 9.8%, domestic volume growth at 6.17%. How does that fare against their guidance at the start of this year? At the start of the year, they had guided for 9.5% total volume growth. So this time around, the total volume growth has been 8.9%. Exim volume growth was 8%, and there it has been a bit of a beat, 9.8% versus 8%. And domestic volume growth target was 15%. The company has reported around 6% in terms of domestic volume growth. So the street is excited by the fact that Exim volume growth has actually beat expectations and the company's own guidance. But here's a couple of points to put it into perspective. This is the first time the company has given a less than double-digit volume guidance growth. In fact, over the last few years, if you look at all the previous leadership of Container Corp, they've given volume growth guidance between 15 and 20% itself. So they curtailed their guidance lower, and this is a mild beat on those lower guided numbers. And remember, the stock over the last few years as well, from closer to 900 had moved closer to 400, and at lower levels, from the lower levels on beating muted expectations, the stock has seen a bit of a bounce. So we'll monitor how Container Corp plays along in today's trading session and beyond this as well. For now, it's rejoicing the fact that at least the lowered guidance has been met, if not beaten.
Okay, thank you very much for that. Still down about 130 points in the Nifty. Chandan Taparia, Motilal Oswal Financial Services is now joining in on the show. Chandan, how would you approach this gap down? Any trade that you've taken on the Nifty and Nifty Bank?
Yeah, good morning, Rima. Thanks for having me. So the Nifty got stuck in a range. We have noticed in last 15-20 days that multiple supports are intact at 23,800 marks, but at the same time, two key hurdles are placed near 24,250 and 24,450. So those hurdles are not allowing market to move on higher side due to the geopolitical concerns. But at the same time, we have noticed the declines are being bought. So we have to be very selective until the market doesn't give a decisive breakout of this range. It would be tough to get the next leg of rally. So as of now, the suggestion is you have to be in a broader trading range. If market comes near 24,000, utilize the support near 23,800, play the bounce towards 24,250. So that's all what we can do in the index as of now. If I look at the data setup, that is giving the mixed cues. FI's long short ratio is near 10%, put call ratio and the VIX are giving the mixed setup sentiment in the market. Now, if I look at the Bank Nifty index, that has been consolidating in a range from last almost 15 days. Multiple supports are visible near 57,000, but hurdles are at 58,000 to 58,250. So mixed setup cues in both the indices, but as immediate trend setup is positive, so one can go with buy on decline near the key support on declines in the market.
Stocks, Chandan, that you would bet on?
Yeah, so to buy one sell side, first it is buy on Divis Lab. Selective pharma counter are doing well, and Divis Lab has given a consolidation breakout on the daily and the weekly chart after 40 days long consolidation. It is holding well above its rising trend line with the respect of key moving averages. In fact, a positive price pattern of the rounding formation also indicate the bullish stance, or the counter can play as a defensive nature as well. So with support of 68.50, looking for an upside move towards 72.70 in the Divis Lab. Second trading idea, that is buy on Adani Power. Somehow Adani group of companies has been consolidating in a range, and Adani Power has taken support at 50 demo after the corrective or consolidative move of last 8-10 weeks. It took support near 215 and higher base is being created. So looking for some bullish stance. So with support of 216, look for a recovery towards 233. One more trade that is on the sell side, that is sell on PI industry. One of the weak counter has been making lower top, lower bottom on the daily and the weekly. So one can sell with hurdle at 25.80. Counter can decline towards 24.50, 24.25 marks.
Thank you very much for that. Just one word on the Korean markets before we get into the break. Kospi sliding now once again, nearly 3.5% to 4% lower now. When we last checked at about 8 o'clock, Kospi was down 2%. But the sell-off in the Korean technology semiconductor names is accelerating. So 3.7% down now on the cost. Okay, sorry, on my screen it showed about 3.5%, but maybe it's still down 1.5%. So we'll go with that. Get into a break. We'll come back with more on commodities. Stay tuned.
Welcome back. Sterlite Tech, a stock which had a one-way meteoric rise from the beginning of the year, has been correcting for the last 3 or 4 trading sessions. So Sterlite Tech, another 4-5% down. This week itself, stock is lost close to about, I think every day it's been going down 4-5% yesterday and today. The other one is Lodha Developers, a stock which rallied 20% from the beginning of July as interest revived in the real estate space, is also correcting a tad bit. So Lodha Developers is down nearly 3.5%. But Manisha is now joining in and she's going to give us data on India's sowing. Manisha, how's it looking considering how erratic monsoon has been?
Oh, well, absolutely. It's not looking good at all. And, you know, it's not just the crude oil prices that gained 10% overnight, which is a worry. It is going to be about the El Nino that India is facing and the weaker monsoon as well. That does seem like a double whammy for the Indian markets right now. So when you look at the overall monsoon itself, starting from June 1 to 13th of July, we're looking at 19% of a deficient monsoon, even as July has been quite great. June, remember, was 40% deficient. So we haven't been able to get up to those numbers. And then, of course, after that 1st to 10th of July rainfall, after that, it really has slowed down yet again. So while overall India is 19% of a deficiency, East and Northeast continues to be very deficient at 36%. South Peninsula hasn't been able to pick up as well, 22% of a deficiency there. West is 12%, Central India 8% of deficiency at this point in time. But when you look at the overall map, the large deficiency may have come off, but the deficiencies across the country still stand at a 40% toll. So we are looking at many states which have seen more than 20 to 30% of deficient rainfall coming in there. This is what we've done in the last many years when it comes to the Indian monsoon. So last couple of years actually was above normal at 108%. And then we've seen 94% of a normal monsoon, normal again, and then normal again. So after 5 years, India is looking at a back-to-back very good monsoon. India is perhaps preparing itself for a deficient monsoon. The all-time low in sense of overall monsoon deficiency has been to the tune of 22%. And India is not too far away from that, depending on, of course, on how August and September pan out. Is something that we'll have to see in that sense of number there. The lower monsoon has led to delayed sowing. And if you look at the latest data that came in yesterday evening, we are standing at 16% lower sowing as compared to last year. And this is what we've done in various commodities as well. And there are concerns, by the way, building up in pulses, oil seeds and cereals as well. Pulses sowing is 23% down. This is perhaps the lowest number that we're looking at in a decade right now. And within pulses as well, it is about tur, it's about urad, moong, where you have seen 10 to 30% of a decline in sales of sowing. The next one on your screen is coarse cereals, where again, 23% of a decline coming in for this one. So whether it is about bajra, jowar, maize, you're looking at 20 to 25% of a decline in sense of sowing. Pretty much similar scenario when you're looking at oil seeds, yet another very important crop in Kharif. And here as well, 21% of a decline in sense of sowing. You're looking at 34% of a decline in groundnut, 46% in sesame, and 16% in soybean as well. So weaker numbers continuing. The important point to watch out for is that while the sowing has been delayed, the window is open for next 10 days, and that's about it. So if the sowing does not pick up in next 10 days until the end of July, then we are looking at serious concerns in sense of sowing numbers as well. The only positives that I see in this one is rice decline, but just about 9%. And then you have cotton, which also has seen a 15% of a decline coming in. Cane is 1.2% higher as compared to last year. So barring cane and a couple of other crops, almost every crop number sowing shows a decline as compared to previous year. As I said, it's a bit of a concern. If it's end of July and these numbers don't catch up, then we are looking at lower sowing and lower crop numbers.
Thank you very much for that, Manisha. Some more stocks. Bajaj Consumer is taking a leg down. The stock was down 2% yesterday despite good numbers. Today, another 11% lower. Remember, this is a stock which has gained 150% in the last 1 year. And in Q2, the management in the conference call did indicate that there could be margin pressure on account of raw material inflation. And MTAR Tech is another one of those high flyers, 165% gain year to date. And the stock today is correcting. Overall, benchmark indices are down nearly 0.5%. We will get into break. On the other side, Lata will speak to the management of Bank of Maharashtra on the back of the Q1 numbers. Stay tuned.
impressive set of numbers. Well, Bank of Maharashtra posted an impressive set of numbers, 27% rise in profit, 27% rise in advances, and a 13% rise in deposits. Net interest margins, however, fell from 3.91 in the March quarter to 3.79 in the June quarter, a cut of about 12 basis points, and that probably led the stock to see some kind of selling this week, though, of course, even the macro factors have been very difficult this week. Joining me to discuss the result is Nidhu Saxena, Managing Director and CEO of Bank of Maharashtra. Mr. Saxena, thank you very much, as always, for dropping into our studios. Well, let me start first, not with your results, but where you were yesterday. You know, our reporter Sapna was reporting on your meeting with the finance minister. What is the overall sense that we may get in terms of FCNR, overseas OFCBs and ECBs? Was the mood very positive?
So the agenda for the meeting was to discuss on the preparedness and the steps individually banks are taking, just to take a stock of those on all the three elements, all the three opportunities. So FCBs, ECBs, OFCBs, and of course FCNRB. FCNRB is going to close, the window will close on 30th September, while the other two continues till December 2026. In Bank of Maharashtra, we also are looking at this opportunity in terms of, if you look at our credit growth, which is 27%. Of course, there is a 3% contribution from IBU. Minus that, it is 24%. So it's a decent high double-digit credit growth that we are able to register. We feel that OFCB's fundraising that we will be doing are going to make a lot of commercial sense also to the bank, and we will continue to see that good contribution to the bottom lines, margins, if we are going to go through this route. Okay. And what has it been a big strategic move we did when September 2025, our GIFT IBU was operational in a record time of 5 months of RBI approval. That gives us a lot of opportunities to do ECB transactions and also do OFCBs easily through that route. We have already done 9 ECB transactions so far, 430 million odd, and there are a lot of things in pipeline, and I think...
What is the likely OFCB you will raise? And I mean, is there any target number you have in mind?
So yes, we are looking at a figure of 1 billion actually for the bank, and this is going to be a supplementing me in raising resources for supporting this credit growth. So while I have other options to look at, but when I evaluate this option, this also makes a lot of sense. And when there are RBI swap benefit which is available, when the need is there also for the country, why not we will participate.
Fair point, but let me come to the advances part itself. 27 and 13, 27 advances and 13% growth in deposits is the widest difference if you look at any bank. And that is seen in your credit deposit ratio. You were at a very healthy 79. Now you have come to, I think, 88.
86.
So that is, that cushion is going down. Can you continue to have such a big difference? Do you not have to narrow the difference?
Right. So, very good question. I think I would like to showcase what is happening behind this, and it is a conscious strategy on our part to see what element of resources we are raising to support this credit growth. If you see 27%, yes, 3% is coming from IBU, which is supported by borrowing. So, domestic advances are growing at 24%.
Yes.
Probably in the Q1, we haven't raised a single CD. Okay. And I could be seeing myself, because the results so far and the average in the PSB and average in the private banks, the CD contribution is substantial. Okay. PSB average I was seeing, if they've grown their book deposits at 11%, you minus the CD, it is 10%.
Yes.
In case of private banks, the book has grown, deposits have grown at 14%, you minus the CD, it is actually 11%.
Yes.
So against a 10-11%, mine 13%, which is a core deposit growth, is something which is good, I would say, and very consciously done. What we feel, we are not averse to CDs. We can keep looking at those options as and when. But CDs, of course, come with some of their own challenges. It's a short-term measure. Maximum tenor is 1 year. You also have a runoff factor of 40% when you do your LCR calculations. So actually, you are supporting your credit growth through borrowings. While the situation when we have not raised a single CD in the Q1, we have supported all the credit growth through our deposits. And yes, there is one another element which is supporting, which is refinance that we have been taking. And that also almost 19,000 crores of refinance is availed. Again, that comes with the advantage when I'm having a blended cost of almost 6.25 to 6.5. There is no CRR and SLR loading.
Yeah.
It makes a lot of sense to continue with this strategy.
But you don't worry. I mean, that is part of the reasons why deposits are still low cost compared to the other avenues. And there is a historical RBI discomfort with a very high CD ratio. They have not mentioned it in the last 2 years, but as you go towards 90, that discomfort will come. Will that impact on margins? If you are pushed to raise deposits, as it is from, you have lost 12 basis points in terms of margins, can there be more pressure?
So I'll tell you the YOY dip in margins NIM, which is 10 bips and 12 bips Q on Q. We had done a lot of MCLR cuts in the last FY. And the MCLR cuts, the reset has happened in the entire MCLR book by March last Q4. So we have seen in Q1 a full impact of the MCLR cut. No more pressure, that is one. Second, yes, we have also seen with the widening of rate that we offer on a TD versus a SB rate. So there is some shift in movement from savings accounts to term deposits. My saving CASA has grown at 9%, while TD has grown at 16%. So these two elements are playing. But if you see, we are 3.85 NIM, which is a good, high, decent number. And if I recall the guidance that we have shared, to maintain our NIM at 3.75. So we are still 10 bips more than that, is what I sense. Okay. Tomorrow, we feel that, of course, there is no talk of any further rate cuts now. If there is a
rate hike,
I'm sorry, I correct myself, no rate hikes. But if there is a rate cut, I have almost now 50%, 53% book which is repo linked. Moment that happens, I will start seeing that there is a
cost of the cost funds go down. Yeah. But anyway, at the moment, given that inflation is on the rise, there is no rate cut on the horizon.
And I would like to answer, sorry ma'am, about the CD also. CD ratio, which is from 80 has gone to 86. But again, if you minus the refinance, it is 70, I mean, today it is 81%.
Okay. It's not as big as 86.
It is what looks like 86 is actually 81% only because of the refinance, and which is a conscious strategy because we are having our sight on the margins at all times.
Okay. I wanted to come to your tax. That has been a very big asset for you, the lower tax ratio because of past bad loans. Does the advantage run for this year also? Will you be paying lesser tax rate than a comparable bank?
The accumulated losses benefit got exhausted in the last FY. Okay. FY 25-26 in the half year, we completely exhausted. I paid almost 900 crores as advance tax for the last FY. For the Q1 also, we have paid an advance tax of 300 crores. Okay. So now we are into the new regime. The applicable rate is 25%. But looking at the eligible deductions that we are allowed to take when we are raising provisions for rural advances, non-rural advances. So as per guidelines, so my effective rate is around 17%. Okay. And I have also shared this in past with the tax liability coming up. I don't foresee even in percentage terms or in absolute terms that you will see any dip in my OP or NP numbers.
Okay. Oh, well, there's one question which a viewer asked me to ask you. Are you going to raise capital because you have taken permission for 5,000 crores? He was worried because your CRAR is already 18%. Will you raise capital?
So while you rightly observed, we are adequately capitalized with the CRAR of 18% is quite healthy. But if I look at my guidance is to maintain it at 17 and above 17. Now with the fast credit growth that is happening in the system, and my ROE, if you look at, is 24.65. And if I decide to raise capital, looking at the market conditions, it can be a case where you can look at. So what ideally we do at the beginning of the FVI, we do take the enablers. So today my board approval is there to raise equity of 500,000 crores and total is 7,500 crores. We have gone for a shareholder approval is also there. It's with now government. We have submitted our request. Once that enabler is there, at opportune time and using an opportune mode, we will decide on this element also.
Now, the most important question is this farm loan waiver and, how your agri loans will perform. At the moment, your slippages or NPAs or SMAs, it is not even worth talking about. It is so good, so low. But your agriculture sector loans have grown at 28.9%. And the percentage share of NPAs in agri loans is, I think, 7.5% or something.
You're right.
Now, if you take that and you take an El Nino year and you take this farm loan waiver, where even those who are not eligible for waiver, it kind of spoils the credit behavior. Should we worry about your agri loans?
So I would clarify that the agri growth that has come, almost 10,000 crores YOY basis, my agriculture book has increased. If you see the contribution that has come from the gold loans, it is 9,200 crores is gold loans. So which is all backed by security. So there is absolutely no concern about our agri going and going to give any problems. My gold loan, if you see, YOY has grown at 75% and major part is happening in the agri segment. That is one. Second, you asked about the farm loan waiver.
Yeah.
We have looked at the eligible accounts. 3,500 crores is the portfolio, which is eligible as per the state scheme. I have 2,600 crores, which are already slipped to NPA or TWO. So anything that is happening in the farm loan waiver and with a 91% of provision coverage ratio outside the TWO book, any recovery that is going to come from the government and even the farmers have
that will be fine.
So
my worry was only whether it spoils credit behavior.
Yes.
El Nino pressure is there and this feeling that waiver mil jayega.
So I have already, my agri NPA is 7.93. And we have seen that because of the waiver announcements, there are some holding back of repayments to banks. Whatever has slipped is already come. Now it is the time to, I would say, see the benefits out of it. Moment the recovery is coming, I will see in my P&L statement, both I will see a TWO recovery. I will also see a PL positive benefit through write back of provisions.
So absolutely out of time. My producer is angry with me. I have to thank you for coming to our studio. Let's have a longer chat when results are not, sitting on our head.
Thank you, ma'am, for having me.
We have to wrap up on Bazaar on that note. After a break, Chartbusters.
Brent crude has climbed back above the $80 mark, now at $85 as US-Iran tensions heat up. President Donald Trump has announced a 20% toll on ships using the Strait of Hormuz, sparking fresh concerns over global oil supplies. The spike in prices drives action in crude-sensitive stocks. As you can see, ONGC mildly in the green. The users are in the red.
HCL Tech takes a knock. The IT major reports an earnings beat in Q1 FY27. The company records its best ever new bookings at around $2.4 billion. AI business grows by around 10%. The management retains FY27 guidance of around 1 to around 4% growth in constant currency revenue. Brokerages deliver a mixed verdict on the counter. So the stock comes in for profit taking.
Viatris-owned Mylan exits Biocon. 9.2 crore shares worth 3,600 crores change hands in a block deal at an average of 400 rupees a piece. That's a 5% premium versus floor price of 378 rupees a share. The stock jumps 7% in early trade.
High flyers of today's session, Nuvoco Vistas delivers a steady Q1 results, sustained cost discipline and operational efficiencies back margins. The consolidated volumes grow by close to around 5%, while the realizations pop up by close to around 7% on a sequential basis. PDS inks a multi-year SaaS SaaS contract with a French headquartered supermarket company. The stock pops up more than 10%.
The centre fast-tracks IDBI Bank's divestment following high-level talks yesterday. DIPAM and DFS secretary is part of the ministerial group. That's a CNBC TV18 exclusive. IDBI Bank pops 3%.
Well, hello and welcome to Chartbusters. We're coming to you live from the CNBC TV18 Motilal Oswal studio. I'm Nigel, with me is Mangalam. And as you can see to the top of our screens, the Nifty is down by close to around 100 points. But like we saw yesterday, relatively actually the Nifty is doing an outperformance. The Kospi, the last time I checked, was down close to around 1.5%. And the remainder of the Asian markets as well are seeing some selling. The problem is that the rupee has weakened yet again. It's holding at around the 96 odd mark. And the crude oil prices have spiked up, holding above that $85 per barrel mark. But the Kospi actually has wibbly-wobblied. Now it's recovered from the day's low. Though if you look at it in the last few trading sessions, it's corrected from around that 8,000 odd mark all the way to around 6,800. Mangalam, we wouldn't want those sort of moves here in the Indian markets. The Kospi, even after the pullback though, it's still up close to around 60% or thereabouts. And important to note that in the Kospi, the FIs have been sellers actually from the start of this year. It is more the domestic money and its leverage positions that have pushed up that market.
Let's see where that goes, Nigel. But the important part is the FI shouldn't continue or resume their selling in the Indian markets. Yesterday, we saw a little bit of that with the FI selling about 3,000 crores in the cash market. But so far, they've been fairly well behaved for the last 1 month or so. And as a result of which, we've seen the rupee stabilize as well. Now with Brent going back to 85 and the rupee moving towards the lows of today's trading session around 96.14, will be very, very crucial to track how these two matrices perform from here on as well. But from the broader markets, we are seeing a sharper sell-off. We have 2,000 stocks which are now in the red for about sub 900 which are in the green. So those lines are moving further apart from each other. And now as we speak, a bunch of stocks have come in for fresh bout of selling. HDFC AMC for one is moved to the low point of trade. ICICI Pru Life is the other one which has moved lower. A couple of these banking names are not doing too well, currently at the low point for Indian Bank as well. The Nifty Bank very close to its 200-day moving average. So long as it holds that, bulls will be fancying their chances. But let's welcome Manish Hathiramani for a quick technical check on the market. Manish, you had last time given us a target of around 23,900 as a level for the Nifty, above which, if it continues to hold on, the trade to 24,600, 24,700 is still on. We are off those highs and now at 24,100. Do you still maintain your bullish stance, or do you believe that maybe we're in a no-trade zone?
Good morning, Nigel and Mangalam. Thank you so much for having me on the show. Well, we are currently facing resistance around that 224-250 levels. We have reacted from those levels twice already, including a gap down this morning. 23,800 now continues to remain a strong support to keep our eyes on. Until that does not break, we would be looking at signals to go long on this market. On the upside, 24,600 is a plausible target. And if we break 23,800, then 23,500 is a possibility.
Got it. Okay. All right. Hi, Manish. It's been a while since we spoke. What about the Nifty Bank? I missed the level out there.
Nifty Bank, I'm working with 55,700 as a good support for the index. On the upside, we can scale up to 60,000. But the real level to look out for will be 55,700. Until then, certain banking names continue to look weak.
All right. Until then, certain banking names continue to look weak. A bunch of stocks actually doing well right now. Kalyan Jewellers is up around 4%. Just Dial 13%. A big 20% up move yesterday. Followed that up with 13%. Takes the last 2 days moves to about 35%. And now in the jewelry pack, we have TBZ as well, which is participating. That stock is another one which is up around 30% this month. So TBZ up around 12% for that counter. But we do have a bunch of your stocks that you've listed out for us. Manish, what would they be?
2 sell calls I'm working with. The first one is on Axis Bank for a target of 1270, stop loss of 1335. This stock resisted around the 1330 levels yesterday, and that's where we've turned from. The volumes are supporting the downward move. The second one is on SBI for a target of 995, stop loss of 1046. Similar situation like Axis Bank. We resisted yesterday at 1050 and we've resumed the short-term downtrend today.
All right, take that point. Manish, always a pleasure speaking with you. Thank you so much for joining in. And let's get you some ideas for profit. Before that, look at Cartrade, up around 5% today. Had seen a big move in the last few trading sessions. Yesterday, there was a UBS note that came in and they have a target price of 4,000 rupees on the stock. The stock didn't react as much, but now we are seeing some up move on Cartrade Tech.
Interesting, Manglam. What a year it's been for Cartrade, right? If you pull up the chart in the last 1 year or so, you'll see the stock had gone to around 1,800 odd because there was a lot of selling. How much of a challenge will AI be for the counter? And from there, there was a lot of buying. Just take a look at that. Yeah. In the month of March, April as well, the stock came down, I think, to around 1,600. And from there, let's take a look at that. Almost doubling, actually, from the lows that we saw.
Brokers is believing that there's still some more way to go. Over 30% gains from here on as well, as per UBS. Up 4,000 is their target price. But let's get you some ideas for profit. Our colleagues at Money Control joining in today. Neha Dave has a stock that she's tracking. Neha.
Today's stock idea is HDFC Bank. HDFC Bank's stock took a beating after the episode of chairman's resignation. Consequently, the bank is currently trading at around 1.5 times core book value estimated for FY28 after adjusting the valuation of subsidiaries. The valuation is attractive given that the bank delivered return on asset of 1.9% and return on equity of 16% in FY26. Going ahead, investors would closely track the development related to the reappointment of the current MD and CEO whose term is ending in October. Apart from this soft factor, the street remains focused on 2 key variables, that is loan growth and net interest margin, both of which came under pressure since the merger. However, there has been an improvement in these variables since the past couple of quarters and is likely to improve further in FY27. The bank's loan growth has accelerated to 15% YOY as of June end as per the business update released. And going ahead, the management has guided that the loan growth will surpass the industry growth from FY27 onwards. On the margin front, there has been a small uptick since past couple of quarters. There are certain tailwinds that are emerging, the impact of which will be gradually realized over the next 4 to 6 quarters. HDFC Bank is trading at a discount in terms of valuation to ICICI Bank. The valuation gap should narrow going forward. Long-term investors should accumulate the stock.
And thanks a lot for that, Neha. For the time being, we slip into a short break. On the other side, we focus on markets and stocks that are moving around. Stay tuned.
Welcome back. A lot of stocks which are buzzing around. Let's address them. Nuvoco is one. A good performance coming in. The stock holding the opening gains right now. Nigel, take it away.
Well, that's right. It's holding on to some gains. And remember, Nuvoco has been a big underperformer. But the numbers look good. And it's the first cement company to get off the blocks. So the revenue is coming higher by close to around 9%. Consolidated volumes jumped up by close to around 5%, coming in at around 5.3 million tons or thereabouts. The positive was that the realizations, that popped up by close to around 7% on a sequential basis because they have high amount of exposure to East India. That could give them some good contribution, as well as premium products as well could have supported those realizations. So that was the bright spot. The EBITDA number, the operating profit, that popped up by close to around 10%. And the EBITDA per ton, on a sequential basis, it improved by close to around 80 to 90 rupees. Well, the street likes that very, very much, and that's at a multi-quarter high, coming in at more than 1,070 rupees. On a structural growth trajectory, the Vadraj cement plant, as well as the East India expansion that they're planned, that's what's going to drive their capacity to around 35 million tons or thereabouts. So now they'll have exposure to the west part of the country as well. And we'll have to see how that pans out, because they've taken a bold move, gone ahead and acquired Vadraj cement. How they ramp it up is going to be top of mind for the time being. The street likes it. A good start, multi-quarter high EBITDA per ton. We'll have to hear the management commentary from here on, but for the time being, a thumbs up for the street.
Thumbs up indeed. And 2 thumbs up for Biocon post the large trade. 9.5 crore shares worth nearly 3,600 crores changed hands. Mylan has exited the company, offloading its entire 5.5% stake. Sudarshan joins in with more. Sudarshan, is it just a case of supply overhang gone, or is it also fueled by some short covering?
So two major triggers for Biocon that, as you have talked about, one trigger, that is the Mylan exiting the company, selling its entire 5.64% stake. What exactly happened is the entire block deal happened in the block deal window, and the price at which it happened was at 5% premium to the floor price. So block deal price was 400 rupees per share. Floor price was rupees 378.50 per share. So Mylan had got these shares in Biocon because of Biocon Biologics deal that company had announced in early 2026. And after, because of the preferential allotment, Mylan had the stake of more than 6% stake, and now they are out of Biocon. Another trigger for Biocon is MSCI rejig and the flows that company might see. So the level or range for the MSCI rejig is from 440 to 445 rupees per share. Now the stock is trading around 440. So it is technically eligible for MSCI rejig. What exactly it would happen? So currently Biocon is part of MSCI small cap index. Now post the rejig, it can be the part of MSCI standard index. Now because of that, flows can be of more than $260 million. So that also will be triggered very closely, and MSCI rejig is likely to take place next month.
Got it. Thanks a lot for that, Sudarshan, for explaining that. As we speak, the stock at 440 rupees. The other one that's buzzing from the broader markets is PDS. It bagged a multi-year contract with the global supermart chain. Divyani joins us to break that news piece for us. Divyani?
Well, PDS has secured a multi-year sourcing as a service contract with a leading French headquartered global supermarket effective from the 1st of November 2026 onwards. Now, under the agreement, PDS will manage textile sourcing operations across Bangladesh, Pakistan, India, Sri Lanka and Turkey for the French giant. And the company expects to handle approximately $250 million worth of apparel sourcing annually for the company. Now, based on the FY26 gross merchandise value of roughly around $2.2 billion US, the contract represents a potential incremental sourcing opportunity for the company with roughly around 11.5% of the FY26 GMV. So this is significant for the company, and the street is clearly taking note of this.
Significant indeed. The stock up close to 12% in a market that actually is trading in the red. Thanks a lot for that, Divyani. For the time being, slip into a short break, come back. We'll continue our focus on stocks that are moving around. Stay tuned. Welcome back. Well, let's focus on the banking pack. Then Sapna's picking up some information with regard to IDBI Bank and learns that the government has sped up the stake sale plan in the bank. Sapna, tell us what's the latest?
Well, that's exactly what it is, as you have put it very nicely, that yes, the disinvestment process for the strategic divestment of IDBI Bank has definitely been speeded up by the government. And just yesterday, 2 high-level panels have met consecutively. And also the departmental, group basically comprising of the DPM Secretary and Secretary DFS, they too have had discussions. So basically the 2 high-level panels, of course, are the CVD, that is the core group of disinvestment, core group of secretaries on disinvestment. It's headed by the Cabinet Secretary, and 2 consecutive meetings along with the IMG. So this is basically a clear indication that there is going to be a very visible acceleration in the process of divesting stake. 60.72% is what both LIC and government aim to disinvest. As you must be aware, some time back, the bids which had come in earlier for IDBI, they were below the reserve price. So there was a bit of a rethink at that point in time. It was almost thought that probably the process is going to be scrapped and the government has to redo it. But that's not what it is. The same thing is going ahead, except that there will be important changes that will go along. So that is what the CGD and the IMG have been discussing. We have to wait and watch as to when the transaction really finalizes and who the actual bidder is going to be. But this is very, very positive. Acceleration, speeding up, and going forward with the process.
Take that point indeed. Thank you, Sapna, and trust you to keep us, on top of the developments out here. The stock up nearly 4% right now. But let's talk about another key Supreme Court ruling on mining royalties today. The court has upheld the royalty computation framework and dismissed the challenges to the royalty on royalty provision. Ashmit joins in with more details. Ashmit.
Well, the concern that had been raised by particularly Kirloskar Ferris, which was the petitioner in this matter, was that currently the royalty framework is structured in a way that it has a cascading impact on the finances of the miners. What they were saying is that they're effectively paying royalty on royalty. Their argument essentially is that they're already paying the District Mineral Foundation. There's a contribution to that. There's another contribution to the National Mineral Exploration Trust. And this, importantly, is computed as a part of the selling price, which forms the basis for a computation of the royalty. So effectively, the argument was that this is a royalty on royalty and therefore should not be allowed. The Supreme Court has not agreed with that. Supreme Court instead has agreed with the centre's position. The centre's position was that there will be huge revenue losses as far as the state governments are concerned. In fact, one of the figures that had been cited by the centre is that over the life of the mining lease, the loss just for iron ore would be as high as 7 lakh crore rupees over the life of the lease, and that it could be several lakhs of crores if one were to include other minerals as well. So that is the argument with which the apex court has agreed. The Supreme Court has dismissed the application by Kirloskar Ferris in this matter, and in doing so, giving clarity as far as the computation of royalty is concerned. As far as the impact is concerned, important to watch as far as miners are concerned, of course, a bit of a setback coming in the sense that the Supreme Court decision, in a way, has dashed hopes for a lower royalty burden. But on the flip side, it does give certainty to miners as to what this burden will be going forward. As far as the state governments are concerned, they're clear beneficiaries, a huge uptick for them in terms of royalty payouts by miners.
All right, Ashwin, thanks a lot for that. So we will monitor the developments out here. For now, it's a sentiment negative. But one stock which is buzzing in trade today is Container Corp, following its volume numbers that came yesterday during markets. If you look at the overall volumes that the company reported, were just shy of the 9% mark, and it was led highly by the EXIM segment. So, the data comes up for you on the screen. The company's overall guidance was 9.5%. The company's reported 8.89%. But the reason why the stock is higher, because the EXIM volumes, the second point that you see out there, the guidance was 8%. And as against that, the company's done about 9.78%. And that accounts for most of the company's volumes. So, and as a result of which, the street has taken that with both hands. Domestic volumes much below street expectations. 15% was the guidance, and the numbers have come in at around 6%. But remember, the stock too, from levels closer to 900, has corrected to levels sub 500, and as a result of which, on lower volumes, we've seen a bit of a spike on Container Corp. But the other stock is Grasim, as it kickstarts today's session following the company's new acquisition. Nigel.
Well, that's right, Manglam. A big deal that was announced overnight. Aditya Birla Renewables has acquired Sulin Ergi Power. That, in fact, remember, that's a subsidiary. Aditya Birla Renewables is a subsidiary of Grasim that's gone ahead and done this inorganic growth. The seller, as we know, is Shell PLC. Here are the details then. The deal is done at an enterprise value of around 17,200 crores. Sulin Ergi Power, where it has a cumulative contracted portfolio of around 5 gigawatt. The consolidated turnover of the last few years has been 1,100 to around 1,250 crores or thereabouts. What's the rationale? Well, the Aditya Birla Group says it gives an opportunity to expand its renewable energy footprint. It increases Aditya Birla Renewables portfolio from around 4.4 gigawatt to around 9.4 gigawatt. And they target to scale this even more. So they've doubled it with this transaction. They're not done. They say the next few years it should hit around 20 gigawatt. The debt in the Grasim's book standalone basis is around 6,900 crores. Consolidated basis is around 37,000 crores. But you'll be wondering, such a big ambition, how will it be funded? Well, they have some details. They say that it will be funded by a mix of debt as well as equity from Grasim and some investment coming in from Global Infra Partners, that is GIP. Remember, GIP is a wholly owned subsidiary of BlackRock. And to recap, GIP had invested close to 2,000 crores in Aditya Birla Renewables with a green shoe option of around 1,000 crores. At that point of time, that's December 2025, they were valuing Aditya Birla Renewable Energy at around 14,600 crores. The timeline for this transaction is expected to close in this calendar year itself. Brokerages, both Morgan Stanley as well as Citi, both of them have a positive stance on the stock. However, Citi believes that in the near term, there could be some kind of pullback on the stock, while Morgan Stanley says that it's perfectly aligned and it helps them scale up the renewable vertical. So they continue to maintain their overweight stance. Knee-jerk reactions, the stock turned close to 100%. I think that's okay because the street appears to have more or less digested this transaction, going by the replacement value, going by the peers that trade on an EV upon EBITDA basis. So pretty okay. Markets down, stock down in line. Down 1% or thereabouts.
Take that point entirely, Nigel. And just before we, take your leave, we can say that the market's cut its deficit slightly, about 30, 40 points. When we started the show, it was sub the 24,100 mark. The Nifty was sitting with a cut of almost 120, 130 points. And now as we speak, down about 93, 94 points. And one of the bigger reasons for that is that there's been a slight recovery in the Nifty Bank by about 70, 80 points and the IT index as well. So the Nifty IT index had actually seen a bit of a drop and now currently trying to ameliorate from those as well, just under the flat line for that index. But apart from that, let's look at Reliance. That's the stock which has moved to the high point of trade. And that's caused the bulk of recovery on the Nifty right now from the lows. Reliance has moved higher. And with that weight on the index, we've seen, obviously, the Nifty cut its deficit. Even the pharmaceutical pack is doing a lot better, obviously led by Biocon. But around that, ahead of the semi-finals, the World Cup semi-finals, the FIFA World Cup semi-finals, we have Z Entertainment, which is higher by about 4%. So they are obviously broadcasting that game in India today. But apart from that, we'll also have it being, broadcast on the Doordarshan platform. But Nigel, who are you gunning for?
Who do you think are going to make the finals?
Can I tell you something? I don't know who are playing the semi-finals right now.
I'm going to go for England versus France in the finals. So let's see how that goes. My son believes that it's going to be Argentina versus Spain, but good to be on opposite ends. It promises to be an exciting next couple of nights because watch the game and turn up to work in the morning. If I don't, you know why.
For me, the more important part is that today Virat Kohli and Rohit Sharma are making their comeback once again on the ODI side. So I will monitor that, not taking place too far from the World Cup venue also. You have England and these guys are playing in England as well. With that, we'll wrap up on this edition of Chartbusters. Our director tells us the team of Trading Hour is waiting by. So stay tuned for that.
Good morning, you're with us here on Trading Hour. We are coming to you live from the CNBC TV 18 Motilal Oswal studios. I'm Harmas Patakia. Joining me as always is Ritu Singh. Ritu, good morning to you. Well, the word of the day today could be, well, resilience, as was the case yesterday as well. 200-point gap down yesterday, and we managed to end at the flat line. A 200-point gap down today, and we are yet again looking to recover from the lows of the day. 25,050 or thereabouts has the low, and we are around about 70 points off the lowest level of the morning so far. And it's been choppy, today being the weekly expiry as well of the Nifty contract, so that will also bring about its fair share of volatility today, possibly the last quiet sort of a day in terms of results before the earnings season picks up and culminating into a very action-packed Saturday that is going to keep Ritu very, very busy, isn't it, Ritu?
Yes, Harmaz. I mean, you name all the top private banks and they've decided to all come together and report all of the numbers on the same day on Saturday. But that aside, good morning to you. Your resilience is the word of the day. And, the market's looking to recover a tad, at least in the last half hour. And so the banking pack, the IT pack, which has been under pressure. I mean, they're still trading very much in the red, but looking to make a bit of a recovery as we speak. The volatility index, which had spiked up quite sharply to about 8.5% yesterday. That's also at about 13, it's up just about 1.8% as we speak. The market breadth shows you there's almost 2 stocks that are declining for every 1 stock that is advancing. But that said, there are some pockets of green here and there, where you can look to. For instance, the metal pack is doing relatively better today. Pharma, media as well is holding up. But the realty pack, PSU Bank, auto, financial services, of course, banking and IT very much in the red. But as always, let's go across to Hormas to give us a list of the key movers and shakers in today's market.
Something that the bulls might be also taking heart from the fact that although Asia has been very, very volatile, they are also looking to recover from the lows of the day, even though the oil prices have gone up significantly. We'll get to that in just a bit, but 24,120 is where the index currently is. The bulls would be happy for the fact that, yes, Asia has now turned positive, and the fact that we have managed to hold on to 24,000 yet again, at least as of now. So that is one good thing. Look at the Nifty Bank as well. At around about 10:30, the Nifty Bank had also slipped to the lows of the day, losses of almost over 400 points. That too is seeing some recovery from the lows of the day. But you must say that the Nifty is looking slightly better than the Nifty Bank in today's trading session. So around still a 500-point cut on the Nifty Bank, and is looking to hold on to the 57,500 level on the downside. Another point of concern today is the currency. And for the first time in almost a couple of months, the currency has crossed 96, 96.08 right now on the dollar rupee. And of course, crude. Brent back at 85 a barrel, and the bulls would be looking or would be hoping that this does not go any further higher, because as more and more the oil prices keep rising, and that is a detriment for our own markets. Of course, plenty of stock specific action, earnings reactions that came in yesterday. Look at ICICI Prudential, AMC is a negative reaction, but brokerages are fairly optimistic, seeing targets of close to 4,000. HCL Tech is now extending its losses. Brokerages are worried that the kind of growth that the company is projecting, it's not enough to justify the valuation premium that it is commanding over TCS and Infosys. And therefore, while TCS and Infosys are doing fairly okay, HCL Tech is down 3%. And the positive reaction on the morning though is Nuvoco Vista is 8% higher on the stock after some very, very strong results. Look at the newsmakers. The stock of the morning has been Biocon. 7% higher now on the stock. A potential MSCI inclusion as well. We'll get more on this during the course of the day. Welspun Corp after an order win, now over 110% higher on a year-to-date basis. Concor after its business update is up 5%. And IDBI Bank, some more news with regards to its disinvestment, 3% higher there as well. Real estate was a high-flying sector since the start of the month. There's some profit booking setting in here today. Lodha is down 3, Godrej Properties 2, DLF, Sobha also seeing some bit of cuts there, anywhere between 1.5% to 2.5%. And lastly, take a look at some of the small cap movers in today's session. Fino Payments Bank, we'll talk about this as well on the show. 13.5% higher, extending its gains from yesterday. Bajaj Consumer numbers were strong, but of course the stock has had a very, very significant run up during the year, up almost 150% year to date. Mangalam spoke about this yesterday. 11% lower on this one. MTAR Tech, another 5% lower circuit. The stock is now under under stage 4 of the ASM framework. So that too is having a bearing on the stock, down well over 25% now from its 52-week highs. And Newgen Software did very well yesterday, seeing some profit booking in today's session. And lastly, stocks at 52-week highs. PDS on the back of an order win is up 11%. Jai Bharat Maruti is doing well, as is Sem India Projects at 52-week highs as well today, Ritu.
All right, Hormaz, thank you very much. That sets us up very nicely for inviting our next guest on the show. Mukul Kochar from Investec Capital Services joins us now to discuss market fundamentals, his top sectoral picks, and a whole lot more. Mukul, thanks always. A pleasure to have you here on the show. And let me start with, in your note, you talk about the FTAs, and it's a good day to talk about it, given that 15 July tomorrow is when the India-UK FTA comes into the picture. Now, in your note, you talk about how India's trade connectivity is seen jumping from 11% to 60%. Factoring in all of these deals that are in the works, will be in the works, hopefully, fructify as well. How much of this 60% is really priced in the market, especially when you yourself in your report point out, past trade deals, whether that is ASEAN or Japan, then possibly work out the way they were expected to. So how much of this is factored in the market currently, and what is the best and worst case scenario you're building up?
Yeah, so, some of this, of course, is priced in because what these trade treaties impact is our goods, manufactured goods exports, because that is what the trade treaties try to target. And looking at the multiples of some of the manufacturing companies, you can see, or the industrial set, you can see that some of that, optimism is already in the price. Having said that, what I remind people is that we are starting from a very low base. In the report, we have also mentioned that India's export market share, which is our goods export divided by total global goods exports, which stands at roughly $22 trillion, our export market share is only 1.9%. Yeah, our GDP market share is 3.4%. Our services export market share is 4.5%. So we massively underfire when it comes to goods export. So despite high multiples, in some stocks, we are still optimistic on the sector because the base is very small. We expect a multi-year growth trajectory from here. One catalyst, of course, being what you mentioned, is our trade connectivity improves starting this year. Yeah.
Mukul, morning. Thank you for taking out time. So, well, in this that you highlight, what among the exporters that you like the most? Do you like textile names? Do you like these Alcobev companies? Or do you like the pharma names, for that matter, the pharma exporters? Of course, UK is a completely different market altogether. They have a more US-oriented exposure. But what about these export-oriented names, or maybe even the shrimp names for that matter?
Yeah. That's a great set of sectors that you mentioned. By the way, we can't go specific to companies, but I can point out the sectors, and typically the market is top down, bottom up anyway. So just, the sectors that benefit, first of all, the one sector that will benefit the most, I feel, is electronics. Yeah. And there's multiple reasons. One is the fact that we have the capital now to invest in electronics. It's a heavily capital intensive business. Our balance sheet repair is more than complete in India. Banks have started lending again because banks are overcapitalized. So we can do capital intensive business in India. Incidentally, in electronics, we have huge, engineering capacity as well to drive the sector forward. So that's one sector that is top of the, recommended list. By the way, our electronics export market share is only 1.2%. China, which is the number one, has a 25% electronics export market share. Critically, what will also help us in electronics market share is that we are part of the Pax Silica trusted network, and China is not. There's a lot of suspicion from electronics goods coming in the Western world from China, and India being a trusted market, it's not just, diversification away from a single large source. It's a diversification into a trusted network. So electronics is top of our recommended list. We have a few stocks that we are sort of talking about to our investors there. The second sector that comes in is autos and auto comps. Again, here the stocks are not even priced for manufacturing exports, because Ritu made a very important point, how much is in the price. I think it's not in the price here at all, because when the conversations on this sector take place, people start taking into account 5 to 6% passenger vehicle growth. and similar growth in two-wheelers. When you add an export element to that, this growth number automatically just goes up. I think autos and auto components will also be an export area over there. In auto components, we'll be taking market share from countries like Thailand, etc. The next sector, of course, is textiles. Very natural to sort of look at that. For many years, our textile export has not grown because we've been disadvantaged when we sort of go out to the market. Just to let you know, the top exporters in the world, number one is China, second is Vietnam, third is Bangladesh, and fourth is India. Yeah, and fifth is Turkey, and then Pakistan. Out of this list of 6 countries I mentioned, the countries that face the most onerous tariffs in the bigger markets in the world, the biggest market, import market is Europe, is China and India. Yeah, Bangladesh is tariff-free, Vietnam is tariff-free, Pakistan is tariff-free for different reasons, and Turkey is tariff-free. So we have a 12% disadvantage to all our major competitors, and that goes away as these trade treaties become operational. Then you have chemicals, including the pharma pack. Pharma actually doesn't benefit as much as the trade treaties because it's an essential good and largely tariff-free in most countries anyway. But pharma, we have massive expertise, and we are insourcing some of the back end like APIs. So that's another benefit. And then finally, you know, we have agri commodities that comes in. These are the broad sectors that I expect us to do well in, and I'm recommending clients to go there and look for winners.
All right. So, Mukul, apart from this trade theme, I mean, you spoke about pharma, you spoke about textiles, autos, electronics. What are the other themes that stand out in the current market, perhaps, that, are going under the radar? Where would you put incremental money? I mean, FTAs aside.
Yeah, so on this, just one point I will make additionally on the manufacturing export theme. It's not just the FTAs. Our energy cost, because of the adoption of solar, including open access, our energy cost has come down, which has made us competitive. The other comparison we made is we've done a 25-year correlation of our export market share with capital expenditure. So if capital expenditure by BSE 500 company goes up, our export market share goes up. And this capital expenditure was hampered by 7-8 years of balance sheet repair in the Indian industry. And that balance sheet repair is done now. So that's another sort of, aspect that benefits the theme that we are speaking about. Apart from, manufacturing exports, which I think is going to be the potentially the most significant driver of the economy going forward. Today we see that the banking sector, is also, undervalued in a manner. It is not a thematic the way we speak about manufacturing export. Thematic being that it's the manufacturing export, if you're expecting a 25% EPS CAGR in this theme, banking will compound at a 15% CAGR, I feel. But that sector is massively undervalued today for various reasons that we can go into the past. And here also we are finding winners in the financial services sector.
Well, Mukul, very briefly since you brought up the energy space, the renewable energy space, and in light of this large deal that has been announced by the Aditya Birla Group, acquiring that renewable energy business from Shell, what sort of opportunities does this indicate that are open in the market? Any places you see favorable risk rewards?
Yeah. So this is a great space to be invested in. Our electrification in India is still quite low relative to where we should be compared to, let's say, Japan or Korea or China for that matter. Our electrification is also almost 10 percentage point lower. Yeah. And, solar is a great energy source for us because India has a very high solar incidence, number of hours of solar available. So we produce one of the cheapest solar electricity in the world, just after Saudi Arabia. So this electrification is going to be a massive theme going forward for a cheap source of energy, cheap, clean source of energy. And here there is a lot of sort of companies that one can play in, which are also reasonably priced. So again, we are looking at a bunch that this sector actually plays into manufacturing as well. As a theme. So again, utilities and especially utilities on renewable, very, very good play in India, I feel.
Mukul, pleasure having you today. Thank you for spending time and joining us on the show. Looking forward to the next interaction as well. We'll take a short break. On the other side, focus on the bond markets with Manisha Gupta on the other side. Stay tuned.
Welcome back. As promised, let's get you all of the action from the bond market, and Manisha Gupta is joining in to fill us in. Manisha.
Well, thank you so much for that. It's a day that has started on a weaker note for the Indian rupee and for the government bonds as well. The impact comes in from the global markets as well, where we have seen overnight rise in the US Treasury yields. It also has to do with the crude oil prices, which have gained up by 10% overnight, trading very close to that $85 a barrel mark. We're also looking at escalation of tensions between West Asia, which has soured the market sentiment, as it were. The US president has called the strikes as a multi-day campaign, so this perhaps could just continue for days to come. We already have seen 3 nights of constant strikes there. There also are concerns about selling from FIs, as they might seek safe haven and take money out of India. But remember, the month of June has been quite strong when it comes to FI inflows into the asset class. It also has to do with the overall numbers that have started to show already. So if you look at the FI numbers on Monday itself, it has been a first day since 4th of June that we did see some selling coming in, and that to the tune of 8.7 billion rupees there. What led to limiting the losses was buying from the public sector banks, because they bought gilts worth nearly 40.39 billion on Monday. How long can this go on is something that the street will keep an eye on. The focus also is going to be on about the 248 billion rupees state government bond auction. That result is expected today. The WPI data for the month of June comes in at 12 o'clock, expected at 9.3% for June. That is another thing that the street will take cues from. And then it is about inclusion of India gilts in Bloomberg index. That announcement is expected anywhere between July. Some are expecting in August or September as well. That's another thing that is keeping the hopes high. And finally, you have some private bond issuances happening in the market today as well. There's a list of some 4 or 5 companies. Top on my list is Vagoli Estates. They're looking to raise 2 billion, and they're doing it via issuances of bonds which are maturing in 2029. And then you have Mizo Capsave Finance. They are also looking to raise up to 1.5 billion. They are doing it via issuances of 5-year bonds maturing in 2031. Nuvama Wealth Finance is on your screens. They are looking to raise nearly 3.5 billion, and they are doing it via bonds which are maturing in 2029. And then, of course, there is Muthoot Finance as well, planning to raise nearly 15 billion, and they are doing it via reissuances of bonds which are maturing in 2029. So some interesting names coming in which are looking at bids today in the day.
Manisha, thank you for those updates there from the bond markets. But while the equity markets are looking to recover from the lows of the day, what's not, or what has moved to the lows of the day is HCL Tech. And it's witnessing some profit booking after its results. A couple of downgrades coming in as well. Rima is here with that breakdown. Rima.
Thanks so much for that. So just still yesterday, HCL Tech was up 14% so far this month. So seeing some profit booking despite good numbers. In fact, what we are seeing is rotation out of HCL Tech into names like TCS. TCS was high yesterday. It's followed it up with some more gains today. And peers are playing catch up because still yesterday, HCL Tech was clearly the standout gainer so far this month, while TCS and Infosys were lagging. And today, the gap between the two is narrowing. Two downgrades also visible on HCL Tech today. So CLSA has downgraded the stock to a hold from an outperform. They say the stock trades at 16 times and is fairly pricing in most of the positives. They're forecasting a 2.7% organic constant currency growth for the company in FY27, lower than TCS at 3%, and hence they believe the current 15% premium to HCL to TCS is fairly valued. Citi too has downgraded in HCL Tech to a sell, cut the target price to 1,040. They believe the valuation premium of HCL Tech to peers like an Infi and TCS is very high. On the flip side though, Nomura is still bullish. They've got a buy call. Goldman and HSBC have a hold rating. That said, what we are seeing today is just profit taking. The numbers, the internals were fine. The company recorded its highest ever deal wins in Q1 at $2.4 billion. Their AI revenues are growing at 60% plus on a year-on-year basis. And the company has announced a 3,500 crore play into the data center business, which has also seen an extension of participating in the AI ecosystem and up the value chain. So all that is fine. But my guess is today the stock is correcting on account of the fact that it had run up in the last couple of days, and valuations too of HCL Tech were trading at a premium, and some analysts on the street believe that maybe the premium valuation is a little unjustified at the extent at which it's present now. Back to you.
All right, so some correction after that run-up. Rima, thanks very much for bringing us that update. We'll slip into a short break on that note, but don't go anywhere. We're back with more on the markets and some stock-specific news when we return.
Welcome back. It's time for our special segment, Quarter Se Quarter Tak, where we bring you earnings expectations from each sector. Today, Nigel will tell you how the first quarter is likely to be for the metal stocks. Over to you, Nigel.
Well, Q1 FY27 earnings season is set to begin for the metal sector, and expectations point to more or less a mixed quarter. While for ferrous companies, well, they're likely to benefit from stronger steel prices, non-ferrous players could see support coming in from elevated base metal prices. Let's start off with the steel companies first. The average steel realizations are expected to increase by around 4,000 rupees per ton on a quarter-to-quarter basis. That's driven by price hikes that were implemented over the last 2 quarters. However, higher realizations are likely to partly offset by rising input costs, like coking coal prices, which remain elevated, and iron ore cost as well did move up higher in the past quarter. On the volume front, well, steel companies are expected to report around an 8% year-on-year growth, although volumes may decline by close to around 14% on a sequential basis, but that's because of the seasonality factor that did play out. The capacity ramp-ups at Jindal Steel as well as at JSW Steel, that's what's expected to support the overall shipment growth. Overall, the sector margins are expected to improve by roughly around 1,500 rupees per ton in Q1 FY27. That's supported by elevated flat steel prices. That said, the benefit is likely to be moderated because of the higher coking coal cost as well as seasonal weakness in rebar prices in particular. Though HRC prices have remained pretty stable, the rebar prices have come in for some profit taking, or in fact, there's come in for some pressure as well. And now we're getting to a seasonally weak period as well. So rebar prices could remain under the weather. For non-ferrous companies now, expectations remain broadly positive because commodity prices have been strong, and that's what's going to support earnings for the past quarter. On a sequential basis, your aluminium prices are up by 12%, zinc prices are up by close to around 7%. However, silver prices have pulled back in the past quarter. So let's have a check now on the company-wise EBITDA expectations. Hindalco, that's expected to report the strongest EBITDA growth at around 14%. This is as per Jefferies estimates on a sequential basis. Followed by JSW Steel, that's expected to deliver a growth of close to 11% on the EBITDA. On the other hand, Hindustan Zinc is expected to see a marginal decline of around 1%. Coal India could report a fall of close to around 4%. And Tata Steel is expected to report a decline of close to around 7% in EBITDA, followed by Shyam Metallics at around 11%, and Jindal Stainless, which may see the sharpest decline on a sequential basis of around 13%. Overall, the quarter is expected to reflect the improving steel realizations and resilient base metal prices, although higher input costs and company-specific factors are likely to keep the performance a little bit mixed across the metals pack.
All right, Nigel, thanks very much for bringing us that update. But let's shift focus to some specific stocks. Sesha Sai Technologies and Privy Specialty Chemicals. These are some of the names that are buzzing on the back of positive brokerage reports that have come in. Let's get in Sonal Bhutra for more details on this one. Sonal.
Well, yes, Investec has initiated coverage on Sesha Sai Technologies. They speak about 3 things that are working for the company. They call it a rare combination of market leadership. There's annuity-like revenues that the company receives, strong cash generation, and emerging high growth optionality as well. It is one of India's dominant payment card manufacturer with a market share of around 31.9% in FY25. And that's why they are forecasting a revenue growth of around 12% and profit growth of around 14% in terms of growth in the next 3 fiscal. It operates in an oligopolistic industry with high entry barrier, and there are recurring revenues as well, the annuity model that the broker spoke about earlier. They initiate with a buy rating and a target price of 430 rupees a share, so they're valuing it at 21.7 times FY28 PE. Of course, there are risks to this as well. If there are delayed recovery in card issuances, execution risk in some of the segments, customer concentration, and increasing competitive intensity as well. So these are some things that should be kept in mind while looking at this stock. The other initiating coverage is from Incred on Privy Specialty Chemicals. They have an ad rating on the stock. They say company has evolved from a 2-product company to almost 75-product company and integrated supplier now. And the company is looking at spending around 1,200 to 1,250 crore rupees, which will boost the capacity of the company and will support 10% volume growth in FY29. The company has seen 10.6% volume CAGR in last couple of years, and InCred expects this trend to continue as well from FY21 to FY26. Crude sulfate turpentine, which is one of the raw materials, the prices there are relatively stable, while gum turpentine, that is the other raw material where prices have been quite volatile. But company has the ability to switch between these two, and that's why they are able to weather any margin headwinds going forward as well. They expect gross margins to remain around 48%, EBITDA margins at 25 to 26%, and they're applying a conservative 35 times one-year forward earnings multiple to the stock price, and that's why the EPS that comes out of it is at around 137 rupees a share, and that's why the target price is at 47.96 rupees a share. They have an ad rating, so despite being positive in it, they have not issued a buy rating on the stock, but starting with an ad.
Sonal, thank you for that. A couple of bullish brokerage reports coming in. One on Seisha Technologies, the stock still below its IPO price, and Privi Specialty Chemicals, that too trading gains of around about 1.5%. Take a short break. Market technicals on the other side with Dharmesh Shah of ICICI Securities and some trading ideas as well. Stay tuned. Welcome back. Still 80 points lower on the index, but still managing to hold on to that 24,100 mark. On the downside is the Nifty. The Nifty Bank, well, is still managing to defend that 57,500 mark and is looking to recover from those lower levels. So from around about a 550 odd point cut, the Nifty Bank has recovered some 50-60 points from those lows. And a similar story for the broader markets as well, in line with the Nifty. Good time to get in Mangalam, who's at the FNO desk, to tell you the latest on today's weekly expiry. What's the FNO data indicating now, Mangalam?
Well, it's a range-bound move that, the option writers are playing for right now. We're back to times where you looked at the markets, they're lower, but you also, equated them to the macros right now. We had forgotten to look at crude levels and rupee levels because they were so stable over the last month or so that over the last 2 or 3 trading sessions, they've come back in focus. And now as we speak, Brent above that $84 per barrel mark, and the rupee also weakened past that 96. Indices in focus, as a result of which are the same ones that actually were moving around, when there were the wartime peaks. So we had the metals doing well, we had pharmaceutical stocks doing well, and the realty pack, which had actually come back, is now seeing a bout of selling. So that index too down by about 2% right now. But the important part, amidst all of this, we have moving averages which have moved much higher, and that means that there is strong support for all the frontline indices right now. For the Nifty, it's the 20-day moving average and the 100-day moving average. Incidentally, yesterday's low was the 100-day moving average at 24,000 mark. For the Nifty Bank, so long as it holds above the 200-day moving average, no real problems. Bulls will continue to fancy their chances and look at buying dips. And increasingly, we've seen some support come in from the IT index as well, which over the last 5 or 6 trading sessions has played a decent knock. And so long as it holds the 50-day moving average, there's no problem for that index as well. But ahead of expiry, we have the 24-100 straddle, which is fairly active in trade. So the 24-100 put has seen a fair amount of writing, 35 rupees premium, telling you around 24,050 thereabouts is where support starts to kick in. And if you look at the 24-100 call as well, that is equally active, and that has a premium of almost 55 rupees. So those who are writing this straddle, which is a call and a put together, are playing for a premium of almost 85 to 90 odd rupees. So between 24,010 to about 24,210 is where the range is what these option writers are playing for, a 200-point range, 24,000 to 24,200. But amidst all of this, a lot of stocks on our radar. We have shorts building up on Ashok Leyland, which has been a bit of an underperformer in today's trading session, down about 2.5%, and some longs built on Polycab. That stock has been a buzz, and that stock's actually moved to the high point of trade with a lot of long positions backing that counter.
Anklam, thanks very much for getting us that update from the FNO desk. Let's bring in Dharmesh from ICICI Securities for a quick technical check of the markets. Dharmesh, very quickly, what are the near-term levels you'll watch out for? We've been able to defend that 24,100 mark, but it's been quite choppy and narrow. And also your top stock picks in this current market.
Yeah, so good morning. Absolutely, I think so. The market has been too volatile in the last few trading sessions, but the levels to look out for from the short-term perspective, I think so. The 50-day moving average is something that important to be watch out for, which is placed at around 23,800 to 23,900. And if you look at the market for last 3 weeks, I think so, we have been trading in this range of 23,600, 700 on the downside. On the higher side, again, 24,200, 500 has been acted as a resistance. So we believe, I think so, look like the way the things are panning out and the way the market responding to the 50-day moving average, respecting even in case of the crude spiking back to 84, looks like buy on dip should be something which is working fine at the current levels, where 20-day moving 50-day moving average will be a very strong support for the Nifty, 23,800 on the higher side. Again, we believe 24,400 to 500 will act as an immediate reaction. So it's more of a stock-specific action likely to continue with more of a consolidation going forward. As far as stock specific is concerned, yes, we remain to be constructive positive for telecom space as a whole, where Bharti Airtel remains to be our top pick. Now again, Bharti, if you look from the long-term picture, I think so the way the stock has been respecting to the long-term trend line, it looks like I think that the way the weekly setup looks more promising for Bharti, making higher top, higher bottom formation, looks for a target of around 2030, giving a stop loss of 1875. Apart from Bharti, again, NBFC space looks more promising from the current levels, where again the financial services index itself has seen a breakout of the last 3 months of consolidation, indicating I think so more upside likely in the coming days, where PNB housing again remains to be our top pick. Again, PNB housing, if you look at the chart from the medium term perspective, a downward sloping channel breakout supported by strong volumes, indicating I think so the days are going to be much better for overall housing finance companies, where PNB housing looks for a target of around 1,200, giving a stop loss of 998. So Bharti Airtel and PNB housing remains to be our top pick.
Dharmesh, thank you for sparing time and joining us today on the show with your views on the index and your stock recommendations as well. On to some more market opinion then. Soham Asset Managers' Sanjay Parekh earlier today talked about the stocks and sectors that he likes and the themes that he's bullish on. Listen into what he had to say.
We moved up to large cap. We said that which are the leaders which are better off. And then you write that we also had hedges through, Vedanta Aluminum or, even metals, Vedanta standalone. And you do get, even Reliance, we believe, is better off in the sense it's not, it's not going to get negatively affected. So some of the large players is what we invested in. And then leaders which will get less affected, like some of the telecom names, barring the crude part, which the diesel price in the tower generally is insulated. So that's where we positioned our portfolio, and it's worked well till now for us. IT, which you always been covering so well, we've increased our weight to IT recently in the fall. We've added Coforge. We increased our exposure, and so we've reduced our underweight, but we've increased the weight to IT. To Infosys, which was our existing holding. So that's where our overall, and then real estate we like because the opportunity is pretty large. So we do own DLF, and a recent entry we've done into Lodha, that is around 15 days back. So that's the way most of, and then Lenskart, which is broadly insulated or eternal, we have small weights. So this is how our portfolio is positioned, which has helped us as a large cap buyers and avoiding the fall.
Okay, let's take a short break. But on the other side, we'll get you more on the markets. We'll focus on specific names like Fino Payments Bank, which has seen a massive surge in the last 4 sessions. Welcome back. For the markets, still trading with cuts of more than 100 points now, 24,108. Let's see if it holds up above that 24,100 mark. The Sensex too trading with cuts of about 370 points as we speak. But, one stock that has been bucking this trend, and at least for the last 4 sessions, Fino Payment Bank, what a phenomenal run. Now, 4th consecutive session, it is up. The bank, of course, reported a strong business update for June just yesterday. There was good growth in deposits, digital customers, even though the transaction business continued to moderate. So it opened more than 3.1 lakh new accounts, up 31% from a year ago. But the average deposits also increased to about 11% from, to 2,755 crore rupees. The active users on FinoPay app have also risen 38%. So even with all of that, the standout was the loan referral business, where disbursals have surged 253% year-on-year to 240 crore rupees as the bank continues preparing for its proposed small finance pack transition. Transaction throughput, however, has declined 35% to about 2830 crore rupees, with the bank attributing that fall to the shift from cash to UPI and saying the pace of decline has eased in the current month. So stellar growth there apart from that. And, the street expects lending to only pick up from here as the bank makes that transition into a universal bank. But on the back of to a small finance bank, but on the back of these updates, Fino Payment Bank shares have surged 21% today. They were up as much as 24% or so, but have cooled off from that high, taking the gains to nearly 35% in the past week, 34% in the last 1 month. And even after this rebound, though, the stock remains down almost 29% when you look at it on a year-to-date basis, and almost 36% in the last 1 year. So fundamentals, Hormaz, they're looking strong. Fino has had a phenomenal run. What are the technicals saying?
Hey, the very interesting chart pattern that Fino Payments Bank has shown up. As you mentioned, over the last 4 sessions, the stock has been on an uptrend. The 40% now the stock has gained in the last 4 trading sessions, was up 20% almost yesterday, adding another 12, 13, 14% in today's session as well. But, the volumes that the stock saw in yesterday's session and in today's session are the 2 best days in terms of volumes on record for the stock. It had gone public in 2021, and since then it has never seen that kind of volumes that it has seen in yesterday's session and in today's session. In fact, in the first 2.5 hours of today's trade, today's volumes have already crossed Monday's volumes. So that's the kind of volumes that you are seeing on Fino Payments Bank. Even yesterday, the stock was before this 4-day winning streak, the stock was on a 13-day losing run, and after this 13-day losing run ended, the stock fell to its 50-day moving average, took support from there, and then staged a rebound from the 50 DMA. And as a result of this 4-day up move, the stock has now broken above its 100-day moving average, which was at 147. And now the next level to watch on the upside is the 200-day moving average, which is still some distance away, but is around about 208. So around about 25-30 rupees from current levels for Fino Payments Bank is where the 200 DMA is. Now, why is the 200 DMA significant? That's because of the fact that it has not tested or crossed that level in all of this year so far. The last time it was above the 200-day moving average was between September and December of last year, and it broke below that on the 16th of December in 2025. Now, the last instance when the stock was above its 200-day moving average, when it broke above that in September, which was around about the 29th or the 30th of September, within the next 3 weeks, the stock had gained almost 30%. And then it kept yo-yoing around those levels as well, from around 350 odd to around about 430 or so. But so the 29th of September low to the 21st of October high is what I'm trying to mention. But even after this kind of up move, the stock is significantly below. You mentioned YTD, and on a 12-month basis, from its IPO price, which is 577, the stock is still down almost 70%. So a big underperformer is Fino Payments Bank. Despite this 40-odd% up move that you have seen over the last 4 sessions, the stock is still a big underperformer. But of course, not a recommendation by any means, just chart observations is what we are seeing. And of course, investors advised to do their own due diligence and research. Take a short break. More on the markets and macros on the other side. Stay tuned. Welcome back. Well, the biggest IPO of the year so far has opened for subscription today, and that's SBI Funds Management as the 11,700 crore rupee issue. Of course, after the pre-IPO fundraising and so on, the issue size has come down as well. Devyani is here with all of those updates. Devyani, tell us more.
SBI Funds Management is raising 11,692 crore rupees and its issue opens today. Now, it is a pure offer for sale with 20.37 crore shares being sold by its promoters SBI and Amundi. Now, the price band is set at 545 rupees all the way till 574 rupees per share, implying a market cap of roughly around 1.17 lakh crores at the upper end of the price band, with the price to earnings set at 38 times its FY26 PAT. Now, coming to SBI Funds Management as a company itself, is the largest asset management company in India with over 12.5 lakh crores in mutual fund assets with a market share of 15.3% at the end of FY26. Now, it's a partnership between India's largest lender, that's SBI, and Amundi, which is a leading European asset management firm. Now, it's one of the largest PMS AUMs with 16.88 lakh crores, out of which around 92% of it comes from Provident Fund and EPFO mandates. So keep in mind, those are very low margin products for the company. Now, coming to the financials, the revenue for FY26 came in at 4,390 crores, growing at a CAGR of roughly around 26% since FY23, while PAT came in at 3,067 crores, growing at a CAGR of roughly around 31% since FY23. Now, it has already garnered roughly around 2,663 crores from anchor investors at 574 rupees per share, and some of the key anchor investors include HDFC Mutual Fund, ICICI Prudential Mutual Fund, Capital World Investors, GIC, LIC of India, among others. And now the issue is also open to the public from today all the way till the 16th of July 2026.
Devyani, thanks very much for bringing us that update. Now, earlier we caught up with the management of SBI Fund Management. Joint CEO DP Singh says clocking in 5,000 crore profits is possible by FY28. Listen in to that conversation.
Assuming 25-26% growth, 5,000 crore net profits in FY28, which gets us a multiple of about 24 times. Is that the right way to look at the is that the right multiple, Mr. Singh?
So many factors around it, but if we go by our past history, the way we have been growing, then definitely yes.
Okay.
But there are always in the market there are uncertainties. It could be more than this, it could be a little less than this. But the growth rate, the more and more financialization happens in the country. SBI Mutual Fund is at the forefront. We will get the maximum benefit. The moment today the biggest friction in growth of mutual fund business is the way KYCs are being done. These small players, the way it's a linkage between the remuneration for acquiring a customer and all efforts to be bring in. So that is not working. The moment that friction is over, which is likely to happen very, very soon, and once because all the bank accounts are now KYC compliant. The moment any bank account which is KYC compliant frictionlessly can part money in mutual fund, I think that will be the biggest revolution, and the number which is there today, only 6 crore investors, that will multiply like anything, and that the number could be anywhere. I'm not saying as much as number of bank accounts are there, but at least 20% of the bank accounts will be the mutual fund investors.
As your equities, which are actively managed, compound at 20-25% on an annual basis from here on, what would your blended yield look like going ahead, say 2 years or 3 years down the line?
I think the way to think about it is that today the best in class is close to about 40-44 basis point. I think we should come very close to that because clearly, as you see, the active participation going up. But at our scale, that's a difference. The blended yield for a smaller player at 40 basis point and at a 13 lakh crore player is a completely different way to think about it.
All right, let's get you the macro signal for the day. Now, as microfinance lenders head into the June quarter earnings season, the big question is whether the worst of the credit stress is finally behind. And the first signs of a turnaround are here. So look at the data. NBFC MFI credit has grown by 14.5% year on year as of end of March, turning positive after 7 quarters of consecutive decline. And for a sector that has been battling rising delinquencies and weak disbursements in the last 2 years, that is a very important shift. But, it's not a broad-based lending revival yet. The number of active borrowers have actually fallen by 22.7 lakhs in the March quarter alone, and that suggests lenders are being far more selective. They're growing their loan books, but without aggressively adding new customers. So they're writing bigger loans to smaller, a more selective pool of borrowers to stay cautious. And at the same time, the share of borrowers with loans from 3 or more lenders has also fallen to 9.7% as of March. Now, that is a sign that the focus remains on portfolio quality rather than chasing growth. Now, the improvement is also showing up in asset quality. So the share of loans that are 31 to 180 days past due fell to 1.8% in March, which is down from 4.4% as recently as September of 2023. That is the peaks that we saw. Now, credit costs for these NBFC MFIs have also come down as provisioning and write-offs also came down. But RBI itself, in its latest financial stability report, flags that costs remain elevated relative to that September base. So it's not exactly a very clean bill of health yet, but it does suggest some normalization. So even as loan growth returns, lenders continue to reduce exposure to borrowers with multiple loans, reflecting tighter underwriting and more disciplined lending. And that is a very different strategy from the rapid expansion that the sector saw before the stress cycle began. So we'll have to keep an eye out on how these June numbers come out, which will be in the next few days. And on that note, we're going to wrap up this edition of Trading Hour. From Hormaz and me, it's a goodbye. But stay tuned, Halftime Report will be up next.
Stocks come in for selling after Brent jumps to near $84 per barrel and the rupee slides to below 96 versus dollar. Realty, autos and NBFCs drag while metals and healthcare eke out some gains.
After its recent $1.8 billion RCB joint acquisition from United Spirits, KM Birla Group has snapped up Shell Spring Energy via Aditya Birla Renewables, a Grassam venture at an enterprise value of around $1.8 billion to be co-funded by BlackRock.
Biocon leaps after Mylan sells its remaining 5.6% stake received on sale of its biologics business to the Indian pharma major. The sale makes the Biocon stock eligible for inclusion in the MSCI Standard Index, analysts say. The stocks of HCL Tech stumps after a pre-earning rally despite beating muted street estimates. The IT major keeps guidance unchanged but unveils a plan to invest 3,500 crore rupees to build data centers.
CNBC TV 18 has learned that the strategic sale of IDBI Bank is being put on the fast track with several meetings of ministerial group, core group of secretaries and DPAM having taken place on the matter over the past few days.
The near 11,700 crore IPO of SBI Fund Management opens today. India's largest fund manager has already seen a marquee list of investors being allotted shares in the anchor book. Hello and welcome to a halftime report live from the CNBC TV 18 Motilal Oswal studio. I'm Ekta Patra and with me Sonal Bhutra as well as Vinny Motiwala. Well, it is turning out to be a session where we are seeing some amount of a downtake for the markets. We have the Bank Nifty, in fact, which is underperforming at this point in time. So what really seems to be weighing on the markets is obviously Brent crude, which has seen that jump above $80 per barrel, in fact, close to $85 per barrel. We have the FIIs, which sold, the largest that we've seen since June 9th in the equity markets, and we also have the rupee, which is at the lowest level that we've seen since May 22nd. So all of these in terms of a combination is not boding well for the markets. We have the Nifty, which is currently lower by around 0.4%, and the mid cap index, which is down around 0.4% at this point. Bank Nifty, like I said, underperforming. Hi girls.
Hey girls, good afternoon. Feels like deja vu, right? We're talking about crude prices increasing, rupee depreciating. This is something we were discussing every day just a month back. There was some relief, but then again, the West Asia tensions, they are on the table, and that's what the markets are factoring as well. However, the fall is contained. We are above the 24,000 mark for now. 24,000 is an important support that we are watching out for on the Nifty. On the upside, there is a strong resistance at 24,300. So if Nifty crosses that level, we could see higher highs. But for now, that's not the attempt that Nifty is making for. Currently, Realty Index is the top loser, followed by PSU banking names. Autos also not doing so well. Pharma is keeping markets afloat, so defensives are on the move. But again, it's very stock specific for now, and the WPI data is out as well, Vinny.
Absolutely. Stock specific and WPI data is also what we'll be keeping an eye out on. But right now, advance decline ratio clearly is more in the favor of declines versus advances as well. So that is what we're going to be keeping an eye out on. A lot of individual movers also that are coming in on that front as well in terms of earnings. So let's watch out for that as well. But the WPI data, we did see a bit of a flash that is coming in. So we'll wait out for that. The June WPI data has come in at 9.87%. And that's an important update that is coming in here versus food inflation at 6.14% versus 4.49% on a month-on-month basis. We're seeing an increase in terms of food inflation as well. The poll was of 9.38% for the June overall WPI data as well. Let's go across to my colleague Lata, who's here to break this down for us as well, help us understand what this data actually is indicating now. Lata, over to you.
Well, this is not a good number, obviously. It's almost 10% at 9.87. You're talking about 9.9, really. And the poll was actually more at 9.38, 9.4. The bulk of the numbers were at 9.1, actually, but one reading of 9.75, which was SBI, took the average a little higher. Otherwise, I would have got an even lower average. So SBI really is closest to the guess. which is coming at 9.87. Now, there is no one-to-one correspondence between WPI and CPI, but a double-digit WPI can mean a 5% CPI because some of it does seep in. Manufacturing inflation does make its presence in sooner or later. It gets passed on. When a wholesale price is very high, it gets passed on by the companies sooner or later, and that is bound to have an impact. Now, what do we have here? Primary articles inflation is at 7%. Now, primary articles obviously includes, minerals and metals, and those prices have shot up, aluminum in particular, and therefore you've got a 7% primary articles inflation. Manufactured products is 7.48. That was as it was in May. Fuel and power is at a 27.4. See, in the WPI, it doesn't go by the prices raised by the government for you and me. It is the wholesale price. So what companies pay in the international market is already priced in. That's why our WPI has been at 8% from the month of April. 8% in April, 9% in May, 9 point something in May, and now almost 10% at 9.9. So it is already, the government's fuel price hike doesn't impact it. It was already impacted by the fuel price hike. The month-on-month rise in food index of 1.6% is not good. Imagine 1.6 into 12. We are talking about, a very hefty increase if it were to be as bad as that, a 7% inflation. Obviously, it doesn't work that way. This is clearly in anticipation of El Nino. Wholesale prices have gone up for edible oils, for cereals, pulses. So that is also getting reflected. It's not a pleasant number. It is not the policy number. So that's the consolation. The policy number is the CPI, which we should worry about. And that, at the moment, is not bad enough for the Reserve Bank to move. And in any case, the Reserve Bank looks through supply shocks because they can't be controlled by raising interest rates. Only a demand-led inflation, only if it is a price-wage spiral, will the Reserve Bank move. So to that extent, the market is taking this a bit sanguine. But we will have to really wait and see how the West Asia war progresses. Aditi Nair, Chief Economist at ICRA, is with us to give us the comments. Aditi, we are at 9.9 on WPI. Your first thoughts?
Yeah, Lata, definitely, as you said, a very unpleasant number. We had a forecast which was lower than this, and this number is absolutely not pleasant, as you said. Food inflation has come in a little higher than we expected. Typically, in the months of June, July, August, 1 to 1.5% month-on-month increases are quite par for the course, and 1.6% is a little higher than what we had penciled in for the month-on-month food increase. But this is definitely one of the areas that we need to keep a watch on. What happens with the monsoon deficit, the lull which has happened recently after the deluge that we sort of had at the beginning of the month should set us up for a good jump in sowing when the next round of the sowing numbers comes in. But otherwise, perishables, etc., we'll have to keep an eye on the entire food pack in the next few weeks.
Okay, the positive... Sorry, go ahead.
And of course, West Asia, just as we thought that, things are settled, crude is back below 80. Now it's crossed 80 again. So that's the other sort of uncertainty to watch out for.
Yeah, sorry, why I was intervening was to look at the positive, which several economists pointed out yesterday at CPI also. A high WPI also means a high nominal GDP. A high nominal GDP means better tax buoyancy. So are you upping your nominal GDP forecast?
Lata, let's first start with the real GDP forecast. It's kind of going all over the place. 1 week, the numbers seem like we should push up our forecast. The next week, again, something happens that suggests that maybe we need to be a little less optimistic. So we are going to be somewhere in the region of, I'm going to give you a broad range, 6.2 to 6.7% for the real GDP, depending on where the monsoon and West Asia finally end up. And on top of that, we're looking at CPI inflation that's again going to be in the range of, let's say, 4.7 to 5%, maybe a little higher if the monsoon really turns out to be terrible. And then the WPI after that, we've got data on a new base. We kind of do need to watch out for how it behaves. But broadly, I would say the nominal GDP is probably going to end up in the range of 12 to 12.5% this fiscal.
Yeah, I think I even heard a number 13% yesterday when we were discussing CPI. So the government in its budget has factored in only 10.6%. So if you get a 13% nominal GDP, that gives you that much more elbow room to have a higher fiscal deficit. It's not a great deal, maybe a 10,000 crores more or something, but it gives you that elbow room because it is not 4.3% of say 357 lakh crore, it is 4.3% of 360 lakh crore or 365 lakh crore. So that gives you a little more elbow room in terms of fiscal deficit. That's perhaps the advantage. Aditi, thank you very much indeed for joining in and giving us an idea. I guess as you get into the numbers, you will have a better idea of where the inflation numbers actually come. Actually, they've also giving us now a producer price index. And the producer price input index has actually risen very sharply to 107 from 104 in May. That means input prices have risen. Whereas output PPI has been more stationary, 109.9 compared to 109.6. So just 30 bips. That means margins have shrunk. Your raw materials have gone up, but your output has not gone up. GVA shrinks. So that is GDP negative or GVA negative. But this is just an experimental number. We don't know to what extent it will be used by the MOSPI in the GDP calculation. Suffice it to say now that WPI is a little higher than expected, but it may not impact the Reserve Bank's thinking because it's, CPI that they track.
All right, Lata, well, absolutely. That's on the June WPI data at around 9.87% is where it's coming at. The core inflation above 7% this time round as well. But the other niggling worry which seems to be coming back on board, Lata, is the rupee. It's breached 96. The last time we saw a level above 96 for the rupee was all the way back on the 22nd of May. Tell us more.
Well, the rupee has been down for 2 consecutive days. It was down about 0.3% yesterday and plus a 0.6% today. So we are almost looking at a 1% cut this week. July 10th, when we closed the week, we were at 95.3, now staring at 96.1 plus. It even touched 96.17 intraday low. Now the fall is obviously entirely due to the war and due to the crude price at 85 and dollar index also striding higher. Now, what we need to see is the market positioning. As you pointed out, up until last week, we were at 94. At its strength, the rupee had even seen 94.5. This led a lot of importers to remove their hedges. And it led a lot of exporters to come and forward sell their dollars. Now, in this last 48 hours, there is complete panic because everyone is short dollar and long rupee. So they're coming and aggressively hedging. Importers are coming and hedging, that is buying dollars, and exporters are coming and unwinding their sales, which they did earlier of their dollar positions. That has led to this sharp 1% rise. The Reserve Bank apparently is in the market, but people are not looking at it as aggressively protecting any level. And the other thing that's a niggling worry, which is just a speculative worry, is yesterday the finance minister met all the PSU banks, and today the governor is meeting all the banks. So the worry is, and we know Sapna reported that they spoke about FCNRB scheme and what is the arrangement. So is the RBI a little worried that FCNR deposit flows are a little slower than they would like? So that adds to the market's positioning, adds to the market's hyper worries. All that is impacting the rupee. It is, in the last 2 days, one of the worst performing currencies. But to be fair, up until July 8th, it was one of the best performing currencies.
Okay, all right. Thank you so much, Lata, for that comprehensive breakup first on the WPI data and then on the rupee. Both worrying figures for now. But we'll slip into a short break. When we come back, we'll connect with Satvik Energy Management as Motilal Oswal has initiated coverage on the stock. That and a lot more on the other side. Welcome back. You're still tuned into Halftime Report. Well, Satwik Green Energy, that is the stock on our radar. It is buzzing in trade after Motilal Oswal has initiated coverage with a target price of 565 rupees a share. To discuss the company's growth roadmap and FY27 outlook and a lot more, we have with us Prashant Mathur, the CEO of the company, joining us now. Mr. Mathur, good afternoon. Thank you so much for joining us. Well, Motilal Oswal is quite bullish on the stock, considering the capex that you are entering. For modules, you plan to go to 8.8 gigawatt by FY29. For cells, around 6 gigawatt. You're looking at ingots and wafers as well. So it's backward integration that you're looking at. Give us a sense of what the capex that you will be spending on all this. What is the funding plan here? And what is the asset turn on the capex that you're looking at? What kind of revenue potential are you looking at?
Good afternoon, and very happy to be back on the show. Yeah, so this Motilal Oswal report has been published today morning. So it aligns with what our growth plans is, and quite a positive report to say. So we have our capex plan in 3 phases. The first phase is ongoing right now, which is 4.4 gigawatt of module and 2.4 gigawatt of cell. The capex for that is close to about 1,750 crores. And part of it was funded by our IPO, and rest is debt. The second phase is 3.6 gigawatt of cell, which will make a 6 gigawatt cell and 4 gigawatt module. So the second phase is around 1,700 crores, which will be the debt is already fixed, and the equity will be from our internal accruals. And then the third phase is 6 gigawatt of ingot and wafer. That is going to be next year. So for that, we are working on the plan, either to raise from internal accruals and debt, or maybe we'll go back to the market at that time.
Mr. Mathur, obviously for the ingot, you may look to go back to the market or internal debt. But I want to understand the recent commissioning, right, of whether you talk about the cells and modules, which you're talking about. You said Q1 FY27, H2 FY27. Is that online? Have we seen the module capacity come in online in Q1?
Yes, so module capacity, we will be starting this month.
Okay.
And the cell is also underway, and we are very positive that by second half of the year, we will start getting yield from the cell capacities as well.
Sir, there was no worry in terms of raw material prices going up. Any concern on that, given the recent issues? I'm asking because of that. Any delays or any supply issues that we faced because of that, and maybe the cell commissioning could be delayed, or there's nothing on that front?
No, our equipments have already left, so they are on the way. Part of it is already there. So no specific worries. Obviously, there have been a massive change in the geopolitical situation since February, and there have been the commodity prices also. So that has led to a lot of instability in terms of the price, and also there has been a change from ALMM 1 to ALMM 2 from 1st of June. So overall, the market has there have been a lot of changes in terms of, or challenges, I would say, in terms of that. But our job is to go to fight those challenges and keep performing in those scenarios.
Sure. Mr. Mathur, just based on what you've told us about your order book and the visibility that you have, what are you projecting in terms of revenue for FY27 then? Because you closed FY26 with obviously 110% growth in terms of sales. Are you looking to replicate that?
So we have, if you see our history, we have continuously grown over 88% CAGR. But this year, we will be growing, but it's difficult to give a number, but it seems that it is not going to be 110% over 100% growth, because we are in a situation right now where there's a lot of geopolitical scenarios are going on. Commodity prices are really up and down. So we will see also ALMM1 and ALMM2 implementation. So there has been a lot of uncertainty in the market, because of which there has been some pause in the demand and also alignment on the prices, because a lot of projects are either
What are
were
you
ALMM1,
projecting?
which is now shifting
What are
to
you
ALMM2.
sure, Mr. Mathur, while you can't give us specific numbers, you can probably give us a range. So if you do 100%, you go to over 8,000 odd crores. But obviously, you're projecting that you're not going to reach those levels. Give us a range in terms of what you could probably see in terms of revenue as an exit rate for FY27. Is it going to be a range between 6.5 to 7,000 crores or 7.5 to 8, a roundabout figure there?
It's not fair to give a number, but if you see the coverage report, it shows about 6,000 crore revenue projected for this year. This looks much in line with what we
Around
feel would be
50% growth is what you're anticipating in FY27. Last question before we let you go. Total debt that will be in your books once the phase-wise capex is done in your books, what will your leverage look like? And since we are talking about long-term targets and revenues as well, what is the general asset turn on projects like this? And since there's overcapacity in the market, do you think you'll be conservative with or see lower numbers than that, considering that prices might fall?
So currently our debt, long-term debt is 200 crores. After phase 1, it's going to be close to 1,200 crores. Phase 2 will be additional 1,200 crores. And phase 3 will be about 3,000 crores. So that is going to be in phases. So peak debt after phase 1 will be about 1,200 crores. In terms of overcapacity, the market has now realigned towards the cell manufacturing. So the ecosystem built up which is happening now. So it is not relevant how much module capacity is there. Ultimately, 1 year, 1.5 years down the line, when ALMM2 gets fully implemented, it is going to be the cell capacities which are going to determine how much you can sell your modules. And currently the cell capacities is only 30 gigawatt, out of which only 10 gigawatt is the latest technology. So there is a lot of headroom. We feel for next 2-3 years, the cell will not have an overcapacity situation. And while the market is also expanding with the kind of geopolitical situation there is, a lot of focus on electric vehicles, cooking, moving electric, and also data center, AI. There is going to be very high demand for energy, and most of it is going to come from renewable energy. So we feel that the demand is going to continuously grow up, and overcapacity does not seem like for the next 2-3 years. And then ALMM3 will come, wherein ingot and wafer will become the norm based on which the capacities will be measured.
Okay, just one number, sir. Margins, obviously we've seen a decline, but we're making a lot of investments. So will it be at the levels of FY26 around 12 to 13% for FY27? Is that the new normal right now?
Yes, it should be around the same number. That's what we are projecting.
Okay, sir, thank you so much for... Okay, sure.
In the first, second quarter, we may see little dip because of the geopolitical situation.
Okay.
But what we feel is that once our cell manufacturing starts giving revenue, that will add in to the bottom line, and we will have a blended EBITDA of about the same which we were at last year.
Okay, Mr. Mathur, thank you so much for joining us on the show this afternoon, giving us an understanding in terms of the outlook of the company, current trends, pricing trends, and what we're keeping an eye on. So thank you so much for that. That's the management of Satwik Green Energy for you all. But on that note, we're going to slip into a very short break. After the break, we'll have Sachidanand Dutekar of Trade Pulse who will join us to take us through some trading strategies. Welcome back to a halftime report on CNBC TV 18. Nifty is at 24,050 around that mark, down 143 points in the trading session as of now, 0.6% of decline. But on that note, let's also bring on board Sachidanand Tekar, Vice President, Research, Derivatives and Technicals at Trade Bulls right now to talk to us about his trading strategies. Hi Sachidanand, good afternoon. Thank you so much for joining us on the show. In terms of the levels that now we are keeping an eye out on, last couple of days has not been anything great. Yesterday we did manage to see some bit of a recovery, but any indication of that coming in on the charts today, and what levels are you keeping an eye out on?
Good afternoon, Vinny. Vinny, clearly it's a day of consolidation again. What we have been observing here for the last three trading sessions is that Nifty is not able to surpass that 24,200, 240 kind of a zone. Even today, it has been trending below its 5-day exponential moving average, which is acting as a resistance. 24,120, 130 would be a very significant hurdle for the day. And unless we don't see a closing above the same, the expectation of a directional momentum move looks very bleak. On the lower side, we have support and evidence of support at 24,000, 24,040, where its 20-day exponential moving average is also placed. But even this particular support looks, is not looking very confident. So we may see the Nifty, oscillating within this range of 24,120 on the higher side, and on the lower side, we may see some slippages towards 24,000. Which may extend towards 23,950 as well. But if you look at the overall construct, it looks more of a range bound action, a broader range oscillation. But at least for the day, there is pressure, and that particular pressure is very evident. We don't see the Nifty, closing above that 24,120 mark, at least for the day.
Okay, all right. What would your stock picks be today in such a market?
Good afternoon, Ekta. Clearly, pharma is something which is very interesting. And if you look at the Nifty Pharma Index, we've already seen a fresh breakout from a continuation bullish flat formation. Now here, Divi's Labs contribution has been very significant. It has been one of the leaders of the pack. And if you look at the overall construction from a momentum perspective, we see an extended move towards 71.85. The pattern target on the weekly scale is placed somewhere close to around 73.50. So we are still recommending building fresh long positions here when it comes to Divi's Lab. The stop loss for the trade can be placed at 69.80 on closing basis, and expect this momentum to continue throughout the day. The other pocket of strength is Amber Enterprises, wherein we have seen a very strong rebound during the day. The cluster at around 7,900 has been very dominant, but we see this particular cluster getting breached. We are expecting a momentum push towards 8160, 8200 kind of a level, and hence we are recommending building fresh long positions here, keeping a stop loss at 77.80. And the last call is again a buy call on PG Electronics. Now, if you look at the overall construction, we've already seen a very steady outperformance in the last three trading sessions. It has started trending above its 50-week exponential moving average, which will act as a support now. We are expecting this particular move to extend towards 634 and eventually see an extended move towards 680, and hence we are recommending building fresh long positions in PG Electronics. One can keep a stop loss at around 586 on closing basis.
Okay, thank you so much, Sachidanand, for joining us. So those are some technical trades while the markets are at the day's low. Time for a break now. On the other side, Manisha Gupta joins in with Saul Kawanik of MST Marquee and focuses on rising crude oil prices. The war in West Asia is flaring up again. Stay tuned for that conversation.
Welcome back, and joining us on the show now is Saul Korvanik. He is Head of Energy Research at MST Marquee. Saul, hi, thank you so much for joining in. And it clearly is a everyday story, and we're looking at markets absolutely responding to that. But how would you look at the 10% of a jump that we've seen in crude oil prices now, almost $85 to a barrel, given the fact that both the countries are now claiming to be controlling or wanting to control the Strait of Hormuz?
Well, we've been on a roller coaster ride for oil and fuel prices. We obviously saw very high prices in March and into April in the wake of the war, but prices were really coming down again in June in expectation that the ceasefire would see a rapid opening of the Strait of Hormuz and in fact even tip the market into oversupply. But that's all been dashed over the last few days, where we've seen now in the wake of Trump calling the MOU and ceasefire over, reimposing a blockade, Iran is firing missiles at Gulf states and continues to fire missiles at ships, including hitting 2 UAE-linked ships over the course of overnight. And that's seen volumes through the Strait halve from the low levels they were at last week, and they're sitting at about 15% of pre-war flows. And so that light at the end of the tunnel for a normalization of oil markets is now no longer there. We're back on an escalatory pathway for the conflict, and volumes to the Strait have been reduced again. And that's seen oil prices edge up into the mid-80s. But that's still a relatively contained price. And the reason for that is we still see signs from both the US and Iran that they want to contain this conflict. Oil infrastructure has largely not been targeted, at least yet. Israel has been on the sidelines of this current conflict, at least so far. And that's seeing the market still willing to assume that there's going to be a de-escalatory off-ramp at some point ahead. But it does mean if it doesn't go that way and these things spiral out of control, there's still a lot more upside to oil prices in the weeks and months ahead.
Saul, if you were to see both of those scenarios play out, what would be your best case and a worst case scenario when it comes to at the Strait of Hormuz and then an impact on prices?
Look, best case scenario, if we saw de-escalatory off-ramp soon, is we could return to where prices were in the last week or so, and we could see that 10% come off. But I don't see a lot more downside beyond that, given the fundamentals here where you've got the Iranian regime wants to control, is absolutely adamant that it's going to control the Strait, and that is fundamentally unacceptable, not just to the US, but many countries around the world. And so this will be an ongoing flashpoint. But in the worst case scenario, where this conflict persists in its current form or even expands to target oil infrastructure in the region, then we could see oil prices head back up above $100 a barrel and retest those levels we saw in March and April. We need to remember the world's economy is still living on the oil credit card. We're still drawing down strategic stocks to get by day to day, and that can only last so long as the Strait of Hormuz remains largely shut off to markets.
Saul, going forward from here, how are you looking at the supply glut situation that the market has been talking about for the last fortnight or so? Clearly, those things change as the Strait of Hormuz is nearly shut yet again. But how are you looking at the global demand and supply, as it were, let's say in the next 6 to 8 months?
So in the world where the Strait was going to open rapidly, what you were likely to see is an influx of oil flows onto the market, particularly in the first few weeks when a lot of ships were exiting the Strait. And that would arrive on the market while we still have demand destruction taking place in parts of Asia. China's still reduced its demand and its imports, and we're having strategic petroleum reserve releases. And those two things could actually have flipped the market, at least temporarily, into surplus. And you started to see the market start to price that in last week. But of course, this latest development now throws that out of the window, where now we're back towards flows reducing in volume again. We're now 15% of pre-war levels, half of the levels we were seeing a week ago. And at these current throughput rates, we are not going to be able to see that surplus develop. And in fact, I think we remain structurally short still, relying on stocks to get through this. So we need to see the situation de-escalate and flows to the Strait move back up to 30 to 40, maybe 50% of pre-war levels to start to get the market to go back to a trajectory of lowering oil prices and seeing the worst being behind us for oil markets in the wake of this war.
So the general belief right now is that the things perhaps would take a very, very long time, beyond perhaps a year as well, for things to normalize around Iran and rest of the Middle East countries therein. Would you say that the dependence in some sense of the major producers in that area would continue to go down at Strait of Hormuz? We already have been reading those reports of pipeline development, acceleration going on there. Would you say a lot of things are perhaps going to change there?
I think the whole paradigm for energy security and flows in the Middle East is fundamentally changed going forwards. There is no return to normal. If what we mean by normal, what happened, the situation prior to the war, I think ever going forward, or at least for several years. And that means that because Iran's now in a position where they can threaten the Strait for anything they want going forward, many Gulf states are going to have to find ways to bypass the Strait. We've already seen announcements by the UAE and Saudi Arabia to expand some of their pipeline capacity to bypass the Strait. I expect we'll see more of those kind of plans announced. But the reality is it's going to take a few years to get to the point where all that infrastructure is built and the reliance on the Strait is significantly diminished. It's going to be even more difficult for countries such as Kuwait and Iraq to find their export routes. That will require some multinational cooperation, and some of those discussions have started too. So with this ability of Iran to hold the world hostage over the Strait is still going to be in place for a few years until those additional infrastructure can be built out.
Okay, Saul, thank you so much for joining us with your take on what's happening in the energy market. Manisha, thank you so much for joining us and taking us through that conversation. Let's slip into a short break. When we come back, we'll talk to you more about market action. We'll also focus on some of these chemical stocks that are buzzing in trade. And in July so far, they have seen big moves. Stay tuned for that.
Welcome back. Well, for the Bank Nifty, that's the clear pressure point today, down around 720 odd points. We have the Nifty, which is now down around 137 odd points, so just about trying to protect that 24,000 mark. Let's see whether that takes place or not. But one space which has been quite resilient is chemical stocks, which have surged anywhere between 8 to 20% this month so far. Sonal explains the run-up in the stocks and what to expect from the sector in their Q1 numbers. Sonal.
Okay, so these stocks have seen a recovery post the news that, okay, the war might not continue, the peace deal as well. But look at the moves in these names this month. Sumitomo Chemicals up 25%. We do have Sudarshan Chemicals, which is buzzing today, was up 22%. Jubilant Ingrevia, Tatva Chintan Pharma, which has otherwise been an underperformer. Balaji Miles and Alkyl Amines, one-way move there. We do have Deepak Nitrite and Lakshmi Organic as well, which are up around 8%. Going back again to the previous plate, because these stocks are still off their 52-week high, some of them by a big margin. Sumitomo Chemicals is down 21% from 52-week high, Sudarshan Chemicals by 32%, Jubilant Ingrevia just 4%, but we do have Tatva Chintan Pharma, Alkyl Amines, Deepak Nitrite, Lakshmi Organic. They are sitting much lower than their 52-week high levels, which they did see in their prime. But in terms of Q1 numbers, it is expected to be very weak because these companies have seen huge increases in their raw material costs because most of them are crude based, and crude prices saw a sharp increase. It is expected to be a weak quarter and sharp input cost surge to weigh on near-term margins. However, a few companies now in this quarter and the last week of June started passing on those costs to the customers as well in order to protect some of their margins. And domestic demand is the place where they did see a lot of traction. So that is something that will also protect their revenues overall. Additionally, what is the industry focusing on? What would the fundamental trigger be from here on? It is the ongoing anti-dumping duty investigations or the approvals that have come by for these companies. So I'm just listing some of them. It's a huge and a long list across the board. For Lakshmi Organic, it is acetoacetyl derivatives, which is ongoing. For Balaji Specialty Chemicals, which is the subsidiary of Balaji Amines, it's ethylene diamine, where there is an imposition. For alkyl amine, it is monoisopropylamine, where there is an imposition of anti-dumping duty. For Deepak Nitrite, it's on sodium nitrate. For Sudarshan Chemicals, it's on azopigment. And for Deepak Phenolics, it's their biggest product ever, which is phenol. So all these places, either they have received the approval or it's ongoing, and there is some positive traction on that one as well. So this is one of the things that the street is factoring in as well, that ongoing anti-dumping duty investigations could turn positive. Let's talk about the valuations now. Every company has a different product profile. Not all of them are peers for each other, so just keep that in mind. But the sector continues to trade at premium valuations. We do have Sumitomo Chemicals, which is trading at 35.5 times, so Sudarshan at lower. Jubilant Ingrevia, despite having a big commodity portfolio, is trading at 26 times. Tatva Chintan Pharma, it has been an underperformer despite that 32 times on that stock FY28 earnings. Balaji Amines is 27 times, and its peer Alkyl Amines, it's trading at 50 times. So that continues to be at a premium valuation. So it hasn't surged as much as Balaji. Deepak Nitrite, commoditized portfolio at 33 times. And look at our Lakshmi Organic at 35.5 times. So it is not cheap at all despite the fall from the highs. And maybe that is the other thing that the street is factoring in, that if the anti-dumping duty investigations actually come through, that could be the other trigger for these stocks.
Absolutely, another trigger that we'll keep an eye out on, but that's about the chemical stocks, chemical names there which are in focus or which have seen a move coming around. On that note, we're going to slip into a very short break. After the break, we'll come back and talk about Biocon that's surging in trade today. Factors coming in here, what is the reason behind this as well? We'll take you through all of that.
Welcome back. Still tuned in Halftime Report, and this is our What's Trending segment. Pharma really stands out, and the focus now is on Biocon, which is buzzing in trade after Mylan sells its 5.64% stake in the company. Sudarshan is joining us with more, and later Ekta will focus on the Biocon-Mylan timeline, tracing their 17-year partnership. But Sudarshan, let's begin with you.
So it's been a shock of the day. Two triggers that are working for Biocon. First one, Mylan exiting the company by selling its entire stake of more than 5.6%. And entire stake has been sold via block deals. In today's block window, 9.2 crore shares have exchanged hand, and the price at which it happened was rupees 400 per share at 5% premium to the floor price of rupees 378.50 per share. Remember, Mylan was allotted shares in Biocon via preferential allotment after the deal of company for Biocon Biologics was announced in January 2026. Now, another trigger that's working for Biocon, that after today's surge, company now becomes eligible for MSCI rejig. Company currently is part of MSCI Small Cap Index. Now, after this, it will be rejigged to MSCI Standard Index, and the range of the price range for this is rupees 440 to 445 per share, and that's the current trading price. And also, because of this, the inflows that we might see, it can be more than $260 million. So because of these triggers, now you are seeing a big surge in the stock, currently up more than 6%.
Okay, thank you so much for that, Sudarshan. But Ekta, tell us the Biocon-Mylan timeline, tracing their 17-year partnership, key milestones that were shaped as well. So take us through all of that.
Yes, absolutely. You know, 16 years plus in terms of a relationship is what Biocon and Mylan shared. So it started all the way back in 2009, where Mylan and Biocon signed an agreement in June of 2009, and that was an exclusive partnership to develop, manufacture, commercialize generic biologics. Then in 2013, that particular partnership expanded to cover generic insulin analogs as well. So Mylan basically gained the rights to develop and market Biocon's insulin glargine, insulin aspart, basically all of the biosimilars within that insulin space. Now, eventually after that, in 2020, interestingly, Mylan merged with Pfizer's Upjohn business to become Viatris. So remember that Mylan officially in November 2020 merged with Pfizer's off-patent medicines and generics division, Upjohn, and that created Viatris. Now, what does that mean for Biocon? In 2022, Viatris sold that biosimilar portfolio that they had to Biocon Biologics. So Viatris received $3 billion in terms of consideration. $2 billion was in cash, $1 billion was in equity stake, which was equal to 12.9% in Biocon Biologics, which is a subsidiary of Biocon at that point. December 2025, Viatris and Biocon announced a deal in December of 2025 where Viatris will be selling their remaining equity stake in Biocon Biologics to Biocon for $815 million. So Viatris at that point in time with this transaction got 5.64% stake in Biocon. Jan 2026, Biocon completed the acquisition of the remaining shares of Biocon Biologics from Mylan, and now in June 2026, Mylan has exited Biocon by selling 5.64% stake in a large block which was worth around $363 million. So remember, it is, life comes a full circle. What started in 2009 as a licensing collaboration evolved into what was an actual equity stake for Mylan and Viatris in 2022, and that stake has now fully unwound by Biocon in December 2025, and now Mylan has completely exited what was an iconic relationship that they shared with Biocon.
Absolutely, Ekta, thanks so much for that. An interesting relationship over 16 plus years with both the companies. But on that note, we're absolutely out of time on this edition of Halftime Report, leaving the Nifty at around 24,080 levels. Stay tuned, and up next, a business lunch.
Stocks come in for some selling after Brent jumps to nearly $85 a barrel and the rupee slides to below 96 against the US dollar. Realty, auto and NBFCs drag while metals and healthcare eke out some gains.
After its recent $1.8 billion RCB joint acquisition from United Spirits, KM Birla Group has snapped up Shell's Spring Energy via Aditya Birla Renewables, a Grasim venture at an enterprise value of $1.8 billion to be co-funded by BlackRock.
Biocon leaps after Mylan sells its remaining 5.6% stake received on sale of its biologics business to the Indian pharma major. The sale makes the Biocon stock eligible for inclusion in the MSCI Standard Index, according to analysts.
The stock of HCL Tech slumps after a pre-earnings rally despite beating muted street estimates. The IT major keeps guidance unchanged but unveils a plan to invest 3,500 crore rupees on building data centers.
And CNBC TV 18 has learned that the strategic sale of IDBI Bank is being put on the fast track, with several meetings of ministerial group, core group of secretaries and DPAM having taken place on the matter over the last few days.
The near 11,700 crore rupee IPO of SBI Fund Management opens today. India's largest fund manager has already seen a marquee list of investors being allotted shares in the anchor book.
Good afternoon, you're with us here on Business Lunch. We are coming to you live from the CNBC TV 18 Motilal Oswal studios. I'm Hormuz Fatakia. With me as always, Arundhati Ramanan. Arundhati, good afternoon.
Good afternoon, Hormuz. You know, an escalation in that tensions in West Asia and that war has actually hurt market sentiment. You know, crude prices now above $85 a barrel. We've got the rupee that's weaker today as well. So the Nifty above 24,000 but below that 24,100 mark that we'd seen earlier today.
There's a weekly expiry as well for the Nifty contract. So that, of course, brings with it its own share of volatility. But yes, we have somehow managed to hold on to that 24,000 mark yet again in today's session. So today's intraday low is still higher than yesterday's intraday low. So we've made a higher low, at least as of now, as we go into the last 150 minutes of today's trading session. So 24,000 is something that the bulls would want to hold on to, even if they end the session on a negative note. The good part is the fact that the Nasdaq futures in the US have recovered, even though the Dow futures are down. It's a very big macro data day for the US markets as well. The inflation print gets reported today, this evening. Almost every major bank is reporting results before market open as well on Wall Street. So that is going to be a big market driver later this evening. But of course, oil is one point of concern. Brent now nearing 85, and there is some resistance around that $85 a barrel mark. Oh well, in fact, it has now crossed that 85 a barrel mark, 86 now for Brent. So that continues to move higher. And of course, the currency as well, that has of course moved past 96 for the first time since May. So on the currency and the oil front, things not looking good. Absolutely. But the bulls would be looking to hold on to that 24,000 mark.
Absolutely. And if you take a look at the sectors, helping the market higher is that pharma pack, right? We've got Divi's Labs and Sun Pharma up over 1.5%. We've seen a big rally in Biocon. That stock has jumped nearly 8%, right now about 7% higher in trade. And this was on the back of a big block deal. Mylan actually sold its remaining 5.6% stake in the company, and that's what's helped the stock rally. It's nearly 7% higher. If you take a look at the metal pack, that's also doing well. Hindalco, Nalco and Tata Steel, all of them up between 1% and 3%. But what's dragging the market lower? That's that realty pack. It is the top losing index, over 2% lower. We've got Lodha down nearly 4%, Godrej Properties down over 2%, and DLF as well down over 2%. PSU banks, that's also not doing well today. SBI, Bank of Baroda, both of them down 1.5%. And we've got Canara Bank that is seeing cuts of over 2.5%. But the big story today is the rupee, right, Hormuz?
Indeed, and for a cumulative 1% this week for the first couple of days now, following the return of the war fears and a sharp rise in oil prices as well, and of course the strengthening in the dollar. Lata Venkatesh is here to explain the going-ons in the forex markets right now. Lata.
Well, it was a steady run for the rupee up until last week, July 8th, and then the events of the weekend, the surge in crude prices, all of them led to a 0.3% fall yesterday. That's Monday, and followed by a 0.6% fall, a little more than that, Tuesday today, and that's, a 1% fall. We are the worst performing currency in the last 2 days because we were one of the better performing currencies from, say, June 5th to about July 5th. When the market was responding to the FCNR deposit scheme of the Reserve Bank. So that actually explains the slightly sharper fall that we are experiencing because of the higher crude prices. The entire market was very light on the dollar and heavy on the rupee. That is, importers had not hedged. They had in fact pulled back their old hedges, thinking that they will be able to buy dollars cheaper as the FCNR deposits come. Likewise, exporters had sold forward their dollars, thinking that they will not get such a good rate of 95 and 96 once the FCNR deposits come. Now, everyone is rushing to the door to overturn, to change their positions. You're finding importers trying to buy up dollars forward and buy hedges, that is, and exporters cancelling their earlier dollar sales and buying them back. And that explains this 1% jump that we're seeing in the price of the dollar. We understand from dealers that the Reserve Bank is there, but they're not trying to protect any level. In fact, speaking of the Reserve Bank, another needling factor for the market is that the finance minister met public sector bankers yesterday, and the conversation, as our colleague Sapna Das told us, was around how are you preparing for the FCNRB deposit scheme. Today, the Reserve Bank governor met first the private sector banks and then will meet the public sector banks. And the conversation is expected to center, among other things, on the FCNR scheme. So the market's getting a hint that maybe the authorities are worried that the FCNRB flow is not as strong as they expected. When you are in a bad mood, everything looks bad to you. That's the situation the market is in now.
Absolutely. The rupee there over 96 as we speak. But Lata, stay on. India's consumer price inflation for June that was announced yesterday came in higher than expected at 4.38%. And today, the wholesale price index for June followed suit, coming in higher than expected at 9.87%. Now, the CNBC TV18 poll had estimated 9.38%. What are the details and the implications?
9.87 is visually not a very good number because it's like, a breath away from the 10% inflation number. But the WPI has been steadily increasing. This is the new WPI series, so it starts only in March. April was 8.36, May was 9.68, and now even higher at 9.87. That's because the WPI doesn't wait for the government of India to increase fuel prices. The moment global prices rise and people are importing at that level, the wholesale index starts reflecting that. The consumer index only waits for the government to raise prices. So we saw that 8.36% inflation as early as April, as far as the wholesale price index was concerned. In June itself, again, manufacturing index is a high at 7.5. Core WPI is also high at about 7.5, 7.7. Now, the score is what worries. If it stays on, then chances are the wholesalers or the manufacturers who buy at wholesale prices will sooner or later pass it on to the consumers. And then the CPI starts getting impacted. So everybody's worried about the persistence of WPI and whether the manufacturers will be able to pass it on. That's where we bring the June CPI number. The June CPI number was only a tad higher than what we expected. 4.2, 4.25 was the poll estimates on the street, and it came in at 4.38, a tad higher. But even then, if you took April, May, June, the quarterly average was 3.93 and Reserve Bank's forecast was 4.2. So the market is quite convinced that given that difference, that it is undershooting Reserve Bank, we should not worry about any rate hike, at least not in August. The expectation also is that the full year RBI inflation number of 5.1 will also be undershot. And the full year core forecast of the Reserve Bank, which stands at 4.7, will also be undershot because the market is basically moving on the premise that this West Asia war-related disruption in prices of the entire petrochemical chain is not going to last for a very long time. Now, one doesn't know whether the market's confidence is seriously misplaced. The market is mad, as some people say, or whether the market's getting it right. But at the moment, you're not seeing too much of an impact on yields. Yields have moved up because crude prices have moved up. But it's not as yet a very difficult situation. The market still believes that I mean, a large part of the market does not expect the rate hike in August for sure. And maybe half the market expects some hikes in the second half, maybe 1 or 2. So this inflation number is worse than expected, but it's not hurting too much as of now.
Right, the 10-year is also at 6.8 right now, so it's still well below the 7.1, 7.2 levels that it had surged to at the peak of the first phase of the Iran war. But Lata, thank you for summarizing both of the numbers for us, the currency as well as on the WPI. Well, HCL Tech is the big underperformer today. This is some profit booking after its first quarter results. Both CLSA and Citi downgraded the stock after its numbers. Rima is here with all of those details. Rima.
Thanks so much for that. So just still yesterday, HCL Tech was up 14% so far this month. So seeing some profit booking despite good numbers. In fact, what we are seeing is rotation out of HCL Tech into names like TCS. TCS was high yesterday. It's followed it up with some more gains today. And peers are playing catch up because still yesterday, HCL Tech was clearly the standout gainer so far this month, while TCS and Infosys were lagging. And today, the gap between the two is narrowing. Two downgrades also visible on HCL Tech today. So CLSA has downgraded the stock to a hold from an outperform. They say the stock trades at 16 times and is fairly pricing in most of the positives. They're forecasting a 2.7% organic constant currency growth for the company in FY27, lower than TCS at 3%, and hence they believe the current 15% premium to HCL to TCS is fairly valued. Citi too has downgraded an HCL Tech to a sell, cut the target price to 1,040. They believe the valuation premium of HCL Tech to peers like an Infi and TCS is very high. On the flip side though, Nomura is still bullish. They've got a buy call. Goldman and HSBC have a hold rating. That said, what we are seeing today is just profit taking. The numbers, the internals were fine. The company recorded its highest ever deal wins in Q1 at $2.4 billion. Their AI revenues are growing at 60% plus on a year-on-year basis. And the company has announced a 3,500 crore play into the data center business, which has also seen an extension of participating in the AI ecosystem and up the value chain. So all that is fine. But my guess is today the stock is correcting on account of the fact that it had run up in the last couple of days and valuations too of HCL Tech were trading at a premium, and some analysts on the street believe that maybe the premium valuation is a little unjustified at the extent at which it's present now. Back to you.
So HCL Tech underperforming after its Q1 results yesterday. Thank you so much for all those details, Rima. Moving on, Grasim kickstarts Tuesday's session on a muted note following the company's new acquisition. Subsidiary Aditya Birla Renewables is all set to acquire solar energy power from Shell. Nigel D'Souza is here with all of those details. Nigel?
Well, Grasim subsidiary Aditya Birla Renewables will acquire solar energy power from Shell PLC. Here are the details. The deal is done at an enterprise value of around 17,200 crores. A little bit about the asset that they're acquiring. Solar Energy's power has a total cumulative contracted portfolio of around 5 gigawatt. Part of that is functional, part of that will come on stream. The turnover for the last few years has been in the vicinity of around 1,100 crores to around 1,250 crores as we saw in the past year. The rationale for the transaction? Well, it gives the group an opportunity to expand its renewable energy footprint. It increases Aditya Birla Renewables portfolio from around 4.4 gigawatt, you add nearly around 5 gigawatt. So it takes it to around 9.4 gigawatt. Not just that, after doubling its capacity, they have their eyes set on around 20 gigawatts over the next 3 years or so. What about the debt in Grasim's books? Well, it's currently, as of the last reported number, around 6,900 crores, approximately consolidated basis around 37,000 crores. But you'll be wondering, how will this be funded? Well, it will be funded via a mix of debt, equity from Grasim, and also there'll be investments that will come in from Global Infra Partners, which is a wholly owned subsidiary of BlackRock. And just to take a quick recap, GIP, they had invested 2,000 crores in Aditya Birla Renewable Energy with a green shoe option of around 1,000 crores in December 2025. At that point of time, the transaction of GIP into Aditya Birla Renewable was valued at around 14,600 crores or thereabouts. That's what they were valuing the entity at. The transaction is expected to close in 2026 itself. Brokerages, well, we have a couple of opinions coming in there. Citi, they maintain their buy rating, target price of around 3,600 crores. They understand, though, going by the math that they are working with, that Grasim will have to raise some debt. And there will be some clarity that they are awaiting for. But in the near term, they expect the stock to react negatively. While Morgan Stanley, they have an overweight rating on the stock, target price of 3,900 rupees per share. They see this as a positive development because it provides an immediate scale in comparison to any greenfield expansion that they would have attempted. So the big foray by the Aditya Birla Group into the renewable energy space.
Nigel, thank you for that update there. A percent lower for Grasim. Some updates from Landmark Cars at the bottom of your screens. 22.5% revenue growth in the first quarter, 1,733 crore. Vehicle sales also up around 24% as well. That stock has seen a bit of a spike after that update there from Landmark Cars. So 4% higher at 440. Take a short break. Back with more on the other side. Stay tuned.
Welcome back. You're still with us on Business Lunch. India's largest asset manager is finally knocking on Dalal Street's doors. The SBI Funds Management IPO opens for subscription today and will remain open till July 16th, marking the market debut of India's largest asset management company. At 11,692 crore rupees, this is one of the biggest IPOs in the financial services space this year and will be an offer for sale where SBI and Amundi will sell 20.37 crore shares, with the company itself not raising any fresh capital from the issue. Now, the price band has been set at 545 to 575 rupees per share, valuing the company at around 1.1 to 7 lakh crore rupees at the upper end. The company has already mopped up 2,663 crore rupees from anchor investors ahead of the issue opening.
Now, Anthropic has rolled out rupee pricing for Claude AI services in India. Rachna is here with more details on that. Rachna.
Well, Anthropic, the company behind Claude, has now rolled out India-specific pricing in rupees, with Claude Pro starting at 1,999 rupees a month on annual billing, Until now, Indian users paid in dollars, roughly $20, and then absorbed forex charges and 18% GST on top. That also came to roughly about 2,000 rupees. Now, Claude was the last major AI holdout on local pricing. That gap has now closed, except for Grok. But it also closes into a market that has already been fighting hard on prices. OpenAI's ChatGPT and Google's Gemini moved to rupee pricing last year. ChatGPT Plus sits at 1,999 a month, the same as Claude Pro if billed annually. Then there's Google's Gemini AI Pro, which is also priced around 1,950 rupees. So at the premium individual tier, all three are now clustered within 50 rupees of each other. Grok from Elon Musk's XAI is the outlier here. It still has no official India plan, though on the Indian App Store, it works out to among the cheapest in the world, close to 640 rupees a month for its entry tier, which is cheaper when you compare it to the premium, but not to the entry ones. Because the shift here is that the competition in India is no longer being fought at the top. It's being fought at the level 0. OpenAI launched ChatGPT Go as an India-first plan at 399 rupees, and it's currently free through December. Google went further, partnering with Reliance Jio to give eligible 5G subscribers 18 months of Gemini AI Pro at no cost, a bundle worth over 35,000 rupees. Every one of these 4 also runs a permanent free tier. The difference is how generous it gets. ChatGPT and Gemini are the most usable for free. Grok is the most limited and the most expensive for the plan that it has. So Anthropic's move is significant, but it's also a catch-up move. It removes the payment friction Indian users complained about. What it doesn't do, at least not yet, is the answer. The answer to the big question is now that every rival has already placed a bet on. In the world's second largest AI market, the winner may not be whoever charges the most cleverly, but whoever gives the most away. The catch with Anthropic's Claude is also that there's no UPI factored in yet, so you have to pay through card only.
All right, Rachna, many thanks for taking us through those details. But on that note, it is time for us to head into another short break. More news and updates on the other side. Stay tuned.
Welcome back. On to the latest updates then from West Asia. The conflict with the US launching strikes on Iran hours after President Donald Trump said that Washington is reinstating a blockade on Iran in the Strait of Hormuz. Trump also said that the Hormuz Strait would stay open, quote unquote, with or without Iran, end of quote. But of course, that the US would start charging fees on ships transiting through the waterway. CNBC's Dan Murphy is now joining in with all the latest updates. Dan.
We saw oil just posting its biggest surge in years as the Strait of Hormuz effectively became the new front line in this conflict. Brent crude surging nearly 10% overnight. That was its biggest one-day gain since 2020, some 6 years ago. US crude also jumping more than 9% to around $78 a barrel, erasing what has been a month of losses in a single session, which he has called the new guardian of the Strait, will impose this 20% fee on cargo transiting Hormuz, and also saying America should be paid for this because it's protecting a very rich portion of the world, he says. Listen to this.
We're putting the blockade back, and it's a blockade not for anybody but Iran. In other words, anybody doing business with Iran can't go through. Everyone else will be able to go through. So it's a blockade. It's a very strong blockade. The blockade was probably more effective even than hitting them, but I think the combination is the thing that really does it.
President Trump speaking there, and there's an obvious contradiction as well, because when Iran previously floated a similar toll, Trump's own Secretary of State and UN ambassador called it a violation of international law. And we've already seen the Iranians firing back on this. The foreign minister on X saying Iran has always been the guardian of the Strait and will remain so forever. So this really sets the US and Iran up on another collision course here, one that will ultimately directly impact markets as well. And a Wall Street Journal editorial today also says this US blockade is costing Iran about $435 million a day in lost economic activity. The White House clearly betting here that this attempt on economic pressure will succeed where diplomacy has not.
So, Dan, there were the latest on what's happening with West Asia. But that's all we have on Business Lunch. Midcap Radar will take all the market action forward. Stay tuned.
Good afternoon. Welcome to Midcap Radar. We are coming to you live from the CNBC TV 18 Motilal Oswal studio. I'm Sonal Bhutra, and joining me today is Hormuz Patakia. Hormuz, good afternoon. Well, we've come off from the 24,100 mark, but so far stayed above the 24,000 mark, which is an important support. It's the pharma index which is contributing a little bit. Metals too in the positive, but we do have realty pack which is under pressure.
Considering, good afternoon to you as well, Sonal, the fact that the sell-off in Asia, the sell-off on Wall Street, the rise in oil prices, the currency, the yields, the markets have been fairly okay despite all of that. Deja vu indeed. Let's also revisit the headlines at 1:30 this afternoon before we take the show forward. The markets continue to trade lower with the Nifty languishing around that 24,000 to 24,100 range. Auto, financial and realty are the big drags, while pharma and metals buck the trend.
Sattvic Green Energy is in focus after Motilal Oswal initiates coverage with a buy rating, but the management tells CNBC TV 18 that FY27 growth will be slower than FY26 and Q1 and Q2 margin could see a dip due to geopolitical tensions.
Seshasai Technologies and Privi Specialty Chemicals gain in trade on the back of positive brokerage reports. Investec has initiated coverage on Seshasai Tech with a price target of 430, while Incred maintains its add recommendation on Privi Specialty with a price target of 4,796. That's another 30% upside from current levels.
Biocon leaps after Mylan sells its remaining 5.6% stake received on sale of its biologics business to the Indian pharma major. The sale makes the Biocon stock eligible for inclusion in the MSCI Standard Index, analysts say.
PDS is having a very good day in trade today after the company secured a sourcing as a service contract with the global sourcing arm of a leading French headquartered supermarket. The street estimates an addition of a potential 11.4% to the company's gross merchandise value annually.
Okay, those are the top headlines that we are tracking for now. The Bank Nifty is the one which is putting a lot of pressure on the Nifty as we speak. Mid-caps falling in line with the benchmark. A couple of stocks which are reacting to maybe earnings. We do have quarterly updates which are coming by as well. So we'll cover all of that on the show. For now, Nifty mid-cap has come off from the highs of the day, the recovery that it made around 11:30 and is closer to the day's low as we speak. But a lot of stocks on our radar today.
Plenty of stocks indeed. And this is stock specific, right? Even if you take your eyes off the index, you can't take your eyes off a lot of the specific stocks that are moving around. And to tell you just that, Upasana is standing by at the big wall. Upasana.
Well, the Nifty mid-cap index is down about 0.5%. Let us look at some of the key gainers in today's trading session. Topping the list is Fino Payment Bank. It continues as yesterday's rally that was seen after the company reported its business update for the month of June. Followed by Car Trade Tech. Continues to remain in focus, up more than 6%. Acme Solar is also in focus. The stock is near its 52-week high. Dynamic Cables, an unusual one here, is up more than about 4% as we speak. And lastly, Polycab is also seeing some sort of a buying ahead of his result, which is scheduled on 16th of July. Now, mind you, for cables and wire companies, strong growth is expected this time around. Now, let us move on to some of the PVC pipe makers. They also seeing a dash of green today. Supreme Industries, Astral, both are up nearly about 2% as we speak. Now, on the flip side, let us look at some of the top losers in today's trading session. Newgen Software is down more than 5%. Thermax is also seeing a deep cut of 6%. Engineers India down about 3%, and followed by MRPL and UTI AMC, both of them seeing a deep cut of nearly about 4% as we speak. So all in all, these are the stocks on our radar.
Okay, all right. Thank you so much for joining us with all those details and the names on your radar, Upasana. It's a good time to get a technical check on the market. Shrikant Chauhan of Kotak Securities joins us now for just that. Shrikant, good afternoon. Thank you for joining us. What is the next important level for the Nifty that you're watching out for? What happens if we break from that resistance of 24,300 mark? Is there a possibility of that happening soon?
Good afternoon, Sunil. Good afternoon, Hormuz and everyone. So while looking at the setup of the market, at least at this level, it looks difficult for the market to cross the level of 24,250, 300 sort of level. It is forming some lower top sort of formation on a daily basis. And based on that, if we see the market is sustaining comfortably below this 24,100, then there is a possibility that we may again revisit the levels of 23,800 or 23,900 in the near future. So at this level, till the market is not crossing 24,300, we need to be careful and we can expect downward activity in the market. There is a possibility that we can expect weakness in large cap companies, but stock specific action is going to remain there in the market. The reason is because the market is still in the range. It is not breaking the upward boundary. It is not breaking the lower boundary of 23,800, above which the market has spent nearly 4 weeks. So I am of the view that for the time being, we need to be stock specific, but with a very short term view, we need to be careful.
Which are those stocks then, Shrikant? Good afternoon to you.
Good afternoon. So stock specific Container Corporation, there we are seeing some reversal activity on daily as well as weekly charts. The stock has made a high of 540, 550 some few weeks back. After that, we saw a dip decline. But now again, on the back of specific news flow, we are seeing some upward activity. And today it has crossed the crucial mark of 490, which is positive. So based on that, again, I am expecting stock to move towards the levels of 540, 550. So Container Corporation at this level looks decent candidate to buy and hold with a target of 550. We can keep a stop loss at 470 for the same. The other stock on which we are bullish is Sun Pharma. There also we are seeing breakout, and it has spent a lot of time within the range of 1900 and 1650 on the downside, almost 2 years. And now it is breaking out of that range. Also, sector is performing well. So at current levels, it looks very strong candidate to buy and hold with a target of 2050. We can keep a stop loss somewhere around 1900.
Okay, all right. Thank you so much, Shrikant, for joining us with all those levels to watch out for on the Nifty. We'll slip into a short break now and get you more on the markets and stock-specific action. We'll also focus on OMEX, which is buzzing in trade today.
Welcome back. You know, the market has taken a bit of a leg down in just the last few minutes. 170 points lower now on the Nifty. 24,040 is where we are. So we are back to hurtling down towards the lows of the day yet again. But the bulls would be hopeful that the 24,000 mark is still defended as we enter the last 2 hours of this weekly expiry session. But in our special segment, Midcap Spotlight, Sonal is here to put the spotlight on a company, and that is Omex. Sonal, over to you.
Thank you for that. This stock has seen a sudden surge in last couple of trading sessions. It is still off around 11% from its 52-week high, but in 2026 so far, it has gained around 17%, and in last 1 month itself, it is up around 24%. And this is not a company that we talk about often, right? So let's tell you what this company really does. It is a North India-based real estate company, and on 29th of June, the company announced a dedicated hospitality vertical with around 6,200 crore of investments. The company said it will develop 19 hotels spread over 5 million square feet across 6 states, and this will be done over the next 4 to 5 years. And this is the news on which the stock surged big time. They said they will have a presence across 13 cities in 5 states over the next 4 to 5 years, and hospitality business itself had the potential to generate approximately 1,000 crore in annual revenue upon stabilization. So this is what the street like. But let's talk about some more numbers. Do they really have the balance sheet strength to invest here. Look at the free cash flows that have been reported by the companies. From FY23 levels of around 450 crore rupees, they have come down to levels of 186 crore rupees in FY26. If we talk about debt, that has been continuously increasing for them. Yes, it did see a fall from FY23 to FY25, but then it has increased again to levels of around 1466 crore rupees. This is in FY26. Now, let's talk about the balance sheet. Now, in the liability side, just below equity, you do have the reserves column. And reserves for the company after 298 crores in FY24 have become negative in FY25, 388 crore here, and FY26 around 1084 crore rupees. The company says because they were loss-making, they did not transfer anything to reserves, but that doesn't show really a good picture. If we talk about the interest coverage ratio as well, not looking good. FY25, it's a minus 1.4 times number, and in FY26, it is at minus 0.81 times. Even the debtor turnover ratio has increased in FY26 versus FY25. Now, let's talk about some more news updates for the company itself. WSB Partners invested 75 crore rupees. The company entered tier 2 markets with that, so they did get some investment. But the company does not have a very positive past, or it does have a checky past. Let's put it that way. Company's chairman and MD was barred from securities market for 2 years. Why is that? Because they alleged, or SEBI order said, that it was on the back of irregularities in company's financial statements. CareEdge also put out a report on October 13, 2025, where they said that the company is constrained by ongoing adverse orders, which might constrain company's liquidity, and there is increase in funding from debt to total project cost at 40% on a sustained basis, which could lead to decline in collections as well. They also withdrew the long-term bank facilities ratings for this particular company. Not only that, the company in the past has been taken to RERA, consumer forums for delay in project delivery and construction quality as well. Additionally, one of the group companies, which is Omex Infra and Construction, which was dissolved by the NCLT because of completion of liquidation process. So there were some issues with that company as well. So yes, the stock has been surging. Yes, they are looking at new verticals to invest and looking at big revenue potential. But these are some things that investors should keep in mind. For real estate companies, it's a lot to do with their bookings, their collections, and most importantly, what their balance sheet is looking like.
Conditions apply as always. Sonal, thank you for summarizing today's mid-cap spotlight for us. Omex, the stock on her radar. Well, other one, of course, being Satvik Green Energy, and that's after Motilal Oswal initiated coverage with a buy recommendation. Vinny is here with more details on that. Vinny.
Hi, so first up, initiation coverage, buy rating, target price of 565 rupees for Satvik Green Energy. This is from Motilal Oswal. What are they highlighting? One, obviously, this is a multi-decade opportunity that comes in terms for solar manufacturing. Now, the company already has module manufacturing. They're expanding cell manufacturing and backward integration in terms of ingot and wafers as well. That will come in by FY28 and FY29 when ingot and wafers will also be manufactured by the company. But as of now, solar manufacturing is a very big opportunity given the government's focus that is coming in on renewable energy as well. Apart from that, the company's expansion plan is something that Motilal Oswal finds very attractive. They said that FY26 end, Satvik Green had said an installed manufacturing capacity of 4.8 gigawatt, and this is in its Haryana facility, and the company has an expansion plan to additionally add 4 gigawatt of module manufacturing as well as cell manufacturing of 6 gigawatt. That is going to be by FY27, FY28 as well. So that is why they're positive on this one in terms of the growth story. When we spoke to the management of the company as well, they too highlighted that yes, FY27 they will see growth, not as much as they saw in FY26. Obviously, FY26 was around 110% growth. It's going to be lower than those levels of around 40 odd %. And margins, yes, could be in the range of 12% as well. But they have expansion plans. There will be some debt that will come in as well. That will be something that one should watch out for.
Vinny, thank you for that update there on Satvik Green Energy. Motilal Oswal initiating coverage, a bull case upside of around about 45 odd % as well for the company. Now, the other sector in focus has been chemical names, and they have also surged anywhere between 8 to 20% so far this month. Sonal is explaining the run-up in these stocks and what to expect from the sector in its first quarter results, Sonal.
Okay, so these stocks have surged anywhere between 8 to 24% in a time when markets have not really surged so much, and these are from the mid-cap space, so that space is done really well. But look at some of these moves. Sumitomo Chemicals up 24%. It is still off 21% from its 52-week high. Sudarshan Chemicals up 22%, 32% off its 52-week high. Jubilant Ingrevia up 18%. Tatwachintan Pharma, which has been an underperformer in terms of earnings, is up 15%. It is still off 14% from its 52-week high. Balaji Amines, Alkyl Amines were some of the big movers in last week as well. They are still off their 52-week high levels. Deepak Nitrite and Lakshmi Organic, which mostly have a commodity portfolio, these stocks are also up around 8%. But quarter one is not expected to be strong for them. So they are not rallying on the back of good quarterly earnings. It's just the outlook that they're looking at. Maybe they think it could be positive. Quarter one is expected to be a weak quarter for Chemical Universe, and sharp input cost surge is expected to weigh on near-term margins for these companies. However, a few companies have started passing on these higher costs to their customers, which could protect the downside. Domestic demand is the other thing which could provide some cushion and some stability for chemical manufacturers during the quarter. The other thing that these chemical companies are tracking, or the investors are tracking, is the fact that anti-dumping duty investigations in some of these important chemicals, the decisions are expected very soon. For some of them, the decisions are already out. For Lakshmi Organic, it is for acetoacetyl derivatives, which is ongoing. For Balaji Specialty Chemicals, which is the subsidiary of Balaji Amines, this is for ethylene diamine, where it is imposed. We have alkyl amines, where monoisopropylamine, that's where it has been imposed. Deepak Nitrite for sodium nitrite, it is awaited. We have Sudarshan Chemicals, which is a pigment player. Their Azo pigment has seen an imposition of this duty. And Deepak Phenolics, where phenol is a big product for that company, for Deepak Nitrite, it is ongoing as well. Let's talk about the valuations as well. It's not cheap, despite them falling from the highs of the day and despite them seeing some surge. Every chemical is different, so most of these companies cannot be considered a peer for the other. But look at the valuation. Sumitomo Chemicals at 35.5 times, Sudarshan Chemicals at 20 times, Jubilant Ingrevia at 26 times, Tatwachintan Pharma, despite that sharp fall in their stock price, because the IPO was priced at such steep valuations, the stock still trades at 32 times. Balaji and Alkyl have such a big difference in their valuations, and that's the reason why Alkyl Amines has fallen sharply from the highs of from the top as well. Deepak Nitrite, largely a commodity portfolio, still trading at 33 times. We do have Lakshmi Organic at 35.5 times. So not a cheap looking valuation for the entire universe.
Not cheap indeed. I was just fixated on monoisopropylamine. I managed to say that properly with a straight face too. Sonal, thank you for summarizing the chemical sector for us as well. But the one stock that has been possibly the stock of the last 60 minutes has been Landmark Cars. And you see the stock that has zoomed after its first quarter business update. It's up 15% now as we speak. Sudarshan is joining in with all of those details. Sudarshan.
The reason of this sharp surge is because company has reported the update for quarter one, and it has reported highest ever sales for this April to June quarter, and both vehicle sales and after sales segments have reported healthy growth of more than 20%. If you talk about overall revenue, it has increased by 20.5%. Revenue from vehicle sales were up almost 24%. After sales service revenue too has seen an increase of 14%. What has added the growth? So first, company talks about the deliveries of several new key models have begun in June that have added the growth. And going forward, some of the companies like Mercedes, BYD, MG, M&M, Honda and Kia are going to launch new models that will be aiding the growth in Q2, Q3 and Q4 of FY27. As far as supply of BYD cars are concerned, that was one of the major issues that company had raised in the past. They are saying it has improved in June quarter, and further improvement they are expecting in Q2 FY27. So overall, Q1 was good, and company believes that now considering the improvement in supply of BYD, Q2 will also be very good.
Sudarshan, thank you for summarizing Landmark Cars for us. 13.5% higher now on the stock, continuing to do well. Take a short break. More on the markets on the other side and put the spotlight on two more stocks. Nuvoco Vistas is one of them, another positive earnings reaction. And Concor, after a strong business update too, that's up 6%. Back with more on the other side.
Welcome back. You're still tuned in Mid-Cap Radar. So many stocks in the broader markets which are buzzing. Nuvoco Vistas is one of them, gaining on the back of strong Q1 results. Nigel is here to give us the lowdown. Nigel.
Well, a good result reaction coming in from Nuvoco Vistas, and the numbers look quite good. Start of the cement earnings on a positive note, and their exposure to East India seems to have worked well for them. Let's run you through a few details. Revenue growth is to the tune of close to around 9%. Bulk of that came in because of volume growth. Volume growth came in at around 5%, which effectively means that they came in at around 5.3 million tons or thereabouts. But the bright spot of the numbers was the realizations. On a sequential basis, realizations moved up by 7%. Now, that was the biggest surprise element. And what played out here? Premium products as well as exposure to East India, that seemed to have worked in their favor. So they had an element of operating leverage. They had a little bit of cushion with regard to the realizations. And also you had input costs that spiked up, but not by that much. And that's why we did see the margins expand a little bit on a year-on-year basis as well. They bit up per ton, well, it expanded by around 80 to 90 rupees on a sequential basis. And that's telling you the negative impact of the higher input cost didn't really play out in this quarter. Or at least they managed to focus on the cost efficiencies, which kept cost under check. The market is quite enthused with the numbers because the stock has been a big underperformer. The numbers look quite good. And also they've set out the trajectory to move to around 35 million tons in terms of capacity as they ramp up the Vadraj unit as well. All in all, good set of numbers, an underperforming stock, but it appears that exposure to East India has worked well. And that's why now the street will keep an eye out on Dalmia Bharat's numbers because that as well has a fair bit of exposure to East India. Back to you guys.
Indeed. Nigel, thank you for that update there. A positive earnings reaction coming in today from Nuvoco Vistas. The other one that's doing well, though, is Container Corp, and that's following its volume numbers that it posted just after market close yesterday. Manglam is here with more insights on that. Manglam.
Well, indeed, Container Corp has been buzzing around in trade, and that's largely on account of the business update disclosure of volumes that the company has made just in dying hours of trade in yesterday's session, and now the street's reacting to that. The important part, the internals, if you look at it, the overall volumes the first quarter for the company grew at just under 9%, and this pretty much in line with the company's own guidance of around 9.5% for the full year. The reason why the street is enthused by these numbers is because the large part of the company's volumes are coming in from the Exim business, and out there the guidance for the full year was close to around 6%, and this time around the company has done over 8%. So the beat in the largest segment of the company has the street a lot more enthused. If you look at the domestic business, out here the growth has been around 6% versus street expectations or the company's own guidance of about 15%. And that's not a big concern, largely because one, it is less than 20% of the company's overall revenue contribution. And the fact that Exim is doing well in uncertain times means that things are looking good. But we need to know a couple of things. The management's own guidance has been curtailed down by about average of 15 to 20% over the last few years, to the new leadership saying it will be less than 10%. So it's met lowered guidance. And secondly, the stock, which was closer to 900, about a year and a half ago, is now trading at nearly half of those levels. So on a low base and lowered guidance, the expectations are met, and which explains the spike that we've seen on the stock.
Manglam, thank you for that update there. Concor as well, doing well for itself. Just a few seconds ago, you saw some flashes at the bottom of your screens. The SBI Funds IPO that has opened for subscription. The first day today, 44% currently, the overall subscription. The non-institutional portion subscribed 75%. The retail portion subscribed around 45%. And the employee portion is subscribed around 80% so far. So an overall subscription nearly at the halfway mark then. Is SBI Funds around about 10,000 crore rupees IPO now after that pre-IPO funding that it raised just before the issue opened for subscription. But the index though continues to remain around about the 24,050 mark. So it remains in that 24,000, 24,100 range. It's not seen any significant moves. Of course, the next 90 minutes are going to be very crucial as to where the index goes from here. As of now, well, the Nifty Auto Index, every single constituent is trading with losses there. The Realty Index is another one where every single constituent is trading with losses, and the PSU Bank Index, well, barring one name, every other stock is trading with losses. Take your leave on this edition of Mid-Cap Radar. From Sonal, me and the team, thank you so much for watching, and MF Corner comes up on the other side.
Good afternoon. You've tuned into MF Corner on CNBC TV 18. I'm Vinny Motiwala. With me is my colleague Sonal Luthra as always. Sonal, a very good afternoon. And viewers, good afternoon to you all because we're back with solving all your MF queries that you all have sent us. To do just that, we do have our experts joining us today. We have Prableen Bajpai, founder at Finfex Research and Analytics, as well as Nasser Salim, managing director at Flexi Capital, to answer all those mutual fund related queries. Nasser, as well as Prableen, good afternoon. Thank you so much for joining us on the show as always. Let's quickly get started with those queries. We have a lot of queries that have come in and we want to cover as much as we can. So the first query for today, we have Neera, who is writing to us from Surat, and his first question, it's two-part question. One is, it revolves around insurance plan. He's asking if it would be wise to surrender traditional LIC endowment policy if already insured with an adequate term plan. Now, additionally, also more in terms of investing via SIPs in mutual funds, he's looking at Aditya Birla Sun Life Flexi Cap Fund, DSP Small Cap Fund, among others that he's mentioned. So he's saying his goal is to accumulate 3 crore rupees over 20 years, asking if this portfolio requires any change on both the points. Nasser, first up to you. Afternoon.
Good afternoon, Sonal and Vinny. Wonderful to be back on MF Corner. So, yeah, I know to Neerav's question, I think, the clear answer is if your protection need is already adequately covered through term insurance and plans, then an LIC endowment, for example, should be evaluated purely as an investment. And therefore, you need to compare the policy's expected long-term return versus alternative investments available. Neerav, and more importantly, most traditional endowment plans historically deliver low single-digit to mid-single-digit returns, so anywhere between 4 to 6 to 7%. That's a very, very important point. The other quick point on this question on insurance is don't surrender blindly. Please check surrender value, paid-up options, tax implications, and obviously years already completed in the plan. As far as your portfolio is concerned, obviously you have the portfolio is diversified and has been held with discipline for nearly 9 years. Our only concern in this case would be overlaps. And I think that's where, overlap leads to over-diversification, which can be avoided. I think an SBI large cap, Mira large and mid cap, and an ABSL mid cap, and a flexi cap that you already have meaningful exposure to large caps. And therefore, the issue is not fund quality. All the funds are credible. The issue is clearly overlap. And therefore, all these three companies, funds have larger exposures, and therefore suggested simplification is just keep one flexi cap, keep one large and mid cap in your from your chosen kitty, and keep one small cap, so that it's very, very simplified and not overlapping.
Okay, take that point. Let's go to the next query now. Kiran is writing to us from Chandigarh. She says she is considering to take a loan against mutual funds and adds that while top banks charge somewhere around 11 to 13% interest, some NBFCs and platforms like Volt Money offer it at around 6.5 to 7%. She asks if these NBFCs or platforms are viable options to take loans against. Prableen, we did discuss this actually in detail with our other guest, loans against mutual funds. But since this is a very specific query, let me get it addressed by you. Tell us, what do you make of this?
Right, Sonal. So Volt Money basically operates as an aggregator, and they bring together the customers who are looking to take loan against their mutual funds as well as NBFCs and banks. So Volt Money themselves are not an NBFC. So there's also the question on the safety or the default. So, that is something that they'll have to deal with. But of course, all the companies which are coming to provide that over there are regulated by RBI. Next, Sonal here, that she's mentioned that it's about a 6.5 to 7% what Volt Money is offering, but I was just checking the website myself, and they themselves say that, loans the interest starts at 9.99%. So I think what they're able to do when you have more lenders, they have these NBFCs and banks, probably they're able to give a choice to the person who's coming on their platform, because it's a technology platform, and also negotiate better rates. But at the same time, I don't think the difference is almost half, because she's mentioned like 6.5 for them, and she's mentioning 11 to 13%. So there might be a 1 or 2% difference overall. But I think that, typically depends on her comfort if she's okay. Also, I would recommend that if in case, it's a very short-term requirement, then maybe some other options can also be exercised. And if it's, there is a part of the portfolio that can also be sold. I'm also, I belong to the gang where I feel that not necessarily for everything a loan has to be taken. Maybe a part of the portfolio can be sold if there's something underperforming. So she must reevaluate, how she wants to meet the short-term need overall for funds.
Absolutely, point taken there, Prableen. Thanks so much for that. Let's move on then to the next query. This is an interesting one. We have Arman, who's age 23, is starting off his investment journey, and he has some doubts. Now, he wants to invest 5 lakh rupees over 6 months. Furthermore, he's saying that he's looking at a 10K SIP for the next 25 years. So he wants to do the SIP route as well as 5 lakhs investing over 6 tranches as well. His goal obviously is to move towards an SWP after 25 years and more on financial independence side as well. He's spoken about some of these fund names he wants to look at: Parag Parikh Flexi Cap, Kotak Large Cap and Mid Caps, Edelweiss Mid Cap and Bandhan Small Cap. He's looking at these names right now to invest in. Is this something good to look at? How should he go about it? Nasir, what's your view on this one? He's starting off right now.
Yes. So, the biggest asset that Arman has is not his choice of funds, but his age at 23. That's the biggest advantage he has, Vinny. And I think the fund selection is good because it covers broadly all major equity segments, flexi cap, large and mid and small. Any additional funds at this point of time, you just add to complexity without meaningful improving diversification. So our view is very, very simple. Again, 1 flexi, 1 mid, 1 small cap. Please continue what you've already shortlisted. I think the real driver in this case is what he clearly said, outlined, staying invested for 25 years. More importantly, increasing SIPs within these funds by at least 10 to 15% annually. So what we call is a step-up SIP annually. I think he will be closer to his goal and towards discipline. He will achieve this number.
Okay, take that point. As you said, you're right. It is the age which is on his side, Arman's side, that is, and he does have a lot of choices where he wants to invest in. Prableen, come in on this. What do you suggest Arman should do?
With the 25 years ahead of him, I think, Sonal, that the portfolio should be a mix of active and passive funds. So I would also recommend if, he can add maybe from the large cap space and even from the mid cap space, a passive fund, that would be ideal because it's a very, very long time horizon. And also the amount that he's investing. So, just because he's intending to do a systematic withdrawal later on. So as part of his portfolio, I would advocate to add some passives and also look at gold eventually and maybe something in the international space. As far as his, the SWP probably later after 25 years, what he's intending to do. Just a quick example, let's say today his expenses are roughly, let's say 50,000 a month. The same in the next 25 years would become 2,15,000. So the target that he wants to achieve in the next 48 years, because he wants to be financially free, there would be a requirement to create a corpus of roughly 10 crores. And that would require an investment of 55,000 as on date. So Sonal, I would also recommend Arman to keep a track of his plans in terms of doing his financial planning or retirement planning so that, he's the overall portfolio is aligned to the goals.
Absolutely. Aligning your portfolio to your goals is important as well. But on that note, let's move on to the next query. He still has age on his time. But the next query we have is from Jinesh, who is writing to us from Gujarat. This is an interesting one because it's around the commodity fund. They have invested 6 lakh rupees in Quant Commodity Fund and is asking if it's worth, still looking at and holding on to, and furthermore investable as well. We do not have details about any of their other portfolio holdings. But Nasir, what's your view? Quant Commodity Fund, obviously we have seen the swings coming in the commodity prices, gold, silver. When 2025, we saw that very sharp run up for a year, and then we've seen that decline, the volatility in terms of war. What should they be doing?
So very clearly, while the question is purely on just one quant commodity fund where he's taken exposure about 6 odd lakhs, I think commodity prices are largely driven by global cycles. Vinny and Sonal, and inflation expectations and geopolitical events, right? Unlike businesses, commodities do not grow earnings or generate cash flows. Commodity funds are tactical allocations, which is very, very clear and not core portfolio holdings. We've been advocating this for a long, long time. Current commodity returns have been driven primarily by, as you rightly said, gold and precious metals. But commodity funds can also be very, very volatile, right? In the last 25 calendar year to now, if you see the last 18 months, we've seen their upswing and then, there's been a lot of FOMO participation also coming in. So, my only two thoughts on this. Historically, equities have been superior long-term wealth creators because earnings compound over time, Vinny, and while commodities are more cyclical. So keep commodity exposures to not more than 10% of your overall portfolio, which means that if you have 6 lakhs in this, I'm assuming that your overall portfolio is 60 lakhs, and therefore the exposure in commodities that you're participating in this through a fund or through gold and silver should not be more than at max 10%. Commodities are excellent diversifiers, Vinny, but equities remain the primary engine of long-term wealth creation.
Okay, take that point. So we've answered quite a bit of queries for today, but we have to take a quick break before we head to the other set, and we'll answer more queries on the other side of the short commercial break. Welcome back. You're still tuned into MF Corner. We still have with us Prableen Bajpai, founder at FinFix Research and Analytics, and Nasser Salim, who is the managing director at Flexi Capital, and they're answering all your individual mutual fund queries. Prableen, let me begin with you. Akshay is writing to us from Mumbai. He says he's investing more than 3,50,000 rupees in mutual funds. Of the total amount, he has invested in some funds through SIP, in some through lump sum. He says his goal is to accumulate around 8 crore rupees for a period of 22 years, and ask if his funds can achieve that corpus amount. So the list will come up for you on the screen. There's PPFAS Flexi Cap, DSP Multi Asset, Edelweiss Mid Cap, HDFC Small Cap, and the goal is 8 crore plus of a portfolio in the next 22 years. There's Kotak Multi Cap, there's Motilal Mid Cap. So it's a mix of a lot of these different categories. There's exposure to Flexi Cap, he has Multi Cap, the Small Cap. So it's covered mostly every category that one could look at. What do you suggest? Is this good enough to get to that the 8 crore mark in 22 years?
So it's a good target, Sonal, of 8 crores that he's looking to create for himself. And Akshay will have to increase his SIP from 12,100 with a 10% step up. He has to go up to 32,000 per month with the 10% step up. So there's a substantial increase in the SIP that he needs to do. And for the portfolio, I feel that with the 22-year horizon, and all this is calculated at 12% return, Sonal. And to reach there, he has a small cap, he has one mid cap SIP, he has the flexi cap, which is partially doing the work of a large cap as well. But I think with this sort of a horizon, maybe he can add an SIP in his multi-cap, which he's invested in only as a lump sum. So that can be added. And of course, I would again advocate to have a mix of active and passive funds. So going forward, a pure active fund can also be added, which can be the Nifty 50 equal weight strategy. And a bit of gold, maybe not at this point when we are facing, a huge the crisis of high rupee depreciation. But going forward, yeah, that can be done as well.
Okay, point taken there. That's a view coming in here. But the next query, let's move on and talk about the next query. This is from Rajesh, who's writing to us from BR. He is planning to invest 2 lakh rupees in mutual funds over a period of 8 to 10 years. He adds that he wants to allocate 50% to small cap fund and the remaining is 50% to flexi cap fund. He's given 2 names also that he's looking at. Mirai Asset Small Cap Fund as well as Invesco India Flexi Cap Fund he's looking at. So given this current environment, current scenario, are these 2 good funds to look at? Is the strategy right? Should there be any change in this one? Nasir, what's your view?
Yeah, so, Vinny, as far as Rajesh is concerned, I think I would slightly reduce between Mirai Asset Small Cap, which is currently at 50, and Invesco India Flexi Cap at 50%. We're fine with the choice of fund, but I would definitely reduce small cap allocation because small caps have produced the highest long-term returns, but they've also experienced the highest volatility and deepest drawdowns. For an 8 to 10-year horizon, a 30-35% small cap is fairly reasonable timeline. The balance can be in a 65 to 70% flexi cap. Flexi cap, of course, comes in with its own benefits. The fund manager has choices to move between large, mid, and small. So there will be some overlap in flexi cap there as well, which will have some small cap exposures. A 35 small to 65 in flexi cap is a more balanced allocation. Which will give investors and, Rajesh, the pure diversification in this case and valuation flexibility, which you will enjoy. And a smaller small cap allocation, therefore, retains also growth potential. Very, very simple. If you look at all the returns between flexi cap, mid and small cap obviously has given the highest returns as evident from past historical returns.
Okay, take that point. Let's go to the next query. Meher Chand is writing to us from Vishakhapatnam. She says, as she's retiring soon, can she invest in Edelweiss US Technologies Equity Funds of Fund to supplement her income source? She adds if some other fund would work better to generate additional income. A lot of these international funds are shut for subscription, and Edelweiss is also one of them. But if somebody had to plan for retirement, Prableen, what would your suggestion be? And if at all the subscriptions open or the LRS limit is increased, do you think these international funds are worth looking at from a retirement perspective?
Right, Sonal. So definitely international funds do make a lot of sense, but if, we don't really know how much portfolio she has, and, overall, it needs to be a diversified portfolio to manage your retirement in across different buckets, in the sense that it has to be something in the low volatility bucket, and then you have something for your SWPs if you're looking to supplement your, let's say, pension, or if you're looking to generate a monthly income, and then something in the hybrids, and then comes the equity part. So the international fund would, as it has become a part of the equity part, which is with a long-term view, and then later you can definitely start an SWP from there. And given the limitations that we have, because the $8 billion limit is already breached, Sonal, I think the GIFT City route will be a better choice to take international exposure, and that too, at least with a 4 to 6 year view. Of course, we've seen international funds do really well, so there's a lot of recency bias there as well. But I would really advocate, in between what we saw in 22, we did see US markets take a deep cut, and the returns were really, everything was a negative at that time. Nasdaq had fallen by roughly 30%. So I feel that they'll give the same sort of volatility like equity, even the Indian equities. So it has to be part of the third bucket, and thus it cannot be the only exposure. The question is only related to this. So definitely yes, international exposure as part of your overall portfolio, part of your third bucket for retirement purposes, and has to be a smaller component of the overall portfolio.
Nasir, what's your view for Meher, right? She's retiring soon, looking to invest in that Edelweiss US Tech Equity Funds, fund of fund, to supplement her income. Is that something that you would advise to generate this additional income?
Very clearly, for Meher, I would not at all advocate for any technology funds because these are not for income generation. Because that's a specific question. Technology funds are concentrated, highly volatile, and designed for growth. Retirement portfolios require stability, liquidity, and what we know as sustainable withdrawal capabilities. And I think given some of these tech plays, we've seen them in the past, highly volatile, very concentrated bets meant for growth and multi-baggers. I think for retirement income, we prefer very, very simple balance advantage, multi-asset funds, which are dynamically, which manage risk and can provide smoother investment journeys during retirement stages. So, categories such as BAF, which has been pretty active predominantly with where we've seen a lot of retirement benefits coming in. I mean, a lot of people who've been looking at retirement are looking at BAF as a category. Then there are multi-assets which look between multiple, asset allocations between gold, silver, commodities, put in money investing stage. And then when you come out the drawdown stage, you adopt a SWP strategy from them for liquidity generation. I think, my recommendation to her is keep it very simple. Don't look at, aggressive bets on at least the retirement kitty.
Okay, take that point. So let's go to the next query that we have now. Rohan writes to us from Chennai. He asks if HDFC FlexiCap Fund is a good fund to start with SIP investments. There needs to be some more details as to for how long is he looking at this one. But for now, is this a good starting point if somebody is looking at the HDFC FlexiCap Fund, or do you think probably PPFAS would be a better fit?
Okay, of course, these
Praveen,
two have been pretty close. Yeah. Sonal, I'm able to hear you. So yeah, between the two, I think they've been close competitors, and I think it's a good starting point that he's starting with equity investing. That's more important, Sonal, over here. And I think a FlexiCap space is a decent starting point because you definitely get exposure to equities, but primarily what we've seen is majority of the large caps are large cap tilted like the HDFC fund. So I think HDFC has a very creditable record in terms of its performance, and in terms of rolling returns over the years, it's done quite well. So definitely can be a starting point, but eventually Rohan must look at his own financial planning, see how long his horizon is. And even for this particular fund, his horizon must be at least 5 years, not lesser than that. So please don't expect immediate returns. In fact, for even 1 to 3 years, your SIP may give you very low negative or single digit meager returns. So please do stick to your SIP during tough times.
Okay, stick to your SIP during tough times. That's the word there. But that was actually the last query for today. So Prableen as well as Nasir, thank you so much for joining us on the show and helping our viewers get answers to all their MF related queries. Thanks so much for that. And with that, viewers, thank you so much for tuning in. As always, up next, closing bell to take you through the last hour of trade.
beyond market headlines. To understand the reasons for the day's movers and shakers. And get your portfolio ready for tomorrow. Beaming live from the CNBC TV 18 Motilal Oswal studio.
The markets have opened about 2% down, 1.8%, and Hang Seng also 1.11%.
We're controlling the straits. We're putting the blockade back. And it's a blockade not for anybody but Iran.
It's at 84 as the US-Iran standoff continues to escalate. We have a gap down opening, still hovering around 24,200.
More than 9 crore shares have changed hands, and the entire block deals happened in the block deal.
The disinvestment process for the strategic divestment of IDBI Bank has definitely been speeded up by the government.
Currently, the royalty framework is structured in a way that it has a cascading impact on the finances of the miners. What they were saying is that they're effectively paying royalty on royalty.
I'm going to give you a broad range, 6.2 to 6.7% for the real GDP, depending on where the monsoon and West Asia finally end up.
Importers are coming and hedging, that is buying dollars, and exporters are coming and unwinding their sales, which they did earlier of their dollar positions.
Aditya Birla Renewables will acquire Solarnergy Power from Shell PLC. Here are the details. The deal is done at an enterprise value of around 17,200 crore.
We've come off from the 24,100 mark, but so far stayed above the 24,000 mark, which is an important support. It's the pharma index which is contributing a little bit. Metals too in the positive, but we do have realty pack which is under pressure.
Well, that is the day so far. It's been, of course, in response to what's happening with the price of oil, which is back at about $86, $87. Markets are down 160 odd points if you want to count it to the T. This is Closing Bell coming to you from the CNBC TV 18 Motilal Oswal studios. I'm Prashant, with me my colleagues Reema and Nigel. Guys, hi. Afternoon.
Hi, afternoon. I think I'll just take comfort from the fact that at least yesterday's intraday low has been protected. So today the intraday low was 24,038. Yesterday we were at 24,000. Unlike yesterday, there is no recovery, but you've got banks struggling, and oil, of course, is at a very different level compared to yesterday, and now 86.7, and rupee too has tanked.
Well, oil is the worry, right? It's at around $87 per barrel and showing no signs of giving that up. And as we speak, actually, we're the high point of the day. That's going to be the big barometer. Traffic, as it is, on the strait has reduced considerably. Number of tankers moving out there. So hopefully that cools off for the time being. We'll be pleased that we've actually outperformed for the first 2 trading sessions, at least in comparison to any of our global peers. And it's been a while since we said that.
Yeah,
absolutely.
I was just going to make the point that after yesterday's CPI inflation figure and crossing that 4% mark for the RBI at 4.38, all the rate sensitives are under pressure. US yields went up overnight, 4.62. But look at realty is down. That's down 2%. Auto index is down 1.7. And banks, of course, have been struggling. The Nifty banking index down 750
This
points.
is, sorry, after the...
So US yields went up 4.62. And yesterday we got the India CPI number for June at 4.38. And it crossed the 4% mark after 18 months. Yeah. So I'm not saying that there's a rate hike coming. Yeah. But again, all the rate sensitives, though, are under pressure.
Yeah, absolutely. And I think the other thing is, just wondering, and we'll have to ask some experts in the rupee market, right? There's FCNR bit. If dollar rates go up, if dollar becomes more expensive and you are looking to leverage and get money in, suddenly all the math goes out of the window. I mean, as you say, the 10-year is at 4.62. I think the 2-year has gone up in value. So essentially the cost for borrowing dollars is going up, and you're offering, I mean, the way you're getting all this dollar is if somebody's offering 5 times leverage, 10 times leverage. But, if the underlying goes up, the cost goes up. I think there was a meeting yesterday in Delhi, right? Finance Minister met the CEOs of all banks. And from what I pick up, reading, it's all, of course, public information, is that the government wanted an update. What's happening with that, the FCNR scheme? So I think they want to fast track it. Because underlying conditions can change. So that's the other thing to watch. The dollar rupee, of course, is also at the day's, I think pretty much the day's high, 0.64 lower on the rupee at this stage. Well, how should you position yourself in the last hour? That's the question. Mitesh is with us of Bonanza Portfolio. Mitesh, good to have you with us here. Thanks very much for joining us. Quick thoughts. I think it's kind of worked, right? It depends. yesterday the market rebounded from the lows about 200 points and we ended flat. Today you got 150, 160 odd point cut. I think your advice was to kind of stay away, not buy the dip.
So actually, good afternoon, Prashant. The movement is slightly, not so typical. We've had a gap down yesterday as well. Yesterday we saw a pullback. Today we saw a mild and a feeble pullback. But yet we haven't broken below the key averages. So I think it's still, as I said, and most of the indicators are flat. That would indicate that the chances of market kind of consolidating are slightly on the higher side, and we are going with that possibility. Having said that, on the stock side, Concor appears to be making a sequence of higher highs. So recommend a long here with a stop at 483.5 for targets of 515. And Bharti Airtel is a buy with a stop below 1919 for a target of around 1985.
Bharti Airtel, what a strong move in the stock today. That's the top Nifty gainer today. And just in the morning, we were chatting with Sanjay Parekh of Soham, and he believed Bharti Airtel can be a long-term compounder, at least over the next 3 years. And his basic call is that the street is undervaluing or underappreciating what the company is doing with NBFC and the data center. I think he listed one more thing, but the data center and NBFC were the two things which the street is not appreciating the way it can grow. He's saying the business of Airtel can look completely different in the next 3 years. So that is one of their key portfolio bets. And he said it acts as a hedge even when geopolitical tensions rise. We'll come back to you, Mitesh, for more ideas. For now, let's talk about Fino Payments. That's in focus for the last 4 trading sessions as the bank has reported a strong business update for Q1. Ritu joins in with more details. Ritu.
Fino Payment Bank, what a phenomenal run. Our 4th consecutive session, it is up. The bank, of course, reported a strong business update for June just yesterday. There was good growth in deposits, digital customers, even though the transaction business continued to moderate. So it opened more than 3.1 lakh new accounts, up 31% from a year ago. But the average deposits also increased to about 11% from, to 2,755 crore rupees. The active users on Fino Pay app have also risen 38%. So even with all of that, the standout was the loan referral business, where disbursals have surged 253% year-on-year to 240 crore rupees as the bank continues preparing for its proposed small finance pack transition. Transaction throughput, however, has declined 35% to about 2830 crore rupees, with the bank attributing that fall to the shift from cash to UPI and saying the pace of decline has eased in the current month. So stellar growth there apart from that. And, the street expects lending to only pick up from here as the bank makes that transition into a universal bank.
Okay, thanks a lot for that, Ritu. Let's go across to Dharmesh Kant, Head of Research at Chola Securities. Dharmesh, hi. Good afternoon. Good to see you in. Well, Mr. Trump is spoiling things, right? Markets are getting to good momentum. Cherry picking was coming in there. And then suddenly this crude oil's price spike from $73 per barrel mark all the way to around $87 per barrel mark. What do you make of this one, Fino?
Yeah, Dr. Nigel. Fino, we have been seeing it, but I haven't done a deep dive into it. But broadly, all the fintechs, we are staying away from that because the disruptions can be very fast and furious in this segment, and the type of money, per transaction money, which they have been making can still undergo a huge change on the downside. So that's the concern out there. RBI is working on many of the regulations. So how those regulations are going to shape up finally is another overhang on this entire fintech system. So that basket we have been ignoring, though the business update has been good by Fino Payments and the stock price is seeing handsome gains.
Okay, let's quickly address HCL Technology. And here I just want to talk a little bit only about the data center. So what did the companies say, the data center investment? So what we know is 3 months back, they made a 10% investment in Sarvam AI, which is India's homegrown LLM. Yesterday, they said they will be making an initial investment of 3,500 crore rupees. And they also said that their goal is to have 50 megawatts of data center capacity. Again, it's not the 3,500 crore is the amount required for 50 megawatts. This is only an initial investment and they will scale it up. So there is no timeline shared. And how HCL Tech is going to be different from the other data center companies, whether it's TCS with Hypervault or a Yota, Sifi, Control S, Nextra. Those are largely realistic. I mean, those are, when you want to buy capacity from those companies, you're leasing it. You're only renting it.
they don't own the chips. They provide you the real estate. They give you the power connections. They will give you all the electromechanical connections there. So in that sense, it's seen in its real estate plus play. But HCL Tech is going to own the hardware. It's going to own the software. So they will buy the GPUs. They will buy the CPUs. And on that, they will bundle in the software and the services play. So they will own the infrastructure and they will add the AI services and then sell the proposition to the clients. And therefore, they're calling it a complete AI stack play, a full stack AI angle. Now, what is the street concerned about? One, that this is a material commitment. That if you want to broadly look, the 50 megawatt investment, that the capacity that the company is talking about, if you assume the hardware software cost, we're talking about 30,000 crore rupees or $3 billion. That's a sizable amount. Where will that capital come from? What's the timeline for investment? Will they take in another player like TPG and TCS, joint hands? If there is a PE player who partners in, at some point they will want an exit. So the investment aspect of it is still a bit unclear. Secondly, if you read what CVK or HCL Tech had to say, they talk about how sovereign AI represents a compelling opportunity. So basically, the read is that maybe the company is getting into this to capture more of the India government or the PSU work, because it's the government or even Indian enterprises. They want to have the data in India and keep the intelligence in India. So this is not for the US or the European clients. So if it is a way to get more India or PSU work, then it typically comes in with lower margins and different poorer working capital requirements. The third point that I picked up from analysts is that they're only talking about 50 megawatts capacity. Their peer TCS is already talking 20x, 1 gigawatt of eventual capacity. So is this size subscale? What is 50 megawatts going to really do? Especially when India's ambitions anyway are 6, 7, even 10 gigawatts in the next 4 or 5 years. So if the size is so small, it is not meaningful enough. Will that in a way act as a bit of a distraction? And then finally, data center is not their core competence because IT services are asset-light service businesses. These are capital intensive. There's you require land, the land approvals. It's a very complex game. It's a very different game that the company has to deal with. So I think these are some things that I picked up on. I don't think I could call them concerns also, but these are the question marks that analysts have raised on the data center investment.
One thing, they invested in this Sarvam, right? And maybe there is some synergy, right? I mean, it's a, so it's, but basically the concern is capital cost.
It's the capital cost because they will own the hardware. So analysts are expecting $33 billion. That's 30,000 crore rupees.
Yeah, no, absolutely. Eventually. And the rupee is 96. So we're going to
multiply by 100 for ease.
Absolutely. Any thoughts, Dharmesh, HCL Tech?
Yeah, Prashant, I mean, as far as numbers are concerned, they were better than what the expectation was. So there it goes on a positive path. But to my mind, the entire IT space is now quarter to quarter kind of a game. So, I mean, the deal wins are of shorter quarters, and one is to deal with each quarter, how things are shaping up and how the disruption is shaping up. The other thing that is my thinking, is more of a survival strategy. Most of these companies are, banking on rather than a sustainable growth kind of a strategy. So whatever is there under the sun on the IT space, they are trying to test the waters. So, I mean, TCS went up with 1 gigawatt kind of a capacity for data center, and they are trying with 50 megawatt to begin with. So these all are low margin business, high gestation period of capital intensive business. But this also tells you have nothing more to do as of now with the cash lying in the balance sheet, how to effectively utilize that. So I leave it there. I mean, the cloud is still there, and you have to take it each quarter how the commentary goes by, and if there is a gap, or valuation gap, juice is there, utilize that.
Okay. We'll come back to you for more stocks. Let's talk about Biocon. That's buzzing in trade after Mylan sells its 5.6% stake in the company. Sudarshan has been tracking the journey of Biocon, Mylan, at what price point Mylan invested in, and what they're selling at. Sudarshan, take us through.
So two major important triggers for Biocon that happened today. First one is the block deal of more than 9.2 crore shares, and that exactly happened in the block deal window as we expected. And the biggest positive was the price at which the block deal happened. It happened at rupees 400 per share at 5% premium to the floor price that company had set for the block deals, and the floor price was 378.50 rupees per share. Now, if you remember, how did Mylan get the shares of Biocon? So in early 2026, so basically in Jan 2026, Biocon and Mylan had announced an agreement for Biocon Biologics. So Mylan used to hold the stake in Biocon Biologics. Now, because of the agreement via share swap and cash, Biocon has acquired the Mylan stake in Biocon Biologics, and via preferential allotment, Mylan had got more than 6% stake in Biocon. Now, they had sold a part stake before after Jan to July, but remaining stake was 5.64% that they sold in today's block deal window. Entire stake sale was done in the window itself. That's the reason the stock, you have seen a sharp surge. Another trigger is after the big surge that we have seen today, stock becomes eligible for MSCI rebalancing. Currently, Biocon is part of MSCI Small Cap Index. Now, after the rejig, it will be transferred to MSCI Standard Index, and for that, price range is 440 to 445 rupees per share, and that's around the current CMP that stock is currently trading at. Once it happens, it can see the inflows of more than $260 million. So these two important triggers that have happened and led to a sharp surge in the stock price. If you talk about the agreement between Biocon or partnership between Biocon and Mylan, it's a long-standing partnership that has been going on since 2009 and continues to have. Let's see how exactly things go on in the future. But as of now, it's positive for Biocon, and that's the reason, sharp surge.
Got it. All right. Thanks a lot for that, Sudarshan. Dharmesh, what do you make of this one? There were some shots in the system. They seem to get cleared out because, as Sudarshan mentioned, got the block got done in pre-market. And, those that were expecting that discount, they got wiped out. So I think the low of the day is 420, and the stock currently is holding around that 435, 440 bucks odd. Your view?
Yeah, I mean, shorts were taken in for root supplies. At the same time, with this technical buy triggers by the MSCI index inclusion, will attract some more buying interest because of rebalancing of portfolios. We can see a further upside on the stock. As far as the business is concerned, it's into a unique space and a market leader out there. So nothing, nothing to take away from that. But valuations are a concern to me on the Biocon side. If you look at it, it's trading at 20 times EV to EBITDA multiple 1 year forward. At the same time, last 10, 11 years or 5 years, compounding on the revenue has been 16, 17%. Same has been the operating profit compounding. Though profitability PAT has been lower because of exceptional natures and the items out there. The other concern is that debt has gone up from 1,100 crores in 2015 to 15,000 crores as of now. And that's creating a dent into the profitability side. The margins are very low return ratios. I mean, return on equity or return on capital employed is low single digit. With that kind of a margin, 100 plus kind of a PE multiple, it's difficult to justify the valuation part. So celebrated company, it has always been a unique proposition, a delight for investors, and it continues to attract the buying interest.
Quick word, Dharmesh. I recall you were bullish, I think, on Welspun Corp. That stock is in a world of its own. 1,700 rupees, I think, almost 1,700 as we speak. Are you still bullish? If I'm not mistaken, I had visited the facility at around, I think that when the stock was less than half, I think 750 bucks or thereabouts. We here at CNBC TV 18 a year ago had explained prospects of the business as well. But with the stock at around 1,700 rupees, what is your view? Bulk of the good news in the price, or you expect it to continue to remain a compounder? Then it gets that valuation expansion.
Yeah, I mean, both can play out. It can get the valuation expansion as well. I mean, around the same time, 830, 40 rupees, we did an initiating coverage on Welspun Corp. And our target price was far lower. It is traded for it. It's almost doubled from that price in the last 4 or 5 months kind of a time frame. But the opportunity is huge. I mean, the entire Middle East opportunity is coming to them. Our interaction with the management did suggest that laying of the pipes, they would be the bigger beneficiary when oil pipes are laid for transportation. At the same time, US business is picking up fairly well. So it's onto a new territory on the valuation part. But I think over a period of time, next 1 year, valuation P re-rating and multiple expansion can happen. As of now, what we have been recommending to our client is a hold on Western Corp. We are not suggesting fresh additions to the stock, but at the same time, profit booking is also not warranted. So continue holding the stock.
Holding the stock. Got that. Thanks a lot, Dharmesh, for that. Wishing you a good remainder of the day. We catch up soon. Hopefully, by that point of time, we'll see markets in better momentum and, hopefully crude oil prices cool off. Well, let's get you a quick check on the F&O market. We have expiry that's going to play out very, very soon. Crude prices. That's the problem. If it wasn't for crude, spiking up to this extent, if there was some kind of cool off, you'd expect a bit of a bounce like we saw yesterday. However, in today's trading session, that's the problem. It's up close to around 5%. So in a matter of around 3 sessions, you've seen that of 2 sessions, crude has moved very swiftly from $75 per barrel to around $87 per barrel mark. And the call writers, they are at play today. 24,100 call. Take a look at the premiums, down to around $5, $4 now. It started the day at around 150 rupees. So aggressive writing is being seen out there. On the flip side, you've got the direction right, but the time value of money is getting eaten up because with that, the strike that's up for you on the screen, that's going to expire. So the 24,000 put is seeing some writing. The premium is down to around 12 rupees now from around 28 rupees or thereabouts. So just punching in there, given that there is writing being seen on that level. The reference point comes in at around 23,975. 23,975 to around 24,000. That's the important mark on the downside. On the upside, well, 24,150 is the important resistance mark since we have a good amount of activity at around 24,100 call. So just keep that in mind. Individual stocks, MCX recently pulled back. That's coming for a bit of a short squeeze. So that's popped up in trade. Adani Power as well. Shorts were sitting in the system. That as well has got squeezed out. And Biocon, there were shorts in the system. They have closed out, and now you're seeing some fresh long addition backed by delivery-based buying as well. So that as well is up and about in today's trading session. Keep an eye out on that one. Been a relative underperformer actually, but with that block out of the way, let's see whether or not it can get back to its winning ways. That said, let's focus on NetWeb. That stock's on our radar. We have BofA Securities that's come out with a note on that company. Vinny is joining us to decode what they have to say. Vinny, please explain that to us.
Hi. Afternoon. So firstly, initiating coverage on this one for BofA Securities. It's a buy rating, target price of 5,000 rupees per share. Now, obviously, do not forget, every time we see the word AI come in, Network Technologies was buzzing in trade, right? So they are making those AI build-outs. They're focusing on that as well. And they'll be a key beneficiary of this AI story that is starting to play out in India. Now, in terms of tech that they have a tie-up with NVIDIA, which is a long-term partnership they have, a 15-year partnership that they have with NVIDIA. So they get the infra for AI build-outs from NVIDIA before anybody else does. So the background for supercomputing is set for them as well. Long-standing relationships they have with government players as well. And what BofA believes that, given that India's supercomputing share has increased from just 2% to around 9% in FY26, this is just in 6 years, this is a story that will work out for Network Technologies as well. So they're expecting the company to see a growth which will be led mainly by operating leverage, competitiveness also. They will have an edge versus other players given the current scenario as well, and the tie-ups that they have with NVIDIA, as well as they're forecasting a revenue growth, CAGR growth of 40% for the company over the next 3 years. Now, do not forget, yes, the stock has already seen a very good run-up. In the last 1 year, the stock is up 122%. Last 6 months itself, the stock is up around 40% as well. Just in the last 1 month, we've seen a bit of a muted performance, but valuations are already very high for the company. They're still initiating coverage on this one with a target price of 5,000 rupees per share. That is something that we'll watch out for. Stock is currently at 4,400.
Okay, well, I think it's the first, Vinny, thank you very much for that. First foreign brokerage initiation, if I'm not mistaken, on NetWeb. So it's one of a kind of a company, at least in the listed space, makes server racks, imports GPUs, supplies to the India Semiconductor Mission. And actually takes orders from the India Semiconductor Mission, into supercomputers, etc. It's not a new company, old company, and of course it's done well over the last few years or so. 4,400 or so on NetWeb. We'll take a break. We're back. Dinshaw Irani from Helios Mutual Fund is going to be with us on the other side. Stay tuned.
Welcome back. Well, a bit of an expiry-related factors playing out. The Nifty has dipped a little bit, moving to around the 24,000 odd mark. And I think this is that expiry-related factor that's playing out. But it's a good time to get in Nimish. He's been working the phone lines. He always gets us a sense in terms of what's going on in dealing room chatter. Nimish, take it away.
Hi, Nigel. I would say a bit of a lackluster day of trade. We have not seen a big reaction. Of course, as you rightly pointed out, a bit of reaction to the expiry playing out on that basis. But otherwise, it's been pretty much a quiet day, so to speak. Under pressure, largely dragged by the crude sensitive. So most of the sectors related to crude are down today, whether it's autos or OMCs. Those are under pressure. From a flow perspective, again, a mixed day of trade. The good part is there is no big selling coming in from large institutions, but today the number may look large because of that Biocon block where the seller was an FDI, so that needs to be taken into account. NBFCs are a bit under pressure today. Largely, it looks like it's a bit of profit booking day after the recent outperformance. No big news or any major sell-off, so to speak, in that space as well. Technically, I've been pointing out for a while now that on the upside, 24,300, 24,350 is a bit of a resistance zone. So every now and then, from those levels, we pull back a bit from those levels, but broadly, looks like it's a bit of a profit booking day, largely in the crude sensitive sectors.
Got that. Nimesh, in terms of individual names, what's on your list?
Well, the first stock is NBCC. That's been under pressure today and a large volumes as well. My sense is one of the leading domestic mutual fund is a big seller, and that's the reason why that stock is under pressure today. So that's the first name. Second, in a weak market, couple of names where there is buying today: Tata Consumer and GSPL. Both stands out in terms of delivery-based buying from large institutions today. So that's the reason why I've highlighted that. And the last is Astral. There was a Morgan Stanley upgrade in the morning on a couple of these names, including Astral. They have put out a tactical buy as well, and it's been buzzing since morning. Largely a bit of institutional interest back as well. So some bit of buying back in names like Astral from larger institutions today.
Okay, all right. Thanks very much, Nimesh, for that. So that's the chatter and some of the names that perhaps should be on your radar. Dinshaw Irani is with us, CEO Helios Mutual Fund. Dinshaw, great to have you with us here. Thanks very much. Good afternoon. So, I know you don't want to talk about, rather not talk about individual names. I know you would want to if you could, if that framing is correct. But, we were talking about Welspun Corp a little while earlier. We spoke about it yesterday as well. What a move it's had since, and maybe at the margin, the trigger which lit the fire was this entire pipeline build-out news that eventually, we don't know if the orders are coming. We had Dharmesh Kant of Chola earlier tell us that he's been in touch with the company and maybe there is some ordering happening. I'm talking about the Saudi, the UAE, the others wanting to build out more pipeline infrastructure to avoid the Strait of Hormuz. So, yeah, I mean, it's a bunch of things, not one, but I understand you've added, this one to your portfolio as well over the last few months. Just talk to us about what your broad rationale was, Dinshaw.
So, hi, first of all, very good afternoon to you and your viewers, and thank you for having me on your show. Basically, the rationale was this: only the things will normalize over a period of time, which fell flat on our faces. I mean, it's again started off in that region. So we were thinking of reconstruction happening. We weren't even thinking about trans-peninsular pipelines from Hormuz to Aden. We were more thinking about rebuilding happening in the Gulf area after things have normalized. But that doesn't seem to be working out. Beyond that, I don't want to say anything, but the stock has worked out well for us anyways.
Sorry, why did you say fell flat on the face? What was, I mean, it's worked out very well.
Our argument of that things will build out and build-outs will happen in the Gulf area when things normalize. Well, normalization doesn't seem to be the case out here. Yeah. If anything, it's getting escalated further.
Yeah. No, but Dinshaw, the point I'm making is it's pipeline, I mean, the Saudi, East-West pipeline. So this is actually, this disruption between Iran and US, if anything, adds to the bullish case for Welspun. I mean, because there's no ships going through. So what do? You accelerate the pipeline build out to carry the oil and gas out of the Persian Gulf to your customers on the other side. So that's the.
I agree.
Yeah. So
I agree there. I agree there. But I think the bigger contracts would have been rather on the immediate ones would have been that. But yeah, you're right about this, that this is what is being played out. But frankly, I mean, if things don't normalize out there, I don't think they'll be spending anything on the capex initially. You saw what happened in the first quarter when things were at a standstill in March and April in the Saudi area, and when things were escalating. And right now it seems to be escalating. So that's why we are just holding on right now. So, but the stock has done well for us, no doubt.
Dinshaw, hi, afternoon. I believe you're completely exited your holding in Kotak Mahindra Bank and increased your weightage in HDFC Bank and ICICI Bank. Take us through the decision.
Actually, we haven't increased. I mean, we added some to both the banks. Yeah, we did exit out of Kotak. Basically, we felt that we had too many names, one, in the banking space. And plus, we were not, I mean, basically on the overall banking weight, we wanted to reduce our weight to an extent in the private sector. We wanted to move into certain exciting NBFCs in the capital market facing space and in the mid and small cap space as such. And that was the reason for rationalizing this. Otherwise, there's no other reason. I mean, we don't have any specific. I mean, the fact was it was
So you completely exited Kotak Mahindra Bank, and which of these exciting NBFCs?
Yeah, you can see from my portfolio, I won't talk about the names as such. As Prashant mentioned, I would love to, but I cannot. My compliance guy doesn't allow me to.
We can put up a disclosure on the screen, Dinshaw.
Still.
Dinshaw, tell us about this. I can see both the listed exchanges you have, BSE as well as MCX, and both of them have been the biggest wealth creators, in the last few years. Now you have another one that's coming up. What is it? How would you approach it? I mean, the new one is going to be a massive market capitalization. A lot of funds will be forced to have ownership out there. And maybe some part of this re-rating for stocks like BSE that was gradually picking up market share that could be in the price. How will you view this? Do you hold on to these existing exchanges that you have, commodity and stock exchange? Or would you also be looking at the new one that could come in the second half of the year?
So, okay, Nigel, I will neither say yes or no to that. But let me just point out on 1st July, the prop trading rules change, right? I mean, the margin funding. And after that, you've seen quite a bit of pressure on both the exchanges in the terms of the volume declines and all. I think that's not good news for the exchanges. The good news for BSE, though, would have been that NSE's listing on BSE, and you can see the volumes going up there if things trade the way we are expecting. I mean, we're looking at something like 6,000 crores of trading happening every day in NSE stock if the market cap is what is being talked about. And that's delivery volumes we're talking about. So if that happens, I think that exchange can do well. But frankly, I think both the guys are now too expensive to add further from here on. So I'll leave it there. And frankly, I mean, NSE depends on what kind of market values it's coming at. What we've been hearing is not too exciting for us.
Two areas, Dinshaw, if you can. One is the textile space where there is exposure in the, I think in the small cap fund, right? Top holding there. So what do you expect to happen? I mean, I think it's a broadly positive environment for textile exposure, rupee depreciation, and all these trade deals, etc. Is that it? And you've got some well-run companies here. And the other space is, in the mid-cap fund where you have Paytm as a top idea. Now, what is that at the back of? Are you expecting MDR to be introduced on some high-value transactions, as some have been talking about for a while? Do you expect that to happen? Go on.
Okay, so basically, let's start with the textile plays. Yeah, we got two textile plays out there. One is the top holding and one is in between. The fact is that, as you rightly mentioned, with the FTA happening with the EU area and UK and all, they will benefit. And obviously, the one big player that we have is US facing. Mind you, I mean, that particular stock was making margins even when the tariffs are at 50%. I'm sure there must have been some deal on the side allowing him that he was giving away certain portions of his margin. So maybe, and one saw that actually in the March quarter, when the results came out, the margins were way beyond normal per se. So I don't expect them to normalize even this quarter. I think they'll be far higher than normal as such, and probably move on to normalization by the end of this year. But frankly, I mean, the fact is with the FTAs coming through, I think that's a very exciting space. Coming to Paytm, MDR is one of them. I mean, it's just one of the triggers that we are expecting out here. But frankly, I mean, look at it this way. The subsidies that were being offered for UPI payments were taken away by the government. I'm sure the private sector is no mood for charity for far too long, right? So the fact is that something has to give somewhere. And maybe, and we're not looking at the kind of MDRs that they allow credit card companies. We're talking about a couple of basis points here and there, which won't be impacting any transactions per se. So I think there's something around the corner. But frankly, even besides that, the stock has done very well in terms of earnings growth and all, given the kind of firepower he's got in various other gamuts of the facets of the business that he's in.
Okay. And very quickly, why did you sell your stake in Hero MotoCorp, Bajaj Autos?
You on the ball. Okay, so basically we had taken these guys because of entry-level vehicles being there, and we thought that they will be gaining market share. They had been losing for a while. But frankly, and also in the EV space, Hero was more for his foray into EV also, that we liked it. But really nothing happened. And in fact, the volume growth just tapered off. And that's what put us off. So the only two-wheeler play we have is the EV play, which is Ather. You must be knowing about that. But otherwise, we've given up all the other two-wheelers that we used to own as such.
Okay, all right. Thanks very much for being a sport, Dinshaw. Dinshaw is like, I don't want to talk about stocks. Well, stock after stock after stock.
Finally, you guys made me talk about them. So,
thank you. Thanks very much. Appreciate it. Well, I think that's Helios with some perspective on what their holding is and some of the rationale, as he's explained. We'll take a break. We are back as always. We'll get you some trading ideas with a technical expert. Stay tuned on the other side.
Welcome back. As promised, let's get in some technical trading ideas. Mitesh Thakkar, as always, joins in. Mitesh, what calls do you have?
From a monthly kind of perspective, and it's very difficult to guess which side the market will open depending on the week. Some stocks to show a lot of strength and therefore should do well in this DV's lab. It's moved up about 3.5% day side. So BTS is there at the start below 72.60. Look for a target of around 72.10 to 72.20, possibly for tomorrow. And the other stock which I have, that's negative Selco on Hero Motors. STVT was stop at 4,900 for target of 4,950.
Thank you very much for that. Now let's put the spotlight on the Aditya Birla Group, because from renewable energy to cement to financial services, fashion and even sports, the Aditya Birla Group is making bold bets across various sectors with billion-dollar acquisitions and aggressive capacity expansion. 2026 is perhaps shaping up to be another landmark year for one of India's largest conglomerates. Nigel is here with a deep dive.
Well, Kumar Mangalam Birla is on the front foot. Over the years, Mr. Birla has spearheaded more than 60 mergers, acquisitions and joint ventures, with the enterprise value of the landmark acquisitions crossing an estimated $20 to $22 billion. And 2026 is proving to be another defining year. The most recent is a transaction that Grasim's Aditya Birla Renewables has done as they acquire Solenergy Power from Shell in a deal with an enterprise value of around 17,200 crores. The acquisition nearly doubles the renewable energy portfolio from around 4.4 gigawatt all the way to around 9.4 gigawatt. And it puts the group on course to achieve 20 gigawatt of renewable portfolio over the next few years or so. Earlier this year, we saw one of the biggest moves in Indian sports as well, as the Aditya Birla Group-led consortium, along with the Times Group, Bolt Ventures and Blackstone, acquired Royal Challengers Bengaluru, IPL and WPL franchises from the United Spirits. That deal was valued at around $1.8 billion, marking a high-profile entry into sports ownership. The group has also doubled down on financial services. Grasim invested around 2,880 crore rupees through a preferential equity issue to raise its stake in Aditya Birla Capital, reinforcing its long-term commitment to the financial services business. In cement, the big boy, UltraTech, continues to rewrite the record books, and the domestic capacity has now crossed 200 million tons per annum, with the new target set at around 240 million tons. What's remarkable is the speed. It took 36 long years to reach 100 million tons of capacity, but it took just 7 years to add another 100 million tons. The expansion has also been powered by acquisitions. In 2025, UltraTech acquired the cement business of Kesoram in a $645 million transaction. A year earlier, it bought India Cements in a 3,954 crore deal, securing 55.5% stake and strengthening the leadership in the cement sector. Another ambitious bet has been paints. Launched in 2021, Birla Opus came with a committed capital expenditure of around 10,000 crores. And in just a matter of a few years, it's emerged as the number 2 player in India's decorative paint industry by installed capacity, underlying the group's intent to disrupt an already established paint market. The acquisition strategy, well, it expands beyond infrastructure as well. In 2023, Aditya Birla Fashion and Retail acquired 51% stake in TCNS Clothing in a deal worth 1,650 crore rupees, creating one of India's largest branded ethnic and women's fashion platforms. So from renewable energy and cement to financial services, paints, fashion, and even sports, Mr. Birla's strategy has remained consistent. Scale through bold investments, strategic acquisitions, and long-term value creation, with deal-making accelerating and expansion plans gathering momentum. The Aditya Birla Group appears to be on the front foot.
Well, absolutely, no doubt about it. Big deals over the last many years, Nigel. Very interesting that you put this together. Jay Bala is with us, cmtcashthechaos.com. Jay, great to have you with us here. Thanks very much for joining us. So we are once again in that, after a brief, interruption-less period where the market could, do what it wanted to do, you're once again blockaded in that sense. Not a naval blockade, but price blockade. We're down 150. What's your sense, Jay? You think we will retest some of these levels on the downside? 23,800, for example, acted as a support multiple times this time around as well before we moved higher. Or you think we go lower?
Hi, Prashant. Thanks for having me on your show. The markets in the short term, even without what happened in the last few sessions, related to the geopolitical tensions, was always giving contradictory signals in the very short term. See, the higher time frame has always been clear. The markets have bottomed in April, and the April low is very likely to hold. That's not at risk. The short term has always been that whether the markets gets back one more time below the gap down area or the gap up area that it saw a few weeks ago, and then takes out the key resistance at 24,602. So as long as markets are below 24,602, that uncertainty will linger on. Watch 24,602 as a important level to take out to confirm that the markets are heading immediately higher. Whether the markets goes down one more time back to the 23,000 or holds the gap support at 23,600, all that will remain and linger on. Only a clearance of 24,602 will remove this muddied picture.
Okay. Some of this, of course, comes back to the macro point that which is what's happening as far as oil is concerned. It's also, of course, showing up to in the rupee, right? And the dollar rupee will come up on your screens, 96.20 once again. It's a large move. I'm sure lots of players would have gotten stopped out. Lata is here with some spotlighting on what's happening here. Lata, take it away.
It makes it a 1% fall this week, 0.3% on Monday, and a little over 0.6% fall on Tuesday. Until July 10th, the rupee was the best performing currency. I mean, from June 5th to July 10th. And this week, one of the worst performing currencies. The reasons are obvious. We are vulnerable to a crude price rise. And the market simply was not prepared for $85, $87. Some movement from 70 to 75, 78 was perhaps taken. But once the 80 number comes, the market was clearly not prepared for that level. And of course, the dollar index also has shot up. The problem in the market for the rupee market is the positioning. The whole market was positioned for short dollar and long rupee because the anticipation was that I'm going to have $50-60 billion of FCNR deposits. So importers were completely unhedged as to their future dollar requirements, and exporters had sold forward dollars expecting that we are not going to get 95 and 95.5 anytime soon when the FCNR dollars come. Now it is the other way around. Exporters have bought back the dollars they sold, and importers are rushing to buy dollars for their immediate 1 month, 2 month ahead sales, 2 month ahead purchases. And that is creating this, just in one day, a 1% fall in the currency. This meeting of the finance minister with the public sector banks yesterday, where FCNRB quite clearly was the most important topic discussed, our reporter Sapna Das told us that, is being followed up by the Reserve Bank meeting private sector bankers this morning and public sector bankers in the afternoon. And one of the topics we are given to understand is very clearly FCNRB deposits. So the market is jittery that the rulers are jittery. If they are not sure of the money coming in, then, there is a bit of a rethink. Nothing is as bad as an attempt to protect the rupee that has failed. I mean, I'm not saying it has failed, but the market is just nervous whether that step will pay off. And that itself is creating, it's kind of redoubling the pessimism on the currency. The salve to this, of course, is only if the West Asia fortunes change. So really keeping fingers crossed.
All right, Lata, thanks very much for that. And we'll see how this one goes. Try and get you more updates in terms of how the situation has changed after this latest flare-up. Jay, just to come back to you on the Nifty, what are the levels? On the Nifty, what are the levels that you put out on the downside?
Yeah, 24,602 on the higher side is a very, very key resistance. On the downside, 23,800 to 23,600 is a very important support. What we call as a rising window. That support is likely to hold. And I would like to see the markets go below the Friday's low and then turn around. That will give the short-term bullishness a solid base. And when it comes to crude, I'm very confident that crude is going to continue to go down. In fact, today's high at 81.5 is an important resistance. It was an anticipated level. I wrote to my clients 2 weeks ago that I expect a $10 rally. And that has come through. And there are multiple degrees of downtrend that's pending for crude. And very confident that crude is likely to crash below the December low of 54.2. I'm talking about WTI. And today's high is about 81.23, I think. So that is a very important resistance. So that is giving me, confidence that, probably sometime today or tomorrow, you're going to hear Donald Trump say, Iran called me, Qatar called me, Pakistan called me, and there's going to be a change of stance.
basically you're saying it's topped out at 86 on Brent. It's topped out. That's the view.
That's right. Today's high, the Globex high is very likely to be an important top, and it's going to go back below 67.
So if you can do it, I'm sure you can. Short oil and buy Nifty.
I don't know that correlation is working so well, but definitely short crude.
Got it. Short crude. Okay, let's talk about what's on your mind, Jay. Any specific stock trades, ideas, positional buys or sells?
Yeah, I'm bullish on two stocks, Prashant. One is Siemens. I've been very bullish on capital goods space, and I think the recent decline in the capital goods index is very close to finishing a corrective decline. So Siemens, with a stop loss at about 32.80, I'm anticipating it to crop fresh 52-week highs around the 4,000 plus mark. And the second stock is from the refrigeration space. Blue Star, a small cap name. Today it's breaking out of inverse head and shoulders pattern. Stop loss at about 1560, possibly scaling fresh 52-week highs about 2,400.
All right, Jay, just hold on to that thought. Just pull up the intraday chart of SG Mart. I can see a rather large trade actually that's taken place out there. And the stock as well has popped up in trade. So let's pull up SG Mart. I think, the multiple blocks actually that took place on the BSE around 650 rupees. And that one has suddenly spiked up as we speak. So I think that one should come up for you on the screen. It's up close to 4.5%. Big volume spike is what we're seeing on that one. So just thought we'll point that out.
Okay. All right, let's, stay on, Jay. We just want to quickly update our viewers on what's happening in the primary market because today, India's largest AMC, SBI Funds Management, opens up for subscription. And day one at 3:10 p.m., it's already subscribed about 0.55 times. Now, earlier, we caught up with the management of SBI Funds Management, the joint CEO, DP Singh, and we were trying to get a sense of how the company has valued itself. So currently, the company's profits are a little more than 3,000 crore rupees. Can they get to 5,000 crore rupees by FY28? Just to try and get to understand the PE of the company. This is what Mr. Singh had to say.
Assuming 25-26% growth, 5,000 crore net profits in FY28, which gets us a multiple of about 24 times. Is that the right way to look at is that the right multiple, Mr. Singh?
So many factors around it, but if we go by our past history, the way we have been growing, then definitely yes.
Okay.
But there are always in the markets, there are uncertainties. It could be more than this, it could be a little less than this. But the growth rate, the more and more financialization happens in the country. SBI Mutual Fund is at the forefront. We will get the maximum benefit. The moment, today the biggest friction in growth of mutual fund business is the way KYCs are being done, these small players, the way it's a linkage between the remuneration for acquiring a customer and all efforts to be bring in. So that is not working. The moment that friction is over, which is likely to happen very, very soon, and once because all the bank accounts are now KYC compliant. The moment any bank account which is KYC compliant, frictionlessly can part money in mutual fund, I think that will be the biggest revolution. And the number which is there today, only 6 crore investors, that will multiply like anything. And that the number could be anywhere. I'm not saying as much as number of bank accounts are there, but at least 20% of the bank accounts will be the mutual fund investors.
Okay, well, we've been saying it's attractively valued, and you heard it from Sanjay Parekh of Soham Asset Managers as well, in terms of the asking market cap and the implied valuation multiples. Listen in to that voice which we heard earlier today. That's Sanjay Parekh of Soham.
SBI Mutual Fund is reasonably valued. Certainly, they have kept money on the table at 24 times, broadly on 28. It is at a discount to the large peers. And I really believe that there could be good listing gains, surely. So we really believe, certainly the listing should be broadly around 650, 670 is what our assessment is. It's a very good IPO. They've done a phenomenal work.
Final few minutes of trade. Jay, the big headline today is crude oil prices. After all the measures that were imposed, we did see crude, we saw the rupee, beg your pardon, the rupee pull back, and now it's back towards the lower end of the range. I think you were tracking a level of around 96.5 or 96.2, if I remember correctly. It's holding around there. What do you think? Is it going to slip again, or it'll pull back from here?
Yeah, I agree with what Lata said, that the fortunes of the rupee are very closely related to what crude is doing. I'm expecting crude to crash. So the key level for rupee for me was 96.75 on a closing basis. We recently saw an intraday high of about 96, and then the rupee turned around. I think that top is in, but it's threatening that top. I don't think that's going to get taken out. So, and since I believe the crude is going to go back below 67, I think that high will get protected. A break below 78.8 today will confirm that NYMEX crude has stopped, and the Brent variety, I think the high is about 86 and a half, 87 odds. So watch for 78.8 to save the rupee and the crude's rise. I am very, very confident crude is going to turn around lower.
Got that. Jay, any thoughts on HCL Tech? Was the big outperformer, was growing faster than the peers, and today it's just taken a step back.
Yeah, see, the frontline IT is a bit of a risk. I would like to see most of them go to the July 1st lows, or at least test them and hold them. Then IT index as such, I would like to see a break of the July 1st lows. That will help the large cap IT names build a base. And that will be a structural completion of the decline that started from the beginning of this year, or mid-May of this year. So I would be a bit cautious here. HCL Tech on the long-term charts is not that encouraging. So if you want to look at IT names, like I pointed out last time too, I had pointed to Newgen. Newgen had nearly 2 circuits in the last 2 sessions and it's pulling back lower. Look at Tata Technologies. And something like Saxoft, you better off avoiding the large cap names, but don't have to get even aggressive on the mid cap and small cap IT names. There is still protection to be taken care.
Got it. Okay, all right. Thanks, Jay, for joining in. You're still sounding very, very bullish. So let's see how that goes. Expecting the crude oil prices to crash, the markets to move up, and the rupee hopefully pulls back from here. So that's Jay sounding a little bit bullish. Well, let's run you through market action then. Today we go on with a bit of a cut. The biggest loser in trade was HCL Tech. That one, in fact, was down close to around 3% or thereabouts. In the broader markets, there were plenty of movers though, doing a thing of their own. Kalyan Jewellers was up on high volumes. You had SG Mart that we had a large trade towards the end of the trading session. So that popped up in trade. Welspun Corp continues to win orders. Today it was a 1,400 crore order. So that stock was up and about in today's trading session. Good move out there. Just Style as well comes up. You had Kalyan Jewellers that continued its winning way, so that stock as well went home with solid gains in trade. On the flip side, you had a couple of stocks as well that made a comeback. Novoco, after a while, that one came out with a good set of numbers, and that rank underperformer actually has popped up in trade today. It went home with gains of close to around 6-7%, so good going on that one. On the flip side, you had a few stocks as well that did react negatively in today's trading session. Jindal saw, came up with its set of numbers towards the end of close. That one did come in for some profit taking as well. Net, a bit of a down day, but in line with what we saw for global equity markets. Risk off played out, and that's why our markets went home with a bit of red. We'll wrap up on this edition of Closing Bell. Don't go anywhere. The team of Markets Forward comes up next. Stay tuned.
Dalal Street ends firmly in the red as escalating tensions in West Asia sparked off a risk-off mood across global markets. Sensex and Nifty declined nearly 1%. The rupee slips nearly 60 paise to close around the 96.20 mark against the dollar.
HCL Tech slumps after a pre-earnings rally despite beating muted street estimates. The IT major keeps guidance unchanged but unveils a plan to invest 3,500 crore on building data centers.
Biocon leaps after Mylan sells its remaining stake received on sale of its biologics business to the Indian pharma major. The sale makes the Biocon stock eligible for inclusion in the MSCI Standard Index.
Hello and welcome to Markets Forward, your go-to show where we aim to get you all the key data points to get up for the next trading day. I'm Sonal Bhutra and with me is my colleague Ekta Batra. Ekta, good afternoon. Well, a down day. We are finally penciling in the West Asia war risk yet again. We came off from the highs of the day, but the important point is we defended 24,000. That's an important level on the downside. The weekly options expiry also played its role, but we did have the mid-caps which slightly outperformed the benchmark, but Bank Nifty continued to decline. Most of the sectoral indices were in the red today, barring something like a Nifty Pharma, which Ekta will of course discuss in greater detail, but Nifty Metals also played its part on the upside. Having said that, it's very stock specific now, considering that earnings are coming in thick and fast.
Well, yes, Sonal. And you know what was concerning for me today was definitely the underperformance that we saw from the banking stocks. The Bank Nifty, in fact, ended down around 1-odd%. There was no sort of recovery that we saw for the Bank Nifty, which lost around 660-odd points. A lot of stocks such as State Bank of India, which was lower by around 2-odd%, Kotak Mahindra Bank, IndusInd Bank, all of these stocks lost out quite considerably. The advanced decline ratio, nothing to write home about. So 1,640 stocks which were advancing to over 2,800 stocks which declined in today's trading session. So overall, down day for us with the Bank Nifty underperforming and the Nifty just about clasping on to that 24,000 mark. Let's see what the overnight developments are for it to possibly sustain those levels. But let's tell you what we have lined up in store for you. We'll start with the top movers and shakers of the day with Sudarshan. And from a large block deal to Biocon to Grasim's latest renewable energy bet, we break down the big stories and the other stocks that gained traction today. Last but not least, we delve into the key market events to watch out for in tomorrow's trading session. But on to our first segment of the day. Sudarshan joins in from the big wall with all of the top movers and shakers of the day. Sudarshan, over to you.
So it was the day of down move. Unlike yesterday, we did not see any recovery because we saw a sharp spike in crude and also a sharp depreciation in rupee against US dollar. So first, talk about the major Nifty movers. Top Nifty loser was HCL Technologies after posting a mixed set of earnings for Q1. HDFC Life, all the life insurance names were sharply lower ahead of their earnings tomorrow. All the major life insurance companies like HDFC Life, ICICI Life will be reporting their earnings, so will be tracked very closely. And because of sharp fall in rupee and also tracking the yield move, all the NBFCs have seen profit booking, and Shriram Finance was amongst top Nifty losers, has fallen more than 3%. And amid the buying seen in defensive names, Bharti Airtel was top Nifty gainer, up around 2%. Some of the stocks that have reacted to news flows on top of the list is Container Corp. After several quarters, company has come out with quarterly updates, and that was better than expectations, and that's the reason you have seen a sharp up move, up more than 6%. Biocon, because overhang of Mylan selling the stake has gone away. Mylan has sold its entire 5.64% stake, and that's the reason Biocon closed the day with a gain of more than 6%. Landmark continues to post double-digit growth for the quarter. In Q1 also, company has posted revenue growth of 21%. That's the reason this stock closed at upper circuit up 20%. Novoco also, after several quarters, has come out with the earnings, and those earnings look better than expectations. That's the reason you can see 8% up move. Bajaj Consumer, remember, had come out with earnings yesterday. Those earnings were good, but this year so far the stock was up 150%, and that's the reason it has been seeing profit booking. Some of the other mid-cap movers on top of the list is Adani Power. For the several day, major Adani Group companies have been seeing an up move, and today also majority of the names were higher. Adani Power was top of them, up almost 5%. Kalyan Jewellers, everyone knows, in the last 5 trading days the stock is up 50%. Today also another 4% up move. MCX tracking the move in gold and silver. This stock has too moved higher 4%, and Tata Elxsi ahead of its earnings has closed with a cut of 3%. And Lodha Developers, after seeing an up move for several days, today has seen profit booking down more than 4%.
Okay, all right. Thank you so much. That's an exhaustive list of all the stocks which were in focus today. But one of the stocks which we'll speak in greater detail is Grasim. It is making one of the biggest renewable energy bets yet. The company's renewable arm is acquiring solar energy power in a deal valued at nearly 17,200 crore rupees, almost doubling its clean energy portfolio. Nigel is joining us now with the key details of this acquisitions and what brokerages are making of this deal. Nigel?
Well, Grasim subsidiary Aditya Birla Renewables will acquire Solarnergy Power from Shell PLC. Here are the details. The deal is done at an enterprise value of around 17,200 crores. A little bit about the asset that they're acquiring. Solarnergy's Power has a total cumulative contracted portfolio of around 5 gigawatt. Part of that is functional, part of that will come on stream. The turnover for the last few years has been in the vicinity of around 1,100 crores to around 1,250 crores, as we saw in the past year. The rationale for the transaction? Well, it gives the group an opportunity to expand its renewable energy footprint. It increases Aditya Birla Renewables portfolio from around 4.4 gigawatt, you add nearly around 5 gigawatt. So it takes it to around 9.4 gigawatt. Not just that, after doubling its capacity, they have their eyes set on around 20 gigawatts over the next 3 years or so. What would the debt in Grasim's books? Well, it's currently, as of the last reported number, around 6,900 crores, approximately consolidated basis around 37,000 crores. But you'll be wondering, how will this be funded? Well, it will be funded via a mix of debt, equity from Grasim, and also there'll be investments that will come in from Global Infra Partners, which is a wholly owned subsidiary of BlackRock. And just to take a quick recap, GIP, they had invested 2,000 crores in Aditya Birla Renewable Energy with a green shoe option of around 1,000 crores in December 2025. At that point of time, the transaction of GIP into Aditya Birla Renewable was valued at around 14,600 crores or thereabouts. That's what they were valuing the entity at. The transaction is expected to close in 2026 itself. Brokerages, well, we have a couple of opinions coming in there. Citi, they maintain their buy rating, target price of around 3,600 crores. They understand, though, going by the math that they are working with, that Grasim will have to raise some debt. And, there will be some clarity that they are awaiting for. But in the near term, they expect the stock to react negatively. While Morgan Stanley, they have an overweight rating on the stock, target price of 3,900 rupees per share. They see this as a positive development because it provides an immediate scale in comparison to any greenfield expansion that they would have attempted. So the big foray by the Aditya Birla Group into the renewable energy space.
Okay, all right, Nigel. Thanks very much for that. Well, to take this discussion forward, we have with us Jay Bala from Cash the Chaos and Sudeep Bandopadhyay from Indie Trade Capital. Jay as well as Sudeep, thank you very much for joining in. Well, before we discuss Grasim and this big renewable energy bet, Jay, just wanted your thoughts in terms of the closing that we saw today and the Bank Nifty underperformance.
Yeah, the short-term uncertainty lingers on Ekta. As long as Nifty remains below 24,602, I think this uncertainty will remain. But the higher time frame structure is quite clear. The markets are bullish, but what it does from a 1 to 5 day time frame, that's the thing that's up for debate. Either the markets go back one more time to 23,800 and then go past this key resistance at 24,602, or it straight away takes out that levels and expands higher. So the short-term movements aren't that much of an impact for me. I'm expecting crude to decline sharply back below the 67 mark that it saw a couple of weeks ago. And this is what we've seen in crude. It's just a short-term bounce, and it is well expected. I was anticipating a $10 bounce, and it's come through. And today's Globex high on NYMEX crude is likely to be an important high, and crude is likely to decline from this level.
Okay, so that's on the market move. Sudeep, coming on Grasim, what did you make of this move that has been, the acquisition that has been done by Aditya Birla Group? Anything that you like from the renewable space, if not this, in the listed space?
Well, I think, first of all, Sonal, this is a fantastic transaction to my mind. They're doubling their capacity at one shot. It is, of course, will involve some amount of debt in the balance sheet of Grasim. But that's understandable. If you're expanding your renewables capacity and making it double through this acquisition, there will be some debt. So short term, yes, the market will probably worry about the debt, and there has been some correction already. There may be some amount of correction going ahead as well. But I think from an overall Grasim perspective and Aditya Birla Renewable specific perspective, this is a good transaction. And we are positive on Grasim. We continue to maintain our positive view on Grasim. We have a target of 3,500 and we maintain that.
Okay, all right. Thank you for that thought, Sudeep. But hold on, we will speak about Biocon as well. The shares of the company jumped over 6% after Mylan offloaded its entire stake in the company via a block deal. Sudarshan is joining us now with all the details. Sudarshan.
So two major triggers for Biocon that have happened through the day. First one is the Mylan offloading its entire 5.64% stake. Why exactly had the stock to move sharply higher? The reason, the entire block deal of 5.64% happened in the block deal window, and it happened at a price of rupees 400 per share. That was at a 5% premium to the floor price of rupees 378.50 per share. Remember, Mylan had got more than 6% stake after the deal between Biocon Biologics and Mylan was announced in early 2026, or say in January of 2026. And after that, Mylan had got more than 6% stake through preferential allotment in Biocon. So Mylan had sold a bit of stake between Jan to July. So remaining 5.64% stake was sold today and happened in the block deal window. One trigger. The second trigger was after this deal, we have seen a sharp surge in the stock. Now the stock becomes eligible for MSCI rejig. Now, so currently the stock is part of MSCI small cap index. Once the rejig happens, it will become part of MSCI standard index. And now for that, price range is 340 to 345 rupees per share. The stock is currently around that level. Once it happens, there can be inflows of more than $260 million. So these were the main two triggers why this stock has seen a sharp surge, up more than 6% today.
Okay, all right, Sudarshan, thanks very much for that. So yes, a 17-year-old relationship, whether it's partnership, whether it's an equity stake, now has completely ended, which is basically between Biocon and Mylan. Sudeep, your thoughts on Biocon and what might the future hold, considering that Mylan has been such a long talked about relationship that they've had, and now with the biosimilar portfolio along with their GLP-1 portfolio as well, what do you think the prospects for Biocon would be?
Well, I'm positive on Biocon, and of course, this selling and their exit, clears the overhang on the stock, and that's good for the stock undoubtedly. Of course, the MSCI rejig, which Sudarshan talked about, will add some, additional masala and ensure that there is momentum in the stock for some time. But fundamentally, we do like Biocon, and I think this exit, of course, the relationship and things like that was great, but the selling of shares and that overhang on the counter was a problem, and that's now gone. So it's positive overall for Biocon.
Okay, it's positive fundamentally, but Jay, chartically, what do you make of the stock?
It still got record highs to complete from a chart structure perspective. But I would project a too high a level. I'm also positive overall on the pharma space. I'm anticipating the pharma sector to do well. I think there will be better picks here, but I would say, the upside will be capped to something like 480 to 500. So that's what I'm projecting for Biocon. But the short term is good. Medium to long term, I don't see much great upsides here. I'm sure there are better picks to seek out in the pharma space.
Okay, all right. Well, moving on from Biocon now, several stocks were buzzing on the back of business updates, brokerage calls and fresh deal wins. Devyani joins in with the top stocks that made headlines today. Devyani, over to you.
Hi, so let me start with Landmark Cars. Now, the Q1 business update is out, with the company having recorded its highest ever Q1 sales. Now, revenue came in at 1,733 crores, up 22.5%, while revenue from vehicle sales was up 24%, and after-sales service and spare parts revenue was up 14% year-on-year. Next up is Privi Specialty Chemicals. Now, the INCRED came out with an initiating coverage report with an ad rating and a target price set at 4,796 rupees per share, implying 30% upside from current levels. And the company expects volume growth and revenue growth of roughly around 10% through FY29, with gross margins likely to remain around the 48% mark and EBITDA margin at 25 to 26% mark. Next up is PDS. Now, the company has entered into a multi-year sourcing as a service contract with a leading French retailer. Now, PDS will manage and operate the retailer's textile sourcing operations across 5 countries, and it also expects to manage apparel sourcing of roughly around $250 million of volumes annually as a result of this. Last up is Concor. Now, the Q1 update of the company was positive. Total volume growth came in at 8.9%, with EXIM volume growth at 9.8% and domestic volume growth at roughly around the 6.2% mark. The company had guided for roughly around 9.5% volume growth for FY27, EXIM growth of 8% and domestic growth of roughly around 15%. So all in all, these were all buzzing in trade today.
Okay, all right. Thank you, Devyani, for joining us. So some of these stocks which buzzing on the upside on the back of news updates and some brokerage notes as well. Jay, anything that stood out for you? Landmark Cars, a big surge. The stock has been a laggard, but we did have Privy. The chemicals pack has been doing really well. Anything where you do see a strength going forward?
So, particularly on chemical space, I know I'm liking BASF. That's looking good. But from a stock perspective, I like Blue Star today. That's also done a bit well today. I'm anticipating it to rise to 2,400 from current levels. And I also starting to like Siemens once again. So I'm bullish on capital goods space.
Okay, all right, Jay, as well as Sudeep, we're going to leave it on that note. Thanks very much for joining in and giving us all of your perspective on all of the stocks discussed. Well, let's move on now. And one of the key factors to watch out for today was definitely the rupee, which was under pressure once again as soaring crude prices and renewed geopolitical tensions weighed on the currency. At the same time, wholesale inflation, or WPI, has surprised on the upside. Lata joins in with all of the key details on this. Lata, over to you.
Yes, it's a big day for macros with rupee and inflation being in the news. First, about the rupee, it's down actually over Monday and Tuesday by 1%. 0.3% fall on Monday and over a 0.6% fall on Tuesday. And of course, the reason is obvious to everyone. Crude going over $85 was nowhere on the cards. The market was prepared for some jitters as, the skirmishes between Iran and US was always to be expected. But $85, $87 has clearly taken the market by surprise. And the dollar index has also shot up. And that explains the fall in the rupee. But what explains the rupee's fall even more, it's the worst performing currency this week, is because the positioning was very pro-rupee and short dollar up until July 10th. Because of the expected FCNRB flows, importers had not bought forward at all. In fact, they'd taken off their forward hedges and exporters had come and supplied selling forward dollars. Now they reverse. The forward dollars they sold, they have bought back, and importers are coming in a rush over the last 48 hours to buy dollars, all of which is leading to this sudden 1% fall in the currency. As well, the meeting of the FM with banks yesterday and the Reserve Bank meeting other bankers, private and public sector bankers today, and the conversation has been entirely around FCNRB. So if the regulator and the government feel that FCNRB flows are not fast enough, the market is, increasing its worry about how the currency will fare. That is adding to the pessimism. We have to wait and see. One hopes that it doesn't go all the way to 96, the prevailing all-time low, because that was before the FCNRB announcement. It's a wait and watch game. The market is clearly not prepared for this blockade which was announced by President Trump. And with that, let me come to the WPI numbers. The wholesale inflation numbers for June are almost double digits. 9.87 is almost 9.9. The market was prepared for 9.4, which was the CNBC TV 18 poll. And you're seeing core WPI also go up to 7.5. Manufacturing WPI also at 7.48, nearly 7.5. After a point, core starts seeping into consumer price inflation. Wholesale price inflation has always been high. From April, May, the fuel price is absorbed even before it starts rising for you and me, because it's a wholesale price index. But once it persists for some time, the core WPI, it may start seeping into core CPI as well. And as we know, yesterday the CPI numbers also came in slightly higher than expected at 4.38. The market was prepared for 4.2. Likewise, core inflation also hit 4.1. Right now, it is more because of gold. So the market will wait and watch. At the moment, the mood is that inflation will not hit the RBI's forecast of 5.1 for the full year, nor will it hit the 4.7 forecast for the full year. It will be much less than that, but we will have to wait and see. The war has changed perceptions. There is one positive, however, in the whole thing. When WPI and CPI inflation are both higher than expected, the market's estimate of the nominal GDP has gone up. No, real GDP forecasts are still a little south of 7%, but if you add a 5%, 5.5% inflation to it, then you get a nominal GDP of about 13%, which is very positive. You know, that gives the government a little more space for fiscal deficit, could mean tax buoyancy. So that's the only positive of this inflation number.
Okay, all right. Thank you so much, Lata, for joining us with all those details. With that, it's time for a short break. We'll catch you the top corporate voices along with the key market events to watch out for on the other side.
Welcome back. You're still tuned into Markets Forward on CNBC TV 18. Well, some of the corporate voices of the day that we got. Bank of Maharashtra is looking to raise up to $1 billion through overseas foreign currency borrowings while aiming to maintain its capital adequacy ratio at 17%. Speaking to CNBC TV 18, company's management said the bank is seeing a shift from savings account to term deposits.
And Satvik Green is planning a three-phase expansion with its total debt expected to rise to around 3,000 crore rupees at peak. Speaking to CNBC TV 18, the management said the first phase of the expansion will be funded through IPO proceeds and debt, while the second phase will be financed using a mix of debt and internal accruals. The stock was up nearly 4% today.
All right, and before we wrap, we'll bring you some key market events to watch out for. Devyani is standing by with key events to focus on for tomorrow's trading session. Devyani, over to you.
Well, globally, all eyes will be on the China's Q2 GDP, along with the UK CPI as well as the US Producer Price Index inflation data for June. Now, on the earnings front, ASML reports in Europe, while Johnson & Johnson, Morgan Stanley, BlackRock, as well as United Airlines headline the US earnings calendar. Now, back in India, the spotlight will be on the financials as HDFC Life, HDFC AMC, Angel One, Union Bank, ICICI Lombard, as well as ICICI Prudential Life announced their June quarter results. Now, SBI Funds IPO also enters its second day of subscription. Now, markets will also be tracking two key major macro developments. The India-UK free trade agreement officially comes into effect from tomorrow onwards, while the US begins enforcing its measures against Iran, including a naval blockade of Iranian ports, as well as a 20% security fee on commercial cargo that is transiting the Strait of Hormuz.
Okay, all right. Thank you so much, Devyani. So those are some events to watch out for in tomorrow's trading session. And with that, it's a wrap on this edition of Markets Forward. We'll be back with more news and updates on the other side.
Hello and welcome to Business 360. I'm Archana Solanki. Here are the headlines we're tracking this evening. Crude prices breach the $85 mark after US President Donald Trump reimposes a maritime blockade of Iran. He hints at imposing 20% fee on ships transiting the Strait of Hormuz. Iranian Foreign Minister mocks Trump's plans of imposing a transit fee as tensions flare up in the Gulf. One Indian sailor killed in the attack on commercial vessels at Hormuz. India summons Iran's deputy chief of mission to lodge a protest. 30 Indian sailors were on board 2 vessels that came under attack. Indian rupee breaches the 96 mark against the dollar, weakening to the lowest level in nearly 2 months. Sensex and Nifty slide in trade as crude oil spike and rupee weakness roil sentiment. Kumar Mangalam Birla's acquisition spree continues with a $1.8 billion bet on Shell India's renewable business. Birla has spearheaded more than 60 deals so far with an enterprise value of more than $20 billion. Government fast-tracks the sale of IDBI Bank. Sources say the high-level panel held 2 meetings yesterday, indicating an acceleration in the decision-making process. India's largest fund manager is going public. The 11,700 crore rupee SBI Funds IPO is open with a marquee list of investors already getting shares allotted in the anchor book. The issue is subscribed more than 60% on day one. Competition Commission of India imposes a penalty of more than 14 crore rupees on laptop and printer maker HP and 16 of its resellers, alleges cartelization and bid rigging in the sale of print hardware. This comes a day after the M&A watchdog imposed a 142 crore penalty on HP India and its resellers over 2 separate cases of alleged cartelization and bid rigging in supply of IT products. IKEA plans to double headcount and global sourcing from India by 2030. Also plans to open 25 more stores in different formats over the next 4 years. That's an exclusive. The government's 10,000 crore rupee ATF price stabilization fund has found no takers so far. Airlines stayed away as global fuel prices fell sharply, making the 3-year commitment unattractive, with oil prices rising again amid fresh Gulf tensions. Is it time for airlines to rethink? And Football World Cup semi-finals kick off tonight with the mega showdown between 2022 edition runners-up and France and Euro champion Spain. France has scored 16 goals, the most for a team this World Cup, with Mbappe alone accounting for 50% of them. Spain, meanwhile, has conceded only 1 goal so far. All right, the top story this evening. US intensifies strikes on Iranian port cities as Iran targets US bases across the Gulf. So here are the latest developments. Now, US President Donald Trump has imposed a US blockade on the Strait of Hormuz once again. He said that the blockade will only target Iranian ships. Speaking to reporters at the White House, President Trump also said that Washington needs to be reimbursed for protecting the Gulf nation. This as the US military struck Iranian port cities in an attempt to degrade Iran's ability to attack commercial shipping. In response, Iran targeted Bahrain and Jordan once more. The Iranian Revolutionary Guard said it also targeted the US 5th Fleet headquarters in Bahrain and oil tankers in the Strait of Hormuz. According to UAE Defense Ministry, 1 Indian national was killed in the attacks on 2 UAE tankers. Indian officials have summoned Iran's deputy ambassador in New Delhi over the killing of the Indian national. Meanwhile, in Yemen, the Houthis said they launched missiles at Saudi Arabia's Abha airport in response to airstrikes on Sana'a airport, which it controls. The attacks marked an escalation not seen since a Saudi-led coalition struck Houthi-controlled areas several years ago. This, both US and Iran continue to claim control of the Strait of Hormuz hours after US claims of guarding the waterway. Iranian Foreign Minister Araghchi disputed the assertion and said that Tehran won't charge the 20% fee that Trump proposed. The escalation also spooked the oil markets, pushing Brent crude prices to $86 per barrel. Within the last 24 hours, 58 vessels entered the Persian Gulf and 59 left the area. Listen to the comments made by President Trump about the strait.
We're controlling the straits. We're putting the blockade back. And it's a blockade not for anybody but Iran. In other words, anybody doing business with Iran can't go through. Everyone else will be able to go through. Yeah, I want to be reimbursed because we're protecting a very rich portion of the world. We're spending money. And so what we've done is we are going to be reimbursed for protection. We're protecting by the countries that we're helping.
Now, sources in the shipping ministry tell CNBC TV 18 that 148 Indian seafarers are aboard 7 Indian flagged vessels in the Persian Gulf. Santhya Gora has more details. Santhya.
So the Indian government is now racing against time to ensure the safety of Indian flagged vessels and Indian seafarers stranded in the Persian Gulf, waiting to transit through the Strait of Hormuz and caught in the escalating US-Iran conflicts. Today, the Ministry of Port, Shipping and Waterways held a high-level meeting to chalk out a strategy to move these Indian vessels and Indian seafarers to safer waters as soon as possible. Sources in the ministry have told CNBC TV 18 that at present there are total 7 Indian flagged vessels in the Persian Gulf. All these 7 vessels are waiting to transit through the Strait of Hormuz, and there are 148 Indian seafarers on board these vessels. Talking about these 7 vessels, out of these 7, 3 are container vessels. One is a crude oil tanker, one is an oil chemical tanker, one is a bulk carrier, and one is a dredger. The sources have also told CNBC TV 18 that the ministry, Indian government, the ministry, along with Indian Navy and other concerned authorities are closely monitoring the situation. The concerned authorities are in continuous and they're in touch with the families of these seafarers, and they have also set up a control room which was actually earlier set up and it remains operational at present. It's a control room which remains operational, on which these families of these seafarers can contact the concerned authorities to know about the whereabouts of their loved ones.
All right. Thank you, Santhya, for that update. We'll keep coming back to you. Now, escalating tensions in West Asia, rising oil prices and a weaker rupee dented sentiment on Dalal Street. Today, Nifty and Sensex ended with cuts of over 0.5%. Nifty Bank underperformed blue chips to end over 600 points lower. 34 Nifty stocks ended the day in the red, with 11 of them falling over 2%. Even rupee slipped past the 96 to the dollar mark for the first time since May, as renewed geopolitical tensions and a sharp spike in crude oil prices weighed on sentiment. Lata Venkatesh joins us now with more on the rupee's decline. Lata.
Yes, a bad day for the rupee for the past 2 days. July 10th, we wound up at 95.3, and then a 0.3% fall on Monday and a 0.65% fall on Tuesday, a 1% fall in total, entirely driven by the way in which the dollar and the dollar index and crude have surged because of the re-emergence of strife in West Asia and a possible blockade. The rupee was particularly badly placed because it was the best performing currency up until July 10th in anticipation of the FCNRB deposits. So the entire market was positioned for short dollar, long rupee. That is, importers did not hedge their forward dollar purchases, and exporters came and sold dollars forward in the run-up to July 10th. But now, over the weekend, with things changing, the importers are rushing to buy dollars, forward dollars in a hurry, and exporters who sold the dollars are now buying it back because they're expecting a better rate if they wait. That is leading to a bigger fall in the rupee. It's the worst performing currency this week itself. Another point which is kind of making the market a little uneasy is the fact that yesterday the finance minister met all the PSU bankers and they discussed how the FCNRB flows are doing. And today the Reserve Bank governor has met both private and public sector bankers, and the conversation, among other things, is also going to be FCNRB deposits and their performance. So the market is worried that the regulators are worried. If that is the case, then, maybe there is still some pessimism. That is the additional negative that's dodging the rupee.
Right, India's wholesale price inflation hit a 2-year high of 9.87% in June from 9.68% in May. The sharp rise was led by a sharp spike in prices of food and non-food items. Fuel and power inflation remained the biggest contributor to headline WPI, despite moderating to 27.41% from 30.33% in May. India's largest asset manager is headed for Dalal Street. The 11,700 crore rupee SBI Funds Management IPO opened today and was subscribed close to 60%. The IPO has seen a marquee list of investors being allotted shares in the anchor book. The issue comprises solely an offer for sale, with SBI and its joint venture partner Hyundai diluting their stakes. The price band has been set at 545 to 574 rupees, valuing the asset manager at around 1.17 lakh crore rupees at the upper end. The government has stepped up the pace of the IDBI bank privatization process. Sources tell CNBC TV18 that the high-level panel held 2 meetings yesterday, signaling an acceleration in the decision-making process. The centre and LIC are jointly looking to sell their combined 60.7% stake in IDBI Bank as part of the strategic divestment plan. Now, Kumar Mangalam Birla's acquisition spree continues with a $1.8 billion bet on Shell India's renewable business. Birla has spearheaded more than 60 deals so far with an enterprise value of more than $20 billion. Nigel D'Souza has more on Birla's big M&A bet.
Well, Kumar Mangalam Birla is on the front foot. Over the years, Mr. Birla has spearheaded more than 60 mergers, acquisitions and joint ventures, with the enterprise value of the landmark acquisitions crossing an estimated $20 to $22 billion. And 2026 is proving to be another defining year. The most recent is a transaction that Grasim's Aditya Birla Renewables has done as they acquire Solenergy Power from Shell in a deal with an enterprise value of around 17,200 crores. The acquisition nearly doubles the renewable energy portfolio from around 4.4 gigawatt all the way to around 9.4 gigawatt. And it puts the group on course to achieve 20 gigawatt of renewable portfolio over the next few years or so. Earlier this year, we saw one of the biggest moves in Indian sports as well, as the Aditya Birla Group-led consortium, along with the Times Group, Bolt Ventures and Blackstone, acquired Royal Challengers Bengaluru, IPL and WPL franchises from the United Spirits. That deal was valued at around $1.8 billion, marking a high-profile entry into sports ownership. The group has also doubled down on financial services. Grasim invested around 2,880 crore rupees through a preferential equity issue to raise its stake in Aditya Birla Capital, reinforcing its long-term commitment to the financial services business. In cement, the big boy, Ultratech, continues to rewrite the record books, and the domestic capacity has now crossed 200 million tons per annum, with the new target set at around 240 million tons. What's remarkable is the speed. It took 36 long years to reach 100 million tons of capacity, but it took just 7 years to add another 100 million tons. The expansion has also been powered by acquisitions. In 2025, Ultratech acquired the cement business of Kesoram in a $645 million transaction. A year earlier, it bought India Cements in a 3,954 crore deal, securing 55.5% stake and strengthening the leadership in the cement sector. Another ambitious bet has been Paints. Launched in 2021, Birla Opus came with a committed capital expenditure of around 10,000 crores. And in just a matter of a few years, it's emerged as the number 2 player in India's decorative paint industry by installed capacity, underlying the group's intent to disrupt an already established paint market. The acquisition strategy, well, it expands beyond infrastructure as well. In 2023, Aditya Birla Fashion and Retail acquired 51% stake in TCNS Clothing in a deal worth 1,650 crore rupees, creating one of India's largest branded ethnic and women's fashion platforms. So from renewable energy and cement to financial services, paints, fashion, and even sports, Mr. Birla's strategy has remained consistent. Scale through bold investments, strategic acquisitions, and long-term value creation, with deal-making accelerating and expansion plans gathering momentum. The Aditya Birla Group appears to be on the front foot.
All right, thank you, Nigel, for that. Moving on, Biocon's shares gained after Mylan offloaded its 5.6% stake received in the sale of its biologics business. More than 9 crores shares changed hands at an average price of 400 rupees a share. The floor price of the block deal was set at 378 rupees per share. Mylan was offered a 6% stake in Biocon after the biopharma company acquired all of its stake in the Biocon Biologics in January. The Competition Commission of India imposes a penalty of more than 14 crore rupees on laptop and printer maker HP and 16 of its resellers. The regulator alleges cartelization and bid rigging in the sale of print hardware. This comes a day after the M&A watchdog imposed a 142 crore penalty on HP India and its resellers over 2 separate cases of alleged cartelization and bid rigging in supply of IT products. 3 online gaming companies have moved the Supreme Court seeking a review of the judgment upholding the constitutional validity of 28% GST levy. Tax experts had estimated an additional tax burden of over 2.5 lakh crores for the sector. A setback for Baiju's founder, Baiju Ravindran. The High Court of Singapore has rejected his plea to overturn a 6-month jail sentence in a contempt case. The court has declined his request to keep the sentence on hold, effectively limiting his return to Singapore unless he serves the term. The latest order adds to Ravindran's challenges as Baiju's continues to deal with the fallout from its aggressive expansion, financial troubles and corporate governance lapses. And time for a short break. Coming up next, the government's 10,000 crore rupee ATF price stabilization fund has found no takers so far. More details when we return. Stay tuned. Welcome back. Road Transport Minister Nitin Gadkari has defended the push to blend more ethanol with petrol. Speaking to Network 18, he pushed back on claims that ethanol blending hasn't benefited consumers.
मेरी गाड़ी E15, E20 और अब E25 के लिए रेडी है कि नहीं मुझे बताया नहीं। तीसरा, कंज्यूमर को ये लगता है कि मेरे को फ़ायदा भी पहुंचा नहीं। आप कहते हो इथेनॉल 25% इथेनॉल लगाए तो मेरे को तो 75% ही पेट्रोल का दाम देना चाहिए। वो प्राइस बेनिफिट भी मुझे साफ दिखा नहीं।
पहली बात तो ऐसी है कि हमारा इसका नोटिफिकेशन निकलता है। देश में 1450 करोड़ लीटर इथेनॉल लगता है। अब कैपेसिटी 1700-1800 करोड़ लीटर हो गई जी। पेट्रोलियम मिनिस्ट्री इसका टेंडर निकालती है और कैबिनेट इसका रेट तय करती है और 550 इंडस्ट्रीज हैं। अब मेरे बारे में आरोप होते मैं हाइड्रोजन की बात कर रहा हूँ तो मैं हाइड्रोजन बना रहा हूँ क्या? मैं इलेक्ट्रिक की बात कर रहा हूँ तो लिथियम आयन बैटरी बना रहा हूँ क्या? मैं अल्टरनेटिव बायोफ्यूल की बात करता हूँ क्योंकि देश आत्मनिर्भर बने। तो पहली बात इसका नोटिफिकेशन डिक्लेयर होता है, इसके बारे में इंजन के बारे में हम निकालते हैं और उसके बाद होता है। दूसरी बात, ऑटोमोबाइल कंपनियां भी इसका एक्सपेरिमेंट करती है और ये 4-5 कंपनियां, देहरादून पेट्रोलियम इंस्टीट्यूट हो, ARAI हो, ये सर्टिफाई करती है, उसके रिपोर्ट आते हैं।
All right, Akasa Air is set to raise around 1,050 crore rupees through equity and debt to offset the financial impact of the ongoing Iran conflict. Now, this conflict has driven up jet fuel prices, disrupted flight operations and raised costs across the aviation sector. Bloomberg reported that the proposed fundraising includes about 800 crore rupees in equity. It's also in talks with state-run lenders for 250 crore rupees in debt under a government-backed credit line for airlines affected by the conflict.
Now, the government's 10,000 crore rupee price stabilization fund for jet fuel has found no takers so far. Airlines stayed away as global fuel prices fell sharply, making the 3-year commitment unattractive, with oil prices rising again amid fresh Gulf tensions. Is it time for airlines to rethink? Madiha Mujawar is here with the details. Madiha, please explain what this scheme proposed and what's the way forward.
Well, the question, why have airlines stayed away from the 10,000 crore ATF price stabilization fund, even when it promises to protect them from price volatility? The next table that will come on your screen has all the answers. It shows how ATF prices moved since March. Each month's price was driven by what was happening externally. Look at the March prices, which didn't have any war impact. International ATF, the MOPAC benchmark price was around 61 rupees per litre, while the domestic price was 84 rupees per litre. Now remember, in normal circumstances, domestic ATF is higher because of excise duty and state level VAT. Then came the West Asia crisis impact in the April price cycle. International ATF prices more than doubled to 134 rupees per litre. But look at what happened to domestic prices. The government stepped in to cushion airlines from the full impact of the surge and capped domestic ATF at 105 rupees per litre, while international prices kept surging. So international price surged to 142 rupees per litre in May, but domestic prices remained capped at 105 rupees per litre. And that helped airlines, for whom fuel is the single largest operating cost. But sources tell CNBC TV18, OMCs accumulated around 6,000 crores in under-recoveries due to that price capping. Jet fuel price started to hurt airlines very badly, and they were forced to cut flights on domestic as well as international routes. So when June came, the government came up with a middle path and launched a 10,000 crore ATF price stabilization fund and arrived at a price of around 115 rupees per litre to protect airlines from the price volatility. But there was a condition attached. Airlines had to commit to this price of 115 rupees per litre for 3 years. But look at the timing of the scheme. By June, international ATF had already fallen to 106 rupees per litre. So oil companies raised domestic ATF price to 115 as fixed in the fund, even when no airline had opted for the scheme. By July, international ATF had fallen further to 85 rupees per litre. So why would airlines commit to a scheme or a 3-year arrangement at a time when international prices were falling? So no airline opted for the scheme. But here's where the standoff begins. In July, the 85 rupees international price would normally translate to a domestic price of around 102 rupees per litre after taxes. OMCs are instead charging 110 instead of 102, an additional 8 rupee per litre to recover the past under-recoveries. Now, airlines want prices closer to prevailing market rates. OMCs say, we sold at a lower price to protect airlines from a shock in April and May, and now we want to recover the under-recoveries. So that is the standoff. But there is also no certainty to how long will oil prices remain lower. Brent is rising again amid fresh tensions in West Asia. The question is, will airlines rethink the stabilization fund or continue to bet on market prices falling once geopolitical tensions ease, as what happened in the month of June?
Thank you, Madiha, for that comprehensive update. Moving on to an exclusive, Swedish furniture giant IKEA is doubling down on India. The company has outlined an ambitious expansion plan, which includes doubling headcount and sourcing from India over the next 4 years. Speaking exclusively to CNBC TV18, Patrick Anthony, the CEO of IKEA in India, also laid out plans to open 25 new stores by 2030.
So the big stores that are coming up now, Noida and Gurgaon, as you mentioned.
Yeah.
Gurgaon end 27 and Noida
27.
end 28.
Okay, so it's still a while away.
It's still a while away. The big projects, they are mixed-use developments. So you have a large IKEA store combined with 200 other small stores in a shopping center environment.
And a hotel.
And a hotel and offices.
Oh, yeah.
So the ambition is to increase our sourcing from India a lot. So today we're exporting around 400 million euros of product value, so on product purchase price. And we intend to double that by 2030.
Okay.
So this is both for export but also internal. The local retail will grow, we will produce more and more and more, and we'll also export more. So we hope to do a lot more.
All right, that's a wrap on this edition of Business 360. News and updates continue right here on CNBC TV18.
Well, the southwest monsoon has lost momentum once again, raising fresh concerns over the progress of the Kharif sowing season. While the overall rainfall deficit has narrowed after a brief monsoon revival, uneven showers across key rain-fed regions have delayed planting. As of July 10, the Kharif crops had been sowing across 531 lakh hectares, around 16% of decline as compared to the last year. However, several key crops continue to trail normal levels, with the biggest lag seen in soybean, in cotton, pulses and core cereals. So what does the weak monsoon mean for India's sowing season? Hello and welcome to Commodity Champions. I'm Manisha Gupta. And joining me on the show to discuss all of this in further detail are Mr. D.N. Pathak. He's ED at Soybean Processor Association of India. Dev Garg is Vice President at India Rice Exporter Federation. And Mr. Bimal Kothari is Chairman at India Pulses and Grains Association. Gentlemen, hi. Thank you so much for joining in. Well, it's an El Nino year. The first half of July, of course, has been slightly supportive. And that is where we are looking at sowing starting as well. But now it's mid-July and we perhaps have another 10 to 15 days till the sowing window is on. But this is a delayed sowing. Are we looking at a delayed harvest? What are the concerns that El Nino is putting through? And what really is an impact or threat on yields going forward is what we are looking to discuss. Mr. Pathak, let me come to you first. And I remember our previous conversation and you told me that the soybean planting this year could be higher than last year. With the kind of numbers that we are dealing with, 16% of a lag as compared to previous year, would you still stand by that statement?
No, I think I'll have to revise that because there are complaints in Maharashtra of not germination of seed. The similar complaints are seen in Rajasthan, in Gujarat. There has been resowing in some areas. There is a shortage of seed in some places. So the farmer may either leave the field open for next planting of onion or something else, or so I'm not now saying that there could be substantial increase in the area. Of course, the sowing window is still open, but with the monsoon going awry right now and no rains in sight, as everybody is saying, I think we will have to revise that statement now.
Mr. Pathak, the one part is that it is a delayed sowing. Are you also anticipating a longer, in case there is a longer break in sense of monsoon, the farmers may have to sow again. As you said, the farmers may move to other crops as well. And then there is a threat about yields at the fag end of the sowing season as well. What all concerns in sense of sowing are you working with right now?
Both.
Okay.
In fact, if there is no rain in the next, I would say 20 days, then the farmer will have to move to some other crop if possible at that time, or he will have to leave his field fallow for the next crop. And if the same thing happens, 20 days, no rains, then even the existing crop which is on the field will suffer very serious moisture stress, and that will certainly affect yields significantly. So the next 15, 20 days range we certainly need immediately. As of now, Madhya Pradesh looks okay, normal. Rajasthan looks certainly not normal and there are problems. Gujarat, as I said, the area is certainly sinking. Maharashtra, already there are problems of seeding and seed non-germination of seeds. So overall there are some concerns. We have to wait for how the monsoon behaves in the next 15 to 20 years. That's most important.
Well, that's about edible oils, and soybean, of course, is the most important crop therein. But you have even deeper numbers, declines in groundnut, 30% of decline as compared to last year. Sesame, castor going the same way, where we are looking at weaker numbers therein. But let's shift focus to pulses now. And Mr. Kothari, the scenario here also is not very clear, not encouraging for that matter. Nearly 20% decline in pulses sowing till time. Do you also believe that there are similar concerns as Mr. Pathak have in sense of pulses as well?
Thank you, Manisha, for invitation. Yes, definitely. We have been knowing this concern, and this warning has been given to. We have been, in fact, this warning has been there for last few months that we are going to see a severe El Nino this year. So, government has taken few steps, and they have created a good buffer stock, but. Definitely, as far as the production is concerned, there is definitely concern for the production of the Kharif crops. If you look at the sowing of urad in particular, the crop is almost down by, sowing is almost down by 30%. And window for, unfortunately, window for udar sowing is almost getting over. So I think we are going to see a concern in the production of udar. As far as tuber is concerned, of course, there is again the year-on-year basis that it is down by 30%. But still the window is open. So we are expecting some rainfall in the coming week. And if there is the rainfall is there, then I'm sure that this window could shrink, and this year this deficit can shrink to maybe to a normal or maybe a smaller percentage. Whereas we are this which gap which we can meet through the imports. As far as the supply is concerned, despite this El Nino, I will tell you that we have a good supply from the origins. There is a good crop in Africa, which is going to be harvested. I'm talking about tur, which is going to be harvested in the month of August. And we will see next 3-4 months a lot of goods coming from Africa. So this year, I don't see any supply constraint as far as tur is concerned. Of course, and the prices are also more or less stable in still minimum support price. If you look at the mandi price of tur, it is around between 75 to 80 rupees. Of course, there is some concern in udar. The prices has gone up. The MSP is around 82 rupees, whereas the FAQ udar is selling around 90, 92 rupees. So there is, and because as I mentioned, the sowing of udar has really been badly hit, and particularly in the state of Maharashtra, Karnataka, and Gujarat. Of course, we have seen that there has been a good sowing in Rajasthan and MP and also in Uttar Pradesh. But the most important thing is that there has to be some follow-up rainfalls. Otherwise, whatever the sowing has been done, that may also get impacted. So definitely, Manisaji, this year we have to address the issue of El Nino, and we have to be very cautious. But I'm sure this year I don't see there is going to be much rise in the generally in the other pulses. Like if you look at the other pulses like lentils, Masoor is selling around 56, 57 rupees, where again as against the minimum support price of 70 rupees. Chana is selling around 59, 50, 60 rupees as against the minimum support price of 58, 75. Then yellow peas is selling around 39 rupees. So other pulses are available at a much affordable prices. So I really don't see that there will be much spurt in the prices except udad. Udad we have definitely seen the prices has gone up, and I think that there might be some room for price further going up by another 5 to 10 rupees a kilo. So udad is concerned. However, there will be a supply in the coming months from Brazil. We have seen about a small shipment about 15,000 tons from Brazil in the month of June. July we will see around 70 to 80,000 tons, which will be shipped from Brazil. So I think once the cargo starts coming to the market, I'm sure that the prices will soften, and we will see the prices to come down a little bit. But definitely there will be some concern as far as the udad will be there.
Point taken. So udad is a big concern as far as the other crops are concerned or the pulses are concerned. The producing countries have enough crop, and India has a strong buffer stock as well. Just taking sense of rice now, and Dev Garg joins in as well. Dev, hi. I remember our previous conversation again, and you weren't very concerned because one, India has great buffer stock. Two, the export numbers are looking great as well. And then, of course, the window has been quite strong. But now, as we are into middle of July, and with the sowing nearly 8 to 9% on the lower side, are there some concerns that are now seeping into this trade also?
Now we have to look at the data released by Ministry of Agriculture. So we have the figures as on 5th of July. So as on that day, the total sowing for Kharif for rice is around 60 lakh hectares. This is down 9 lakh hectares as compared to the previous year's figures of 69 lakh hectares total sowing. This means a 9% drop. Now, if we look at it in the overall scenario, the total area cultivated for rice last year was around 446 lakh hectares. That means that out of the overall sowing, only 16-17% sowing has happened till now. So there is a lot of way to go forward. So this 9% figure would not concern me a lot as of now, because as we know that the reports have been coming from Haryana, Punjab and Uttar Pradesh that due to the recent showers, the sowing has been delayed by some of the farmers. So we will have to wait for a few more days to analyze whether this drop is a acute drop, or is there a impact on the overall figures. But as you rightly said, that we had pointed out on your channel multiple times, that India today is sitting on a record surplus stock of 270 lakh metric tons. And this year, the Ministry of Agriculture is still maintaining its estimate of a total production of 153 million metric tons of rice, which is well above the record figure of 151 million metric tons that we produced last year, which made India the largest producer of rice paddy in the world. So as the matter stands today, this data is not very concerning. Though in the recent past, we have seen that the price of rice in the wholesale market has gone up marginally. In the basmati rice as well as non-basmati rice across the country, there is a small uptick in the wholesale prices. But I would not dive too deep into it, and I won't be concerned as of now, because the demand is very robust and the supply side is more robust than the demand. So today we are still sitting on record surpluses, and there is no indication in the market that there will be a substantial fall in the overall output. So we will have to wait and see. Once I feel that by the end of July, by mid-August, we'll have a much clearer picture when we have the overall figures with respect to the total swing.
All right. So India has enough stocks right now. The prices have gained, but not so much. And even as there is a delayed sowing, it would be the next 15-20 days that are going to be quite critical in sense of monsoons, in sense of further sowing numbers, whether they catch up or not, is the view coming in from across segments on that agriculture space. But with that, gentlemen, stay on with us. We'll go for a short break. When we come back and come to you with a worst case scenario expectation in case the next 15-20 days do not yield up like you were anticipating, then what are the measures that the government is going to take, and what are the measures that industry sees coming is what we will discuss after this break. Welcome back. Still with me to discuss the impact of a weak monsoon on the sowing season are Mr. D.N. Pathak, Dev Garg and Mr. Bimal Kothari. Gentlemen, thank you so much for staying on with us. My first segment of the show does tell me that even as the sowing is delayed, you guys are hopeful, anticipating the best going forward. But let's not forget that this is an El Nino year. June was 40% deficient. And with July first half, whatever we've seen in sense of monsoons, we are still 19% deficient. And IMD has called it an El Nino year with 80% of normal rainfall is what we are anticipating in this year. Mr. Kothari, this one is to you. And pulses clearly has been something that the government has been working on a lot. I remember our previous conversations where you said that there have been so many notifications, so many measures from the government, and is the reason perhaps that we're looking at a stable market right now. But if things don't go as per your expectations, what is it that the industry is then looking at, and what are you anticipating in sense of measures from the government?
Manisha ji, as you see, as far as the government's policy is concerned, this time they have already extended the import, the free import until 31st March 2027. So what the best government can do, which they have already done. They have allowed all the pulses to be imported freely into the market. So now we have to look at the origins, how the availability in the origins. So as I mentioned, say I will come by pulse by pulse. Say as far as tuber is concerned, which is always has been a major concern in past also, and this year also there might be a concern, as you say, if we don't see the the rainfall in coming weeks, then of course there might be some concern. But let me tell you, there is a good quantity available in the origins. They have a very good crop in Africa. African crop will be harvested in the month of August. And during the festival, I think we are going to see more than 1.3 or 1.4 million ton coming to the Indian market. I tell you, last year we imported about 1.2 million tons from only from Africa, besides from another 200 to 300,000 tons from Myanmar and other countries. So I don't think there will be any supply constraint, and the price will also remain stable. I don't think the price will go up because the supply will because tuber is such a commodity which is only consumed in the Indian market. So they have to sell the tuber to the India, but definitely demand will be there. So I don't think the price there will be much concern as far as the prices are concerned. Supply will be there. A major concern will be Udad, but definitely we will see some supply coming from Brazil. They had a good crop. In fact, there has been some concern, but I'm sure they have a good crop. And there is good stock available in Myanmar also. So in the coming months, we will see a good quantity coming into the Indian market, because Brazil crop has just got harvested. They have started the shipping. So once the cargo starts coming here, I'm sure the prices will soften, and the price which has gone up now, there might be some decline in the price, or it may remain stable.
Okay.
If you look at the prices, this has gone by in Udad, the price is about 10 to 15% more than the MSP. Regarding all other pulses, if you see, all are below minimum support price. And there is plenty of pulses available, like lentils and yellow peas available in the market. New crop is just getting harvested or has been harvested. And we will see plenty of supply coming from the origins like Australia, from Canada, from Russia. So I feel that there is definitely, there will be always a concern as far as our production is concerned. But I don't think that the supply would be a major constraint. I think we will.
So, Mr. Kothari, you don't anticipate a problem in availability, and you don't believe that there's going to be an inflation in pulses, and you think government has taken all the valid measures, so we may not perhaps see anything more coming in from them as well.
I don't think there has been any contribution to inflation as far as the pulses has been there.
Okay.
Rather, in last 3 months, we have seen the prices has been declining. In fact, the prices in last 1 week, you have seen that prices has gone up a little bit.
Right.
Otherwise, since April, the prices has been on decline. Almost prices has gone by 5 to 10%. So I think I don't see much concern. Definitely, it's an El Nino year. We have to be cautious, and there might be some events which we may not like. But overall, I think it should be fine.
All right. So what is working in favor of the origin countries is, of course, the El Nino in India, and there's enough and more production in many of those countries. Well, that's about pulses right now. But edible oils, and Mr. Pathak, what is your sense onto this one? A commodity which we in any case import a lot in sense of a segment. There's 65% of our edible oil requirement. From here on, what could really go wrong? And are you anticipating any government measures?
On edible oil, I think the overall global soybean production and palm production is going to be again better than last year. So I don't see any problem with the edible oil per se. With the crude prices coming down, obviously the diversion for biodiesel may also be less than what was being talked about. But on the soybean front, I'm an incorrigible optimist. So I'm hoping, and I'm told by somebody that there are going to be rains in the next 5 days. And if that happens, so all my worries will go away at least for the next 30 days. Well, once we get rains and the vegetation takes place properly, then we will have to wait for the rain in the next 35 days when the flowering takes place, 30 days. So till then, I'm okay. So let's hope for the rains. Of course, if the rains don't come, then we will have a problem and the yield will be affected. But I'm just hoping that it will not happen.
We've spoken about all the positives earlier already, Mr. Pathak. I'm talking about the worst case scenario and how prepared are we, or are we anticipating any measures?
Okay, let's say the worst case scenario.
Yeah.
At the current soybean prices, there's going to be hardly any export.
All right.
We exported 22 lakh tons last year. This year, we brought down the figure to 10 lakh tons. And at these prices, I am not surprised if we end up only 3-4 lakh tons in the next year. So we have that much soybean left over for the Indian consumption. Now, West African countries have tasted a lot of profit in the Indian market. We're expecting an import of about 1 million tons. And the next year, they're also preparing for the same kind of a thing. So if the worst really happens, and we have a crop which is less than last year, it will be amply made up by the loss of exports and imports from Africa. So I don't see any major supply problem as such. Prices is a different function, of course, but I don't see any supply problem because these fundamentals which are known, which are very well known that exports cannot take place and the import is happening. That's how I see it.
And you expect the prices to go higher from here?
I don't talk about prices, you know that.
All right. I was asking for you for a direction, but all right. Dev, let's talk about rice now. And you've told me that the rice prices of various varieties already have gone up right now. We have enough stock, and that is what is making us a lot comfortable as well. The export numbers have continued on. Again, just a worst case scenario. How prepared are you? What are the strategies that you're making? And do you anticipate any government action?
So with respect to our local production, as of now, within the industry or within government circles, there is no discussion on how to prepare for a contingency plan for a fall in production, because everyone across the board is convinced that whatever may happen, we will still have a surplus stock, which will be more than enough to cover up our exports. So for the current year, it is not a time to look inwards, but it is a time to look outwards, because countries like Pakistan will be very badly hit by the El Nino, because as we know, that Pakistan does not have the adequate agri infrastructure and irrigation facilities to overcome a shortfall in monsoons. So whatever space Pakistan will cede in the international market, it is a good time and a very important time for the rice industry to take over that market. So the government interventions, I do not see any government interventions on the production side or anticipating a shortfall. But on the promotion side, wherein we will be investing a lot on marketing, branding, and improving our export infrastructure so that exports continue and the speed is going on. So as the matter stands today, even government has introduced various schemes like the PLI scheme, wherein various exemptions or there were various exclusions for the rice industry. And with respect to other schemes as well, wherein rice was included in the negative list. Many of those schemes have been revised by various government authorities, from Haryana to Tamil Nadu to Telangana. Now, rice is the central point for many government incentives and policies. So going forward, we will see many more interventions in this area. The Indian Rice Exporters Federation has also been working together with various stakeholders, and we are also organizing the Bharat International Rice Conference 2026 at Bharat Mandapam on 23rd, 24th, and 25th of October, wherein we will be taking forward this initiative and promoting Indian rice before the world. Because no matter what happens, I'm still repeating it again and again that we will have a surplus. And it is a time not to prepare for contingencies for shortfall, but for contingencies for other countries' shortfall, wherein we can take over their market share and capture their market. So it is a very important time going forward.
All right. So two commodities that we are importing versus one that we are exporting. And clearly there are hopes high across segment right now. But it clearly is going to be about the month of July, another 15 days. And we will know and understand on what reality do we stand on. If there are rains, then the sowing will go higher. The yields can be better going forward. But remember, it's an El Nino year expected to span up to March or April of the next month, next year as well. And that is perhaps where we see concerns coming in from. Well, at this point in time, a 19% lower than normal monsoon is what India seems to be dealing with. Gentlemen, as always, thank you so much for joining in and putting out your best case and a worst case scenario and what might India could be looking at going forward. But with that, it's a wrap on this edition of Commodity Champions. Thank you for watching.
Hello and welcome to News Centre. I am Ashmit Kumar. Now, India and UK's landmark free trade deal comes into force tomorrow. Now, the agreement has been 4 years in the making. Negotiations began in 2021 under the then UK Prime Minister Boris Johnson, continued under Rishi Sunak, and were finally signed during Prime Minister as Keir Starmer's tenure. Now, both sides are calling it a landmark pact for Britain. It's one of the biggest trade deals since Brexit, as London continues to strengthen trade ties beyond the European Union. For India, it opens up greater access to one of Europe's largest economies. The two countries expect bilateral trade to nearly double to $100 billion by 2030, as the pact is set to boost trade by $35 billion annually. Under this agreement, 99% of India's exports to the UK will enjoy duty-free access, covering nearly the entire value of India's exports. Now, that's a major boost for our labour-intensive sectors such as textiles, leather, marine products and gems and jewellery, along with high-growth industries like engineering goods, chemicals and auto components. In return, India will reduce tariffs on nearly 90% of UK tariff lines, covering about 91% of British exports. At the same time, New Delhi has protected sensitive sectors including dairy, cereals, millets, pulses, apples, select vegetables, gold, jewellery, lab-grown diamonds, smartphones, optical fibre and several strategic products. For consumers, the deal could eventually make Scotch whisky, premium British cars, chocolates, cosmetics, luxury fashion and several UK-made medical devices more affordable. Lower tariffs on imported medical technology could also benefit India's healthcare sector. The agreement also strengthens people-to-people ties. It eases temporary entry for Indian business visitors and contractual service providers. In addition, nearly 75,000 Indian workers on short-term assignments in the UK will be exempt from paying UK social security contributions for up to 3 years, reducing costs for both employees and employers. Now, the UK government says that the India-UK investment relationship already supports over 6 lakh jobs across both economies, although it has not provided a country-wise breakdown of those jobs. Well, helping us now to decode what this trade deal could unpack beginning tomorrow. Tomorrow, of course, is when this trade deal begins to take effect. We are now joined by former UK IBC Global CEO Jayant Krishna. Along with him, we also have with us FICCI Secretary General Anant Swarup, who importantly was also a part of India's negotiating team for the India-UK CETA. Mr. Swarup, he's joining us all the way from Brussels. Coming to you first, Mr. Jayant Krishna, tell us in terms of some of the issues that we're talking about in terms of 99% of the exports from India to the UK enjoying benefits under this treaty. What does that translate into? Where does that position India as compared to some of the other similarly placed economies, say perhaps the ASEAN countries? How is India positioned versus its competitors?
See, Ashmit, one thing is very clear that UK under this deal has decided to eliminate import duty up to, in different categories, up to 70% on processed food, almost 22% on marine products, 18% on engineering products, as well as auto components, 16% on leather, 12% on textile and garments, and 8% on chemicals and pharma sector. So what it essentially means is they're eliminating import duty up to these percentages that I just talked about, right? So if you look at UK is a major importing country. If you look at almost 929 billion worth of goods were imported by UK last year. And India barely exported, $15.2 billion dollar worth, goods to them, which is just about 1.6% of what UK actually imports for its own consumption, right? So I think it's very, very important to look at some of these sectors. Garments, if you look at the total import that UK does from all over the world, it's about 21 billion. What India gets, it's just a 6% share. Processed food, UK imports 33 billion. India gets barely, 0.4, less than 1% of that. auto components. UK imports a total of 92 billion. What India gets is a very, very small, component of that, right? Chemicals, if you look at, they import almost $36 billion worth of goods. India's share is just 2.6%. Pharmaceutical, and we claim that we are the pharma factory for the world. UK imports almost $31 billion of pharma, whereas our share there is barely 3.2 percentage of total pharma imports that UK does. I think this does open a floodgate of opportunities. And I've not really compared it with the ASEAN, but if you look at the deal that we have, which is yet to become operational with the European Union, I think a UK deal I would rate a few notches above that. And it's going to be a genuine win-win for both the countries, as you rightly mentioned in the beginning. 99% of Indian exports would benefit, and eventually the duty will become 0%, not straight away. It's under a phased regime, and 91% of UK exports would benefit through this. So I think, and I'm particularly happy because, the time when I was the group CEO of UK India Business Council, we started, helping both the governments by constituting 3 groups of industry leaders from both the countries in food and drinks, in healthcare and life sciences, as well as the technology space, And everybody felt that, there's a huge opportunity for both the countries going forward. I mean, UK is the 5th largest economy, and India used to be 4th largest economy, but it had slipped to 6th because of the rupee devaluation versus vis-a-vis dollar. So I think there are 2 economies which are where the size is almost neck to neck, and they've had a shared history, a shared past. I think there's a huge opportunity, and I'm very, very hopeful it will benefit both the countries hugely, and eventually, the total bilateral trade, which is of the order of about $56 billion right now, will go up to 100 plus, or perhaps 120. It could be doubled in a few years' time. If once this FTA becomes operational.
Right, Mr. Krishna. Also joining us now is Mr. Anand Swarup, who's also was a part of the Indian negotiating team as far as the India-UK CETA. Mr. Swarup, joining us all the way from Brussels. Thank you so much for taking our time to speak to us. Let's first talk about some of the aspects that has a lot of people talking in terms of what this could unpack. Let's talk about the auto space. Correct me if I'm wrong, this is the first FTA where we're granting concessional rates on completely built-up units as far as cars are concerned. Of course, there has been specialized protection for EVs, so there is no concessional rate for British EVs for the first 5 years. That begins only in the 6th year. But for conventional cars, luxury cars, there is a window open. About 3.7 lakh units is what we're looking at across 15 years. Tell us, what is the impact that is likely to have? Should people perhaps temper their expectations if they're looking at any British cars they may want to buy?
First of all, let me thank you for having me on your show. It's a great sense of satisfaction having worked on an FTA for such a long time. Now it is coming into effect tomorrow. So that's very satisfying. So far as auto is concerned, in every FTA, it has to be a give and take. You cannot only export, and you say, we will not import. However, this FTA has a very good balance between the what your gives are and what your takes are. On autos also, I think it is a good calibrated opening which has been agreed in this agreement, and it would offer Indian automakers also a huge market in the UK. And similarly, UK would also get some market access to the Indian market. But as I mentioned, it's calibrated, it's a long term. As you mentioned, EV is already out for a few years. So overall, it strikes a good balance so far as auto is also concerned. Even on auto components, I'm very bullish. You look at the overall contribution of India in the UK market, it's just 0.3% in auto components. I'm sure this is bound to increase several folds in years to come. In terms of give and take, Mr. Swarup, I want to get a sense,
What are the other major gives that we'll perhaps have to be gearing up for as this bilateral, again, this CETA comes into effect beginning tomorrow?
One of the biggest asks for the UK was on Scotch, and which has happened where India has opened up the alcohol sector. But as I mentioned, the Scotch operates in a very different price segment, in a different market segment, and that does not have much impact on the overall market in India.
Sure. Mr. Krishna, coming to you again, there was a recent report by the GTRI which effectively said that tariff concessions alone, now I'm talking about gives, now I'm talking about takes in terms of what India can perhaps stand to benefit through exports. There was a report by the GTRI that said that simple tariff concessions will not cut it. We need to now work on certification, on quality standardization. How important are these steps going to be to realize the benefits of the CETA? Again, the targets are very high. We're looking at $100 billion bilateral trade by 2030. That's not very far away. How important and how significant are these challenges when it comes to standardization, certification, to meet one of the largest economies in Europe?
So I think one thing is very clear that tariff rationalization and reductions are important, but not everything. I think a lot of non-tariff barriers also need to be looked at very, very seriously by both the countries and more importantly by India as well, right? See, simple things, like UK has this carbon border adjustment mechanism, right? That taxes polluting industries, right? So I think, while environmental protection is very, very important, but I think, in absence of very, very, evidence-based, monitoring mechanisms, I think UK has to relook as to how it administers, that mechanism for taxing polluting industries. That's have been one large concern of India. And I think, and overall, I think it's very, very important that, tariff reduction is important, but, many other non-tariff barriers, I think they need to get rationalized, and they need to, overall improve the ease of doing import and export. I think that's very important, Ashmit,
Again, Mr. Swaroop, coming to you from an operationalizing this CETA perspective, when you have rules being again deployed when it comes to place of origin, and then we have exporters dealing with authorities at the ports, how far away are we? Do we need to anticipate some teething issues at the very start to set this in motion?
No, I think in this FTA, the rules of origin have been quite liberal. And for the first time, self-certification has also been allowed. And that also facilitates the trade between the two sides. Earlier, we used to have very standard rules of origin, 35% value addition plus change in tariffs heading. Here, we have gone product-specific rules of origin line by line. I think it is a very positive step. It is a trust-based step which this FTA has taken. I think it will facilitate better FTA utilization from the Indian side.
Right. In terms of, again, operationalizing this, Mr. Krishna, coming to you, what are some of the initial teething issues that you're anticipating that the Indian exporters may have to contend with, at least in the first quarter or so, to come to terms with the CETA?
See, any new trade agreement, which when it comes into force, both countries and the trading community in both the countries needs to have a better understanding of what the tariff structures are, which are simpler to understand. But I think more important is a very, very proper understanding of the phasing. If you look at whiskies, right? I mean, it is a straight away reduction from 150%. I mean, I'm talking about import of British whiskies into India. The reduction is 150% to 75%. But and it will become 40% in a staggered form over a period of 10 years, right? Similarly, the auto tariff, while the reduction looks very good from 100% to 10%, but it's under a quota system. It's not that everything. So I think, absorbing these rules and fine prints and reading between the lines, I think it takes some time, but I think there is a huge amount of maturity in both, the businesses in both the countries. I don't anticipate that will create a major issue. Some teething troubles in terms of, government officials on both the sides who actually levy the duties. Even their understanding, their education is also equally important, so that there is a healthy relationship between Indian exporters to the US and to the UK. And and then both sides actually. So I think I don't see that as a major problem, other than some teething problem which any new tariff regime sees when you introduce that. I see a lesser problem from the businesses side. I see a greater problem in government authorities which administer these levies, in terms of their understanding and their clarity, and the fact that, they're there to serve the businesses, rather than, do something which adversely affects the ease of doing business,
We're running out of time. I'll come to Mr. Swaroop for one closing comment. And this is one issue that many are watching the FTA for, which is labor mobility. Mr. Swaroop, you're joining us all the way from Brussels. The West is seeing strong anti-immigration sentiments. Those are some of the voices coming in from their leading political voices, political leaders. At a time that we've signed this UK FTA and it's coming into effect, how do we balance that now? India's demand for greater labor mobility. There are, of course, clear provisions inside a part of the FTA as well. But there'll be pressure as well on London, on Washington, to check some of these immigration-related commitments.
Yes, see, I think all these Western countries have a declining population. It's an aging population. They also require people. They also require special people coming for healthcare, coming for the care of the elderly. I think what is more important is the mobility for professionals, which we are talking about. And it is not to do anything about immigration. So that distinction has to be very clearly borne out or understood, that FTAs talk about mobility of professionals, not about immigrations. And I think that is not of much concern on both sides. So this would provide access through a legal route to professionals from India to the UK market.
Right, Mr. Swaroop, Mr. Krishna, thank you for joining us on helping us understand what the impact could be beginning tomorrow. Of course, we'll continue our coverage as this CETA begins to take effect. July 15th is, of course, the big day to watch for. With that, we're heading into a very short break. But on the other side, we get you a conversation with the Transport Minister, Nitin Gadkari. He's defending the push to blend more ethanol with petrol. We get you that interview and much more in just a bit. Welcome back to News Center. Now, Road Transport Minister Nitin Gadkari has defended the push to blend more ethanol with petrol. Speaking to Network 18, the minister pushed back on claims that ethanol blending hasn't benefited customers.
व्यक्ति की भी तबीयत बिगड़ सकती है, पहलवान भी होगा, अच्छा होगा तो बिगड़ सकती है, कभी सर दर्द हो सकता है, तो ये गाड़ी है, कम ज़्यादा हो सकता है। मेरा कहना ऐसा है कि आपकी गाड़ी अगर इंजन में खराबी फ्यूल के कारण होती है, वैसे हमने 4 साल इसके लिए प्रयोग होते हैं, 4 साल लगते हैं, फिर ऑटोमोबाइल कंपनी अपने अलग प्रयोग करती है। दूसरी बात, 13 देशों में ये चल रहा है, ब्राज़ील में यही ब्रांड है, टोयोटा, हुंडई, सब यही है। वहाँ भी इथेनॉल 27% है पेट्रोल में। वहाँ कैसा है, 27% इथेनॉल पेट्रोल में उसका रेट, 100% पेट्रोल उसका रेट और 100% इथेनॉल उसका रेट। तुमको चॉइस है, तुम जो भरना है वो भरो।
हाँ, पर ये चॉइस सारे बंक्स में भारत में अभी इस वक्त नहीं है।
अभी ये पॉलिसी
और नहीं है। और दूसरी बात, जब ये प्रीमिक्स फ्यूल है, यानी कि E15 या E20 फ्यूल है, इसका नोटिफिकेशन हर बंक पे कि आज से आपके पास ये जो फ्यूल आप पेट्रोल भर रहे हो वो प्रीमिक्स है, ये नहीं है सर। ये इन्फॉर्मेशन नहीं दी गई है।
सर मैं आपको बताता हूँ, मेरी मिनिस्ट्री इसके स्टैंडर्ड निश्चित करती है
जी,
इसकी टेस्टिंग करती है ARI में। ये 4-4 साल इसके रिपोर्ट होते हैं, 2-2 लाख मीटर इसके इंजन की टेस्ट होती है, फिर प्राइवेट गाड़ियाँ करती है और उसके बाद ये आते हैं। मैं आपको एक सिंपल बात बताऊँ, ये सुजुकी वर्ल्ड में है, जापानी कंपनी, करेक्ट। ये टोयोटा वर्ल्ड में है जी, अमेरिका में लीडिंग है, सब जगह पर ये है जी। ये जितनी गाड़ी हुंडई है पूरे है। आपको लगता है कि ये लोग अपने रेपुटेशन की चिंता नहीं करते? ये जब इस फ्यूल को मान्यता देते वो प्रयोग नहीं करते हैं? सब प्रयोग होने के बाद ये हुआ। अभी एक मैंने पढ़ा, सोच लो कि मैं गन्ने का जूस निकाल रहा हूँ और गाड़ी में वो डाल रहा है और इथेनॉल के कारण इंजन में मक्खियाँ लगी है, चींटियाँ। अब मुझे बताओ, इथेनॉल मीन्स अल्कोहल, और अल्कोहल जो होता है, तुम ब्रांडी, विस्की, रम पीने वाले क्या कम नहीं, मैं तो नहीं पीता, पर पीने वाले हैं। तो जब कहीं देखा क्या कोई ग्लास में डाल दी और चिट्टी लग गई, मक्खी बैठी, लगा कि देखा आपने कभी? कुछ भी बात करके ये उल्टा सीधा करके जब कन्विंस नहीं किया जाता तो कंफ्यूज करना शुरू होता है। इसमें क्या है, कुछ लोग समझ कर रहे हैं, कुछ लोग ना समझे, उनको पूरी जानकारी नहीं मिली इसलिए कर रहे हैं, और कुछ लोग जो है वो जानबूझकर पॉलिटिकली मोटिवेटेड कर रहे हैं।
ये पॉलिटिकली मोटिवेटेड वाले पे मैं एक सेकंड में आता हूँ। कुछ ऑटो विशेषज्ञों का कहना है और उन्होंने ये कहा कि ब्राज़ील ने इथेनॉल की वजह से या इथेनॉल ब्लेंडेड फ्यूल की वजह से मशीन में जो प्रॉब्लम है, एक तो स्पार्क प्लग चेंज करना और दूसरा कि थोड़ा सा अगर वाटर रेसिड्यू आपके टैंक में आता है तो उसके लिए एक मिक्सचर है जिसको कि हर 3 से 5,000 किलोमीटर में आपको ऐड करना चाहिए। ब्राज़ील ने कुछ वहाँ पर संशोधन किए अपने इंजन्स में, स्पार्क प्लग्स में, जिसकी वजह से ये पूरी तरह से ट्रांजिशन हो पाया। ये चीज़ भारत में नहीं हुई।
अब एक मिनट,
अच्छा हुई है। अच्छा
देखो, ब्राज़ील में जो कंपनी है
जी,
वही भारत में है, इंजन बनाने वाली, गाड़ियाँ बनाने वाली, और जो ब्राज़ील में वो ये हुआ। इसमें और एक बात आपको जोड़ देता हूँ
जी,
जो एकदम 15-20 साल पुरानी गाड़ियाँ हैं, उसके जो वॉशर्स है वो मेटल के हैं
जी जी।
तो ये जब गाड़ियाँ सर्विस को जाती है तो उनका रिकमेंडेशन था कि ये रबर के करने चाहिए, तो मारुति जब जाती है उन्होंने लगा के दिए।
अच्छा, वो चुपचाप उन्होंने ही लगा दिया।
देखो आज कंपनियां जो इसमें जो कुछ है वो सब उन्होंने किया है। जो ब्राज़ील में इंजन है वही इंडिया में है, ब्रांड वही है, टेक्नोलॉजी वही है, और ये ब्राज़ील नहीं, ये अमेरिका में है, ब्राज़ील में है, थाईलैंड में है, स्वीडन में है, जापान में है, 13 देशों में है। ये देश क्या विदाउट प्रूवन, विदाउट टेक्नोलॉजी, बिल्कुल आया नितिन गडकरी डाल दे रही थे ना, ऐसा चल रहा है क्या? ऐसा नहीं है। प्रॉब्लम क्या हुआ है, गाड़ियाँ बिगड़ सकती है। समझो, एक आधी बार कभी आपकी तबीयत, आपको टेम्परेचर आता है तो कोई वायरल इन्फेक्शन भी हो सकता है, कभी आपको खांसी आती है तो और कोई कारण हो सकता है, कभी कभी हार्ट में प्रॉब्लम आ सकता है, कभी किडनी में आ सकता है। तो जब व्यक्ति को आ सकता है तो मशीन को भी आ सकता है।
करेक्ट।
रोड में भी कई प्रॉब्लम आ सकते हैं, भाई दावा नहीं कर सकते कभी आएंगे नहीं, तो ये आने वाला है। पर इसका मतलब ये नहीं है कि आप हर बार वो इथेनॉल डाला उस मशीन के कारण आया। इसलिए बेस्ट वेज, मेरा सुझाव है कि आप गारंटी पीरियड में हो, आपका इंश्योरेंस सुरक्षित है, आप डीलर के पास जाओ, आप पूरे गाड़ी का टेस्टिंग करो और डीलर बताएगा, उसको कोई उसका मैकेनिक बताएगा, और उसमें अगर डीलर ठीक से कंपनी आपको सर्विस नहीं दे रही तो इसके नियम बनाने वाला मैं हूँ, मेरी मिनिस्ट्री है, मेरे मिनिस्ट्री में आपका ईमेल कर दो, मैं इंक्वायरी
कहीं ना कहीं लोगों
Well, staying with flex fuel, only 9 flex fuel cars have been registered since Maruti Suzuki launched India's first flex fuel vehicle. So amid the ongoing debate over E20 fuel, how many buyers are actually opting for flex fuel vehicles, and what does the shift to flex fuel mean for India? CNBC TV 18 Shivani Bajaj joins us now with this analysis. Shivani.
9. Total 9. That's the total number of India's first mass-produced flex fuel passenger car, the WagonR BioFlex, that have been registered since the launch on June 4th. For a technology that's expected to play a key role in India's ethanol roadmap, the number remains extremely modest. Now, Hero MotoCorp also entered the flex fuel space with motorcycles, but retail sales of those models began only in July, so it's still in early stages to judge whether India's two-wheeler market will respond differently. We'll have to wait for the next set of sales data for that. But for now, the passenger vehicle story raises an important question. Is India ready for flex fuel, or has policy moved ahead of the market? Now, the Maruti Suzuki WagonR BioFlex, launched on June 4, is India's first mass-produced flex fuel passenger car. It can run on ethanol blends ranging from E20 to E85 and is central to the government's plan to reduce crude oil imports, increase ethanol consumption, and strengthen India's biofuel ecosystem. A total of 3 WagonR BioFlex cars were registered in June in the month of its launch, and by July 13, that number has reached a total of 9. While registrations are moving up month on month, the overall numbers remain extremely small for a mass market passenger vehicle. So why aren't buyers making the switch? Let's understand. The biggest challenge appears to be the economics of this entire thing. The WagonR BioFlex costs around 75,000 rupees more than the regular petrol WagonR. At first glance, the fuel seems cheaper too. E85 is priced at around 91.18 rupees in Delhi per litre, roughly 20 rupees cheaper than E20 petrol. But that's just one side of the equation. Maruti Suzuki has not disclosed the mileage of the WagonR BioFlex when running on an E85 fuel. However, it is well established that higher ethanol blends generally deliver lower fuel economy than lower ethanol blends. Applying that principle here means the vehicle is expected to consume more fuel to travel the same distance. So while you're paying less per litre, you're also likely using more litres put together, and that economics becomes difficult to understand. You're paying 75,000 rupees more upfront, and the savings at the fuel station are partially offset by the lower mileage. For many buyers, that means the additional investment could take longer time to recover, making that proposition far less compelling. Then comes the infrastructure issue. India currently just has 48 retail outlets dispensing E85 fuel, with most of them concentrated either in Delhi NCR or in Mumbai. And that's important because the entire value proposition of a flex fuel vehicle lies in using higher ethanol blends like E85. If you're forced to run mostly on E20 because E85 isn't easily available, then paying a premium for a flex fuel vehicle makes far less sense. In that case, many buyers may simply prefer a regular petrol vehicle that's cheaper to purchase. Then there's another issue. There's the issue of choice. Today, buyers effectively have just one mass market flex fuel passenger car. Not everyone wants a WagonR-sized hatchback. Some buyers may be looking for an SUV or a sedan or a premium hatchback. Most people choose a car based on their family's needs, budget and lifestyle, not just on the fuel it runs on. Until more manufacturers bring flex fuel models across different segments, adoption is likely to remain limited. So India's ethanol roadmap is ambitious, definitely, and flex fuel vehicles are expected to play a key role in reducing oil imports and supporting the country's biofuel goals. The early numbers, however, tell an interesting story. Until then, India's flex fuel journey remains a promising policy initiative, but one that's still waiting for widespread consumer acceptance.
Right, Shivani, thanks a lot for that. But that's all the time that we have. It's a wrap on this edition of News Center. More news and updates will continue right here.
Hello and welcome to IPO KYC. This is a special one. Rima and I are here at the offices of SBI Funds Management, the company behind what all of us know as SBI Mutual Fund. I think needs little by way of introduction. We're sitting right here at the heart of the offices, a lot of hustle bustle around it. It's a special time. SBI Funds is going the public way. It's a formidable entity, the largest asset management company in the country, 30 lakh crores in terms of assets, 6 lakh crores in terms of equity assets, 3,000 crores in net profits, the last reported number that we have. And it's going to list pretty soon. So we're going to ask the trajectory, the roadmap, and what does it mean for you and me as investors into SBI Funds Management? We've all, of course, had SIPs running with the SBI Mutual Fund. Now, of course, you can be an investor in the company too. And to discuss all of this, we have Mr. D.P. Singh. He's Joint Managing Director and Deputy CEO of the company. Srinivas Jain is Executive Vice President at the company as well. Gentlemen, thank you very much, both of you.
Thank you.
Appreciate it. So between the both of you, it's about 50 years at SBI Funds.
I'm not so old.
Yeah. I mean, how does it feel?
It feels very, very great. I remember when me and Srini started the journey in SBI Funds Management, it was a 2,500 crore company.
Yeah. 2,500 crore AUM?
Yeah.
Wow, 30 lakh crores now.
Yeah, it's a big franchise. We're very proud to be part of this growth journey.
Part of the growth journey.
Yeah.
And, let me just get to the valuation. I mean, we got the price band earlier today. At the upper end of the price band, at about 574, the valuation is about a little less than 1.2 lakh crores. And, you can take forward projections and, assuming 25-26% growth, 5,000 crore net profits in F5 28, which gets us a multiple of about 24 times. Is that the right way to look at is that the right multiple, Mr. Singh?
So many factors around it, but if we go by our past history, the way we have been growing, then definitely yes.
Okay.
But there are always in the markets, there are uncertainties. It could be more than this, it could be a little less than this. But the growth rate, the more and more financialization happens in the country. SBI Mutual Fund is at the forefront. We will get the maximum benefit. The moment today the biggest friction in growth of mutual fund business is the way KYCs are being done. These small players, the way it's a linkage between the remuneration for acquiring a customer and all efforts to be bring in. So that is not working. The moment that friction is over, which is likely to happen very, very soon, and once because all the bank accounts are now KYC compliant. The moment any bank account which is KYC compliant frictionlessly can part money in mutual fund, I think that will be the biggest revolution. And the number which is there today, only 6 crore investors, that will multiply like anything, and that the number could be anywhere. I'm not saying as much as number of bank accounts are there, but at least 20% of the bank accounts will be the mutual fund investors.
As soon as this KYC is that big, whenever that happens.
That's big, because lower level, middle level, nobody is servicing today.
Yeah. So just to close the loop on that, I'm not wildly inaccurate when I say 5,000 crores in net profits, 24 times earnings, which is actually quite reasonable as compared to some of the other listed peers, which I think I'm sure is a conscious decision. Srinivas, you want to just come in on that KYC and that big leap that provides?
What are the two factors today driving the growth of this business, right? One is, of course, education. We talked about the 100 crore bank accounts, 5.5 crore customers in mutual fund industry. So obviously, there is some gap. That means that needs to be driven through either education, with mutual funds IA and such campaigns have really been helpful building that. As that moves, you now need to remove friction also. I think the way eKYCs have now come on board, the friction is kind of come down, but still it exists. Today, if you're a bank customer and you've done every KYC that's there, why do you need to do another KYC when you do a mutual fund? There's new KYC 2.0, which is CKYC 2.0, what they're calling as One Nation, One KYC. If that comes in very quickly, this friction point also goes away.
Do we have any timelines for it?
My understanding is that they are fairly advanced and ready from a technology point of view. We've also been talking to both Proteon, CKYC team and all. SEBI chairman actually made a statement saying you should expect that very soon because he's kind of spearheading this particular debate. So one of the things that we at SBI Group have about 55 crore customer base. And even if you take all those Jandan accounts and others away, we have a 35 crore investors who are KYC'd in the bank. And that's like 55 lakhs today with us from already KYC'd SBI mutual fund customer. The headroom for us to grow, this friction that is going to go away is going to make it a big...
35 lakh accounts, 35 crore KYC'd.
35 crore is the target audience. and 55 lakh is the audience today with PSL
right now.
It's 2%, right? So from 2% to even if I were to go to 10%, DP's number, which we are talking about 20 is a little far. Even if I go to 10%, that's a huge number. That's like 5 times our business that we are today with the bank. That's 2.5 lakh crores is what State Bank of India's AUM is with us. So think about it. That's a huge business.
It's a huge headroom to grow. So let's just understand about SBI Mutual Fund and the scale today.
Right.
So Srini, 30 lakh crore in terms of an overall AUM.
Right.
Break that up for us in terms of categories and the kind of profitability that you make on each.
Yeah, I'll come to the profit, but let me explain the business to you. I think there's a different franchise we have been able to build. One, of course, is the bread and butter mutual fund business, which today, as we speak, about 13 lakh crore plus assets under management, making us the largest asset manager with almost 15.5% market share. We also have a very large ETF pool, which we are our largest passive provider. We have roughly about 4 lakh plus crores of ETF assets. I went 30% market share there. But one of the big business that we do is on the institutional side of the business. We have a very large 60.5 lakh crore worth of business that we do on the pension funds management. A large chunk of it is coming from EPFO. It's roughly about 9 lakh crores of that business. It's a fixed income mandate, but it's a very prestigious mandate. We do impact 11 lakh crore investors who invest through EPFO. In a way, it's a nation building capability that we have. While that business is not a very large revenue pool business, there is also a pool of business in the PMS, which is our international operations. We have a fairly large international client base, roughly about $4.5 billion worth of assets that we manage for global investors, our own joint venture, Amundi. So that's a very revenue generating kind of numbers. So the piece of business that's well known is the bread and butter mutual fund business. That gives me the highest revenue pools. And the second piece of business that we have is the management fee coming out of our portfolio management services business, which has both the EPFO and the other fixed income mandates, plus the money that we get out of our international business.
So in that 13 lakh crore of mutual funds, what is the contribution of equity, debt? And then if you could tell us the yield that you make on each of these and including the ETFs.
I mean, so it's all in the public domain, but I can tell you we are about 6.5 lakh crore worth of active equity out of the 13 lakh crore that we have. Equity is a fairly profitable, very profitable business for every asset manager. For us too, it's upwards of 60 basis point is what we make on that pure equity assets. But then we also have, the scale kind of comes down. We have hybrid products, we have, fixed income products, we have money market products, and then we have ETFs. In ETF also, there are 3 varieties of ETF. The one we manage for the Nifty and Sensex, which are extremely low yield but very high volume business. But we also manage a gold ETF and silver ETF, which are fairly large margin businesses, which are even closer to active equity kind of margin. So it's widely diverse, the pace of business, and it also widely diversified. That means thanks to hybrid business, it's also not very volatile thanks to mark-to-market impacts that we have. We also have a fairly large fixed income pool that we manage. So our business margin moves from 2 basis point to a 65 basis point kind of spread.
Okay. On a blended basis, you would be at 37 basis?
Yeah, in fact, that's an interesting story there. Absolutely. Absolutely. That's a very interesting story. I think one of the things that have happened to us is that passive overhang that we had as 40% plus market share is kind of averaging out, and we are actually building a strong equity book. As you see, our SIP book is now 4,000 plus crores every month. And that's actually improving our active mix. Last 3 years, we've grown almost 32 to 42%. And that's a very steady growth. And I see that growth continuing.
That 6 lakh crore, which is active equity, where will that number be? I mean, what should we expect in terms of growth here?
You want to answer that, please?
No. See, what happens in the 6.3 lakh crores exactly. Today we have got a SIP book of 4,000 crores, out of which 3,800 crores is for this category only. So that itself is beginning 48,000 crores as today's number. If we grow by 10%, it will become 60,000 crores. Then net sales also happen across the country, 50-60,000 crores. And if I take 10% mark to market year on year basis, of course not in a straight line manner, but if we are talking about 3 to 5 years, so if we take an average of 10%, so the 1 year itself it should grow up by 2 lakh crores. This is 6 lakh crores business. And the other is the ETF, etc. The mark to market will come there as well at the stock level. Even if you say incrementally I will get 26% flow. But the stock which is there, which came at a higher level of 75-50%, that is there with us, the mark to market. So the equity book, which is 10 lakh crores today, will grow by 2.5 to 3 lakh crores in 1 year, going by these back of the envelope calculations. And the multiple of that in next 2 to 3 years. So this is going to continue. This is what I'm saying. I'm considering this number is net sales number.
And this is persistency an issue? I mean, across accounts?
Our persistency is better.
It's better, and there is another unique thing also, which of course we've been, it's been a part of our design that we've been trying to get very long-term SIPs only as part of our. So we've always incentivized to get what we call perpetual SIPs, those 30 years NPCI mandates that are there, which has actually helped us to build a very 98% of our SIPs are very long-tenor SIPs, which is a very good thing because we don't have to go every year or alternate year to renew them or ask them to top up their SIPs or sign up on new things. So that's a unique business model we've been able to build, and we have like 1.6 crore SIPs today. Last year alone we added about 40 lakh SIPs to the book. So it's growing at a very fast pace.
So as your equities, which are actively managed, compound at 20-25% on an annual basis from here on, what would your blended yield look like going ahead, say 2 years or 3 years down the line?
The way to think about it is that today the best in class is close to about 40-44 basis point. I think we should come very close to that because clearly, as you see, the active participation going up. But at our scale, that's a difference. The blended yield for a smaller player at 40 basis point and at a 13 lakh crore player is a completely different way to think about it. So we are probably one of those few very large asset manager because of this active mix going up.
Your operating cost, I believe, is also the lowest in the industry.
Yes. We run a very tight book. In fact, our cost-to-income ratio is like 20%, which is probably one of the most attractive, not just in India, globally, for any asset manager.
So you should get to 44 basis points, which is best in class.
We don't want to predict that number because that's like very forward-looking. The better way to think about it is that we want to come closer to an average of the industry, despite having an extremely high book. Size of our book. So that's the way to think about it.
The reason we ask is because the total expense ratio rules also changed effective 1st of April.
Right.
Has that had an impact, and are you passing on the impact to distributors?
No, we have already we are through that, and we have actually neutral to that, revenue neutral.
Revenue.
We have passed on this also. There were some things where we got some benefit as well, and the biggest barometer is if you look at our direct plan expense ratios. If those are remaining intact, that means my management fee is intact. As simple as that. And we have not changed that. Our revenue is continuing.
What is the split between like direct and sort of distributor-led sales now?
It's around 22-23% direct. And the remaining is distributed. That's how this is.
Is this also like a...
This is going up.
It's going up.
This is going up.
Yeah, there's a move towards direct anyway. That's been going on for almost a decade now. Yep. It's picking steam, but at the heart of it, we are a distributor-driven organization, whether it's State Bank of India or third-party distribution. Very focused on it, but we also see a very large trend of self-service investors coming to us. We built an app called Invest App, which is the biggest app among asset managers out there, 4 million plus users, and we get 12% of our SIP book out of that. So it's built a very strong, B2C case also. But at the core of it, we are a B2B company.
Absolutely. Any pressure on yields? I mean, from anywhere, regulatory-wise or anything else? And I mean, we've spoken about this shift to passives
Prashant, I think
globally. Is there...
worst is behind us now.
Okay. Whatever had to happen regulation-wise.
Has happened.
Okay.
At least for next 3, 4, 5 years, nothing is going to happen. That's one thing. And this also has happened because it was already going on. It was work in progress, so they had to do it. They have done it.
This global shift to passives, do you think that will play out here in India?
I mean, not really. If you look at the data, other than maybe 1 year that was post-COVID, active managers have done extremely well. And even when you look at dispersion of returns across asset managers, even the worst asset manager has been able to beat index significantly. Not across the board, but largely. So India continues to have a very active management space, and I think for a while it will be there. But maybe at some point of time that shift will happen.
Well, I have a long list of questions, and I'm sure Rima has more as well. But I think this gives investors a fair bit of sense of what the IPO is about. Not that they needed, an introduction to SBI Mutual Fund. I think we all know it. But we wish you all the best of luck, Mr. Singh.
Thank you, Prashant.
Thank you so much. Thank you. Thank you for coming here. Thank you.
Well, we'll take a quick commercial break. We'll see you on the other side. We are still right here at the SBI Funds Management offices in BKC in Mumbai. The IPO, of course, a fair bit of excitement around it. It's, of course, one of the largest asset managers in the country. And now we are sitting down with Mr. Debashish Mishra, MD and CEO at SBI Funds Management. Mr. Mishra, great to have you with us here.
Yeah.
Thank you very much for joining us. Mutual fund say has become a mantra, has done so well, done wonders for the industry, has done wonders for SBI as a leader as well, SBI MF as a leader as well. What gives you the confidence, the next leg of growth? Because India's sort of, savings, financial savings are still largely in, deposits with banks and real estate and all kinds of things. Equity is, I dare say, still a newer asset class in that sense. What gives you the confidence that this share will structurally keep growing?
So, we have 1.4 billion people. Guess what is the number of bank accounts? 950 million. We are roughly reaching to 80% of the citizens for banking transactions, thanks to PM, Jandan, Jam Trinity, thanks to the inclusions by banks and NBFCs. But you look at the number of customers having investment accounts or folios, we would say in parlor terms, only 53 million. So that gives us a lot of confidence that in future or in today, we have enough to move around, and there's a big road ahead for all of us to cover. My second point is, today's investor is not the one you think of believing in going to the bank or sitting across the counter. Digital delivery is the key, the buzzword for all the investors today. Youngsters, they would like to see the Facebook, maybe the Twitter, maybe the social media to find out who is investing, where is investing, and what is required. Number three, Even if we take the last 5 years journey of financialization, there has been a move from saver to investors. The whole financial assets creation is increasing 11% of CAGR, whereas mutual funds have grown by 41%.
Yep.
So there is an increasing trend to bring these people from the saver to investor world.
So within the SBI ecosystem, right? I think SBI bank accounts are 530 million.
Yeah.
In that, the ones who have a YONO account, 120.
Yeah.
But you're saying only 5.5 million of those invest money with SBI mutual fund,
Yes,
right?
unique customers.
Unique customers. That's a very small number. So now, say in the next 3 years, what would you like that number to go up? And other than fixing the KYC issue, are there any other friction points that you'd like to solve?
So KYC is one, of course. It is going to resolve, I'm sure. Now it is in the hands of SEBI and Government of India. We are now going to solve it through digital integration. So we have got an app called Invest app, which is an AI-based app. We are going to now seamlessly integrate the YONO, so that any YONO customer can go to invest in SIP, in lump sum, in any investment product digitally, seamlessly. So that work in progress. We are already having the integration done. KYC thing comes up, we fix it, and it's done. We are also trying to have increasing our base in B30 centers. So we have now 270 branches of SBI AMC. We are going to make it 50 branches more in this financial year. So we are reaching out to people directly also for solicitation, for clarifications, for any doubts, for any grievances. Our own people, my own people will be there. We are also trying to train our SBI employees with the NISM certification to reach out to people. As per regulation, you can't sell a mutual fund product if you don't have a certification. So as of now, there are 13,000 employees of State Bank of India who are qualified to sell. We are trying to make it maybe 30,000 in coming 3 years.
So what will this 5.5 million number go up to?
So I answered your question, double. So we are trying to make it, we'll make it 10 million in 3 years' time.
So 12 out of 10 basically will be on it.
Yes.
That's going to be a big number, right?
Yeah.
I mean, and that's the thing. You don't need to look elsewhere for growth. You've got this captive large base in that sense.
I have a supplementary answer to this. In addition to SBI, our other side of channel is also equally good and great. I have 130,000 IFAs, individual financial advisors, who are advising to more than 40% of my asset base, or AUM base. See, SBI, although it's a parent bank and we have got a shareholding and all, but they constitute only 23 to 25% of the business. So we have got a large chunk of business in the hands of AIFs, institutions, PMS. Also, we are into alternates. Every sector we are increasing our footprints.
I have a question, slightly maybe offbeat, but Mr. Mishra, you were a career banker at SBI. You've done so many roles across, right? And now you're at the helm of this organization as it goes public. What will change at SBI Funds Management? I mean, it goes from a private financial institution in that sense to like a listed public company now with minority shareholders. What should investors expect?
That's a good question. I expected this to come. See, the priorities for me as a senior management in State Bank of India is only 3. Customer centricity, value creation and governance. Here also same 3. So I have to look at my investors. Now I have to add my shareholders. And I have to look at governance because we will be listed. So we will be more governance oriented, disciplined and value creation. So my investment team, which is creating value, I'm sitting with them. My first interaction with them is only after coming here to understand the whole gamut of investment and fixed income and derivatives, equities, everything. See, overall, in the bank, we understand customer is the key. So as long as I believe that and carry on in my whole activities, then whether it is AMC or bank or anywhere, it's all the same game.
Well, we wish you all the best of luck, Mr. Mishra.
Thank you.
It's a momentous occasion. And I'm sure this is the first of many interactions right here on CNBC TV. Thank you.
Thank you.
All the best. All the best.
Hello and welcome to Business 360. I'm Archana Solanki. Here are the headlines we're tracking this evening. Crude prices breach the $85 mark after US President Donald Trump reimposes a maritime blockade of Iran. He hints at imposing 20% fee on ships transiting the Strait of Hormuz. Iranian Foreign Minister mocks Trump's plans of imposing a transit fee as tensions flare up in the Gulf. One Indian sailor killed in the attack on commercial vessels at Hormuz. India summons Iran's deputy chief of mission to lodge a protest. 30 Indian sailors were on board 2 vessels that came under attack. Indian rupee breaches the 96 mark against the dollar, weakening to the lowest level in nearly 2 months. Sensex and Nifty slide in trade as crude oil spike and rupee weakness roil sentiment. Kumar Mangalam Birla's acquisition spree continues with a $1.8 billion bet on Shell India's renewable business. Birla has spearheaded more than 60 deals so far with an enterprise value of more than $20 billion. Government fast-tracks the sale of IDBI Bank. Sources say the high-level panel held 2 meetings yesterday, indicating an acceleration in the decision-making process. India's largest fund manager is going public. The 11,700 crore rupee SBI Funds IPO is open with a marquee list of investors already getting shares allotted in the anchor book. The issue is subscribed more than 60% on day one. Competition Commission of India imposes a penalty of more than 14 crore rupees on laptop and printer maker HP and 16 of its resellers. Alleges cartelization and bid rigging in the sale of print hardware. This comes a day after the M&A watchdog imposed a 142 crore penalty on HP India and its resellers over 2 separate cases of alleged cartelization and bid rigging in supply of IT products. And global sourcing from India by 2030 also plans to open 25 more stores in different formats over the next 4 years. That's an exclusive. The government's 10,000 crore rupee ATF price stabilization fund has found no takers so far. Airlines stayed away as global fuel prices fell sharply, making the 3-year commitment unattractive, with oil prices rising again amid fresh Gulf tensions. Is it time for airlines to rethink? And Football World Cup semi-finals kick off tonight with the mega showdown between 2022 edition runners-up in France and Euro champion Spain. France has scored 16 goals, the most for a team this World Cup, with Mbappe alone accounting for 50% of them. Spain, meanwhile, has conceded only 1 goal so far. All right, the top story this evening. US intensifies strikes on Iranian port cities as Iran targets US bases across the Gulf. So here are the latest developments. Now, US President Donald Trump has imposed a US blockade on the Strait of Hormuz once again. He said that the blockade will only target Iranian ships. Speaking to reporters at the White House, President Trump also said that Washington needs to be reimbursed for protecting the Gulf nation. This as the US military struck Iranian port cities in an attempt to degrade Iran's ability to attack commercial shipping. In response, Iran targeted Bahrain and Jordan once more. The Iranian Revolutionary Guard said it also targeted the US 5th Fleet headquarters in Bahrain and oil tankers in the Strait of Hormuz. According to UAE Defense Ministry, 1 Indian national was killed in the attacks on 2 UAE tankers. Indian officials have summoned Iran's deputy ambassador in New Delhi over the killing of the Indian national. Meanwhile, in Yemen, the Houthis said they launched missiles at Saudi Arabia's Abha airport in response to airstrikes on Sana'a airport, which it controls. The attacks marked an escalation not seen since the Saudi-led coalition struck Houthi-controlled areas several years ago. This, both US and Iran continue to claim control of the Strait of Hormuz hours after US claims of guarding the waterway. Iranian Foreign Minister Arakchi disputed the assertion and said that Tehran won't charge the 20% fee that Trump proposed. The escalation also spooked the oil markets, pushing Brent crude prices to $86 per barrel. Within the last 24 hours, 58 vessels entered the Persian Gulf and 59 left the area. Listen to the comments made by President Trump about the strait.
We're controlling the straits. We're putting the blockade back. And it's a blockade not for anybody but Iran. In other words, anybody doing business with Iran can't go through. Everyone else will be able to go through. Yeah, I want to be reimbursed because we're protecting a very rich portion of the world. We're spending money. And so what we've done is we are going to be reimbursed for protection. We're protecting by the countries that we're helping.
Now, sources in the shipping ministry tell CNBC TV 18 that 148 Indian seafarers are aboard 7 Indian flagged vessels in the Persian Gulf. Santhya Gora has more details. Santhya.
So the Indian government is now racing against time to ensure the safety of Indian flagged vessels and Indian seafarers stranded in the Persian Gulf, waiting to transit through the Strait of Hormuz and caught in the escalating US-Iran conflicts. Today, the Ministry of Port, Shipping and Waterways held a high-level meeting to chalk out a strategy to move these Indian vessels and Indian seafarers to safer waters as soon as possible. Sources in the ministry have told CNBC TV 18 that at present there are total 7 Indian flagged vessels in the Persian Gulf. All these 7 vessels are waiting to transit through the Strait of Hormuz, and there are 148 Indian seafarers on board these vessels. Talking about these 7 vessels, out of these 7, 3 are container vessels. One is a crude oil tanker, one is an oil chemical tanker, one is a bulk carrier, and one is a dredger. The sources have also told CNBC TV 18 that the ministry, Indian government, the ministry, along with Indian Navy and other concerned authorities are closely monitoring the situation. The concerned authorities are in continuous and they're in touch with the families of these seafarers, and they have also set up a control room which was actually earlier set up and it remains operational at present. It's a control room which remains operational, on which these families of these seafarers can contact the concerned authorities to know about the whereabouts of their loved ones.
All right. Thank you, Santhya, for that update. We'll keep coming back to you. Now, escalating tensions in West Asia, rising oil prices and a weaker rupee dented sentiment on Dalal Street. Today, Nifty and Sensex ended with cuts of over 0.5%. Nifty Bank underperformed blue chips to end over 600 points lower. 34 Nifty stocks ended the day in the red, with 11 of them falling over 2%. Even rupee slipped past the 96 to the dollar mark for the first time since May, as renewed geopolitical tensions and a sharp spike in crude oil prices weighed on sentiment. Lata Venkatesh joins us now with more on the rupee's decline. Lata.
Yes, a bad day for the rupee for the past 2 days. July 10th, we wound up at 95.3, and then a 0.3% fall on Monday and a 0.65% fall on Tuesday, a 1% fall in total, entirely driven by the way in which the dollar and the dollar index and crude have surged because of the re-emergence of strife in West Asia and a possible blockade. The rupee was particularly badly placed because it was the best performing currency up until July 10th in anticipation of the FCNRB deposits. So the entire market was positioned for short dollar, long rupee. That is, importers did not hedge their forward dollar purchases, and exporters came and sold dollars forward in the run-up to July 10th. But now, over the weekend, with things changing, the importers are rushing to buy dollars, forward dollars in a hurry, and exporters who sold the dollars are now buying it back because they're expecting a better rate if they wait. That is leading to a bigger fall in the rupee. It's the worst performing currency this week itself. Another point which is kind of making the market a little uneasy is the fact that yesterday the finance minister met all the PSU bankers and they discussed how the FCNRB flows are doing. And today the Reserve Bank governor has met both private and public sector bankers, and the conversation, among other things, is also going to be FCNRB deposits and their performance. So the market is worried that the regulators are worried. If that is the case, then, maybe there is still some pessimism. That is the additional negative that's dodging the rupee.
Right, India's wholesale price inflation hit a 2-year high of 9.87% in June from 9.68% in May. The sharp rise was led by a sharp spike in prices of food and non-food items. Fuel and power inflation remained the biggest contributor to headline WPI, despite moderating to 27.41% from 30.33% in May. India's largest asset manager is headed for Dalal Street. The 11,700 crore rupee SBI Funds Management IPO opened today and was subscribed close to 60%. The IPO has seen a marquee list of investors being allotted shares in the anchor book. The issue comprises solely an offer for sale, with SBI and its joint venture partner Mindai diluting their stakes. The price band has been set at 545 to 574 rupees. valuing the asset manager at around 1.17 lakh crore rupees at the upper end. The government has stepped up the pace of the IDBI bank privatization process. Sources tell CNBC TV18 that the high-level panel held 2 meetings yesterday, signaling an acceleration in the decision-making process. The centre and LIC are jointly looking to sell their combined 60.7% stake in IDBI Bank as part of the strategic divestment plan. Now, Kumar Mangalam Birla's acquisition spree continues with a $1.8 billion bet on Shell India's renewable business. Birla has spearheaded more than 60 deals so far with an enterprise value of more than $20 billion. Nigel D'Souza has more on Birla's big M&A bet.
Well, Kumar Mangalam Birla is on the front foot. Over the years, Mr. Birla has spearheaded more than 60 mergers, acquisitions and joint ventures, with the enterprise value of the landmark acquisitions crossing an estimated $20 to $22 billion. And 2026 is proving to be another defining year. The most recent is a transaction that Grasim's Aditya Birla Renewables has done as they acquire Solenergy Power from Shell in a deal with an enterprise value of around 17,200 crores. The acquisition nearly doubles the renewable energy portfolio from around 4.4 gigawatt all the way to around 9.4 gigawatt. And it puts the group on course to achieve 20 gigawatt of renewable portfolio over the next few years or so. Earlier this year, we saw one of the biggest moves in Indian sports as well, as the Aditya Birla Group-led consortium, along with the Times Group, Bolt Ventures and Blackstone, acquired Royal Challengers Bengaluru, IPL and WPL franchises from the United Spirits. That deal was valued at around $1.8 billion, marking a high-profile entry into sports ownership. The group has also doubled down on financial services. Grasim invested around 2,880 crore rupees through a preferential equity issue to raise its stake in Aditya Birla Capital, reinforcing its long-term commitment to the financial services business. In cement, the big boy, UltraTech, continues to rewrite the record books, and the domestic capacity has now crossed 200 million tons per annum, with the new target set at around 240 million tons. What's remarkable is the speed. It took 36 long years to reach 100 million tons of capacity, but it took just 7 years to add another 100 million tons. The expansion has also been powered by acquisitions. In 2025, UltraTech acquired the cement business of Kesoram in a $645 million transaction. A year earlier, it bought India Cements in a 3,954 crore deal, securing 55.5% stake and strengthening the leadership in the cement sector. Another ambitious bet has been paints. Launched in 2021, Birla Opus came with a committed capital expenditure of around 10,000 crores. And in just a matter of a few years, it's emerged as the number 2 player in India's decorative paint industry by installed capacity, underlying the group's intent to disrupt an already established paint market. The acquisition strategy, well, it expands beyond infrastructure as well. In 2023, Aditya Birla Fashion and Retail acquired 51% stake in TCNS Clothing in a deal worth 1,650 crore rupees, creating one of India's largest branded ethnic and women's fashion platforms. So from renewable energy and cement to financial services, paints, fashion, and even sports, Mr. Birla's strategy has remained consistent. Scale through bold investments, strategic acquisitions, and long-term value creation, with deal-making accelerating and expansion plans gathering momentum. The Aditya Birla Group appears to be on the front foot.
All right, thank you, Nigel, for that. Moving on, Biocon's shares gained after Mylan offloaded its 5.6% stake received in the sale of its biologics business. More than 9 crores shares changed hands at an average price of 400 rupees a share. The floor price of the block deal was set at 378 rupees per share. Mylan was offered a 6% stake in Biocon after the biopharma company acquired all of its stake in the Biocon Biologics in January. The Competition Commission of India imposes a penalty of more than 14 crore rupees on laptop and printer maker HP and 16 of its resellers. The regulator alleges cartelization and bid rigging in the sale of print hardware. This comes a day after the M&A watchdog imposed a 142 crore penalty on HP India and its resellers over 2 separate cases of alleged cartelization and bid rigging in supply of IT products. Three online gaming companies have moved the Supreme Court seeking a review of the judgment upholding the constitutional validity of 28% GST levy. Tax experts had estimated an additional tax burden of over 2.5 lakh crores for the sector. A setback for Byju's founder, Byju Ravindran. The High Court of Singapore has rejected his plea to overturn a 6-month jail sentence in a contempt case. The court has declined his request to keep the sentence on hold, effectively limiting his return to Singapore unless he serves the term. The latest order adds to Ravindran's challenges as Byju's continues to deal with the fallout from its aggressive expansion, financial troubles and corporate governance lapses. And time for a short break. Coming up next, the government's 10,000 crore rupee ATF price stabilization fund has found no takers so far. More details when we return. Stay tuned. Welcome back. Road Transport Minister Nitin Gadkari has defended the push to blend more ethanol with petrol. Speaking to Network 18, he pushed back on claims that ethanol blending hasn't benefited consumers.
मेरी गाड़ी E15, E20 और अब E25 के लिए रेडी है कि नहीं मुझे बताया नहीं। तीसरा, कंज्यूमर को ये लगता है कि मेरे को फ़ायदा भी पहुंचा नहीं। आप कहते हो इथेनॉल 25% इथेनॉल लगाए तो मेरे को तो 75% ही पेट्रोल का दाम देना चाहिए। वो प्राइस बेनिफिट भी मुझे साफ दिखा नहीं।
पहली बात तो ऐसी है कि हमारा इसका नोटिफिकेशन निकलता है। देश में 1450 करोड़ लीटर इथेनॉल लगता है। अब कैपेसिटी 1700-1800 करोड़ लीटर हो गई
जी।
पेट्रोलियम मिनिस्ट्री इसका टेंडर निकालती है और कैबिनेट इसका रेट तय करती है और 550 इंडस्ट्रीज हैं। अब मेरे बारे में आरोप होते, मैं हाइड्रोजन की बात कर रहा हूँ तो मैं हाइड्रोजन बना रहा हूँ क्या, मैं इलेक्ट्रिक की बात कर रहा हूँ तो लिथियम आयन बैटरी बना रहा हूँ क्या, मैं अल्टरनेटिव बायोफ्यूल की बात करता हूँ क्योंकि देश आत्मनिर्भर बने। तो पहली बात, इसका नोटिफिकेशन डिक्लेयर होता है, इसके बारे में, इंजन के बारे में हम निकालते हैं और उसके बाद होता है। दूसरी बात, ऑटोमोबाइल कंपनियां भी इसका एक्सपेरिमेंट करती है और ये 4-5 कंपनियां, देहरादून पेट्रोलियम इंस्टीट्यूट हो, ARAI हो, ये सर्टिफाई करती है, उसके रिपोर्ट आते हैं।
All right, Akasa Air is set to raise around 1,050 crore rupees through equity and debt to offset the financial impact of the ongoing Iran conflict. Now, this conflict has driven up jet fuel prices, disrupted flight operations and raised costs across the aviation sector. Bloomberg reported that the proposed fundraising includes about 800 crore rupees in equity. It's also in talks with state-run lenders for 250 crore rupees in debt under a government-backed credit line for airlines affected by the conflict. Now, the government's 10,000 crore rupee price stabilization fund for jet fuel has found no takers so far. Airlines stayed away as global fuel prices fell sharply, making the 3-year commitment unattractive, with oil prices rising again amid fresh Gulf tensions. Is it time for airlines to rethink? Madiha Mujawar is here with the details. Madiha, please explain what this scheme proposed and what's the way forward.
Well, the question, why have airlines stayed away from the 10,000 crore ATF price stabilization fund even when it promises to protect them from price volatility? The next table that will come on your screen has all the answers. It shows how ATF prices moved since March. Each month's price was driven by what was happening externally. Look at the March prices, which didn't have any war impact. International ATF, the MOPAG benchmark price was around 61 rupees per litre, while the domestic price was 84 rupees per litre. Now remember, in normal circumstances, domestic ATF is higher because of excise duty and state level VAT. Then came the West Asia crisis impact in the April price cycle. International ATF prices more than doubled to 134 rupees per litre. But look at what happened to domestic prices. The government stepped in to cushion airlines from the full impact of the surge and capped domestic ATF at 105 rupees per litre, while international prices kept surging. So international price surged to 142 rupees per litre in May, but domestic prices remained capped at 105 rupees per litre. And that helped airlines, for whom fuel is the single largest operating cost. But sources tell CNBC TV 18, OMCs accumulated around 6,000 crores in under-recoveries due to that price capping. Jet fuel price started to hurt airlines very badly, and they were forced to cut flights on domestic as well as international routes. So when June came, the government came up with a middle path and launched a 10,000 crore ATF price stabilization fund and arrived at a price of around 115 rupees per litre to protect airlines from the price volatility. But there was a condition attached. Airlines had to commit to this price 3 years. But look at the timing of the scheme. By June, international ATF had already fallen to 106 rupees per litre. So oil companies raised domestic ATF price to 115 as fixed in the fund, even when no airline had opted for the scheme. By July, international ATF had fallen further to 85 rupees per litre. So why would airlines commit to a scheme or a 3-year arrangement at a time when international prices were falling? So no airline opted for the scheme. But here's where the standoff begins. In July, the 85 rupees international price would normally translate to a domestic price of around 102 rupees per litre after taxes. OMCs are instead charging 110 instead of 102, an additional 8 rupee per litre to recover the past under-recoveries. Now, airlines want prices closer to prevailing market rates. OMCs say, we sold at a lower price to protect airlines from a shock in April and May, and now we want to recover the under-recoveries. So that is the standoff. But there is also no certainty to how long will oil prices remain lower. Brent is rising again amid fresh tensions in West Asia. The question is, will airlines rethink the stabilization fund or continue to bet on market prices falling once geopolitical tensions ease, as what happened in the month of June?
Thank you, Madiha, for that comprehensive update. Moving on to an exclusive, Swedish furniture giant IKEA is doubling down on India. The company has outlined an ambitious expansion plan, which includes doubling headcount and sourcing from India over the next 4 years. Speaking exclusively to CNBC TV 18, Patrick Anthony, the CEO of IKEA in India, also laid out plans to open 25 new stores by 2030.
So the big stores that are coming up now, Noida and Gurgaon, as you mentioned.
Yeah.
Gurgaon end 27 and Noida
27.
end 28.
Okay, so it's still a while away.
It's still a while away. The big projects, they are mixed-use developments. So you have a large IKEA store combined with 200 other small stores in a shopping center environment.
And a hotel.
And a hotel and offices.
Oh, yeah.
So the ambition is to increase our sourcing from India a lot. So today we're exporting around 400 million euros of product value, so on product purchase price. And we intend to double that by 2030.
Okay.
So this is both for export but also internal. The local retail will grow, we will produce more and more and more, and we'll also export more. So we hope to do a lot more.
All right, that's a wrap on this edition of Business 360. News and updates continue right here on CNBC TV 18.
Hello and welcome to Startup Street. I'm Shruti Mishra and with me is Ritu Singh. These are the top headlines from the startup space. 3 online gaming companies moved the Apex court seeking a review of the judgment upholding the constitution. AI validity of 28% GST levy. Tax experts had estimated an additional tax burden of over 2.5 lakh crore rupees for the sector. Setback for Byju's founder, Byju Ravindran. The High Court of Singapore has rejected his plea to overturn a 6-month jail term in a contempt case and refused to stay the sentence, effectively limiting his return to Singapore unless he serves it. Paytm and Swiggy Investor Elevation Capital has raised a $500 million fund to back India's next wave of early-stage startups with a sharp focus on AI-led companies. The new vehicle will target seed and Series A investments, reflecting the firm's bet that India's biggest AI opportunities will emerge in the application layer. IKEA plans to double headcount and global sourcing from India by 2030, also plans to open 25 more stores in different formats over the next 4 years. That's an exclusive. Chinese AI startup DeepSeek is considering another funding round. This comes just 1 month after closing its initial financing. The company seeks a valuation of approximately $71 billion. DeepSeek recently raised $7 billion at a $52 billion valuation. The startup is also developing its own AI chip. Those were the headlines we've been tracking for you this evening on What's Brewing. Simple Technology Holding is making a big bet on Web3 consolidation. The company has brought on serial Web3 entrepreneur John Nevala as co-founder to lead its Web3 vertical and M&A strategy. The mandate is ambitious: close 15 acquisitions, deploy $200 million in equity capital, and build a Web3 infrastructure platform ahead of a planned NASDAQ listing. Joining me now is the man himself, John Nevala. John, welcome to Startup Street. Your appointment comes with a very ambitious mandate, like I mentioned earlier, closing 15 acquisitions and deploying $200 million over the next 12 months. Walk us through the strategy. What kind of companies are you looking to acquire? And why is now the right time to roll up the Web3 infrastructure ecosystem?
Hey, and thanks a lot for having me. Yeah, so our strategy is quite simple. We acquire profitable gaming and Web3 firms, integrate them onto one platform, and create value through operational scale. And we're focused on acquiring well-established businesses that generate strong EBITDA and provide real value to the digital assets ecosystem. That includes media businesses, payment infrastructure, Bitcoin brokerages, wallet providers, mining softwares, and so on. And on the other vertical, mobile games, gaming studios, etc. And we are definitely not acquiring speculative token projects and don't get involved into meme coins or NFTs. And why not? Well, because the market is still highly fragmented. Many of these businesses have matured into profitable operators, yet they're still relatively small and independent. So we believe that consolidation creates significant value through shared technology, cross-selling opportunities, operational efficiencies, and scale. And at the same time, currently, the valuations are quite attractive.
Okay, so how much dry powder do you already have committed for these acquisitions, Johnny? And should we expect announcements to start coming through over the next few months?
Yeah, we are planning to deploy around $200 million USD in equity, and well, hopefully you'll start seeing announcements within weeks rather than months.
All right, within weeks, that's what you're telling us. Johnny, the crypto industry has gone through multiple boom and bust cycles, yet you're making it clear that this isn't about buying speculative crypto assets. It's about acquiring cash-generative Web3 infrastructure businesses. So what does that mean in practice? Which parts of the Web3 stack are the most attractive today?
Yeah, we think that this asset class isn't going away, and we reached a point where digital assets have become a permanent part of the global financial ecosystem. And like any emerging industry, it goes through cycles. Let's take a media business as an example. So during bull markets, audience numbers grow significantly because public interest increases, and during more quiet periods, traffic naturally comes down. But if a company establishes itself as one of the leading sources of information, it is well positioned to benefit again when the next cycle arrives. And the same applies to infrastructure businesses. A company providing software for Bitcoin miners continues serving customers regardless of the market cycle. And these are real businesses with real customers and solving real problems.
Okay.
I've been involved asset class like from 2018, and cycles are normal. So the key focus on businesses with strong fundamentals and positive cash flows, and stay away from these hype projects and focus on longer. They're trying to predict short-term market movements.
All right, let's talk about Simple Tech now. It describes itself as a dual platform business, consumer gaming on one side and Web3 infrastructure on the other. How do these businesses complement each other, and what competitive advantage does that model create compared to standalone gaming or blockchain companies? And if you could also take me through the company's current business growth numbers.
Yeah, the two verticals complement each other because they operate on the opposite sides of the same ecosystem. Our gaming and media businesses build audience and user engagement, and the Web3 businesses provide the tools and services that help companies operate and grow within that ecosystem. And this creates advantages that standalone businesses just don't have. So we can share technology, data is big for us, customer relationships, operational expertise across the platform, and creating synergies that simply are not available when companies operate independently. And regarding the growth, so we expect growth to be driven by two levers: cost consolidation, which improves margins across the portfolio by approximately 15 to 20%, and synergies through which we are aiming to grow revenue around 25% each year.
Okay, all right. You know, the company is targeting a NASDAQ listing through a de-SPAC transaction. Where are you on that journey today? What milestones still need to be achieved before going public? And how important is the acquisition strategy to your listing thesis?
Yeah, the acquisition strategy is central to our investment thesis. And, the listing is a milestone for the strategy, but not a dependency for the businesses to function. And post-merger integration is the most important milestone. So this is what our thesis is built around. We're driving synergies across the consumer and enterprise ecosystem, and we're targeting the same Gen Z and millennial user base. I would say that we are quite privileged to be doing this in the age of AI, which enables us to execute integration with a level of precision and speed that would have taken a decade previously.
Okay, all right. You know, Johnny, Simple Tech also plans to build much of its AI engineering operations and deal execution capabilities out of India, while embedding AI agents across the businesses it acquires. So take us through your India plans.
All the businesses in our portfolio operate digitally and generate massive amounts of data that is currently sitting in an isolation. And our thesis is built the centralized intelligence layer that leverages this digital footprint and creates value across multiple platforms in our portfolio. So we built these capabilities out of India, given the deep talent pool and expertise available there. And hopefully we will be announcing a few acquisitions shortly that are specifically targeted to enable it.
All right, and surely we'll be keeping a track of that. One final question before I let you go. Web3 funding has become far more selective over the last couple of years. Venture capital has shifted away from token-driven businesses towards infrastructure and enterprise use cases. Do you believe we're entering a more mature phase for Web3? And where do you see the biggest commercial opportunities over the next 5 years?
Yeah, absolutely. Well, fundamentally, blockchain was adapted to solve problems of trust, identity, and integrity, and in the digital world. And where there is utility, there is a real business and money flows into it. And today, the focus has shifted towards businesses that generate real revenue, solve real problems, and have sustainable business models. I believe that's actually a very healthy evolution for the industry. And our strategy is to focus on this. We want to become the Google of the Web3 ecosystem, owning the value chain across both consumer and enterprise.
All right, on that note, it's time for me to wrap up our discussion. But Johnny, many thanks for joining us on Startup Street today, and wish you the very best with Simple Tech Holdings.
Thanks a million for having me.
Well, Bengaluru-based agri-tech firm Cropin, in partnership with Google Cloud, has unveiled what it calls the world's first agentic AI platform for agriculture. Now, the promise is that AI won't just analyze farm data, but it'll also autonomously help farmers, food companies, banks, and governments make real-time decisions. But can it deliver these kind of outcomes at scale, and what are the limitations? Let's discuss this with Cropin's founder and CEO, Krishna Kumar. Krishna, always a pleasure to have you here on Startup Street. You know, beyond the buzzword, how is this Orbit AI that you've announced fundamentally different from a chatbot or traditional AI assistant? what kind of decisions can it actually make autonomously?
This is trained on, billions of acres, almost like 30 season data, which is spans across 15 years, 103 countries, 400 crops, 10,000 varieties of these crops. So this is not about how big is the model, frontier models, what you are using. It's all about, how does it can answer very, very personal, like a personal assistant when a grower goes into a farm and asks the question, tell me all the risks in next 7 days, or what disease can hit my farm, or I'm planning irrigation, how is my crop stress from the water point of view. So it answers very, very personalized looking at your farm. It brings all the data, whether it's a geospatial data, climate data, crop knowledge graph, and it starts speaking his language. Think of every farmer on this planet can have his own agronomist or assistant who is helping him to become a better farmer, right? So this is it has learned from the intersection of crop, climate, and geospatial data. And then there are models within the Frontier Lab models, which is very specific to the crop stages, disease, yield, which is, the agents are calling those models running in runtime and giving you those insights back in your local language.
Well, your platform is making recommendations that can affect crop yields, procurement decision, and potentially millions of dollars in supply chains. So, what happens if the AI gets it wrong because of, say, an unexpected weather event or flawed data? Who's accountable then, and how do you validate the accuracy of these recommendations?
I think that's where the training comes in handy, right? So it understands the crop, it can't go wrong. So, for example, if there is a climate risk of a heat wave or heavy rainfall, it predicts. Then it also conveys the message that there could be a chance of this, frost attack or heavy rainfall, and your crop is in this stage, and these are the action you should be taking, right? But there is a chance also that those are forecast. It may not also happen. So I don't think it will go wrong, which will, there will be economic impact to the farmer, but it will keep him abreast about all the risks approaching his farm.
Also, Krishna, why Google? I mean, Google Cloud is powering the infrastructure. Why them over other hyperscalers? And is this partnership meant to be exclusive?
Yeah, so, Google is also our investor. We are also on AWS infrastructure. But I think it's not about the models. As I mentioned, we have an MCP architecture, so you can link with DeepSeek or Servam or, Mistral, which could be open source, right? So we're starting with the Gemini as a frontier model, but then it has been tested on all others models as well, and we plan to bring them to life as we move ahead in this journey.
The announcement talks about everyone, from small farmers in Karnataka to sourcing managers in London and whatnot. Realistically, who is your primary customer today for this? Is it first and foremost an enterprise SaaS product, or will small farmers also meaningfully benefit?
Croply started as a B2B company, right? So our primary customers was food and agriculture companies, right? Whether it's enterprises or food processing companies. And we have learned in last 15 years about crop, climate, all those, how does it impact, these climate, how does the crop get impacted through the climate or disease, right? So those learning has been there. And it was only going to the farmers which are attached to those organizations, who are servicing those organizations. But the idea was can we roll it out for retail users like Claude, right? So Claude is also for enterprise, but also for individual developers who can sign up and, do their job better. And, on a similar line, we felt, can we release this for any researcher, any grower, any employee of any company can individually also sign up and make his job better, right? So asking the right questions about his farms, his crop, his location, whether he's an underwriter who's trying to underwrite a loan to a grower, or a grower himself wants to find out when should he plan his sowing, or what disease can impact his farm, what is the economic loss he can get into. So idea is to now broaden the scope and also give it to anyone on the planet who is interacting with the food and agriculture, whether it's an individual or a corporate, can take advantage of this.
Well, Krishna, let me finally ask you, India has been pushing digital public infrastructure in agriculture through things like AgriStack. Do you see your platform integrating with public digital infrastructure, or do you remain focused very much on private enterprise deployments?
No, it's very well in a sweet spot to talk to the, agri-stack, because once you have this public infrastructure on, and any farmer who has got a plot and the crop information, it can layer the intelligence, which will be very actionable for the growers themselves, right? So there is a plan to partnership with the government. I think government with the agri-stack wants to finally achieve, this stage, right? What we have built for the Orbit AI, which can seamlessly plug in on the agri-stack. So, that has been kept in mind. This is basically a model which has learned from, thousands of, I'll say billions of acres from 103 countries on different crops and varieties. And that knowledge is getting distilled, right? So this is very different than you asking a question on a chat GPT or Claude, which can give you answer based on what is there on the internet or whatever it is reading through the materials, right? Here, it is going to talk about next 6 months, how that your farm asset is going to behave in tomorrow or next 3 months or next 6 months.
All right, Krishna, we'll leave it at that. Thank you so much for joining us here today on Startup Street. Always a pleasure to have you here.
Well, with that, it's time for us to head into a short break. But coming up, Avni Wellness adds 4 crore rupees to its kitty and eyes a 15 crore rupee follow-on round. We put the founder on the hot seat to decode the fundraise and the capital allocation plan. Stay tuned. Welcome back to Startup Street. Science-backed women's health brand Avni Wellness has raised 4 crore rupees from investors, including Dr. A. Velumani, and is already planning a 15 crore rupee follow-on round as it builds an integrated women's health platform. To tell us more, joining me now is Sujata Pawar, the founder of Avni Wellness. Sujata, welcome to Startup Street. Now, women's health in India has traditionally been viewed through the lens of menstrual hygiene. You're betting that the next opportunity lies in a much broader life cycle approach, from nutrition and hormonal health to menopause, and what's driving the shift in consumer behavior. Tell us, where do you see the biggest white space in women's healthcare today?
Yes. Thank you, Shruti. I think the lens has not essentially changed. What has changed is who is viewing from the lens and who is solving for those problems. For a pretty long time, actually, women's health was almost synonymous to periods and sanitary pads. But what we see today is women are asking deeper questions. Questions like, how much plastic is really there in my pad? Why am I constantly tired even after sleeping for so long? This is the biggest shift. I feel women are no longer asking, how do I treat a symptom or a problem? They're essentially asking, how do I stay healthy? How can I live a fuller life? And this drive is a combination of, I think, greater awareness, better access to information. Women today are connecting the dots between nutrition, hormones, gut health, and their menstrual cycle.
Yes.
Biggest white space I feel is solving for different life stages from the first period to menopause, and this is exactly where we come into picture. For us, menstruation is not just a destination; it is a visible indicator of a woman's overall health, and we need to solve it with science-backed and safe solutions.
Absolutely, Sujata. And you've, like I mentioned, you've just raised 4 crore rupees from investors, including Dr. A. Velumani. You're already planning to raise another 15 crore rupees within the next year. What milestones are you targeting before the next round, and how will this capital accelerate the business?
The biggest milestone that we are looking at is expanding the portfolio. We have essentially set up our menstrual care and the incontinence care portfolio. We want to widely expand the nutrition and hormonal wellness portfolio.
Okay.
At least introducing 13 to 15 products in the coming couple of years. That is the biggest milestone which we want to achieve. And while we do this, we want to build an army of 10,000 women micro entrepreneurs, which will help us take these products broader India.
Speaking of products, one of your products is India's first patented antimicrobial reusable sanitary pad. And while another focuses on liposomal iron supplementation to tackle iron deficiency, help us understand your innovation strategy.
We've kept it simple. We think about it, what problem is the woman still living with? Because she is made to be believed that it is normal. What is the problem that she's still living with just because she believes it is normal? So because of our helpline number, we actually spend a lot of time listening to customers, and some of essentially come from those conversations. A classic example is our patented product, the pad that you said, the period panties. 60% of India is still comfortable using cloth. They just wanted advanced and modern solutions that would prevent them from infections and so do not compromise on the comfort and the performance.
Yes. And yes, go ahead.
Similarly, when we launched this product during our conversations, the iron deficiency range came up where a mother of 11-year-old was very concerned about her daughter losing a lot of period blood. She was more concerned about what about the iron levels? If she's going to lose so much blood, what do I do about it? I don't know. So that is where what about launching the iron range? It's really simple, nothing that's trending. Simple solutions, meaningful solutions to genuinely improve the quality of the life.
Sure. Sujata, let's talk numbers now. What is your current revenue run rate? Which categories are growing the fastest today? And, menstrual hygiene, nutrition, PCOS, or hormonal wellness? And when do you expect the business to achieve sustainable profitability at scale?
So we are tracking at a 15 crore ARR right now, and plan to achieve profitability by the mid next year, March or April in the next year.
All right.
So that is pretty much in place. The fastest growing categories definitely are the nutrition and the hormonal wellness range that we are getting into. Small range just started, but it's definitely at the cusp of becoming something really big.
Okay. So Jata, around 75% of your revenues currently come from digital channels, but you're also building, like you mentioned earlier, a network of 10,000 women micro entrepreneurs across Bharat. How important will offline community-led distribution be in driving the next phase of growth?
So digital has been an incredible growth engine for us. It has helped us reach to crores of women now. But women's health in India, at least, is still surrounded by a lot of stigma. And we need women as our trusted health ambassadors to reach out to communities, share their own experiences, and help other women make informed choices.
Okay.
This network of women, or this army of women, is just not about offline versus online. Creating economic opportunities for women while expanding the access.
Absolutely. Yes. One final question. The femtech sector globally has attracted significant investor attention, but in India, the category is still relatively early. Do you think investors now understand women's health as a large standalone opportunity? And how big do you believe the Indian market can become over the next decade?
Well, this is half of the population that we are talking about. So from where I see it, women's health is what diabetes was, say, 20 years back, underdiagnosed, underserved, and at the becoming something really big. Why see in the next 5 years? Of course, the feminine hygiene market is there, but we then add to it the iron deficiency management, hormonal health, menopause, everything added together. It is comfortably going to exceed some 1 lakh crore in market cap.
All right. On that note, it's time for me to wrap up our conversation. Many thanks, Sujata, for joining us on Startup Street, and wish you the very best.
Thank you.
Well, moving on, private equity in India is sitting on record dry powder, and TVS Capital, one of the country's largest funds, is putting its money where the action is, from digital lending to AI infrastructure. My colleague Rachna Dhanrajani caught up with Gopal Srinivasan and Shyam Srinivasan of TVS Capital to find out more.
If I can be that dampener from the private equity who keeps harassing the investee companies about singing the song of governance endlessly. I think they have a lot of things going for them: energy, enthusiasm, capital, business ideas, use of technology. But probably where they are yet not sufficiently ready is to stand the scrutiny of great governance. Once you're listed, you have extreme demands on you, right? That's the missing gap, if you will. So slightly balded heads like me have the opportunity to go out and tell them the story. This is how it can be done. This is how it was done. Not necessarily the past is the best example, but I think it's useful to be instructive to give them some kind of dimension around how governance can be. So I think that's the big thing, particularly for those who are rushing to list.
What we realized is India is at the crossroads of two important phenomena. One is people like us. Rupee capital is surging. We're able to raise a fund of 4,000 to 5,000 crores, only 100% rupee capital, impossible in the past. Second is innovation is beginning to open up big time. The Prime Minister is committed to it. The RDI fund with 1 lakh crore is committed. We have Chris Gopalakrishnan here today. And what we realized is that between technology and manufacturing, there's going to be this amazing intersection where you need a very strong precision, deep tech manufacturing infrastructure, whether it's in chemicals or defense or aerospace. So that's a new area we've taken up, the intersection of technology and manufacturing. And we're really, it looks very, very promising to us. So that's, and TVS, as you know, as a group, has a very deep history in manufacturing. So we have a lot of what I call a silver-haired bench of people ready to come and help these companies scale and do a great job on quality.
Well, with that, it's a wrap on this edition of Startup Street. More news and updates coming up on the other side. Stay tuned.
Welcome to a very special Indianomics. My guest is economist and equity expert Neelkant Mishra, who has just been appointed Executive Director to the World Bank. Neelkant, of course, has been our go-to expert to connect the dots between markets and macros. He is very much a private sector professional, currently, of course, still with Axis Bank, and before that in Credit Suisse. But he has also been very active in policy making. He has been member of the Prime Minister's Economic Advisory Council and also currently part-time chairman of the UIDAI. Neelkant, thank you very much. We are very proud that this is your first media interaction after the appointment announcement.
Thank you.
Though I guess you're taking over next week only.
Yes.
Okay. So still with Axis. And therefore, I will stick to the questions you will answer because of your Axis role. First, let's get through with the earnings season. We've got about 4 or 5 important results. What is the sense you're getting? Is it going to be better than expected? Is it going to be double-digit earnings growth?
Double-digit should happen because there's been significant rupee depreciation. Quite a few of the firms benefit from that. There is significant revival in credit growth. So at least our expectation is that the banks we cover should be showing 12% plus earnings growth.
If Indian Bank is an example, then it should be very good.
Yes. So credit growth is fine. There's some NIM compression, but otherwise, again, no reason to have high provisions. There are some sectors where there would be margin pressure because input prices did go up, and I don't think the companies had the clarity, and very rightly so, for taking prices up in the end market. And therefore, there is some. So while volume growth in autos, for example, was very strong, there is also a fear of margin compression. So, but I do think that double-digit earnings growth in the quarter should be possible. But in market, right? I mean, if from the market's perspective, June quarter is priced in.
Quarter is priced. No, that is true. But what about from the FII perspective? That is the more important worry for us, not so much domestic investors who have kept the faith. The outflow has clearly stopped, but is there a growth magnet?
So more than the reported earnings growth, I think what FIIs will respond to is earnings revisions. See, because markets will always be forward-looking. I mean, it's not that the fund manager has suddenly changed his stripes. So, so I do think that the 1% plus earnings cuts that we saw in April and May each should slow down. So June was slightly better. We still had some cuts, but very minor. And with these results, I expect to start seeing some upward revisions as well. But frankly, we don't need that. In fact, the fact that in the month of June, I don't remember which particular day, but on a 30-day period, there was significant outperformance of the Indian market. And almost all of it came from the growth in forward earnings. So if we stop seeing cuts, then the forward earnings start looking much better. FII's inflow, though, I think we should not anticipate for a while. See, the world, and you're seeing that, even when the ceasefire happened, there was apprehension that all of us had that this looks very shaky. And there are too many moving parts on all sides, and therefore it can break. And with that kind of uncertainty, you must have seen the dollar index is shot up. Yes. And the yields in the US are moving around unexpectedly.
Yeah, 4.6 also.
Yeah. So so in this environment, it is very hard for someone to choose emerging markets as an asset class. And especially as I think most people realize that the boom that is happening in Korea, in Taiwan, which has led to the outperformance of the EM basket, is also deeply cyclical in its nature. So by nature. So so I think EMs as an asset class may not see much of inflow. India's steady reduction in weights in the benchmark should stall now. Maybe we start seeing some upturn, but I'm not banking on a significant inflow from FIs.
Okay, I'll come back to the FPI question later, but the more important flows that we are expecting are FCNR. Now, every now and then we get some news, UAE is doing this, Britain is doing this, but is the 50 billion guess of the market something you'll back?
I think so. I think there is a possibility it can be significantly more.
There are some who are betting on 80.
Yeah, we are among them.
Okay.
But see, a lot will happen closer to the date. So if you think about it from the saver's perspective also, you would want to see where the yields are, what are the options. I mean, why would you commit to a certain return even before you see where the markets are, right? So even like say, own personal investment, if you have liquidity, you would say, oh, what, I think the market to correct. And if the market corrects a lot, maybe I'll put the money in there. So that means that all parties, not just the savers, but the banks, the global banks who have to provide leverage, the regulators who can, fine-tune the offerings by giving some clarity or removing some clarity or reducing. So there is a calibration possible. There is clearly from what we see in the initial demand that the demand the inflow can actually be significantly higher if we want it to be. But for now, I think 50 billion seems to be a safe number to work with.
No, I would admit, I think many banks are also believing that September would be the big flow time, or maybe late August. What about, let me come to the earnings season before I get angry mails that you're not asking about markets. First, IT sector. We've got TCS and L&T or LTM already. What is your sense? Do you think IT is going to be the dog in the house, or do you think you're going to see AI earnings? Just how will you invest in that space?
So our team put out, so we have had a coverage transition. The new analyst has put out a very deeply researched note on what really is the role that IT services firms play, and how much is the disruption that these large language models can bring about. And so the conclusion that he has, which I broadly agree with, is that there needs to be a significant transition in how these firms work. But at the same time, this is not the death knell for Indian IT. Having said that, I must say that from a PE multiple perspective, I don't think the uncertainty is going away. See, when you talk to people who are experts, so like just this weekend, I was spending time with my college buddies, 4 of them, and as you know, my formal training is computer science.
Yes.
They're all very successful tech entrepreneurs, all of them deeply involved in AI. And so some of the changes that have happened, like so December, January onward, some of the models that started coming up on code generation have improved dramatically. So it is very hard for anyone to have a very firm view on what are the things that AI can actually take over. So this does not mean that that IT services firms don't have a role to play. You look at Microsoft and all of these tech firms saying we will have FDEs, like the forward deployed engineers. What is FDE? It's IT services.
Yeah.
So, and if Microsoft is putting through FDEs, IT services firms can put up much, equally qualified and maybe a lot cheaper FDEs as well. So there is an opportunity, there is a business. My concern is that from a market perspective, the PE multiples, for someone to go and bet on a trend, you either need very low PEs where you say, okay, this prices in all the uncertainty, or you say that, look, let me wait for clarity. So, and I'm afraid the PE multiples are not low enough. Okay. So there could be volatility around earnings. So people may get excited that, you know what, the damage is not that serious, which frankly is true. Even in the month of April, there was 15% plus growth in IT services exports in dollar terms. Yes. A lot of it from GCCs, of course. May it fell to 3%, but after 7-8 months, generally there is a month where it is weak, so there is nothing much to worry about. So I think that services exports are still continuing. The concern for IT services firms, from the market perspective, is what business model, who will evolve first, and all of these uncertainties are reflected in the low price to earnings multiple. Okay. So, so that PE multiple revival, I think, will take longer.
Okay, so price is the uncertainty, not really business survival. Yeah. Which sectors should investors bet on now? I mean, again, there is a price which has made defense and some power expensive. But otherwise, which are the sectors that now look that can pull in the indexes up?
See, when you are looking at market positioning and your time horizons is at 3 to 12 months, you have to be less fundamental and a lot more tactical. Okay. Meaning that you know what, consumers look beaten down. Any point, say 3 months, 6 months later, you could see, I would say 6 months later, some serious chatter about the pay commission coming up.
No, but consumers do look beaten up. If you looked at Marico's guidance, it looks far more convincing than the P's we are giving to some of the...
exactly. And the fact that, there is people started talking about pay commission, I think, way too early. Okay. But once the clarity emerges on, how this is going to play out, and around this time, you also see a significant improvement in the real estate market. Because if you visualize a very large set of people with fixed salaries and pensions who suddenly see a significant bump up, what are you going to spend on? Yeah. So you're going to spend on housing, you're going to spend on cars, you're going to spend on maybe not clothing, right? Because clothing and food, etc., are generally established, or maybe schooling. So this drives a pickup in momentum, and so these are the sectors that, as of now, both real estate and consumption look fairly beaten down to me. But that's more a 12-month view. From a tactical perspective, maybe even IT can rebound, given further, given that everyone is sitting negative. Okay. So even a minor positive development can actually drive a flare-up.
Okay, let me ask a key question and then come back to, because there are other sectors I want to speak with you. Where are you on this, since you speak to policymakers on this, where are you on this entire debate of taxing debt versus equity? I mean, my sense is that debt has been treated too much like a stepchild with, slab rates, and equity gets a far better treatment. Is there an argument to bridge, to bring it somewhat closer? Because equities attract, people are investing in equities without any other thought, what age you are, what is your risk appetite, nothing. It is only the taxation which seems to be guiding. And it is also leading to overvalued equities, foreign companies like Hyundai or Whirlpool or Prudential wanting to sell out. So is there a case to bring the taxes closer?
First, I don't think the outperformance of equities or the fact that even 2.5, 3 years back, I went on record saying that Indian equities seem to be considered safer by the market than even G-Secs. And that observation is still to some extent true. While P multiples have come off and equity risk premium have gone up, I would say that can still be said. But I'm not sure it's all tax.
Okay.
Because it's about the plumbing. So given that the SIPs and the mutual funds have actually done an excellent job, and there's some serendipity, just confluence of positive developments like post demonetization. Everyone wanted to put money, they put in money, and then monetary conditions were too tight, so economy was slowing, and then post COVID there was a massive rebound and everyone made money. There's a good feedback.
Yeah.
The same treatment on the bond side has not happened. Now, is it all because of tax? I'm not so sure. Should coupons be taxed at marginal rates? I think those are deeper questions. But again, the underlying concern that people seem to have, which I think is totally misplaced, that because interest is charged or taxed at or deposit at the slab rates, that's why banks are not getting deposits. It's like, I think that's totally wrong, and it's conceptually wrong. Because deposits in the system are a macro variable. It is money in the system. Now,
it is the cost at which it comes.
Yeah. So
and you are chasing deposits because it's not the most attractive.
No. So do the banks, given that we just discussed that credit growth is picking up and profit growth is picking up, provision levels are low, everyone is sitting on a lot of Tier 1 capital. So is the objective to boost bank earnings or bank EPS, which maybe there is merit in thinking like that, but it is not about that, deposit growth is only 12% and credit growth is 17%. And so if you do that, deposit growth will pick up. That's the point I'm trying to address.
Fair enough. Okay, I want to belabor that point a little more, Neelkant, but for the moment, we have to take a break. But after the break, some very important questions on both this taxation, the India growth story, and Neelkant's role in the World Bank, which he will take over shortly. Welcome back to the Special Indianomics. I have been speaking with the Executive Director Designate to the World Bank, Neelkant Mishra. Thank you very much, Neelkant, for staying on. Well, before going to the break, we were talking about this unequal capital gains tax on equity. So your sense is that going forward, you're not expecting those taxes to change?
It's the government's prerogative.
Yeah, but if you were to advise, you wouldn't?
Given that some of these major changes were made only 2-3 years back, see, the worst recommendation would be for policy to become volatile. So you have to give predictability, because the policy uncertainty also has very negative effects on the economy and investor behavior. So the taxes are at a certain level, let them stay at a certain level, you see the pattern for a couple of years, and then you go and change. Because the moment you change, I'm sure there will be some other part which gets disrupted, and then you want to go and change again. So this, I think the current system is has been reasonably well thought through.
And therefore should be given.
There can be given some room to play, and then go and revise it as a policy. But the question of whether coupons are the same as fixed deposits or interest on fixed deposits is a much deeper and fundamental question. Are bonds the same as debt? Is a fundamental question which I think perhaps needs to be debated a bit more. But that's the only point where maybe
that's a more minor issue. I would assume that going by the positive response to the tax, removing the taxes on withholding and capital gains for debt investors, the same would come for equities. Is that a good assumption?
No, that's not a good assumption. On the debt side, there is strong precedence. that in order to support index inclusion, even countries like China have actually given exemptions. So that the funds that come through India, because see, for the country, this is really cheap capital. Yes. So one of the concerns and one of the reasons we are having to issue FCNR and sort of explore how to, because our balance sheet is strong, but there is some liquidity stress and we are trying to counter that. The whole reason for that is that a reasonable part of our current account was financed by capital which is very costly. So if a private equity fund brings in $1 billion and then compounds at 15%, most people say it's not, and 10 years later takes out, say, $4 billion, that's a lot of outflow. Yes. And whereas if you get money through the bond funds, there is a 7% flow and it's reasonably sticky. So if we can somehow encourage that to happen, and index inclusion, and we do the necessary stuff, which I think seems to be happening in terms of having much more efficient clearing, having better technology and all that. So all of those things are starting to fall in place. And so if that index inclusion happens, there is a significant flow that can happen. From an FPI equity perspective, does that mean that a significant amount of new money will come in? As I was saying earlier, I don't think it is tax driven.
Yeah, what equity investors look for are very, very different. Yes. Let me come to the growth story, therefore. Even when earnings were not doing well, like in 24 and 25, we saw GDP growth doing well. How are you looking at the current year? The RBI is standing at 6.7. Most estimates in the street are with the 6 handle. I am at the 7 handle. Where are you?
I would be higher than that. So our full year forecast was 7.5. When we noticed that because then this war was going on and on and on, and we waited that, okay, it's going to end, and didn't. We said that, look, let's assume a higher price of oil, $85, $90, and then that means that there is a drag on growth. Let's assume that this skirmish ends again and the oil prices start averaging 70 again. There's no reason from a 12-month forward perspective that we shouldn't be at 7.5% growth. Okay. Look, the momentum going into the war, which we have discussed on your show earlier as well, was extremely strong. So cement volumes are doing well. I mean, can you believe, while I understand GST cuts are not in the base, but 25-30% growth in car sales. See, as much as just the car sales and the production itself will be a big boost. What is important is to understand the people who are buying it. Yeah. They must be seeing significant growth in revenue to be committing to a large capital purchase. The cement volume growth. So all of these things point to a very robust economy. I mean, 18% credit growth is not coming from the supply, right? So
it's coming from the appetite to grow.
Yes. So people are wanting to borrow, which means very significant risk appetite. So all of these are very important cyclical indicators. Here, I'm quite confident that once this oil prices normalize, we are staring at a 7.5% growth, not 6.5.
Okay. Oh, no, I would definitely agree with you. Even exports did well.
Yes.
May and June. April and May, 16% growth.
People say that, I can't see the growth. I said, boss, have you seen that services exports incrementally are now 1/4 of GDP growth?
That's true.
So services, no one seems to look at it. Look at the commercial real estate leasing activity.
Fair enough. No, you're convincing the convinced on this issue. Now, finally, your new role. I believe you're taking over on 20th July at Washington. What do you see is the role?
First is that there is the board position. So India is a meaningful shareholder of the World Bank, and the executive director represents. Of course, I represent 3 other constituent countries as well. So the interests of all those 4 countries. And this is not just in the big loan decisions that come to the board, but also the policy direction. The World Bank is also changing policy. It's reorganizing. It has 5 different parts. There is much So the new president is bringing about a lot of change in how the bank operates. So that is that role. There is a second role that I see in channeling the World Bank's expertise in working across the world in low-income and middle-income countries in terms of the work it did with China, say, on urbanization, the work it has done. For example, say, some of our eastern states have per capita incomes like low-income countries. And so and they also have weak state capacity. Are there lessons that we have learned from other countries where, and so these experts, if they come in, they can be a supplementing of state capacity in some of these states. So that's, I think, also a very, I mean, at least for now, these are the things that I think are going to be important.
Okay, we will look forward. Also, that you will be able to bring a different perspective when you're working out of Washington and looking into India than looking out. Really looking forward to speaking to you after you take over as well. Thank you very much for spending time with us, and all the very best in your new position.
Thank you for having me.
That's it on this special edition of Indianomics. Thank you very much for watching.
Hello and welcome to IPO KYC. This is a special one. Rima and I are here at the offices of SBI Funds Management, the company behind what all of us know as SBI Mutual Fund. I think needs little by way of introduction, and we're sitting right here at the heart of the offices, a lot of hustle bustle around it. It's a special time. SBI Funds is going the public way. It's a formidable entity, the largest asset management company in the country, 30 lakh crores in terms of assets, 6 lakh crores in terms of equity assets, 3,000 crores in net profits, the last reported number that we have, and it's going to list pretty soon. So we're going to ask the trajectory, the roadmap, and what does it mean for you and me as investors into SBI Funds Management. We've all, of course, had SIPs running with the SBI Mutual Fund. Now, of course, you can be an investor in the company too. And to discuss all of this, we have Mr. D.P. Singh. He's Joint Managing Director and Deputy CEO of the company. Srinivas Jain is Executive Vice President at the company as well. Gentlemen, thank you very much, both of you.
Thank you.
Appreciate it. So between the both of you, it's about 50 years